Hello everyone, this is CA Isha Agarwal, your friend, mentor and guide for the subject Audit, and I'm here to make the subject easy for you with fun things and in less timings. So first of all, I hope you people are doing absolutely well, and this particular video is going to be for the CMA Inter aspirants appearing for December 24. So basically there are just 1 to 2 months left for your examination, and all we need during this time are lots and lots of revision videos, because we have studied every chapter in detail, and now it's time to crunch down those chapters in the minimum time and still doing it very effectively and efficiently. So this video is going to be a CMA Inter marathon for the subject Audit. Audit comes under paper 10 of corporate accounting and auditing, wherein both the subjects come for 50 marks. So we will be completing Audit particularly for this marathon or in this marathon, and I hope after this marathon you people feel very confident, at least for the subject Audit. A few important points before we dive into the marathon, so that even you know what to expect from this video and what are the advantages of attending these marathons. So first thing, it is going to be an all English marathon. So you must be noticing that from the time the video has started, I have been speaking only in English. So there are a lot of students who are not comfortable in any regional or colloquial language. So this video is going to be an all English marathon. Not to worry, Hindi folks, a English marathon will be coming up soon. So the Hindi people or the ones who are comfortable in Hindi can watch that marathon, and the ones who are comfortable in English, this marathon is particularly for you people. Next, what would I get in this marathon? So this marathon would involve hardcore revision of every chapter of Audit, and also important and probable Q&A discussion. We will be dealing only with the descriptive Q&A and not MCQs. For MCQs, there will be a separate video, because I particularly feel that MCQs are a marks grabber in theory exams especially. So MCQs, we won't be just restricting to the important and probable ones, and would be doing all the MCQs that have appeared or that have been given by institute till now. So for MCQs, you can refer another separate video, and in this marathon you will get, along with the revision, all the important descriptive questions that have come yet or are probable or can appear in your examination. Third, would this marathon involve 100% coverage? Absolutely yes, there would be 100% coverage. Each topic, each chapter would be covered, so not to worry that whether there would be any topic or there would be any particular section that would be skipped. Not to worry about that. Everything from start to end will be covered. Fourth is a subscription course. So there might be a lot of students who haven't touched the subject Audit till now and won't be very comfortable directly watching the marathon. So for them, we have launched a subscription course, wherein at just 1,999 they can watch the entire subject Audit and have a detailed overview for 30 days. In just 30 days, you will be able to complete the entire subject, along with hardcore Q&A sessions, MCQ sessions, and in-depth and detailed view of the entire chapter. So not to worry, if you are not comfortable directly moving on to the marathons or the revision, you can buy a subscription course. You can check out the subscription course under the CMA exclusive section of our website. The link of the website will be given in the description box, so you can check that out. Fifth, so a lot of students have this confusion that whether all the documents that will be referred in the marathon will be provided to me or not. So all the documents that would be referred in this marathon, be it revision notes or be it Q&A, will be provided to you in the e-form or electronic form, and will be available to you through a link given in the description box. You can check out this link, and if you feel that you won't be able to watch the entire revision video, or you won't have the time to watch the entire revision video, you can still refer that PDFs, and if you want, you can refer those PDF just before the examination also, so as to ensure that in the minimum time you can complete the subject Audit. Now, these were the important points which I felt. Apart from that, in case you have any queries, so you can comment down below and ask us about the same. But I feel that's it. Now, straight away, let's go on to the main topic of this video, that is our marathon and revision. Before diving into the actual marathon, just let's discuss the syllabus one, so that you know what are to be covered in Audit. So there are primarily 3 chapters that need to be covered for the subject Audit. First is provisions under Companies Act. Next is audit of different kinds of undertakings, and third is basics of auditing. You can see the marks distribution available on the screen, and as per the marks distribution, you can easily guess that the most important chapter is Provisions under Companies Act. It accounts for 30 marks out of 50, that is nearly 60% of 50 marks. So obviously this chapter is a must do, and as we do in the class, we will target this chapter first and then the other two chapters. Apart from that, Provisions under Companies Act and Basics of Auditing are a bit lengthy chapters, so I have subdivided them into sub chapters. Not to worry, yet again there would be 100% coverage. In case of subdivision, there has not been any topic that has been missed, so you do not need to take tension on your part. The sub chapters or the subdivision is just to ensure that the child or the student doesn't feel bored and does not think that they have to cover so much for such a small chapter, or for just 30 marks or for just 10 marks. So the subdivision is has been done so as to ensure that you enjoy the subject and you don't take the burden of the subject and you feel okay, there are just light pages that I need to cover. So that is it regarding the syllabus. Now let's start with the marathon. First we'll be doing company audit, then audit of different kinds of undertaking, and then basics of auditing. For the start, we will go with company audit subchapter 1, then Q&A, then company audit subchapter 2, then Q&A. That will be followed by subchapter 3, subchapter 4, and then the rest of the chapters. Company audit subchapter 1 is a bit on the lengthy side. Subchapter 2 is very small, like that would cover or take us hardly 10 to 15 minutes. Company audit subchapter 3 is yet again on the lengthier side, and it is one of the most lengthiest chapter in your entire subject, so that would take us time. And subchapter 4 yet again is on the medium side, you can say, that won't take us much of the time. Then coming on to audit of different kinds of undertaking, which would take us probably like half an hour to 1 hour. And last comes basics of auditing, which in total, combining all the 4 sub chapters, which take us around 2.5 to 3 hours. So first, let's start, and as we progress in the video, you will understand. And in case of any queries, you can freely comment down below. We'll be happy to answer your queries. So, are we excited to start upon the most interesting marathon of this year? So first comes company audit subchapter 1. So this subchapter basically deals with statutory audit. It deals with the qualifications, disqualifications, rights, duties, appointment, removal, salary, and other provisions in relation to statutory audit. Apart from that, we also learn about joint audit, branch audit, and audit committee in this chapter. So this chapter's primary focus, or this chapter mainly revolves around statutory audit. But before beginning to understand what is statutory audit, first let's understand what is audit. So briefly describing the term audit, audit means verification of assets and liability so as to entrust the shareholders with the reliability of financial statements. So if you have ever dealt in share market or have been any shareholder of any company or have observed any shareholder, you must know that for shareholders, the only medium to assess the performance of a company is financial statements. So they want the only documentary evidence by which they are judging the company or by which they are relying upon the company should be true and fair. It should not be deceptive. They should not be scammed by this document, and hence an auditor is appointed to check that whether the financial statements on which the shareholders are relying are correct or not, are true and fair or not, are as per AS or NDS, whatever is applicable upon the company or not. So an auditor basically checks that the financial statements is actually giving the true and fair view and is actually showing what is happening in the company. So if there has been a sales of 200 rupees during the whole year, my financial statement should show a sales of 200 and not 190 or 210. So basically assessing that whether the financial statements are correct or not, and whether the shareholders can rely upon the financial statements or not. So auditors' duty are primarily 2 things. First, to assess the financial statements and provide a view or make a view upon the financial statements, and next is to provide the shareholders with his opinion through the audit report. So first, the auditor will assess the financial statements, then make a view upon the financial statements, and then address the shareholders and communicate them his or her opinion through the audit report. The main essence of audit is basically auditor's opinion, wherein he describes that whether the financial statements are reliable or not, and the shareholders make a judgment regarding the financial statement. As per the auditor, if the financial statements are reliable, the shareholders become relaxed and think that they can trust the financial statements of the company. Whereas if the situation is vice versa and the auditor disclaims that the financial statements of the company are not reliable, the shareholders restrict themselves from trusting the financial statements and do not invest more in that company. Now, what is statutory audit? So, statutory audit is basically derived from the word statutory, which means law or regulation. So, any audit that is mandated by law or regulation is known as statutory audit. Now, what is the title of the chapter? Provisions under Companies Act. So, currently we are reading Companies Act. We need to know the audit provisions of Companies Act. So the Companies Act says that every company, be it listed, unlisted, public, private, small, big, dormant, one person, or any kind of company that is incorporated under the Companies Act needs to get their book audited. So any company, irrespective of the size, irrespective of the nature, irrespective of the legality, needs to get its books audited. And hence, this compulsory audit is known as statutory audit. Why? Because the companies are required to get their books as mandated by law. And anything that is mandated by law or regulation is known as statutory. Hence, company audit is known as statutory audit. Apart from Companies Act, there are other acts also which mandate the audit of certain entities. In that case also, that audit or the audit mandated by law or regulation will be known as statutory audit. Now here, since we are reading Companies Act, we will say companies audit as statutory audit. Now, who can be a statutory auditor? Very important. Who can be a statutory auditor of a company in India? There are multiple companies in India and it is very important to know who can be the auditor of these companies. So, to become the auditor or to become the statutory auditor of a company, you need to certify or you need to basically ensure these three criteria. What are the criteria? First, you need to become a chartered accountant. Next, you need to obtain the membership from ICAI, that is, you must be a CA from India. And lastly, you must obtain COP, that is Certificate of Practicing. Summarizing the 3 points, you should be a CA practicing in India. You should be a CA practicing in India. But that is the condition for an individual. What are the conditions for firm and LLP? Can they also become the statutory auditors? Absolutely yes, they can become the statutory auditors. But for them to become the statutory auditors, there is one more condition that needs to be complied with. That is, most of their members or majority of their members should be CA practicing in India. So if I have a partnership firm or LLP that wants to become the statutory auditor of any company, at least 4 or more partners should be CA practicing in India. But even after becoming a CA practicing in India, a person can be disqualified from being the auditor of a company. Here are a few conditions. If the auditor fulfills that or falls under this criteria, the person won't be able to become the statutory auditor of the company. And what are the conditions or what are the criteria? First, employee of a company. So if you're an employee of a company, you can't become the auditor of a company. Next, employee's employee. So if you are an employee of any employee of that company, you are restricted to become the auditor of that company. Third, if you are a shareholder of the company, you cannot become the auditor of that company. Next, if your relative holds any share of face value more than 1 lakh in company, it's holding subsidiary, co-subsidiary and associate. Fourth, if you or your related party are indebted for more than 5 lakhs in company holding subsidiary, co-subsidiary and associate. Fifth, if you or your related party have given a guarantee of more than 1 lakh in the company holding subsidiary, co-subsidiary and associate. And seventh is that if you have any direct or indirect business relationship with the company holding subsidiary, co-subsidiary and associate. Apart from that, if you are a relative of the director or KMP of the company, you are restricted to become the statutory auditor of the company. Further, if you have been convicted and 10 years have not passed since your conviction, you are not qualified to become the auditor of the company. If you render any service under section 144, then also you are not allowed or not qualified to become the auditor of this company. Now, what is common under all these disqualifications? So, all these disqualifications have been brought in so that the maker and checker concept remains stagnant. That is, if the maker and checker concept is diluted, if the maker and checker becomes the same, there is a possibility that the financial statements may be manipulated and a lot of errors may be overlooked. Example, if I give you a test paper to write, and instead of checking it myself, I give you the authority to check it also. So it could be a possibility that you have made 10 mistakes, but since the maker and checker are same, you could only come up with 4 mistakes and the 6 mistakes got overlooked. So it is very important that the maker and checker of financial statements remain different, and hence these points of disqualifications were included, such as the employee of the company. So the employee of the company which itself is involved in making the financial statements, if he or she is given the authorization to audit the company, there is a possibility that there might be a lot of errors in the financial statement that may be overlooked. Next reason for these disqualification was unusual influence of the auditor. So it could be a possibility that if the auditor is a relative of director or KMP, they might exert an unusual influence on the auditor, which might restrict him to give the correct opinion on financial statements. So it could be that he has found that the financial statements are not giving a correct view or are not giving a true and fair view, but instead of being able to give his opinion on the financial statements, he is restricted by the director or KMP and might develop a familiarity thread and might leave the financial statements manipulated, and hence the purpose of audit won't be served. That is why the next reason for these disqualifications are to ensure that no unusual influence is exerted on the auditor. Apart from that, the points that I said, certain important things about them. First, the auditor cannot be a shareholder of the company. That is, he or she must not even hold one share of that company. The related party is allowed to hold shares, but not of more than 1 lakh face value. Two things to be noted here is that here face value is being talked about and not market value. And next, the value exceeds, or the value is more than 1 lakh in face value of the shares, that is up to 1 lakh or 1 lakh is permitted. It should not be more than face value 1 lakh. Further, if the auditor is appointed and if the related party is holding shares of more than face value 1 lakh, they still have the time to take corrective action, and within 60 days of appointment, within 60 days of appointment of the auditor, they can take corrective action and still the appointment of the auditor shall be valid. Apart from that, in case of indebtedness, even credit terms, credit worthiness, normal operating credit such as credit sales is also included. So indebtedness not only implies to the loans or any debentures or any particular kind of debt, it also refers to the operating debts, that is debts taken in the operating cycle of the company. Further, what are the activities included in section 144 that we will read while solving the Q&A. Apart from the disqualifications that I said to you, there are 2 more disqualifications that restrict a person from becoming the auditor in a company. First, that auditor should not be a part of the company, or that auditor should not be a company. That is, a company which itself is under the audit, which itself has to get its book conducted, cannot audit another company. So an individual, a firm and an LLP are permitted to conduct other companies' audit, but not another company. So either the statutory auditor should be an individual, or should be a part of firm, or should be part of an LLP, but he or she is not permitted to represent a company and then audit another company. So any body corporate other than LLP are disqualified from becoming the statutory auditor. And the last disqualification is one of the most important disqualification. So ICI restricts any statutory auditor to audit more than 20 companies at a point of time. ICI believes in the greed of money, statutory auditor might take up audits of more than 20 companies and in turn may not be able to get their work done properly, and there might be a lot of financial statements which still have the error and which still have the manipulation present. And therefore, to combat this problem or to solve this problem, ICI places a capping on the statutory auditor, that each statutory auditor cannot audit more than 20 companies at a point of time. So if any auditor which the company is thinking to appoint is already an auditor of 20 companies, he or she is disqualified to accept the appointment of any 21st company. But there are 4 exceptions to this 20 companies list. So if the auditor wants, the auditor can audit unlimited number of one-person company, small company, dormant company, private companies whose paid-up share capital is less than 100 crores. These 4 companies are not counted under the capping limit of 20 companies, and the auditor can audit unlimited number of these companies. Apart from these 4 kinds of companies, every company is counted under the 20 company capping list, and the auditor cannot audit more than 20 companies at a point of time. So these were the disqualification. Now once a person is eligible and is qualified and has surpassed all the disqualifications, the next step of a statutory auditor is appointment in a company. So when you talk about the appointment of a statutory auditor, there are 2 questions that needs to be asked. First, whether the auditor is a whether the auditor is a first auditor or a subsequent auditor, and next, whether the company is a government company or a non-government company. Now, what are these terms? So, very simple. Government company means that kind of company in which 51% or more paid up share capital is held by the central government or state government or partly by central and state government. That is, majority voting power is held by government. So any company where majority voting power or majority decision making has been held by government is known as government company. Apart from that, every other company is known as non-government company. Now, what is meant by first auditor and what is meant by subsequent auditor? So, the first auditor is one who comes first in the class, and subsequent auditor is the one who comes second in the class. Is it? No. So, first auditor is the one who takes part in the first audit of the company. So, as soon as the company is incorporated, the first audit that it gets conducted, or the first time it gets its books audited, the person who conducts that audit is known as first auditor. So as soon as the company has taken birth or the company is incorporated, the first time it gets its book audited, the person who conducts that audit is known as first auditor. Post that, every subsequent time the company gets its book audited is known as the person who does that is known as subsequent auditor. So there's a relevance of only first time the audit is done, and that person is known as first auditor. Post that, every second, third, fourth, fifth, sixth, seventh, 100, 200, 300, every auditor is known as subsequent auditor. So here you need to remember the definition of first auditor, because apart from them or apart from him or apart from her, every other auditor is subsequent auditor. Now coming to non-government company. So how is an auditor appointed in a non-government company? So let me tell you, the highest authority in a non-government company is BOD, Board of Directors. So in case of appointment of first auditor in a non-government company, the first decision or the first authority is given the BOD for 30 days. The BOD is allowed to find an auditor for 30 days. If within 30 days BOD fails to find an auditor and appoint an auditor, the next chance is given to the members, and they are given a chance for appointing the auditor. They are given a chance for 90 days for appointing the auditor. That is, first chance is given to the BOD for 30 days. If they fail to appoint the auditor, the next chance is given to the members or the shareholders for 90 days. And what is the tenure or what is the term of this first auditor? So the first auditor is usually for the first AGM in the company, that is for 1 year in the company. That is, he or she remains in the company for the first year or conclusion of first AGM. So the tenure of first auditor is 1 year, the first year of the company or conclusion of first AGM of the company. Next comes subsequent auditor. So how is the subsequent auditor appointed in a non-government company? So first of all, the BOD selects the subsequent auditor. Then he or she obtains a 4-point declaration from the auditor. And what are the 4 points of declaration? First, whether the appointment is as per act. Next, whether the person is not disqualified. Third, whether the appointment is within ceiling limit of 20 companies. And last, whether whatever legal proceedings are going against him has been disclosed by him to the company, and whatever has been disclosed is true and correct. After being satisfied with all these 4 points, the BOD presents the auditor to the shareholders. If the shareholders like the auditor is appointed. Post appointment, within 15 days, the company has to file ADT 1 with ROC, informing them about the appointment. So this form is to be filed by the company as soon as the subsequent auditor is appointed. What will be the term of this subsequent auditor, or basically how many years will will this auditor be in the company? For 5 years. So the tenure of the subsequent auditor is 5 years. They remain from the start of the AGM to the conclusion of 6th AGM, basically calculating 5 years. Now coming to a government company. Here the major appointing authority or the major authority is C&AG, Comptroller and Auditor General of India. So since in a government company the majority stake is held by a government, so they appoint a representative of there to take important decisions on the part of them for the company. So C&AG is a wing of government that takes care of the audit or accounts portions of government companies. C&AG's full form is Comptroller and Auditor General of India. So coming to the first auditor, in case of a government company, the first chance is obviously given to C&AG for appointing the auditor within 60 days. If they fail to do so, the next chance is given to BOD for appointing the auditor within 30 days. And even if they fail to do so, the next chance is given to the shareholders for appointing the auditor within 60 days. So the cycle is 60, 30, and 60. The first chance is given to C&AG for appointing within 60 days. If they fail to do so, then the BOD appoints within 30 days. And even if they fail to do so, the members are given a chance of 60 days. What will be the tenure of this first auditor? Same as non-government company, conclusion of first AGM, that is 1 year. In case of a subsequent auditor, in case of government company, no person other than C&AG is given the authority, and C&AG appoints the subsequent auditor within 180 days from the commencement of financial year. What will be the term of this subsequent auditor in a government company? So unlike a non-government company wherein the subsequent auditor's term is 5 years, herein the term of a subsequent auditor is also 1 year. So in case of a government company, be it the first auditor or the subsequent auditor, the term remains 1 year, whereas in case of a non-government company, the term of first auditor is 1 year and the term of subsequent auditor is 5 years. I hope I am clear till here. Now, let's suppose that a non-government company appointed an auditor, a subsequent auditor, for a term of 5 years, and post 2 years, the auditor met with an accident and is unable to continue. Now, obviously, a company cannot stay without the auditor. The company needs to get its book audited and needs an auditor. So this kind of situation is known as casual vacancy. When the auditor leaves the company midway due to any unforeseen circumstances, it is known that a casual vacancy is created in a company. Now, the casual vacancy obviously needs to be filled, but who fills this casual vacancy? So in case of a non-government company, this casual vacancy is to be filled by BOD within 30 days. Obviously, post that, within 3 months, an approval of shareholders is required, thereby ratifying the appointment of that particular auditor. In case of a government company, the casual vacancy is filled by C&AG within 30 days, and if they fail to do so, then the next chance is given to BOD for appointing the auditor within next 30 days. So here, primarily shareholders do not play an important part. Shareholders' role come in non-government company, that too for ratifying the approval. It is mainly the BOD and the C&AG that is the higher authorities that take decision in part of filling the casual vacancy. What will be the tenure of this person appointed via casual vacancy? So he or she will remain the auditor of the company till the conclusion of subsequent or upcoming AGM. So suppose for the 3rd year, our previous auditor or the auditor who was originally appointed met with an accident. Then the casual vacancy was created and the casual vacancy was filled and an auditor was brought in the 4th year. What will be the tenure of this auditor? Only for 1 year, that is conclusion of the upcoming AGM. Obviously, if the company wants, the company can reappoint this auditor, and not just this, but any previous auditor, first auditor, subsequent auditor, if the company wants, they can reappoint the auditors. Now, since the topic or the word of reappointment has come, what are the conditions for reappointment? So the 3 conditions of reappointment are very, very simple. So first, the auditor should not be disqualified. That is, the auditor should not have met any disqualification criteria. Next, the auditor should be willing, that is, he must not have given any notice of unwillingness. And third, the shareholders must be happy with the auditor, or the shareholders must be willing, that is, they have not passed any resolution for removal of this auditor or for particularly appointing the other auditors. So there are 3 conditions that needs to be followed for reappointment: auditor happy, shareholder happy, and auditor should be qualified. Now, we all work for one thing, that is money. So it is very important to know that who decides the salary of an auditor. So in case of first auditor, the salary is decided by BOD, and in case of subsequent auditor, the salary is decided in general meeting by the shareholders, be it government or non-government company. In any case, the salary is decided by BOD for first and the shareholders for second. Now, the auditor is appointed. What is the next step? So the next step is enforcing his or her duties. But before getting to know about the duties, we must know about the rights of a rights of a statutory auditor. That what are the rights, or what are the things that he or she can access. So rights, basically, each right will have a logic. We will understand the logic and then go on to remember the right. You will see that when you understand things logically, you retain it for better and for a longer time. So first duty of an auditor is to check the financial statements of the company. And what do you think? To check the financial statements of the company, what are the 2 basic rights that the auditor needs? First, he must have access to books of accounts, because obviously if I need to check the financial statements, I need to have the source book, and I need to check the source book, because if I need to find the errors, most of the errors would be found by me in the source book. So first thing is, he or she must have rights or access to books of accounts. Next thing is that he or she must have access to the information and explanation in relation to financial statements. So for suppose tomorrow I make you an audit paper. Tomorrow I make you an audit paper, and I check that paper, and maybe you get just 3 out of 10. Obviously, you'll come up to me and ask for either a solution or what are the points of mistake you have made. What if I refuse to give you that? The purpose of the test will be defeated. You won't be able to know ever that what are the mistakes that you made, or what are the mistakes that you should not be repeating, or what are the solutions to that questions. So similarly, if the auditor does not get access to information and explanation in relation to financial statements, the auditor ever in their life won't be able to check the financial statements. So as much as the financial statements are important, it is also important that the auditor has the right to access the supportings of the financial statements so as to verify the financial statements. So what are the first 2 rights of auditor? First thing, for checking the financial statements, he or she needs access to books of accounts. Next, he or she needs access to information and explanation in relation to financial statement. Now, what if the what if the company that the auditor is auditing has a branch or a holding or subsidiary or any associate? Even that need to be consolidated by the auditor for presenting the final financial statements of the company. So do you think merely the access to books of accounts of the company would be survivable? No. The auditor also needs access to books of accounts of the associates, the joint ventures, the subsidiaries, and even the branches, because ultimately it is the auditor who has to compile all the financial statements and present it to the shareholders. So not just the books of accounts of the company, the auditor also needs to have the right or access to the books of accounts of branches, holding, subsidiary, co-subsidiary, associate, and any other related companies of the main company. Next, the next right is that the most important duty which I said for the auditor was to express an opinion on financial statements and through the audit report. Now, what if instead of the auditor, someone else is signed the audit report? Would it help in achieving the objective of audit? Maybe not, because the person who is authorized to sign the audit report is not signing, but someone else, and the shareholders might not rely upon the audit report, and they might feel that the whole audit done by the auditor is wasted, or they cannot draw an opinion on the financial statements. So the third right which the auditor needs to have is only he and no one else can sign upon the audit report. That is right to sign the audit report. Where is the audit report read? At the AGM, annual general meeting. So the auditor should have all the rights to receive notices of AGM and also to attend AGM, and not just receive notices. So all the AGM that are being done in the tenure of audit, wherein the auditor is conducting the audit of the company, the auditor shall have right to attend all the AGMs and receive all the notices of the AGM. And lastly, be it a small or a big company, there are legal difficulties coming in the way of company every day. So it could be a possibility that even the auditor gets caught in those legal problems, or even the auditor falls into the trap of those legal cases and might have to compete against the company in the court even when he or she is innocent. So there's one more right that has been included, that is right to be indemnified. So in case there's a situation wherein the auditor is innocent and has to compete against the company in the court of law, the auditor has the right to be indemnified provided he is innocent and he is absolutely correct. So there are basically 5 rights that an auditor has. First, to check the financial statements, obviously he needs access to books of accounts. Just books of accounts of the company are not survivable. The books of accounts of branches, books of accounts of holding, books of accounts of subsidiary and other related companies are also needed. Apart from that, the auditor has the right to access the information and explanation of financial statements, because as much as financial statements are important, it is also important that the auditor has right to the documentary evidences to check those financial statements. Apart from that, no person other than auditor should sign the audit report, because it mistrusts the shareholders regarding the audit. So only the auditor has the right to sign audit report. Where is the audit report to be read? At the AGM. So the auditor should have the right to receive all the notices of AGM and also to attend AGM. Lastly, there might be many legal cases happening in the company, and even the auditor could be caught in one. So the auditor has the right to be indemnified in such cases, provided the auditor is innocent and the auditor is correct. So these were the rights. Now coming on to the duties. So there are 2 to 3 duties that we have already discussed. First thing, the auditor has to give an opinion upon the financial statements, that whether the financial statements are giving a true and fair view or not. Next, the auditor has to check whether the financial statements are as per AS or NDS, that is as per the financial reporting framework. Further, if the auditor gives a negative report or states that the financial statements are not reliable, the auditor also has to state the reason and state the paras and state the references. Why does he think that the financial statements are not reliable, and what is the reason for him giving negative report? Apart from that, there are 6 specific things that the auditor needs to check, because these 6 specific things are an indicator of fraud or manipulation. First thing that he needs to check, that whether investments are sold below purchase price, because as you know, investments are usually held for long-term purpose and for long-term capital appreciation. So the investments, if they are sold below purchase price, could be an indication of any manipulation or fraud. Next, whether the terms and conditions of the advances of the company are prejudicial or not, that is whether whatever money that has been lent by the company is on proper terms or not. It could be that the company has been lending money at 0 interest, which might not be very wrong for the company, but it could affect the shareholders since their money is being misused. So the company may go on to this manipulative measures, and this might waste shareholders money. Hence it is to be seen that whatever money is being lent by the company, the terms and condition of those lending are not prejudicial. Third, the loans should not be shown as deposits. So a lot of times the companies show the loans received or the money that they have taken as deposits, so that the shareholders feel that there is not much liability on the company, and there are not many monies that need to be returned to the public. So you need to make sure that all the loans that has been received by the companies are shown under loans only and not deposits. Apart from that, whatever transactions has been present in the books of the accounts should not be prejudicial or should not be just for the sake of window dressing. That is, whatever transaction are in the books of accounts should have actually happened, and there might not be any facade or any manipulative transaction in the books of accounts or any fake transaction in the books of accounts. Whatever the transaction are shown should be real and should have actually happened. Personal expenses are a no-no because it is the company that is using the shareholders money, or it is using the share capital and it is using the public's money. So there is a big no-no that the directors will have a chance to expend their personal expenses through the company's money. It is only the company's business expenses that must be undertaken from the shareholders money or from the business money. Lastly, if the company has allotted any shares during the year, the allotment entry should be properly made in the books of accounts. If the allotment of any person has failed or the money has been given back, the entry should be properly made, and all the monies that has been received against the allotment should be tallied upon the number of shares that has been issued. So these particular 6 things needs to be noticed by the auditors, and this is important, comes in exams. They ask you particularly that what are particular 6 things that needs to be checked by an auditor. Further, if the auditor comes across any fraud that is of more than 1 crore, he should immediately inform BOD or audit committee within 2 days. Wait for their reply for 45 days. If their reply comes, great. If their reply doesn't come, on expiry of the 45 days, give the report about the same to central government within 15 days from the 45 days in the form ADT4. Apart from that, that should be in the registered post acknowledged due, and should also have the letterhead of the auditor and should be signed by the auditor. Further, if the comments of BOD and audit committee have been received within 45 days, then that should also be attached while giving the form to the central government. In case the auditor comes across any fraud which is less than 1 crore, so in case of 1 crore or more, the duty that has been stated by me, that first the BOD or audit committee needs to be informed, then the central government needs to inform, that would be undertaken by the auditor. But if the fraud amount is less than 1 crore, then the procedure of informing the central government would be skipped. That is, the auditor would normally go and inform the BOD and audit committee about the same and wait for their reply and include the fraud description, nature, amount and parties involved in the board report. The part of informing the central government would be skipped. The part of informing central government would come in only if the fraud amount is 1 crore or more. What happens if the auditor skips the entire procedure and does not inform anybody? So if the auditor is doing the audit of a listed company, he would be penalized for 5 lakh, and if the auditor is doing audit of any other company, then he would be penalized for 1 lakh. Apart from all this, the auditor has certain reporting responsibilities also. So the auditor particularly has to report about these 10 things. And what are the 10 things? First, whether all the information and explanation has been received by him, that is, he has been helped for checking the financial statements. Next, whether proper books of accounts has been maintained by the company. So section 128 states that how the books of accounts should be maintained by a company. The auditor needs to check whether the proper books of accounts has been maintained or not. Third, whether the reports of the branch auditor has been received and whether the returns filed by the branch are received. That is, whatever the documents has been asked by him in relation to branch books and branches has been received and duly received on time. Fourth, whether the company's balance sheet and PL are in agreement with the books of accounts. If the books of accounts are saying that I have made a sales of 100 this year, even my P&L should show a sales of 100 and not 110. That is, my books of accounts should tally with my profit and loss and balance sheet. Further, the financial statement should comply with AS or Ind AS, whatever is applicable to the company. Sixth, if the auditor gets to know about any observation or comments that can affect the adverse functioning of the company, that is, that can affect the going concern of the company, or that can affect the operating nature of the company, or that can affect the business of the company, the auditor should state that. the auditor should check whether all the directors of the company are not disqualified, are qualified, have followed all the relevant sections, and do not undertake or do not fall into any criteria of disqualification. Further, if the auditor has any adverse remarks regarding the accounts of the company, so that also needs to be stated. See, one thing is very clear, every person is a human. So the auditor might point of 100 mistakes and the management could correct only 80. The 20 would still remain in error and present in the financial statements. So all these errors should be stated by the auditor in the audit report, so that the shareholders get to know that these are the areas where error is still present. Further, the auditor also has to comment about the internal financial control over financial reporting, and in case of any other comments upon all this, that also has to be stated. This is a newly released reporting responsibility, wherein the auditor has to report about these 5 things. And what are the 5 things? First, whether the pending litigation's impact has been disclosed by the company. So it could be that the company has currently 10 to 15 litigations going on. So the company should ensure that all the litigation's impact is being shown in the financial statements or the notes of accounts, so that the shareholders know that where the litigation can take up to the company and what are the consequences of the litigation. Next, whether the company has made provision for material foreseeable losses. So as we know, the prudence principle of accounts says that whatever losses are upcoming, kindly make a provision on that. So the auditor should check whether the company has made a provision for all material foreseeable losses. IEPF is something about which you will read further. Briefly, IEPF is an account wherein unclaimed dividends are to be kept. If the unclaimed dividends remain unclaimed for more than 7 years, it goes into IEPF, Investor Education Protection Fund, and it is the duty of the company to deposit those unclaimed dividend into IEPF. So if the company has any unclaimed dividend, the auditor needs to be checked that whether all of that are deposited in IEPF or not. Further, whether any dividend paid by the company, if during the year, has complied with section 123 or not. So there's a particular section on in Companies Act that deals with dividend payment and dividend declaration, that is section 123. So whenever a company declares and pays a dividend, the company needs to comply with that, and the auditor should check whether the company has actually complied with that or not. Audit trail is something again about which you will read in detail in the upcoming chapters. In short, audit trail is basically a newly introduced technique wherein every client, whatever software they are using, should have the option of audit log switched in, which shows that who, when, where, and how passed certain entries, so that it ensures that the auditor is checking even the software part. So the auditor should check that whether the audit trail exists in the company or not. Apart from these responsibilities, there are 2 to 3 other responsibilities also which the auditor has to undertake. So if audit committee asks for any comment, the auditor should provide them with that. And lastly, if the auditor is auditing a government company, the auditor should ensure that whatever comments has been given by the CNAG should be complied with, and also the effect of that comment should be disclosed in the financial statement. So the auditors or the shareholders may be able to know that these are the changes made by CNAG, and that are and these are the consequences of those comments on financial statements. So now, appointment done, qualification done, disqualification done, rights done, and even the duty is done. We are almost at the end topics of statutory audit. So one of the last topics of statutory audit is ways of removal. So the auditor now has been qualified, has surpassed all the disqualification, has been appointed, has undertaken all his rights and duties, and now it's time to bid bye to the auditor by the way of ways of removal. So there are primarily 4 to 5 ways of removal. The first one is the most common yet normal way, that is resignation. So if the auditor ain't able to continue with the company, he or she might resign. Post resignation, within 30 days, there's a form that needs to be filed by the auditor, that is ADT 3. in case of a non-government company, this form needs to be filed with ROC and the company. In case of a government company, this form needs to be filed with ROC, company and government, and this form should be filed within 30 days and not later than that. If the auditor makes any misstatement while filing the form, the auditor shall be punished with a minimum penalty of 50,000 or audit remuneration, whichever is lower, and this penalty can go up to 2 lakh. Plus, there would be a continuing failure penalty of 500 per day. So, if the auditor does not fill this form within 30 days, a 500 penalty per day would be added to the already minimum penalty amount, which could be 50,000 or auditor's remuneration. Next is rotation of auditors. So, this way of removal is a newly introduced way. So ICAI saw that if the auditors are staying in the same companies or are auditing the same companies for 10 years, 15 years, there is a possibility that the auditor might develop a familiarity trait. It is very normal if you stay with any company for 5 to 10 years, you kind of develop an affection towards the company. But in case of audit, that may be very harmful, because if the auditor develops a familiarity trait, it could be a possibility that he might overlook certain misstatements in financial statement and let the financial statements remain manipulative. And hence, to solve this problem, the ICAI introduced rotation of auditors clause. So for certain companies, these companies cannot appoint any audit firm for more than 2 terms of 5 years and an individual for 1 term of 5 years. This is basically done to ensure that the auditor remains independent and to avoid all the familiarity and objectivity threats, wherein the auditor might tend to develop a familiar nature with the company and might be overlooking certain mistakes or might be helping the company in certain kind of fraud. So this change, this rotation of auditor really helps the shareholder to get to know of any mistake that was happening previously or any fraud which the auditor was helping the company to do. So as per rotation, these kinds of companies cannot appoint any auditor, cannot appoint any auditor if individual for more than 1 term of 5 years and audit firm for 2 terms of 5 years. What are the classes of company? Listed company, unlisted public company with paid up share capital of 10 crore or more, private limited company with paid up share capital of 50 crore or more, and all the companies with public borrowings of 50 crore or more. Important to be remembered comes in case of MCQs. Also, you might get a question of descriptive from this also. So these limits are to be remembered. So these 4 particular class of companies cannot appoint an audit firm for more than 2 terms of 5 years and an individual for 1 term of 5 years. So if any individual auditor has completed their 1 term here or any audit firm has completed 2 terms here, they need to be removed by the way of rotation of auditors. Now, as I said, that this is a newly introduced clause, and to ensure that the auditor's job is not lost, the auditors tried to find loophole in this provision. So to ensure that no loopholes are present and to ensure that no auditor defies this provision, 3 additional provisions were included. What were the 3 additional provisions? First, if there is any partner of the outgoing firm that joins a new firm, then that new firm will also be rejected for appointment, because ultimately firm is not the problem, the partners or the persons in the firm are problem. So if any partner who is present in the outgoing firm or the firm which has been removed from rotation, if he or she joins any new firm, then the new firm shall also be rejected. Next, any partner or any firm under the same network of firms shall also be rejected. So you must be hearing about the big fours, PwC, KPMG, Deloitte. They have a lot of network firms in India. So if Deloitte, PwC or any of the big four get rejected at one place or get removed through the provision of rotation, any of the sister firms or network firms automatically becomes rejected and they cannot be appointed in place of them. And the third is, if the outgoing firm has any common partner with the new firm, then even the new firm will be rejected. So let's say A, B, C was the outgoing firm and the new firm is PAT. Since partner A is common in both the firms, the new firm will be rejected. So there are three important provisions that need to be remembered for rotation. First, any firm having a common partner as on the date of appointment shall be rejected. Firms with common brand name or common network shall be rejected. And third, if the outgoing firm partners join any new firm, then the new firm shall also be rejected. In case the company has an audit committee, then the audit committee will appoint or reappoint the new auditor. And in case the company does not have an audit committee, the new auditor shall be appointed by BOD. Because post rotation, obviously a new auditor needs to be appointed. So in case of an audit committee, in case the company has an audit committee, the audit committee shall appoint. In case the company does not have an audit committee, BOD shall appoint. About audit committee, yet again you will be reading in whole detail in just like 5 to 10 minutes from now. So not to worry about audit committee. Just a second. Okay, next thing is removal before expiry of term. So it could be a possibility that the auditor is removed before expiry of their tenure. That is, if the auditor is appointed for 5 years, it could be a situation wherein the BOD asks the auditor to get out from 2 years or 3 years itself. So the auditor started from 2011-12 and was appointed for 2016-17, but it could be a situation wherein the wherein the BOD asked the auditor to be removed in the year 2013-14 itself. So this kind of removal is known as removal before expiry of the tenure, wherein the tenure of the auditor has not expired yet, or where the tenure of the auditor has not been fulfilled yet, or the tenure has not been completed yet, and in the mid itself the BOD asks the auditor to be removed. In such kind of situation, first a board resolution needs to be passed. Post board resolution, within 30 days the board needs to inform the same to the central government by the form ADT2. Post approval from central government, within 60 days and approval is also required from the shareholders by special resolution. So here 3 approvals are required: first from board, next from central government, and third from shareholders. Post these 3 approvals, the auditor is removed by the company. But before removal also, auditor is given a reasonable opportunity to speak out, and the BOD discusses all the reasons. And even after discussion with the auditor, if the BOD feels that the auditor is not competent, or if they want to remove the auditor, they can remove the auditor. But after these 3 approvals from board itself, then from the central government, and then from the shareholders. This is done to ensure that no innocent is punished and no innocent auditor is taken out just by the BOD. So there must be approval of all the 3, so as to ensure that there has been a fair removal of auditor, and it also ensures that the BOD is not removing any auditor due to its manipulative practices. Now fourth is removal by tribunal. So tribunal here basically refers to NCLT. So if the NCLT or central government or any third person gets to know that the auditor has either abetted or colluded or acted in a fraudulent manner, that is, the auditor itself has participated in any fraud or has acted in any fraudulent manner, the NCLT shall take these three decisions. And what are the 3 decisions? First, the NCLT shall ban the auditor for 5 years. Next, the NCLT shall ask the company to immediately remove the auditor, and third, the auditor shall be punished under section 447. Now what is section 447? You will be reading in detail in like 5 to 10 minutes from now when we start upon the punishment section. But let me tell you, section 447 is one of the most deadly punishment sections of Companies Act. So if the NCLT or central government or any third party gets to know that the auditor has abetted, colluded or acted in a fraudulent manner, that is, has either participated in any fraud or has given into any malpractices or has supported any fraud, then the NCLT shall pass these three decisions: place a ban for 5 years, ask the company to immediately remove the auditor, and get the auditor punished under section 447. Further, if the complaint has been received from central government in regard to this, NCLT might take a swift decision and might take the decision within 15 days itself, because very clearly, if the central government is involved, the matter is of top-notch priority and top-notch importance. So if the central government gives a complaint regarding the auditor, the NCLT might take the decision within 15 days. And now comes the last part for statutory auditor, that is punishments. So herein the auditor not only gets removed but also needs to pay the penalty, might be imprisoned, and might also have to pay the damages. Now punishments are broadly of two categories: civil liability and criminal liability, wherein the accused does not cause much harm to the victim and does only create a bit of the problem for the victim. The accused does not need to go to the jail or get imprisoned or might have to pay penalty. They just have to give the damages. Example, for suppose a person is driving and there is a puchka cart here. But there is no puchka wala in this cart and there are no public standing in the cart, and this person ultimately hits this puchka cart. What was the loss that would have been caused to the puchka wala? Obviously the loss of the puchka cart and the ingredients. Apart from that, there were no lives lost and there was not any problem that was caused to any person. So this is the case of civil liability, where this person driving will have to pay the damages to the puchka wala and nothing else. However, if there were 5 men standing here and this person accidentally hit 3 men, so this case becomes a case of criminal liability, wherein the person driving not only just has to pay the damages but also has to bear a punishment, because taking someone's life is obviously a very big crime. So civil liability basically means that the person does not harm a lot and just has to pay the damages, wherein in case of criminal liability, apart from the damages, the person also has to bear the penalty and also has to might also have to go to the jail and be imprisoned. So there are 2 cases in which civil liability is attracted for the auditor. First case is wherein the auditor gives any expert statement in the prospectus and that expert statement goes wrong. So he is not authorizing or is responsible for the entire prospectus. He is just writing a statement in the prospectus which goes wrong, and the people suffer due to that. In that case, the auditor has to pay the damages to the persons who are suffering. And the next case is in case of winding up, if the auditor ain't able to allocate the funds as per the proportion of their authority or as per the proportions of their demand, then the auditor has to pay damages. So these are the 2 cases which attract civil liability. First, where the auditor gives the expert statement, and next, where in case of winding up, when the auditor ain't able to allocate the funds properly as per the authorized or as per the person who would have got the funds. Next comes criminal liability. Now, what are the situations of criminal liability? The first situation is if the auditor authorizes the entire prospectus, that is, he or she is responsible for the entire prospectus, and then a statement goes wrong. So the auditor will have to bear the punishment of section 447. Next is if any inspector asks for the documents and the auditor refuses to give the documents, the auditor shall have to suffer an imprisonment up to 6 months, pay a fine of 25,000 which may go up to 1 lakh, and per day when the auditor refuses to give these documents or refuses to give the information, 2,000 will be added. So if any inspector is asking for the documents, you should immediately give it. Otherwise, you will have to bear an imprisonment plus a penalty plus an charge which will be added each day. Next, in case an auditor does any fraud while winding up, so the auditor might be imprisoned for 3 to 5 years and will have to bear a penalty or fine of 1 to 3 lakhs. If the auditor gives any false statement, then section 447 will be attracted. If the auditor gives any false evidence, then imprisonment of 3 to 7 years and fine of maximum 10 lakhs will be attracted. Now, a lot of students have this query that how to remember this punishment section. So the only key to remembering the punishment section is rereading it again and again. If possible, stick a paper or stick a note on your study table so that you are able to memorize it each day. That is the best technique by which you can learn the punishment sections, because punishment sections are such sections which we usually forget before the examination, and these sections are being asked in MCQs and we might lose 2 to 3 marks of MCQs just because of them. So to avoid that loss of marks, you should reread it again and again, and if possible, stick this note to your study table so that you are able to glance it every day. Then one of the most important punishment sections, if the auditor does not comply with section 139, that is appointment, section 144, that is disqualification, and section 145, that is right to sign audit report, then if this has been done unknowingly, the auditor will have to pay a minimum penalty of 25,000, which can go up to 5 lakh or 4 times the audit remuneration, whichever is lower. Whereas if this has been done knowingly by the auditor, this minimum penalty would be 50,000 and the maximum can go up to 25 lakhs or 8 times the audit remuneration, whichever is lower. Apart from this penalty, the auditor will also have to be imprisoned for 1 year, refund the remuneration and pay the damages. So this is one of the most cruel punishment sections for a statutory auditor. So never mess up with the appointment, disqualification and right to sign audit report. If the auditor messes up these three, then if he does it unknowingly, the auditor will have to pay a minimum penalty of 25,000, which can go maximum up to 5 lakhs or 4 times audit remuneration. If he does it knowingly, the auditor will have to bear a minimum penalty of 50,000, which can go up to 25 lakhs or 8 times the audit remuneration, whichever is lower. Apart from this auditor will also have to be imprisoned for 1 year, pay the damages and refund the remuneration. In case of an individual auditor, obviously he has to bear all of this, but in case it is a firm that is the auditing partner, so it is the firm which is auditing the company, then in that case the monetary liability, that is the penalty, will be borne by the entire firm, whereas just the imprisonment part will be borne by the signing partners. So in case of a firm, not every partner needs to go into the jail. It is the signing partner that needs to go into the jail, but apart from that, the monetary liability is to be borne by every partner of that firm. Now, what is section 447? You might have seen section 447 being attracted in a lot of cases. So what is section 447? So section 447 basically says that if any person is involved in a fraud which is less than 10 lakhs or 1% of the turnover and it does not involve public interest, the person shall be imprisoned for 5 years or shall have to pay a fine of 50 lakhs or do both. However, if a person indulges in a fraud which is more than 10 lakhs or 1% of the turnover but does not involve public interest, the imprisonment period will be 6 months, which can go up to 10 years, and the person also has to pay a fine of 100% to 300% of the fraud amount. So you can easily see that this punishment section is very, very hard, because an imprisonment up to 10 years can be really, really tough. Plus, giving 300% of fraud amount can also cause insolvency of that person. Further, if in case of this, where the fraud amount is more than 10 lakhs or 1% of the turnover and it involves public interest, the imprisonment or the minimum imprisonment period would increase up to 3 years. If the fraud amount is 10 lakhs or 1% of the turnover and does not involve public interest, the minimum imprisonment would be 6 months. However, if it does involve public interest, this minimum imprisonment period will increase to 3 years. Apart from that, An auditor is also liable under other acts such as Income Tax Act, Chartered Accountant Act, Life Insurance Act, Banking Regulation Act, and Indian Contract Act. So herein we end the major topic of our chapter, that is statutory audit. Now there are three miscellaneous topics that need to be covered: branch audit, joint audit, and audit committee, which we will do now. So the first topic is branch audit. Now what is meant by branch audit? So you might have heard that a lot of company has a lot of branches. These modern retail stores like Spencer's, Big Bazaars, and maybe Metro and other kind of modern bazaars has a lot and lot of branches in entire city, and apart from the city they also have a lot of branches in other cities of the country and other countries too. So what do you think? Do these branches present the financial statements separately? Do the shareholders see separate financial statements of branches? No. A company always prepares a combined financial statements of its head office and all the branches. So the auditor cannot do so that he audits only the company and leaves the branch unaudited. Even the branches are to be audited maybe by him or by other auditor, and that all needs to be compiled into the financial statements of the company, and that needs to be presented to the shareholders. Now, who can be a branch auditor? So, if the branch is in India, the first preference is always given to the statutory auditor. The statutory auditor of the HO has the right to audit the branches also. So, if he agrees, great. If not, any other person who is qualified to become a statutory auditor in India can become the branch auditor. Whereas if the branch is outside India, again, first preference is given to the statutory auditor. If he agrees, great. If he doesn't, any auditor who is qualified to become the auditor as per the provisions of that country and not India. So for suppose if I have a branch in Paris, either the statutory auditor of my company can become the auditor of that branch. If not, any person who is qualified to become the auditor as per the laws of Paris is eligible to become the auditor of that branch. Apart from that, branch submits its report to the statutory auditor, because obviously it is statutory auditor who ultimately compiles all the branch financial statements and presents it to the shareholders. So it is very important that branch gives all its observation, all its comment to the statutory auditor, so that the statutory auditor can include those comments in the audit report. Apart from that, the duties and rights of the branch auditor remain same as a company auditor or the statutory auditor. Next topic is joint audit. So when a company is being audited by more than one person, it is known as joint audit. So let's take a company as Reliance. So if Reliance is being audited by 4 to 5 auditors, they are known as joint auditors. Now joint audit has both advantages and disadvantages. The advantage is that the workload gets reduced. Work becomes on time because every person is doing their part of the work, and obviously dividing the work makes the work easy and helps in timely completion of that work. Third, a lot of expertise is attracted because obviously there are 4 to 5 auditors and they can share their doubts and expertise also. Quality becomes increased. Competition is there, so there's a healthy competition which helps the company, since because of the healthy competition, each auditor will try to work its best, and if they try to work their best, the financial statements obviously would be error free. And lastly, a lot of knowledge is also shared, but every advantage has a disadvantage too. So there are a lot of disadvantages in joint audit also. First, the fees is being shared. Next, there might be situations when a superiority complex is created. Further, for small companies or small entities, joint audit is not suitable. Coordination might lack, which might turn audit problematic and might not ensure smooth completion of audit. There are a lot of areas that are left common under joint audit, so that tend to be neglected because every other person feels that the next person will look onto the area or the next person will do that work, and in this cycle of thinking, these common areas are usually neglected and no one does these areas. And as said at the start, the fees being shared is a lot of big problem, because at first I was getting 10 lakhs, now I have to share that 10 lakhs with 4 people. That really hurts, because earlier I thought that for 10 lakhs, okay, I'll do this much work. Now for 2,50,000, even my mind won't be interested to do a lot of work for that entity. So the fees being shared is a very big problem or a very big disadvantage of joint audit. How does joint audit work? So the first thing that goes in is division of work. The work is divided. There's a work allocation document that is created, and it is also signed by all the joint auditors and submitted to the company, so that even the company knows that who has done what work, and even the joint auditors have an agreement that these are the works that need to be done by the other person. After division of work, a coordination is expected by joint auditors, because if it is a possibility that maybe I am looking just for the I am looking onto just the assets part, the other auditor is just looking at the liabilities part, but while auditing liability he might come across something that affects asset. So there is obviously a coordination that is needed, so that he lets me know about that and I can look upon to that matter. Third, there are a lot of areas where joint responsibilities are there. So situations or reporting such as or responsibilities such as ensuring that the audit report is as per the standards or the financial statements are as per the standards. It could be that there might be some work that is not allocated. There might also be any situation or anything that comes up which requires all the auditors to pay attention. So it could be a fraud, it could be an error, it could be a big misstatement that requires each of the auditors to pay attention. And lastly, there are certain areas where the nature, time and extent of procedures are decided by all the joint auditors. So all the joint auditors are held responsible for that particular work. So in these cases, the joint auditors have joint responsibility and everyone is expected to work equally for that. Further, there is dependence on other auditors, as I said earlier. So if I'm doing assets, the other person is doing liability. So there is always an dependence by me on the other person, that if the other person comes across something that relates to my area, the person will tell me about that. And last come reporting responsibility. So joint auditors give a joint audit report. However, if any auditor disagrees to that report, he or she can issue a separate audit report, and the joint audit report shall have a reference to that separate audit report. And comes the last topic of our first chapter, that is audit committee. So what is an audit committee? So audit committee is basically a committee formed by the company which overlooks the functions of management and helps in smooth processing of audit, or helps in smooth processing of audit. So there's a big misconception regarding audit committee that auditors are a part of the audit committee. No, it's just that this committee helps in smooth completion of audit. That is why it is not audit committee. There is no involvement of auditor in this committee. Is totally on the part of the company, wherein 2 to 3 independent directors come in and create this committee. This committee is also formed to oversee the activities of management, so that management does not engage in any manipulative activities, and also it serves as a pre-check or a check for the shareholders, that before the auditors also there is a vigilance that ensures that no fraud is being done with the shareholders. Now, who needs to form an audit committee? So big companies where there are public involvement, such as listed companies, public company with paid up share capital 10 crores or more, public company with turnover is 100 crore or more, or public company with deposits 50 crore, with deposits of more than 50 crore are required to create an audit committee. The composition of audit committee is such that there are three minimum requirements, that is, there must be at least 3 members, out of which majority should be independent directors. Now, why independent directors? So independent directors are basically paid remuneration and usually have no relation with the company, so they might be the best persons to judge the management and might not be biased towards the management. So what is the composition? There are 3 members that are required minimum, and out of 3, majority should be independent directors. Obviously any company can increase the number to whatever they wish to, maybe 100, 200, whatever they wish to, they can increase the number. However, the minimum requirement is 3. Now, what are the functions of audit committee? The functions of audit committee are petty L, wherein First, the audit committee oversees the use of public funds. So whatever funds has been grabbed through the IPO, the audit committee sees that whether they are used for the purpose they were promised for and are not used for any other purpose. Next, the audit committee oversees the internal control of the company. It sees whether the internal controls are properly designed or not, properly implemented or not, or they need any changes. The audit committee also oversees the related party transaction, because related party transactions are one of the most tricky and complex transaction and involve most manipulation. It also sees intercorporate loans, that the terms and conditions of intercorporate loans are correct and the company is not undertaking any manipulative trick. It ensures that the audit processes are effective. And lastly, in case an audit committee is present, in case an audit committee is present, every time first the audit committee needs to recommend the name of auditor for appointment, and then only the BOD selects the auditor. So there might be places or there might be companies where audit committee is not present, so the process directly moves on to the BOD, wherein the BOD selects the auditor and obtains a 4-point declaration and recommends it to the shareholder. But in case an audit committee is present, the first preference needs to be given to the audit committee, and the audit committee recommends the name of the auditor, and then it is approved by the BOD and shareholder. Now, what are the powers of this committee? So this committee can ask for any matters from the auditor. So the committee may ask any questions from the auditor in regarding the financial statements or internal controls or any separate thing which is requires. Second, if the audit committee is not able to exert its functions properly, whatever has been mentioned above, the audit committee has a right to investigate. So suppose there's a related party transaction that is going on and the audit committee feels that the related party transaction is not correct, so the audit committee has the right to investigate into it and then go ahead with its function. Third, the audit committee forms a whistleblower policy wherein every person of the company has the right to complain and get forward with their complaints or get forward and let know of the committee about any problems that they are facing. Fourth, whatever victims come to the committee or whatever victims come through the whistleblower policy are promised safeguards, and the other person or the other person causing harm is duly punished. And lastly, in case there is even one point which the board does not agree or the board does not undertake after recommendation from audit committee, the audit committee has the right to put that in the board report. This is one of the most important functions of this is one of the most important powers of audit committee, wherein if the board disagrees to even one point, the audit committee can write it in the board report, which also acts as a check on the board. So it could be a possibility that the board is refusing that particular thing due to any manipulative measures or due to any manipulative tricks. So in that case, the audit committee can declare that in the board report, and due to the fear of being declared that in the board report, the board might usually not undertake manipulative decisions or might not indulge into manipulative tricks. So this was revision, and we'll be taking a 1-minute break, post which we'll be starting with the Q&A related to this chapter, and then we will move upon to the company audit subchapter 2. I hope you like the revision till now. Just a 1-minute break, post which we will start again with the Q&A. Hello guys, we are back from the break, and now we'll be starting the Q&A for company audit subchapter 1. Before starting into the Q&A, there's one important thing that you need to know is the significance of these star marks. So there are star marks ahead of every question, and these star marks denote the number of times these questions have appeared earlier in the past papers, MTPs and PTPs. So if there's a 2 star after the question, it denotes that this question has appeared earlier in the past papers or MTPs or PTPs for 2 times. Similarly, you will see questions with 4 star, 5 star, 7 star, 6 star. So all these are basically to give you assurance that these are questions that have appeared earlier also and are very probable. Now, not even wasting a minute, let's get into the Q&A. So the first question is, what are the disqualifications for appointment of statutory auditor of the company? This we have done at the start itself. So what are the disqualifications? First, employee of a company. Next, employee of a company. Third, shareholder of the company, or if the related party holds share of holding subsidiary, co-subsidiary, associate for more than face value 1 lakh, indebted to the company for more than 5 lakhs in holding subsidiary, co-subsidiary, associate and the company itself, given a guarantee of more than 1 lakh in holding subsidiary, co-subsidiary, associate or the company itself, has a direct or indirect business relationship with holding subsidiary, co-subsidiary and associate, is a relative of KMP or director, has been convicted by court and 10 years has not lapsed, has undertaken any activity as mentioned under section 144, or is already an auditor for 20 companies, and that include every company apart from OPC, small dormant company, and private company which has paid up share capital of less than 100 crores. So apart from 4 companies, if the auditor has already reached the capping limit of 20 companies, the auditor is now disqualified, and an auditor can never represent a company. That is, a company can never audit another company's books. Next question. What are the services which cannot be rendered by a statutory auditor of the company under section 144 of the Companies Act? 3-star question. This I said during the revision that we will do it from the Q&A portion. So what are the activities referred under section 144 of the Companies Act? So an auditor can basically never ever undertake accounting and bookkeeping services of the company, or internal audit services, or design and implementation of financial information system, actuarial services, investment advisory, investment banking, rendering of outsourced financial services, management services, and any other services which is later on added to this section. So why are these functions prohibited by the Companies Act to be rendered by the auditor? Very simple. This or these functions again defy the maker-checker concept. If the auditor itself makes the accounts of the company and is asked to check the accounts of the company, yet again, it could be that the financial statements remain manipulative or have a lot of errors. So if you see all the functions, they basically ensure that the maker and checker of the company is different and manipulation is not involved. So as a statutory auditor, all these 9 services are prohibited. If the auditor undertakes even one of the services, then the auditor becomes disqualified. Next, discuss the procedure for appointment of first auditor of the company and its tenure. So unless and until anything is stated before company, you need to assume that this company is a non-government company. For government company, it would be specifically stated before the company that it is a government company. If not stated anything, you have to assume that the company is a non-government company. So what are the procedure for appointment of first auditor of a non-government company? So first chance is given to the BOD for 30 days. If they fail to do so, then the next chance is given to the members for 90 days. What is the tenure of the first auditor? 1 year, that is completion of first AGM. Here they have also given for government company, however it is not required, but since they have given, we'll discuss. So for government company, who appoints the first auditor, the first chance is given to the CNAG for 60 days. If they fail to do so, then the BOD is given the chance for 30 days, and if even they fail to do so, then the members are given a chance for 60 days. The tenure of first auditor, be it in government company or non-government company, is same, that is 1 year, that is conclusion of first AGM. Next, discuss the provisions for reappointment of retiring auditors. So I said there are 3 basic conditions that need to be followed for reappointment of auditor. Auditor happy, shareholder happy, and auditor not disqualified. So the auditor must not be disqualified. Auditor should be willing, that is, he must not have submitted a notice of unwillingness. And lastly, a resolution must not have been passed by the shareholder specifically appointing some other auditor or removing this particular auditor. Discuss the rights of an auditor according to the company's 3-star question, hence important question, has already appeared 3 times in your examinations before and could be a probable question for your term. So what are the rights of an auditor? First, he needs to check the financial statements, for which he needs access to books of accounts and also access to information and explanation regarding financial statement. Next, if any other person signs the auditor report apart from him, the shareholders might mistrust the audit report and might feel that all the audit has been defied. Hence, only the auditor can sign the audit report and no one else. So the right to sign audit report is to be given to the auditor. Where is the audit report read? Obviously at the AGM. So the auditor should have the right to receive all the notices of AGM and attend AGM. And lastly, in big companies, there is a tendency that the auditor might get attracted in any legal case. So the auditor has the right to be indemnified provided the auditor is innocent and correct. Question number 6, write a note on the duties of company auditor. So when nothing is given regarding which specific duty they are asking, so therein you will have to state the 6 duties which the auditors specifically needs to check, or the 6 areas which the auditor needs to specifically check. And what were those areas? So the first thing was whether the investments are not sold below purchase price. Next, the terms of advances are not prejudicial. Just a second. Third, whether the loans have not been shown as deposits. Personal expenses of directors in the company's book is a no. Whatever transaction has been given in the books of account should not be fake or should not be a facade. All of this transaction should be real and nothing should be unreal or nothing should be kept as fake. And lastly, if the company has issued any shares during the year, whatever allotment has been made by the company should be tallied with the cash received by the company. Discuss the duty of the auditor to report certain matters in the audit report under section 143 subsection 3. So herein, if they have stated that they want reporting responsibilities of the auditor, so you will have to write about the 10 things that the auditor need to report. The auditor need to report. And what are the 10 things that the auditor needs to report? First, whether all the information and explanation has been received by him. Next, whether proper books of accounts has been maintained. Third, whether the branch returns and branch audit reports has been received by him. Whether the balance sheet and PL are in agreement with the books of accounts. Fourth, whether the financial statements, Fifth, whether the financial statements complies with auditing standards. Sixth, any observation or comments regarding the adverse functioning of the company. Seventh, that the directors are not disqualified. Any qualification or adverse remark about the accounts of the companies has to be stated. Whether the internal controls are accurate or not, or adequate or not, has to be stated. And any comments regarding above matters. Question number 8, discuss the provisions of the Companies Act as regards reporting of frauds by the company auditor. 4-star question, hence highly important. So what are the provisions of the Companies Act regarding the reporting of fraud? So if the auditor comes across any fraud which is more than or equal to 1 crore, the auditor needs to immediately report about this to BOD or audit committee within 2 days and wait for at least 45 days for their remarks. If they give the remark within 45 days, great. If not, on the expiry of 45 days, the auditor will inform the same to the central government via form ADT 4. Apart from the form, the auditor also needs to give his signed letter, and that should be on the letterhead of the auditor. Plus, this post needs to be sent through registered post acknowledgement due. Also, if any comments has been received by BOD and audit committee, that needs to be attached. This whole process will remain the same apart from that of central government if the fraud amount is less than 1 crore. So the whole process will continue, and the whole process the auditor has to exert apart from reporting to central government if the fraud amount is less than 1 crore. Question number 9. Discuss the method of removing an auditor appointed under section 139 from his office before expiry of term. So you need 3 people approval for removing an auditor before expiry of term. First of all, a board resolution needs to be passed. Then the board needs to inform the central government within 30 days via form ADT 2. Wait for approval of central government. Once the approval of central government comes, then the BOD needs to take approval of the third person, that is shareholder, by special resolution. Once approval of all these 3 persons have been once the approval of all these 3 persons has been received, the auditor can be removed before expiry of term. Question number 10. Write short notes on branch auditor. So herein you will have to first state that who can be a branch auditor. If the branch is in India, then the statutory auditor or any person who is qualified to become the statutory auditor as per laws of India is eligible to become the branch auditor. Next, if the branch is outside India, then the statutory auditor or any person who can be a statutory auditor as per the laws of that particular country is eligible to become the statutory auditor or the branch auditor for that particular branch. Apart from that, herein you will have to state that the rights and duties of branch auditor are same as statutory auditor, and also the branch auditor submits his or her report to the statutory auditor, because it is ultimately the statutory auditor who compiles all the report and who compiles on the financial statements and presents it to the shareholder. Question number 11. What are the advantages of joint audit? So what were the advantages of joint audit? First, it reduces the workload. Next, it ensures timely completion of work. Third, it ensures expertise and helps to solve critical problems in no time. It increases quality of audit, ensures healthy competition. It is also possible for the auditors to get the benefit of extensive knowledge of different auditors, ensures lower staff deployment cost and lower cost to carry out work. Question number 12. What is the responsibility of joint auditors? So herein you will have to state about the joint responsibilities of auditors. So what are the joint responsibilities of auditors? First, whether the report is as per your auditing standards. Then the financial statements should be as per accounting standards. They should also take care of matters which has not been divided, that is common work. Work where nature, time and extent of audit procedures are decided commonly by all the 3. Should also ensure that if any matter comes up which requires the attention of all the joint auditors, then that would be a joint responsibility of the auditor, and each auditor would undertake the same responsibility for that particular purpose or for that particular work. And this is probably yes, the last question. Question number 13. Discuss briefly the scope of audit committee in public company, or discuss the functions and power of audit committee. So which kinds of the company needs to make audit committee? Listed company, public company with paid up share capital of 10 crores or more, public company having turnover of 100 crore or more, public company having loans or deposits more than 50 crores. Apart from that, what are the functions of your audit committee? First, petty air. First, it ensures monitoring of funds received through IPO. Then it ensures that the internal control of the companies remain intact. It ensures that it oversees the transactions with related parties. Audit process effectiveness is ensured. Intercorporate loans and deposits are overseen. And lastly, from R, it recommends the BOD regarding the appointment and removal of auditor. What are the powers of audit committee? Quibs. The committee may ask comment from the auditors regarding certain matters. The committee develops whistleblower policies wherein any person who has been suffering from anything in the company can come up and complain to the audit committee. It investigates into the matter if it ain't able to exercise its functions properly. Whatever things are not agreed by the board are shown in the board report. And lastly, whomsoever comes to the audit committee with their complaints are ensured safeguard, and it is ensured that the audit committee promises safeguards against victimization. So that was it for the Q&A. Post a 1-minute break, again we will start with the company audit subchapter 2. Company audit subchapter 2 isn't lengthy, would maximum take us 15 to 20 minutes, so that would be a short chapter. You can increase the break if required, but I feel 1 to 2 minutes break is enough. So let's meet again post break with company audit subchapter 2. Hello everyone. So I hope you people are back from a wonderful break. Prior to the break, we were doing company audit subchapter 1 Q&A, and now we'll be starting with company audit subchapter 2. So company audit subchapter 1 basically dealt with statutory audit, whereas subchapter 2 deals with cost and secretarial audit. I always say this in the class that wherein subchapter 1 is more important from the exam point of view, subchapter 2 is important from your career point of view, because just like only a CA in practice is eligible to become a statutory auditor, only a CMA in practice is eligible to become the cost auditor. So if you want to consider a future career prospect as becoming the auditor, this chapter is a must know for me. This chapter is really small, would take us like 15 to 20 minutes from now, but the provisions under this chapter can be tricky, so it requires most attention of yours, or the next 15 to 20 minutes require high attention of yours, so that after 20 minutes you're clearly done with this chapter and have understood each provision of this chapter. Now, what is cost audit? So cost audit basically means checking the cost records of the company. But why cost audit when the statutory audit is being done? So statutory audit basically deals with the financial statements of the company and guarantees the shareholders regarding the accounting or the financial statements of the company, whereas cost audit basically checks the cost records of the company, analyzes it, and gives the company or provides the company with feedbacks wherein their cost can be controlled. They can ensure optimum utilization of resources, and with bare minimum cost they can achieve highest productivity. So wherein statutory audit is more benefited for the outsiders or the shareholders, cost audit benefits more on the part of the company or the insides of the company. Now, do you think that every company would utilize the benefit of cost audit? Small entities which are engaged in maybe services or maybe other things might not require cost audit. And instead of cost audit helping them in cost control measures, cost audit itself would become a burden on them. Cost audit would itself unnecessarily attract more expenses on part of the company. Hence, unlike statutory audit, cost audit is not applicable to every company. But before knowing the applicability criteria of cost audit, there's one more thing that you need to know regarding cost audit, that it is the central government which laid down the foundation of cost audit. So it is the central government which brought into India the concept of cost audit. So herein in this chapter you will see that a lot of times whether the auditor is appointed, removed, remuneration is decided, everything is intimated to central government, because ultimately they are the highest authority in case of cost audit. And to facilitate and ensure effective use of cost audit, and to ensure that the correct person gets the use of cost audit, central government has brought down a list of goods and services which it feels need to get their cost audit done. So for example, fertilizers or tea or coffee, it has mentioned such products and services, and only if you deal in such an industry or if you deal in such an product, you need to check the applicability of cost audit. So central government has already specified the products or services that it thinks require the benefit of cost audit or requires the need of cost audit. But before moving on to the applicability criteria of cost audit, it is important to know the applicability criteria of cost records. So just like every financial statements need books of accounts, every cost audit needs cost records. Cost records are nothing but records that give a bird's eye view of the costing of the company and help the cost auditor make decisions regarding the costs of the company. The detailed description of cost records is available in Form CRA1 that is mentioned on the website of central government, and if you want you can easily check that out. They have mentioned specific products, specific materials, specific expenses, and have shown the treatment of those expenses. They have also specified what are the documents to be maintained, what are the documents not to be maintained, which kind of company needs to maintain what. Everything has been clearly bifurcated. But who needs to maintain cost records? So any company which is dealing in any product or service mentioned in the list of central government and their turnover crosses 35 crore need to maintain cost records. So first you need to check whether you deal with any product or service mentioned in the list of central government. If yes, the next thing that you need to check is whether the turnover is crossing 35 crore is equal to 35 crore. If both these conditions are satisfied, then you need to maintain cost records. This applicability limit includes foreign company but does not include MSME. That is, MSME is exempted from maintaining cost records. So even after their turnover crossing 35 crore or even after them dealing with any product mentioned in the list of central government, they are exempted from maintaining cost records and thus are automatically exempted from getting their books audited or getting cost audit. Now comes the applicability for cost audit. Yes, not every company which maintains cost records need to get their books audited. So there are different applicability criteria for cost records and cost audit also. It could be a possibility that any company is maintaining cost records but is not getting their books audited, because it might fall into the criteria of cost records but might not fall into the criteria of cost audit. So these kind of situations also exist. Now, who needs to get their cost audit done, or which companies need to get their cost audit? So the product or the service list of the central government is basically includes 39 industries. The product service list of the central government basically includes 39 industries which are subdivided into two sectors, regulated and unregulated. Regulated sector has 6 industries and unregulated sector has 33 industries. So firstly, a company needs to check in which sector is it dealing. If the company is dealing in regulated sector, there are two criteria that needs to be checked for cost audit. First, whether the turnover from that particular product is crossing 25 crore and whether the overall turnover is crossing 50 crore. Now, what does that mean? A lot of students have a lot of confusion in this applicability criteria. So let's suppose that fertilizer is mentioned in the list of central government in regulated sector. And this company, let's suppose Agro Pharma, is making fertilizer, pesticide, and is selling seeds. So in order to check the cost audit applicability criteria, Agro Pharma will have to check whether the turnover from particularly fertilizer, that is particularly product mentioned in the list of central government, is crossing or is equal to 25 CR, and will have to check that whether the turnover of the entire company or the overall turnover or the turnover from fertilizer plus pesticide plus seeds is crossing 50 crore or is equal to 50 crore. These both are and conditions, and hence both the condition needs to be satisfied for cost audit. So if a company is dealing with any product mentioned in the list of regulated sector, the company will have to check whether the turnover from that particular product is 25 crore or more and the overall turnover is 50 crore or more. Next, if the company is dealing with any product mentioned in the list of unregulated sector, then the company will have to check that whether the turnover from that particular product is 35 crore or more and the overall turnover is 100 crore or more. Example, let's suppose tea is mentioned in the list of central government for unregulated sector. Tea Me is selling tea, coffee, and let's suppose say sugar. So Tea Me will have to check whether the turnover from tea is 35 crore or more, and the overall turnover of the company, that is tea plus coffee plus sugar, is 100 crore or more. But there are exceptions to this. That is, even after satisfying the above criteria, if you fall into these three categories, you need not get your books cost audited. What are the three categories? So even after satisfying the above limits, if I am engaged into captive power plant consumption, if I am engaged into exporting my goods and the export revenue is 75% or more of my total revenue, and if I operate in an SEZ, I need not get my books cost audited. Once again, we revise the applicability criteria of cost audit because a lot of students have the confusion in it. So, firstly, I need to check whether I deal with any product or service mentioned in the list of central government. If yes, I'll have to see whether I deal with regulated sector or unregulated sector. If I deal with regulated sector, the turnover from that particular product should be 25 crore or more, and my overall turnover should be 50 crore or more for my books to get cost audited. And if I deal with unregulated sector, then the turnover from that particular product should be 35 crore or more, and the overall turnover should be 100 crore or. Now, what does cost audit help in? So, a very basic formula that we were taught in class 11, 12, cost plus profit is equal to price. So, if you can optimize on your cost, it will help you gain more profits also, and it can also help you reduce the price. So, the first thing that cost audit helps you with is pricing policy, product mix, outsourcing, and discontinuance of product. Next, it helps in identifying inefficiencies and help in improving the productivity. Third, it helps in optimum utilization of resources, helps in cost control mechanism. Obviously, if you are stating anything as correct or incorrect, you need to compare it with the standard data. So cost audit also helps you in forming the standard costing data, and the most benefited part, it also helps you gain certain tariff exemptions. Maybe the government would abolish certain tariffs or might reduce the rates of certain tariffs on the basis of your cost audit data. Now, apart from what is mentioned in CRA 1 and is given in detail regarding the cost records, there are three basic principles that need to be satisfied for cost records. First, the cost records should be such that the cost audit is able to make the decision. Next, there should be always the per unit costing of everything, because obviously the decisions can't be the decisions can't be taken on the total cost. Example, so if there's a cost sheet wherein material is 10 lakh, labor is 8 lakh. If I see the total view, or if I see the total amount, I will feel that the material is overpowering or the material is costly. But it could be that I am using 20,000 material but just 10,000 labor hours. Now, if I go for a per unit calculation, I will observe that labor is expensive and not material. So in order to make the decisions, the cost should always be per unit and should not be given in total amounts. So the next principle that the cost record should satisfy, that there should be per unit amounting, or there should be per unit calculation of cost. And lastly, for direct expenses such as material and labor, there should be from scratch to end or from source to end calculation, that is when they would have been purchased, under what production they have been used, under what consumption they have been used, what are the different kinds of labors used, what are the different kind of material used, under which machinery they are given, they are being utilized, everything. So for direct expenses, the cost record should show from scratch to end. Now, who can become a cost auditor? As stated before, only a CMA in practice can become cost auditor. But just like statutory auditor disqualifications, if the cost auditor disqualifies or falls under any of the criterias or under any of the disqualifications mentioned for statutory auditor, then the cost auditor will be disqualified. So the disqualifications are same as statutory auditor. employee of the company, employee of the company, shareholder of the company, same disqualifications that are for statutory auditor are for cost auditor. So if the CMA in practice incurs any of the disqualification, the person cannot be appointed as a cost auditor. Now, who appoints cost auditor? So firstly, BOD checks and BOD searches for a cost auditor. Once found, the BOD obtains a 4-point declaration from the auditor. First, that the auditor is not disqualified. Next, the appointment is as per Act. Third, appointment is within limits, and whatever legal proceedings that the auditor is having has been provided by him to the BOD, and whatever has been declared is correct. Post appointment, the company shall inform the auditor and file CRA 2 with central government. As I said earlier, you will notice that even the slightest of the things are being informed to the central government, because ultimately it is the central government who is the highest authority here. Here you won't see a lot of shareholders coming in or a lot of shareholder intervention, because this has nothing to do with the outside of the company. This is purely an inside work, and here instead of shareholders, you will see a lot of information being given to central government. So once the auditor is appointed, the BOD shall inform central government about it within 30 days of the meeting or 180 days of the commencement of financial year, whichever is earlier. If we get it very simple, so if the auditor is appointed within 150 days of financial year, then the BOD has to inform the central government within 30 days of the meeting, and post 150 days, that is from 150th or 151st day, if the auditor is appointed, the BOD needs to inform the central government within 180 days of meeting. 180 days of commencement of financial year. Commencement of financial year. So a lot of students have the confusion, where would 30 days of the meeting used and where would 180 days from commencement of financial year be used. So if the auditor is appointed within 150 days of financial year, then 30 days of the meeting is the limit by which the BOD has to inform central government. But if the auditor is appointed from 151st to 180th day, then the BOD needs to inform the central government within 180 days of the commencement of financial year by the form CRA 2. Now, what will be the tenure of cost auditor? So the tenure will be expiry of 180 days from the closure of financial year or submission of cost audit report, whichever is earlier. If the cost auditor submits the cost audit report earlier than 180 days, then that would be the tenure. And if he does not, then 180 days from completion of financial year would be the tenure. How can the cost auditor be removed? So firstly, a board resolution needs to be passed. Then the central government needs to be informed via CRA 2. Post approval of central government, the BOD can remove the auditor. What if a casual vacancy is created? Herein I said there is no role of shareholders. So BOD will be making major appointments and would be filling in casual vacancies. So in case a casual vacancy is created in the company, the BOD shall fill in the casual vacancy within 30 days. And form CRA 2 will be filed with the central government, informing them about the same. Who decides the remuneration? If audit committee is there in the company, then the audit committee will decide the remuneration. If the audit committee is not there in the company, then BOD shall be the person or shall be the authority who decides the remuneration of cost auditor. Rights and duties of cost auditors are same as statutory auditors. Nothing differs. As the statutory auditors have the rights, same cost auditors have the rights and the duties. Now, by when does the cost auditor needs to submit their cost audit report? So within 180 days from the closure of financial year, in form CRA 3, the cost auditor shall submit his report to the BOD. Once the BOD examines the report, the BOD shall forward that report to central government within 30 days in form CRA 4. So if you make a summary of the forms in this section, in this chapter, there are basically 4 forms that you need to remember. CRA 3 is when the auditor gives the report to BOD. CRA 4 is when the BOD gives the report to central government. CRA 2 is informing the central government of everything regarding appointment, casual vacancy, removal, anything that needs to be informed to the central government regarding auditor is done through CRA 2, and CRA 1 consists of the cost records details. That is whatever the cost records the company needs to maintain. Again, if you see that in case of statutory audit, the audit report is directly submitted to the shareholders. But here again, post submission to BOD, the report is resubmitted to central government. In which form? XBRL. XBRL's full form is Extensive Business Reporting Language. That is an HTML Java type language which you don't need to understand. Even if you become an auditor someday, you will have to just submit this report to BOD, and BOD then converts into XBRL and submits it to the central government. Now, what are the things that are to be given in the cost audit report, or what are the reporting responsibilities of cost auditor? First, he needs to ensure that he needs to report that all the information and explanation has been received by him or not. Next, whether proper cost records has been maintained or not. Third, whether proper returns has been filed or not. Fourth, whether the books and records give the optimum information, that is, they are well maintained. Fifth, whether proper internal audit system is maintained by the company. Sixth, whether the cost audit report or the cost records give a true and fair view. And lastly, detailed unit wise and product wise cost statements and schedules are to be maintained by the company, or whether they are maintained by the company and they are duly certified by the auditor. In case of any fraud, the company will have to bear a penalty of 25,000, which can go up to 5 lakhs, and the officer in default or the personnel default will have to bear a fine of 10,000, which can go up to 1 lakh. Now that ends cost audit, and we come to the last topic of our syllabus, that is secretarial audit. Now, what is secretarial audit? So just like statutory audit involves checking the financial statements of the company, cost audit involves checking the cost records of the company, secretarial audit ensures checking the compliance of laws and regulations of the company. So you might see in today's era, when everything is connected, where your PAN is linked to Aadhaar is linked to something else, everything is connected. Even one wrong move or even one wrong non-compliance can attract a lot of punishments from a lot of laws and regulation. Plus, there has been situation wherein if you get even one notice from income tax, that attracts a lot of notices from GST or maybe other authorities, and suddenly you feel that the non-compliance or the penalty of non-compliance increases. So it is always better to bear the cost of having a secretarial audit than to bear the cost of multiple penalties. So the large big companies need to get the secretarial audit done so as to provide assurance to the public that they are complying with all the laws and regulation, and it also ensures and helps the company to get free of their legal obligation and ensure that they are not caught up in any penalties. Now, who needs to get secretarial audit done? Every listed company, public companies which have paid up share capital 50 crore or more, public company with turnover 250 crore or more, and lastly, all companies with public deposits of 100 crores or more. Who can be a secretarial auditor? Just like for cost auditor, only a CMA in practice is eligible. For statutory auditor, only a CA in practice is eligible. For secretarial audit, only a CS in practice is eligible. So now you know all the 3 golden degrees of commerce and their particular audit requirements. So a CA in practice can do statutory audit, a CMA in practice can do cost audit, and a CS in practice can do secretarial audit. Who appoints the secretarial auditor? BOD appoints the secretarial auditor by passing a board resolution and gives a letter of engagement to the secretarial auditor or the CS. Once done with the work, secretarial auditor submits his or her report to BOD by MR3. Now, these were the company audit regulations. But apart from the Companies Act or the company audit regulations, there is one more body which requires the companies to get secretarial audit done. So that body is known as SEBI, Security Exchange Board of India. SEBI says that all the listed companies are covered by Companies Act and all the listed companies are having the secretarial audit done. But what about the material unlisted subsidiaries or the material unlisted companies? Hence, SEBI requires all the unlisted subsidiaries or the material unlisted subsidiaries to also get their books audited by a secretarial auditor. As per regulation 24A of the SEBI regulations, every listed company entity and its material unlisted subsidiaries incorporated in India shall undertake secretarial audit and shall annex the secretarial auditor report with the annual report of the listed entity. So, wherein Companies Act just restricts to the highly large public companies and listed companies, SEBI incorporates the obligation of also material unlisted subsidiaries to get their books audited via secretarial audit. This is also a provision related to SEBI regulation. Every listed entity shall submit secretarial compliance report in such form as specified within 60 days from end of each year. So whatever secretarial audit report they have to submit it with SEBI within 60 days from each financial year. Important from MCQ point of view. Okay, so this chapter was very short, might have taken us 20-25 minutes maximum, and this chapter has not a lot of things to learn, also has a lot of repetitions from statutory audit chapter or subchapter 1 chapter also, so it makes it easier for you. Giving you a 1-minute break, post which we will start with the Q&A of this chapter. So I hope you people are back from a wonderful break. Prior to the break, we completed the revision of subchapter 2 and now we'll be doing the questions of subchapter 2. So you can't and you usually don't expect a lot of descriptive questions from this subchapter. This subchapter contains more of the MCQ kind of questions. However, there are 3 to 4 questions that we need to do that are important and will help us revise the whole chapter. So that we'll be doing, again, won't take much of the time. 15-20 minutes is the maximum that will take. First question, with reference to companies' cost records and audit rules 2014 as amended, discuss provisions relating to maintenance of cost accounting records and cost audit. So they are asking the applicability criteria of cost records and cost audit. So what is the applicability criteria of cost records? So first you need to see whether you deal with any product or service that is mentioned in the list of central government. If yes, the next thing that you need to check is whether your turnover is 35 crores or more. If you satisfy both of these criteria, then you need to maintain cost records. However, there's an exception to it, that is MSME need not be required to maintain cost records even after satisfying the above 2 criteria, because MSME is exempted from it. However, foreign companies are included in this, and every foreign company, if they satisfy the above limits, have to maintain cost records. Next comes the applicability criteria of cost audit. So yet again, you'll have to see whether you deal with any product or service mentioned in the list of central government. Further, you will have to see whether that product falls in the regulated sector or unregulated sector. If the product falls in regulated sector, then the turnover from the particular product should be 25 crores or more, and the overall turnover should be 50 crores or more for the books to get cost audit done. And if you deal with unregulated sector, then the turnover from that particular product should be 35 crores or more, and the overall turnover should be 100 crores or more to satisfy the limit of cost audit. Again, there are 3 exceptions to this. That is, if you deal with captive power plant, or if you export your goods outside and the export revenue is more than 75% of total revenue. And lastly, if you operate in SEZ, you are exempted from getting the cost audit done. Next question. with reference to Companies Rules 2014 as amended, discuss provisions relating to maintenance of cost accounting records and cost audit. So basically a repetition of the above question, but herein they have explained cost records in details. So you will have to say and write about the applicability criteria of both cost records and cost audit, and also say that the cost records are maintained as per CRA1. CRA1 is a document that contains in-depth detail of cost records. Now coming to question number 3, what is the procedure for appointing a cost auditor in any company? 3-star question, that is important question. So how is a cost auditor appointed in the company? First of all, BOD selects a person whom he thinks is eligible for becoming the cost auditor. Then they obtain a 4-point declaration from the auditor. What are the 4-point declaration? That is whether appointment is as per act, appointment is within limit, the person is not disqualified, and whatever legal proceedings are being done against him has been stated by him, and whatever has been stated is true. Once BOD is satisfied with all this 4-point declaration, the BOD informs the central government about the appointment via form CRA2, which is to be submitted within 30 days of appointment or 180 days of financial year, whichever is earlier. Coming to question number 4, with reference to Companies Rules 2014 as amended, discuss the following: submission of cost audit report to Board of Directors by cost auditor and applicability of rotation to cost auditors. So there are 2 questions that are being asked. We'll go one by one. First of all, submission of cost audit report to Board of Directors by cost auditor. So cost auditor submits his report to BOD via CRA3, and this report is to be submitted within 180 days of financial year. BOD can check the report and give his remarks, qualification and disqualification, and then resubmit the same to the central government in form CRA2. The next question is applicability of rotation to cost auditors. So let me get this thing very clear. There might be a lot of similarities between statutory auditor and a cost auditor, but every similarity has been stated by me during the revision. I never mentioned during cost audit that rotation is also applicable to the cost auditor. So something that has not been mentioned during the revision or something that has not been given in the notes is to be deleted from your mind. There is no clause of rotation that is applicable to cost auditor. A lot of students mess up thinking that since there are a lot of similar things between statutory auditor and cost auditor, rotation might also be applicable. It is a big no-no. It is nowhere stated that the rotation will be applicable to cost auditor. Hence, do not use your extra mind and do not train it that thinking, oh, might be that ma'am has missed or might be that the notes have missed. There is nothing missed in the notes. So do not ever write that applicability of rotation is also to cost auditors. This particular question is one of the institute's most favorite question because obviously they like to confuse students and a lot of students fall into the trap. So do not fall into the trap. Rotation is never ever applicable to the cost auditor. The Act does not provide for rotation in case of appointment of cost auditors and is not applicable to cost auditors. Next comes question number 5, 4-star question, highly important question. This is one of the most prospective question for secretarial audit. Usually this is the question that is asked for secretarial audit in every term. So question number 5 is that P Limited is an unlisted public company with an authorized capital of 100 crores. The issued and paid up capital of the company is 45 crores. During the financial year 2021, the company has been able to achieve a turnover of 225 crores. The company has taken a bank loan of 110 crores in the current financial year for business expansion. The company secretary of P Limited has asked for opinion as a legal expert on whether the company is required to conduct secretarial audit. Advise the company. So the question has basically given you the data and is asking regarding the applicability of secretarial audit. So first of all, you will have to write about the applicability criteria of secretarial audit, which is listed company, every public company with paid up share capital of 50 crores or more, every public company with turnover of 250 crores or more, and every company which has outstanding loans and borrowings from public of 100 crore rupees or more. Now this company has a paid up share capital of 45 crores, which is well within the limits of 50 crores or under 50 crores. So considering this, there is no secretarial audit applicable. Next, it has a turnover of 2 to 5 crores. So yet again, secretarial audit is not applicable because secretarial audit is applicable to the companies with turnover of 250 crores or more. Third, the company has taken a bank loan of 110 crores. Here the company gets caught because if you satisfy any of the criteria, you will have to get the secretarial audit done. And the last criteria for secretarial audit is if you have loans or borrowings more than 100 crores from any kind of public or have any kind of loan. So herein the company will have to get secretarial audit done since it satisfies the fourth criteria of secretarial audit, that it has loans or borrowings of more than 100 crores. Unlisted company, paid up share capital is 45 crore, which is less than the stated amount of 50 crores. Turnover is 225 crore, which is less than the stated amount of 250 crores. But the outstanding loans is 110 crore, which exceeds 100 crores. Hence, since P Limited crossed the threshold of 100 crore borrowing, P Limited is required to get a secretarial audit done. Not a very hard question, but this is the kind of question that you can expect for secretarial audit. Even in MCQs, you can expect this kind of question. So that was it for subchapter 2. Once again, a 1 to 2 minutes break, and then we will meet post for subchapter 3. I hope you're liking this video up till now, and if you do so, do like, share, comment, and subscribe. Hello everyone, I hope you people are back from a wonderful break. Prior to the break, we completed the Q&A of Company Audit Subchapter 2, and post this break, we will be starting the revision of Company Audit Subchapter 3. So Company Audit Subchapter 3 is one of the lengthiest chapter in our entire syllabus, but beyond being lengthy, it is very, very interesting, and it is one of those chapters which will help you a lot in your practical life. So it basically deals with the auditor's duty of checking the financial statement, wherein the auditor has to give a view that whether the financial statements are giving a true and fair view or not. It discusses the procedures that the auditor needs to undertake or follow to ensure or to give an opinion upon the financial statements. So herein we will get to know what are the audit procedures to be applied to each item of the financial statement and what are the things that the auditor needs to check to give the shareholders the assurance about financial statements. So the name of the chapter is Audit of Items of FS, and herein one by one we will be reading the audit procedure of each item. So since the chapter is lengthy, a lot of times students skip this chapter, but not to worry, I have crunched down this chapter in like 14 to 15 pages. See, even if you don't get the time to watch the revision video, you can just go through the revision notes, and I assure you that you can have a fair share of marks through this revision notes. Now, what is to be checked in the financial statements by the auditor? So basically, the auditor needs to check the assertions in the financial statements to give an opinion about the financial statements. Now, what are assertions? So assertions are basically promises or representations made by the management that are embodied in financial statement and that are validated by auditor. Now, this definition sounds tricky, so let's simplify it down. So as the auditor has the duty to check whether the financial statements are giving a true and fair view or not, management has the duty to make the financial statements such that they give a true and fair view. And in order to make a financial statement that gives a true and fair view, management makes certain adjustments in the financial statement, and these adjustments are known as assertions. For example, if a rent expense is being displayed in the financial statement, as a user of financial statement, the least I will expect that the rent expenses is for 12 months. But if you understand in practical life, the rent expenses for the last month, that is for the month of March, are usually due in April. So the rent expense for March has not been paid. Now, if the financial statements are left unadjusted or management does not make any changes in the financial statement, what will be provided to the users is 11 months of rent expenses. But is that correct? No, because it defies the accrual principle of accounting. And to ensure that the accrual principle of accounting stands strong, management makes the adjustment and shows the last month rent as outstanding rent in the financial statement. So this basic adjustment by the management to ensure that the financial statements are giving true and correct view and are as per AS and Ind AS This is known as assertion. So minute adjustments made in the financial statements by management to ensure that the financial statements are giving a true and fair view are known as assertions. And if the auditor verifies this assertion and it turns out to be correct, then the auditor can give a thumbs up to the financial statements and say that the financial statements are giving a true and fair view. And if they do not stand to be correct, or if they are not present in the financial statements, the auditor can say that the financial statements are unreliable or are not giving true and fair. So there are basic 7 assertions that need to be checked in financial statements. First is existence. That is, whatever is shown in the financial statement should actually exist, or whatever is shown in the P&L should have actually occurred. Next is completeness. That is, whatever is shown in the financial statement should be complete. That is, nothing should be beyond that, or the company should not be hiding or concealing anything. Third, rights and obligations. That is, whatever are the items in financial statement, they should have the legal ownership of the company, and whatever there are liabilities in the financial statements, they should have the obligation of company and no one else. Then comes cutoff. That is, whatever is given in the financial statements for that particular year should belong to that particular year only, not the preceding or the upcoming year. So if I'm making the financial statements for financial year 23-24, so all the items in that financial statement of that particular year should have only transactions that belong to that year and not 22-23 or 24-25. Next comes evaluation. That is, whatever is presented in the financial statement should be of correct amount or correct. And last comes presentation and disclosure. So Schedule 3 of the Companies Act prescribes certain presentation and disclosure requirements to a company. This presentation and disclosure basically ensures that the users of the financial statements get a clarity upon the financial statements. Example, so if I see a figure of loan in the financial statement, it might be possible that I do not get the details of the loan, and I might be still confused that to whom the loan is given, whether it is safe or not, whether my money is invested correctly or not. So the details of the loan basically provide me clarity whether the company is giving the loan to a correct person or not, whether the company has insured all the checks or not, whether the terms and conditions of loan are prejudicial or not. So these details basically ensure a clarity in the mind of users of financial statement, and these details are necessary for the company to put in the financial statement. So the last assertion which the auditor will check, that is presentation and disclosure, that is whether all the presentation as prescribed by Schedule 3 are made in the financial statements or not by the company. So one by one we will be covering all the items, and first we will be targeting P&L items, then balance sheet items. Post that we also have a section of audit of some special transaction, wherein the special transactions, the audit procedures of those special transactions will be covered by us. It is a great initiative by Institute, since although they are special transactions, you in the practical world might encounter these transactions, and let me tell you, there will be no one to explain you the audit procedures for that, because that is the least that is expected by you, that as an auditor you know all the audit procedures. So we should applaud the Institute for that they have also included audit of some special transaction. So post completing the audit of items of financial statement, we will be moving to audit of some special transaction, and after that our syllabus after that our this chapter would be completed, that is company audit sub chapter 3 would be completed. Yet again, as said earlier, this chapter is one of the lengthiest chapter and might take us around 1.5 hours. Post that we have a Q&A session of this chapter, which will take us around 25 minutes to half an hour, and then we will move on to company audit subchapter 2. So let's begin the audit of items of financial statement. Now, first item from P&L is revenue from operations, or popularly known as sales. So what does the auditor check in the item of sales? First, he will have to ensure that whatever sales that have been shown in the financial statement have actually occurred or not. Next, whether the sales shown in the financial statements are complete or not. Third, the amount of sales is correct or not. Fourth, whatever sales is shown in the financial statement belongs to that year only and not the preceding or the upcoming year. And lastly, whatever the presentation and disclosure requirements are relating to sales have been done by the company. Now, how will the auditor check occurrence of these sales transaction? That is, whatever has been shown in the financial statement has actually occurred or actually happened or not. So firstly, the basic evidence for sales and purchase is invoice. So the auditor shall grab the invoice of all the transaction and check whether there are no fake invoices or double invoices. Apart from that, the auditor might also obtain confirmation from the receivable, that is from the debtor. And apart from that, the auditor shall also ensure that the revenue recognition policy is being adhered to. So whatever AS, Ind AS and whatever accounting policy that the company has should be accomplished and should be followed while accounting for sales transaction. Now next comes completeness. Now how will the auditor ensure that whatever sales has been shown in the financial statement is complete, that is beyond that the company has made no sales? So the best trick to test this is checking the gate outward register. So if the goods have gone out of your warehouse and there's also a lorry receipt date that is present in the gate outward register, if you check that, if that is before 31st March, you should ensure that all the sales should be recorded in financial statement. Usually the last week of March, that is 25th to 31st March, is the time when the company does a lot of misstatements and errors. So your primary focus should be on the last week, and you should check that whatever is shown in the gate outward register should be shown in your accounting entries and should be in the books of accounts. Apart from that, you should also see that all the invoices are recorded. So even if there is one invoice that is missing, you can ask the management about the discrepancy and get that recorded in the financial statement. Next comes measurement, or how do you check that the amount of sales is correct? So the first thing that you need to follow is that AS or Ind AS, whatever belongs to the company or whatever is applicable to the company, should be adhered to. So for AS it is AS 9, and for Ind AS it is Ind AS 115, that deals with revenue from operation. So that should be adhered to. Apart from that, if there is any trade discount given to any customer, that should not be accounted for. And if there is a CIF sale, so CIF sales is basically an export sales wherein the customer not only gives you the cost of sale but also insurance and freight expenses. So as an auditor, you should ensure that the CIF amount, cost, insurance and freight amount, is not accumulated and is credited to the sales account. Instead, only the cost of sales is credited to the sales account, and apart from that, insurance and freight are accounted separately. Coming to cutoff, yet again, cutoff means that the sales belong to the current year only. For that, you need to check the gate outward register and ensure that whatever sales has been recorded are in the gate outward register prior to 31st March and not after that. For presentation, you need to give the breakup of sales. Apart from that, if you are a finance company, then interest and other financial services should be in the revenue from operation. Discount allowed should be shown separately, and service income, if any received, should be shown separately. Next comes other income. So basically this is the non-operating income, when you generate income from revenue from operation and invest it in other items, you generate non-operating or other income. In this, what will the auditor check? First, whether this income shown in the financial statement has actually happened or not. Next, whether the income shown in the financial statements is complete or not. Third, the amount of other income is correct or not. Fourth, the presentation and disclosure of other income is correct or not. And fifth, whether all this income belongs to the current year or not. So first, checking the occurrence of other income, the auditor can do so by checking the list of investments or the sources of these other income. Apart from that, there is a document of 26 AS that is released by Income Tax Authority. So the auditor can also check the occurrence of these income through 26 AS. In case any interest is received from bank, so in that case, the auditor can obtain a confirmation from bank. For gain or loss on investment, you might know that now all the shares are dematerialized. So for gain or loss on investments or shares, the auditor can see that or check that through your demat account. And lastly, the auditor shall verify interest and dividend on a sample basis, that is recalculate and check whether the amount that is falling in the financial statement is correct or not. To check completeness, the auditor should yet again consult 26 AS and see whether all the interest that is appearing in 26 AS has been accounted for in the books or not. And apart from that, any interest or any other income that has come in the bank statements or cash book should be recorded in the financial statements. To ensure that the amount of other income is correct, the auditor should first check that the TDS has been deducted for all the interest and dividend under the relevant section. Apart from that, the auditor should also see that the interest that has been credited in the books of accounts should match with the bank information, and the interest should not be credited on their personal calculation, because the interest on bank account is not simple interest, but you get that in compound interest form, or basically IRR form. So it should not be simply calculated by the client, that should be recalculated and verified from the bank information. Dividend income can be calculated on a sample basis, and lastly, if you receive any pre-acquisition interest, that should be duly adjusted. For cutoff, that is to ensure that whether the interest belongs to the current year or not, you should see that all the investments that are lying in the books of client, their income should be credited to the books of account either in the realization form, or if they are not realized, then all of the income should be credited in the form of accrued interest or interest to be received. So a lot of clients make this mistake that when the interest comes in the next year, they credit their books then. So that is incorrect. All the interest that belongs to the current year should be credited in the current year. So whatever interest has not been received till date and will be receivable, that should be recorded as accrued interest. For presentation, interest and dividend income should be shown separately. Apart from that, gain or loss on investment should also be shown separately. And in case the client has any other non-operating income, that should be shown in a separate line item. Next comes expenses. So the biggest expense in a P&L account is purchases, basically purchase of raw material or other goods. So in case of purchases, the auditor has to verify that whatever purchases has been shown in the books has actually occurred or not. Apart from that, purchases are complete or not, amount of purchases is correct or not, purchases belong to current year or not, and lastly, whether all the presentation and disclosure in relation to purchases has been made or not. So to verify occurrence of purchases, as I said, be it sales or be it purchase, the primary documentary evidence that the auditor has to verify is invoices. So to verify occurrence, the first thing that the auditor will do is take the invoices of all the transaction, ensure that there is no fake invoice or no double invoice. Apart from that, the auditor should ensure that all the purchase invoices has the name of the client and no one else. Apart from that, the auditor should also ensure that all the purchases are authorized. Next, coming to completeness, that is to ensure that whatever purchases are shown in the financial statement are complete, and beyond those there are no other purchases. So this the auditor can verify via get inward register, that is whatever goods have come in the warehouse have to be recorded as purchases. Apart from that, in case of goods in transit, it should be ensured that the purchases are not recorded, since these goods are still in transit and have not reached the warehouse. If there has been any purchase return, so the purchase return should not be only from the warehouse, it should be from the accounts also. So the purchase return should be credited correctly. And lastly, if the goods have come in the warehouse, they are to be recorded. So whatever goods are lying in my warehouse as on 31st March, they all have been purchased, and I should ensure as an auditor that all the purchase has been properly debited in the books of accounts. For valuation or measurement or checking whether the purchase amount is correct or not, the first thing I can do is tally the invoice and the ledger. So the amount of invoice should match with the amount of ledger. Apart from that, whenever you do a GST purchase, you have the right to claim input tax credit on that. So as an auditor, I should see whether the client has claimed all the input tax credit. If yes, great. If not, I need to know the reason for that. And if there has been trade discount received, so that should not be shown in the books of account, trade discounts, and not to be accounted in the books of account. To ensure cutoff that all the purchases belong to the current year, I need to check gate inward register. And for presentation, there should be a bifurcation of goods received for manufacturing, then the goods received for trading, and apart from that, goods received from related parties, because as I said earlier also, related parties usually involve complex transaction. Next comes employee benefit expenses, or popularly known as salary expenses, which we pay to our employees or workers of the organization. So in this, the auditor will check whether the salaries that are shown in the financial statements have been actually paid or not. Then apart from that, the salary shown should be complete, that there should not be any instance wherein the salary has been paid but not has been accounted in the books of accounts. Third, whether the amount of salary shown in the book is correct or not. Fourth, whether all salaries belong to current year or not. And lastly, whether the presentation and disclosure requirements for salaries has been certified or not, or have been presented or not. So first comes the occurrence principle, that is whether all the salaries that are shown in the financial statement have been actually paid or not. So to ensure that, first I will check the work strength of the company, where when there is basic reconciliation of opening to closing employees. So it has the number of opening employees, the additions and deletion in each month, and that totals up to the closing employees. So first of all, I'll check the work strength. Apart from that, I need to check the payroll or the attendance register, wherein I will be able to verify whether correct employees paid the correct salary. Also, from the work strength, I can take a sample of appointments or new joinees and the sample of resignation and check whether they are true or not. And apart from the salary, there are many statutory deductions that are to be need to be done from the employees. So as an auditor, I should check whether all the statutory deductions have been done and whether the statutory deductions that are done are properly deposited into the government's account. Next comes completeness, that is whatever salary has been shown is complete or not. So apart from seeing the payroll register, one more way to verify that whether the salary is complete or not is check the bank books or the cash book. So whatever salary has been paid through bank or cash should be properly accounted for in the books of accounts as salary. And as an auditor, as said earlier, I should also verify whatever salary deductions has been done or whatever statutory deductions has been done from the employees should be deposited into the actual account. If not, the employee won't be able to avail the benefit of the statutory deduction. To check whether the amount of salary is correct or not, I'll have to check the payroll or the attendance register and ensure that each person is paid as per the attendance, or each person is paid as per the salary structure. And apart from that, for the statutory deductions, there are calculations that are already prescribed by the government. So the deduction should be as per the calculations prescribed and should not be more or less. For cutoff, that is the salary should only belong to current year, I should ensure that all the employees have their salary debited in the books of accounts for only 12 months and not 13 or 11 months. In case the salary for the month of March is not paid, the salary for that month should be shown as outstanding salaries. In case of presentation, salaries paid, deductions made, ESOP, that is employee stock option plans given in if any, and staff welfare expenses are to be bifurcated and separately shown. Next comes depreciation and amortization. So depreciation and amortization is nothing but a slow deduction of the tangible and intangible assets. So instead of removing the tangible and intangible assets at once from the financial statements, we reduce it year by year so that when we actually sell it, the balance sheet doesn't suffer a shock of a lot of loss. So in case of depreciation and amortization, what will the auditor check? First, whether the depreciation charge or shown in the financial statement is reasonable or not, that is whether whether the assets on which the depreciation is shown exist or not. Apart from that, the auditor will check whether the depreciation is complete or not. Third, whether the depreciation amount is correct or not. Fourth, all the depreciation should belong to assets for the current year only. And fifth, whether the presentation and disclosure requirement is complied with or not. So first, to check whether the depreciation shown in the financial statement is correct or not, that is the depreciation has been shown on only assets which are with the company, you need to check the source, that is asset register. So to check the occurrence of depreciation, I'll have to check the asset register and check whether all the assets on which depreciation have been charged exist or not. Apart from that, I can calculate depreciation on a sample basis and check whether the correct depreciation has been debited in the books of accounts or not. To ensure completeness, I will have to recalculate depreciation on all assets and see whether the depreciation is matching with the books of accounts. In case of any discrepancy, in case of any error, that needs to be checked whether any asset has been missed or not. Depreciation is not charged on land, so don't ever make the mistake and tell the client that the depreciation has been not charged on land. Apart from that, all the assets are depreciable, so you need to recalculate depreciation on the asset schedule and check whether there are any discrepancy. Apart from that, you should ensure that no fake assets has been considered. In case any asset has been revalued during the year, so the amount of revaluation must have gone to the revaluation reserve. So the depreciation charge on that asset will also go to revaluation reserve. Further, if there is any change in the terms of asset, be it rate or be it a useful life, be it scrap value, then there should be a retrospective change in the depreciation also. Next comes the measurement, that is whether the amount of depreciation is correct or not. So there are basically 2 to 3 things that need to be covered in depreciation calculation. First, whether the rate of depreciation is correct or not. Next, whether the useful life is correct or not. And third, whether the scrap value is correct or not. So you should ensure that the rate of depreciation is as per schedule 2. The useful life that is to be considered is correct or not and is properly checked by evaluator or not. Residual value should be proper, and in case there is any impairment during the year, it should be checked that the impairment is reasonable and the calculation is correct. For cutoff, that is depreciation belonging to current year, you should first check whether all the assets that are currently in the books of accounts have been there for all the 12 months. If yes, then the depreciation should be charged for all the 12 months. If any assets had been purchased during the year, then depreciation should be charged from the purchase date till 31st March. And if any asset has been sold during the year, then the depreciation should be charged from 1st April to the sale date. This is to be ensured by the auditor also, and this is to be recalculated by the auditor also, because there are a lot of chances that the client may make mistake in the depreciation. So in order to verify the depreciation well, a recalculation is needed on the part of auditor. In case of presentation, the accounting policy, useful life, method of depreciation and residual value is to be given. Next comes other expenses, or basically known as miscellaneous expenses. So whichever expenses do not have a separate category are categorized as other expenses. Other expenses basically include expenses such as rent, legal professional expenses, computer stationery expenses, printing expenses, cartridge expenses, electricity expenses, power fuel expenses, security guard expenses, and some small expenses that are needed for day-to-day running of business. So in case of other expenses, what does the auditor need to check? First, whether all the expenses shown in the financial statement are reasonable or not, that is whether they have actually occurred or not. Next, whether the expenses shown in financial statement are complete or not, that is beyond those expenses, whether there are certain expenses which the client has concealed or hidden or not. Next, whether the amount of other expenses is correct or not. Fourth, whether all the amount or all the expenses or all the other expenses belong to the current year or not. And lastly, whether the presentation and disclosure of other expenses is done correctly or not. So first thing, that is to check the occurrence of other expenses. The auditor will basically vouch the expenses, that is see the documentary evidence of the expenses. So whenever there are miscellaneous expenses made by the company attaches a documentary supporting or a voucher to the other expenses. So that must be checked by the auditor and ensured that that is not fake and that has actually occurred or not. Then for certain specific expenses, there are certain procedures. So in case of rent, you should check the monthly schedule and ensure that all the rent expenses for all the 12 months are provided for, and you should also check the rent agreement. For power and fuel, yet again the 12-month expenses should be insured. In case of insurance expenses, the policy should be verified and the validity period should be seen. And for legal expenses, the retainership agreements and the month-wise schedule should be obtained. Next comes completeness. Now, how will you verify that whatever other expenses are shown is complete or not? So the best way to verify the completeness is check the petty cash book. So these expenses are usually made in cash and not are routed through bank accounts. So you should check the petty cash book and ensure that whatever cash is taken out by the company has for these expenses has been properly accounted or not. Apart from that, you should see that the transactions should be properly authorized, approved, and then accounted. In order to ensure the calculation of this other expenses, or to see whether the amount of these other expenses are correct or not, the auditor should recalculate the expenses where possible. The auditor should apply analytical procedures, that is compare these expenses from past year, because these expenses are generally same for each month. So a comparison would help the auditor to know whether there are any changes or whether there are any manipulation in the books of accounts. The auditor should also undertake reasonable tests, that is the auditor should ask himself or herself that whether this expense was needed or not. For example, if I have an office wherein there are already 10 guards present in the ground floor, and then my client shows that there are additional 20 guards which they have kept in front of their office. Now obviously if there are 10 guards at the ground, there's no need of 20 guards just in front of my office. So it is a possibility that maybe my client is faking these expenses. So reasonable tests like these need to be done. And for expense like rent, escalation clause and termination clause should be seen. So a lot of times it happens that the rent agreement has terminated and the rent agreement is not valid, but the client is still showing rent expenses in their books of accounts in order to increase their expenses and save taxes. Next is cutoff. So a lot of times in case of other expenses especially, the client forgets to make the adjustment, that is the adjustment of outstanding and prepaid expenses. So it should be ensured that all the outstanding and prepaid expenses are duly adjusted for. And for the presentation you need to refer Schedule 3 Part 1. And here comes the last item in P&L, that is finance cost, or it is popularly known as interest on loans or debentures. So for this, the author needs to check whether the interest that is shown in the books of account is correct or not, that is whether this has actually been paid or not. Next, whether the interest shown is complete or not, that is there should not be any situation where the client has paid more interest but has not shown in the books of accounts. Third, whether the interest amount shown is correct or not. Fourth, that is the interest should belong to current year only. And fifth, whether all the presentation in regard to interests are made by the client or not. So first, to verify the occurrence of finance cost, the auditor shall check the loan agreement and see whether the interest is as per the loan agreement or not. Next, if the interest has been paid, that has been obviously paid by bank or cash, so the bank statement or the cash book proof should be asked for. And lastly, it should be ensured that only the loans which were outstanding against them the interest has been paid and no fake interest has been shown in the books of account. To ensure completeness, you should basically ensure that all the outstanding loans multiplied by rate of interest, whatever amounts that come, should be tallied with the books of accounts. In case of any discrepancy, you should consult the management for that. To ensure measurement or amount or correctness of the value of interest, there are two things that are to be needed: rate of interest and the amount of outstanding loans. So you should basically multiply both of these and check whether the amount that is appearing by your calculation is correct or not, and whether it is tallying with the books of accounts or not. Apart from that, the auditor should be extremely careful with the loans repaid during the year. So a lot of time what happens is, although the client repays the whole loan amount, they still show an installment in the books of accounts, thinking that the auditor will not realize this misstatement and they can still have the benefit of interest expenses on these phase loans. So you should be very sure that the loans which are fully repaid during the year has been removed from the books of accounts. For cutoff, it should be ensured that the interest belongs to the current year only, even if the company has or the client has not paid the interest, they should still account for the interest as accrued interest in the books of accounts. And last comes presentation. So the presentation needs to be referred as per the Schedule 3 and as per AS and Ind AS requirements. Now next comes assets and liability. Before moving on with assets and liability, we will take a 1-minute water break and then we will return to assets and liabilities. So the break is done and let's get back to assets and liability. The first item in assets and liability is property, plant and equipment, or popularly known as fixed tangible assets. So in this, the auditor has to check that whether these assets actually exist or not. Then the auditor has to check whether the rights on these assets belong to the company or not, that is whether they're legally owned by the company or not. These assets should be complete, that is whatever is shown in the financial statement should be final, and the client should not hide anything from the auditor or from the financial statements, then the amount of fixed assets appearing in the financial statement should be correct. These assets should belong to current year only, and whatever presentation and disclosure requirements are prescribed by Schedule 3 should be followed. Now, to ensure existence of assets, the best way to do that is through physical verification. So the asset should be physically verified as much as possible. Popular physical verification are physical verification of fixed assets and physical verification of inventory. So to verify existence of PPE, the auditor will get a physical verification done, then tally that with the books of accounts. In case of any discrepancy, ask the management about it and properly adjust for in the books of accounts. And if the auditor comes across any asset which although exists but is still not in active use, then they'll ask the management to remove that asset from the category of PPE. Then completeness. So for completeness, PV report is the best thing, because PV report, if compared with books of accounts, if there are any discrepancies, that is possibly if there are any assets which are in the physical verification report but not in the books of accounts, that serves as a procedure for completeness assertion also, and the auditor can ask the management to incorporate them in the books of accounts. Apart from that, the auditor should also check the arithmetical accuracy of the FA, that is fixed asset schedule. Next comes valuation, that is the amount of PPE that appears in the books of accounts should be correct. So PPE generally appears in the books of account as cost less depreciation less impairment. So the cost is to be calculated as per the purchase agreement or as per the invoice or as per the completion cost, whatever, if the machine is made in-house. Then for the depreciation, it should be as per the installation certificate. Further, the rate of depreciation and the useful life should be correctly calculated. If there has been any impairment during the year, the auditor should know the reason for the impairment and check whether the calculation for impairment is made correctly or not. In order to check the cut-off principle, that is whether all assets belong to current year or not, the auditor can see the FA schedule. Then comes rights, whether all the ownership rights belong to the entity or not. So how will the auditor verify that? So all the title deeds, all the agreements, all the purchase invoices should have the name of the client. Apart from that, there should be a proper internal control process. So obviously assets are not of minute value. There should be proper authorization, proper approval, proper budgeting, and then only assets should be purchased. So the auditor should see whether there has been proper internal control processes and all the expenses are made within the budget. In case of presentation, PPE is shown under non-current assets, then comes the tangible assets, and then comes PPE. So usually in the balance sheet, first comes the head of non-current assets, then the tangible assets, and then comes PPE. So it should be disclosed this way only. And apart from that, in notes to accounts as per the schedule 3, the disclosure should be made. Next comes patent and copyright. So as we did above for PPE, as we said that they are tangible assets, patent and copyright are basically intangible assets. That is, their unique trait or unique characteristic is that you cannot see these assets. So what are the things that the auditor needs to check? First thing, whether they exist or not. Now this comes as a joke, because one side I am saying that you cannot see them. So how will the auditor verify existence? We'll know that 2 to 3 minutes after. Apart from that, the auditor also has to verify the completeness, whether the patent and copyright that is shown in the financial statement is complete or not. The valuation should be correct or not. Cut of that is they should belong only to the current year. All the patents and the copyright should be owned by the company and no one else. And lastly, there should be proper presentation. Now, to check the existence of patent and copyright, it is basically said that the client should have all the papers relating to patent and copyright, because it is the ultimate documentary proof for a patent and copyright. Since patents and copyrights are intangible assets, you cannot see them. The only way to verify patents and copyrights, or the only way to prove that the patent and copyright belong to you, is by checking the documentary evidence. So the auditor should physically verify the documents of all the patents. Apart from that, the auditor shall also obtain a schedule of patents and tally them with the books of accounts. In case of any discrepancy, the auditor shall ask the management to correct that. And the auditor should also check whether all the patents are in active use or not. If the patents have expired or if the patents are not in active use, they should not come under the category of patent and copyright under intangible assets. To ensure completeness, yet again, the auditor should verify that all the assets contained in the schedule should be in the books of accounts, and the arithmetical accuracy of patents should be verified. For valuation or for correct amount of patent and copyright, the auditor should basically check three things. So the patent appear in the balance sheet as cost less amortization less your impairment if any. So first thing comes cost. Now how will the auditor verify whether the cost is correct or not? So if the patent is created in-house, the auditor should see whether all the direct miscellaneous expenses incurred upon the same and the registration fees is included in the cost. If the patent is purchased from outside, then the purchase cost plus registration cost should be included in the purchase price or the cost. For amortization, it should be charged as per the usefulness or as per the usage of the asset. As soon as the asset is used, it should be amortized. Apart from that, if the client is taking amortization on the basis of useful life, so for patent, it could be legal or commercial life, whichever is lower, and for copyright it should be the legal life. Impairment if any should be asked by the auditor, and the reasonableness should be taken. For ensuring cutoff, that is all the patents belong to the current year, the auditor shall have to see the schedule of intangible assets. In case of rights, that is whether all the patents belong to the company or not, which is very, very important. As said earlier, they do not have a visual appearance, so the documentary evidence proved to be the greatest evidence. To ensure the rights that the patents belong to the company, the auditor shall ensure that all the purchase agreements, all the invoices, all the title deeds should have the name of the company. Apart from that, there should be time to time payment of renewal fees, and the renewal fees should be debited to my P&L account. And the auditor shall also ensure that no patent that is shown as on 31st March has expired. For presentation, they are shown under the non-current assets, for intangible assets under patents and copyright. So the first broad head is non-current assets, then intangible assets, then patents and copyrights. Apart from that, whatever disclosure requirements are there in Schedule 3 should be consulted for. Next comes loans and advances. So here the money given is being talked about and not the money taken. So usually the first thing that comes in our mind with loans is that the company has taken this much money, but here we are talking about the asset side of the loan, that is the company has given this much money. So in case of verifying loans and advances, the first question that comes in the mind of auditor is whether these money has been actually given or not, that is they exist or not. Next, whether it is complete or not, that is there is no such situation where the company has given more money but has not accounted for in the books of accounts. The amount of loans and advances are correct or not. The loans and advances belong to the current year only. The rights of the loans and advances are with the company, that is it is the company at the receiving end, and it is the company who actually has the ownership and who has the right to collect money from the borrowers. And lastly comes the presentation and disclosure. So to verify the existence, that is whether these loans actually exist or not, the auditor shall have a schedule which contains all the details of the loans. And apart from that, the auditor shall also check loan agreement and obtain written confirmation from the borrowers to ensure that they have taken the loans or not. To ensure completeness, the auditor should verify that all the loans that are in the schedule have been recorded and have been accounted for in the books of accounts, and which the loans which are repaid in the current year, that the loans which have been received by the company in current year, there should be extra caution and extra precaution in that, because yet again, as said earlier, usually the company does that when the loan gets fully received or the loan gets fully repaid, the company usually shows a last installment to make the books fictitious. So there should be extra care that is to be taken. So any loan that is repaid by the borrower or received by the company during the year, there should be extra caution on that. To ensure the valuation or amounts of loans and advances, the auditor shall obtain an aging schedule. In case any advance had been tagged as doubtful in the last year, the auditor shall obtain a reasonability or a recoverability check by the management on that whether they are recoverable or not. If they are not recoverable, that should be written off. But yet again, assets write-off is not a very easy job. So assets write-off should be properly authorized and the resolution should be passed. So in case any assets or any advances are there, the probability of recoverability of which is very low, then they should be written off with prior and proper approval of management. Then comes cutoff, that is all loans should belong to current year, so that you can yet again verify from the schedule. For rights, that is whether the company is the actual owner of this loans, that whether the company is the legal owner of these loans, whether the company is at the receivable end. So the auditor shall verify them that through their name in the loan agreement. Apart from that, it should also be authorized by MOA and OA, that is Memorandum of Association and Article of Association. In case there are any RPT loans, that is related party loans, then they should be properly authorized by the BOD or audit committee. In case of employee loans, there should be due installments of the employees, and the loans shall be deducted from their salaries. And in case any assets had been mortgaged by the borrower, that asset should be in the name of the company and not someone else. For presentation, these loans could be tagged as current or non-current depending on their tenure. And apart from that, all the disclosure requirements as prescribed by Schedule 3 should be complied with. Next comes investments. So investments are basically the source by which you earn other income, or investments are basically the source by which the company earns non-operating income. So for investments, the auditor will first have to check whether the investments that are shown in the financial statements actually exist or not. Next, whether these investments are complete or not. Third, whether the company has all the ownership rights on these investments. Fourth, whether the valuation of investment is correct or not. Fifth, whether all these investments belong to the current year or not. And lastly, whether the investments are properly presented and disclosed in the financial statements. Now, to verify the existence of investments, the first thing that the auditor will do is obtain a schedule of these investments which has all the details and check them detail wise. Then the auditor shall physically verify all the investments, and this is to be done in one sitting itself, because if the auditor takes 2 to 3 days to verify the documents of investments, the client may have a chance to manipulate the documents. So physical verification of all the investment certificates should be done in one sitting. If there has been any investment that has been purchased or sold, but there is not a documentary evidence to support that, the ancillary documents should be checked. If there is any investment that is not present with the entity and is given to any other authority, then a confirmation from the authority should be taken, and the schedule should be properly tallied with the book. In case of any discrepancies, the management should intervene and correct that. To ensure completeness, that whether all investments are shown in the books of accounts or not, the auditor shall verify it with the schedule. That is, whatever investments are contained in the schedule should be presented in the books of accounts. Apart from that, all the movements in all the ledgers should be clearly seen and should be ensured that they are properly recorded. For valuation, so in case of investments, if the company has bonus shares, that should be recorded at zero value. In case the company has right shares, that should be priced at right entitlement price. For cum interest investments, there should be separation between purchase price and interest. And in case the company has received pre-acquisition dividend, so that should be adjusted with the dividend and not separately shown as other income. For cutoff, that is all the investments, whether they belong to the current year or not, the auditor can check that from the schedule. For rights, it should be ensured by the auditor that whether the MOA and OA, memorandum and articles, permit the company to make investments or not. All the certificates should have the name of the client and no one else. Further, if the investment is mine, the offsprings are also mine. So the auditor should ensure that all the investments, whatever other income they are giving, has been received by the client, because that is again a clear proof that the investments belong to the client only and not someone else. For presentation, they are shown under financial assets and current non-current depending on the tenure. Next comes inventory. So inventory is basically the closing stock of the company. So whatever goods that the company gets so inventories are basically the closing stock of the company. So whatever goods that the company sells remain unsold as on 31st March, they are shown as closing stock or inventory by the company in balance sheet. So for inventory, the auditor will first check that whatever inventory has been shown in the financial statement, does that actually exist or not. Next, whether the inventory shown in the financial statement is complete or not. Third, the inventory has been correctly valued or not. All the rights on the inventories are the client's and not someone else's. The inventory belongs to the current year only, and whether all the presentation and disclosure requirements have been complied with or not. So as to check the existence of inventory, as said earlier, the best way to verify or check the existence of assets is physical verification. So physical verification of inventory shall be conducted. That should be tallied with the books. In case of any discrepancy, the management should intervene and properly account for the thing. Now, inventories are usually maintained in two types by clients: perpetual and periodical. So if there's a perpetual system that is followed by the client, that is, as soon as the goods are gone out of the warehouse or entered in the warehouse, the accounting is done. The physical verification can be conducted any day. But if there's a periodical system that is followed, that the entries are made after a day or after a week for all the goods that have gone out, then the physical verification should be conducted after a period. In case there is any inventory that is lying with a third party, or maybe with the consignor, or maybe with any customer, then a confirmation shall be obtained from the third party to ensure completeness, that whatever inventory has been shown in the books of accounts is complete or not. The auditor shall perform analytical procedures such as reasonable test or ratio analysis. Apart from that, the auditor shall also concentrate on non-financial information such as weights or other details about the inventory. In case inventory is with third party, then the auditor shall obtain a confirmation about the condition of the inventory. And lastly, if there is any inventory that is lying with the branch or any other parts of the entity, then a confirmation should be obtained from them too. For valuation, it is very easy, as we read in the accounts. Your finished goods should be valued at cost or NRV, whichever is lower. WIP should be valued at cost of completion. Raw material should be valued usually at your cost. However, there may be situations where the raw material shall be valued at NRV. Apart from that, if there is any damaged good, that should be valued at net realizable value, NRV. And for obsolete goods, the goods should be valued at 0, and there should not be any value of the obsolete goods in my inventory. Apart from that, as an auditor, I also need to check the methods of valuation, that is whether FIFO, LIFO, weighted average, or any other method is followed by the client for inventory valuation. For cutoff, that is whether the inventory belongs to 31st March or not. Physical verification report is my greatest support. So whatever inventory is there as on 31st March, that should be tallied with the books of accounts, and only that should be present in the financial statement and not something else. For rights, obviously you can't ask the client to print its name on all the inventory. You'll have to check it from the purchase invoice. So all the purchase invoices, all the GRN should have the name of the client. If there are any goods lying with a third party, you shall obtain a confirmation from them in regard to the quality, quantity, and other details. And if there is any consignor-consignee agreement, then you should also read the terms of those agreement. For presentation, the inventory shall be shown under current assets, and raw material, finished goods, WIP, and goods in transit should be bifurcated. Apart from that, valuation method should also be provided for. Next comes cash and cash equivalence. So cash and cash equivalence is one of the easiest item to audit in financial statement. The reason being very simple. See, the auditor does not have investigative rights. So even if the company is hiding any cash, the auditor cannot get access to that and cannot find that cash. So whatever is shown by the client is to be accepted by the auditor. And apart from that, there is nothing to establish right on cash and cash equivalence. If they belong to the client, the auditor has to agree that the client has the right on them, because obviously the auditor can't ask the client to write their names on the notes or write their names on the coins. So whatever is with the client in regards to cash is to be agreed by the auditor. So in case of cash and cash equivalents, the first thing that the auditor will check whether the cash and cash equivalents as shown in the financial statement exist or not. Apart from that, completeness is to be checked. Valuation almost remains the same. You can check that for bank's account, but for cash, you'll have to believe, because a 200 note is a 200 note, a 2000 note is a 2000 note. So there might be no change in valuation of cash. But yes, for bank accounts, we need to see that. Cut off that all the cash belongs on 31st March only. Write that all the cash and cash equivalents have the ownership of the company and not someone else. And last comes presentation. So to check the existence of cash and cash equivalent, the auditor shall conduct a physical verification. However, since cash is a sensitive item, the physical verification shall be conducted in a surprise manner. So there should be surprise checking and surprise physical verification of cash and cash equivalent. Apart from that, the auditor shall also conduct cash sensitivity analysis. So cash sensitivity analysis is basically monitoring the average expenses and income of each month. So average expenses and income of each month of client in cash should remain same. In case of any hike, it should be monitored by the auditor. Apart from that, in case of bank, the auditor shall obtain bank information and shall ensure that all the entries in BRS, that is bank reconciliation statement, has been properly and duly accounted for. And lastly, for existence, the auditor shall also inquire about the petty cash book. Next comes completeness. So as said earlier, whatever cash belongs to the company is to be considered that it belongs to the company. So for particularly for cash, you need not check completeness, but for bank accounts, you can obtain a confirmation from bank. Better would be that you obtain a blank confirmation from the bank and ensure that all the bank accounts that are being shown by the bank has been duly accounted for in your financial statements. For valuation, yet again, the cash note would remain the same. So there is nothing to be done with the valuation of cash. For bank accounts, if you have a bank account in any foreign country, then that should be restated. And as an auditor, you should ensure that the bank account has been properly restated as per the applicable AS and Ind AS. Then comes cutoff. So all the cash and the bank account should show balances as per 31st March only, not a day prior, not a day later. Then rights, yet again, you can't ask the client to put their or embed their names on the cash notes and the cash coins. It is for bank only. So all the bank accounts should be in the name of client. And for cash, you will have to agree that if the cash is with the client, the client has all the right upon the cash, and all the cash is to be used by client only and not someone else. For presentation, so cash and cash equivalents are liquid assets and are shown under the current assets. Apart from that, there could be certain disclosure requirements of Schedule 3 that needs to be complied with. Next and the last item for assets in case of balance sheet is trade receivables. So trade receivables are popularly known as sundry debtors. So when the client initiates a credit sale, when the client gives the goods on credit and asks for the money later, that creates a sundry debtor, or that creates a trade receivable in the books of accounts. So if there are any sundry debtors in the financial statements of the client, the first thing that the auditor will check that whether these trade receivables or the debtors actually exist or not. Next, whether the debtors that are shown in the financial statements are complete or not. Third, whether the debtors are shown in the correct value or not. Fourth, that all these debtors belong to the current year only and are as on 31st March only. Apart from that, the presentation and disclosure requirements of trade receivables should be complied with, and it should be seen that the trade receivables are shown in the financial statement as on correct amount only. So the first thing is verifying the existence of trade receivable. Now, how will you verify the existence of trade receivable? Firstly, you need to take the aging schedule of the trade receivable, and from that aging schedule, you need to verify these three things. That is, first, if there hasn't been any transfer from one account to another, then that should have been done properly. In case of any debtors that are outstanding but not due, so there could be any debtors that to whom the goods are sold between 15th 31st March and their due date is post 1 month. So as on 31st March, these debtors will be outstanding but not due. So in such cases or such situations where the debtors are outstanding but not due should be carefully examined. And apart from that, it should also be seen that the aging of debtors has been done correctly. That is, the aging should be done as per the due date and not the accounting date. Apart from that, a schedule of debtors should be taken wherein all the details should be provided for, and the validity, accuracy and recoverability of the debtors should be checked. Next comes completeness of trade receivable, that is whether all the trade receivable as shown in the financial statements are complete or not. That is, there is nothing beyond those trade receivables. So the best thing that you can take is the debtor confirmation. However, it is not possible to take a confirmation from all the debtors. So usually the confirmation is taken from the majority debtors. Apart from that, you can also obtain a confirmation from the management that the schedule is exhaustive and compare the schedule with the books of accounts. In case any debtor is under insolvency, you can obtain correspondence in relation to that. And lastly, the most effective way to ensure completeness of debtors is subsequent realization. So there might be debtors who are outstanding or due as on 31st March, and they make the payments within the months of April and May. So usually by the time we complete the audit of financial statements, it becomes May or maybe June. So you can backtrace from the subsequent realization that whether all the realization that has been received from the debtors that did have their actual amounts or actual invoices as on 31st March. So the best way to ensure completeness is by subsequent realization. Now, how will I check the valuation of trade receivables, or how will I ensure that the amount of trade receivable is correct? So the amount of trade receivable should be tallied with the invoice. Apart from that, if there are any bad debts made during the year, you should see that they are properly authorized. The percentage of discount should be reviewed, and in case of any excessive discount, it should be asked, or the reasonability should be known. And the PBDD, that is provision for bad and doubtful debts, should remain same as last year. In case of any change in percentage, yet again it should be known. And that's it for cutoff. For cutoff, you need to ensure that the schedule should be as on 31st March only, and whatever is belonging to the balance sheet, that should be as per 31st March. For rights, that is whether all the debtors are to be owned by the company or all the debtors are receivable by the company. You should see whether the company has raised valid claims against those debtors, and if any BR, that is bills receivable, is received by the company, that should be in the name of the company and not someone else. For presentation, there are a bit of the requirements in case of trade receivable. First, you need to show whether the trade receivables are secured by any asset or not. Next, whether these trade receivables are credit impaired. Third, whether there is increase in credit risk. Fourth, what is the PBDD amount and what is the percentage. Aging schedule needs to be shown so that the users of the financial statement have an idea that how many debtors are outstanding for more than 365 days and what is the tenure of the outstanding debtors. And lastly, if any promoter due is left, that should also be checked. Now comes the liability section of financial statements. So liability sections of financial statements are usually easier to audit than other parts of the financial statements, because liability is majorly governed by the capital part and there are hardly any changes in the capital part. So liability portion is a bit easier. The hard portion of this chapter has been covered by us, and now you will see that there is a smooth and easy audit procedure for each item. So first comes share capital, that is capital contributed by the shareholders of the company. Yet again, here there are hardly any chances for changes. Usually the share capital remains the same. So in case of share capital, the auditor will check whether the share capital that has been shown in balance sheet actually exists or not. Next, whether it is complete or not. Third, whether the amount shown of share capital is correct or not. Fourth, whether all of this belongs to current year or not. Fifth, whether all the obligations in respect of share capital has been satisfied or not. And lastly, whether everything has been presented or not. Now, to verify existence of share capital, that is whether the share capital as shown in the financial statements actually exists or not, the auditor shall obtain a reconciliation from opening to closing. That is, the auditor shall obtain basically and calculation from the opening share capital to the closing share capital. In case of any changes during the year, the auditor should ensure that every change is properly authorized and approved. In case the authorized share capital is revised during the year, the auditor shall also obtain a confirmation in regard to that. Then comes completeness. So in order to ensure completeness, the auditor shall ensure that everything is properly authorized and every change during the year is properly accounted for. For valuation, very simple. If any shares has been issued during the year, then the amount at which the shares has been issued should be received by the company and the share capital should be credited by that amount. cutoff. So the aging schedule or the schedule of reconciliation should be as per 31st March, and whatever is being shown as on 31st March should be displayed in my financial statements. For obligations, the auditor shall have to check that whether the legal obligations have been satisfied with the company or not. That is, whether all the SEBI laws, Companies Act laws, and other laws for a separate kind of shares have been followed or not. Usually, shares are not allowed to be given at discount. However, sweat equity shares can be given at discount, or forfeited shares can be given at discount. So the auditor should ensure that apart from these two, there are no shares that are given at a discount, and there are separate sections for bonus shares, security premium reserves. So that should also be adhered to. For presentation, yet again, there's a long list. The number and amount of shares should be displayed. The number of shares that has been issued, subscribed, paid up, issued but not subscribed should be shown. The par value, that is the face value of shares, have to be shown. Unpaid calls, if any, have to be shown, and lastly, forfeited shares are to be shown. Next comes other equity. So other equity is basically the piggy bank of the company, wherein whatever extra reserves and surplus the company has got, company invests that in other equity, and basically it is all the reserves that the company has created, maybe for other specific purposes or general reserves. So it is a collaboration of whatever reserves and surplus the company has got. Now, in other equity, what are the things that needs to be checked? Whether these other equity balances actually exist or not. Other equity balances are complete or not. The amount of other equity balances are correct or not. All of this belongs to current year or not. Then the obligation in respect to other equity has been satisfied or not. And lastly comes the presentation part, that is whatever presentation requirements are there for other equity, whether they have been satisfied or not. So to check the existence of other equity, that is whether these other equity exists or not, the auditor shall yet again obtain a reconciliation, see that all the changes have been properly accounted for and authorized, and should also ensure that all the additions and deletions are properly made and as per the law. In case of completeness, yet again the auditor shall see whether all the changes during the year are properly and duly accounted for and nothing is missed. In case of valuation, that is whether the amount of other equity is correct or not. Whatever additions and deletions have been during the year, that should be as per the law, and that should be as per the resolution, and that should be as per the amount that had been authorized for. Cutoff, that is all the other equity should belong as on 31st March. So you can re-verify this through the schedule. In case of obligation, so there are a lot of laws that are prescribed by SEBI, or there are a lot of provisions that are certified by SEBI, and yet again there are a lot of provisions that are certified by Companies Act. So both of them in respect of other equity or reserves and surplus should be adhered to. For presentation, other reserves for earmarked balances, retained earnings and debit balance of P&L should be separately shown. Apart from that, there are also certain requirements in relation to Schedule 3. So even that should be satisfied and seen. Next comes sundry creditors. Basically, when the company initiates credit purchase, that is, takes the goods on credit and promises to pay the person later, they have a liability of sundry creditors in the books of accounts. Now, sundry creditors can be of two types. If you directly credit the person in the books of accounts, they are known as sundry creditor. However, if you initiate a bill against them and tell them to encash that bill, the particular liability is known as bills payable in the books of accounts. So in case of sundry creditor, what are the things that the auditor needs to see? Whether the sundry creditors as shown in the financial statements actually exist or not. Next, whether the sundry creditors in the financial statements are complete or not. Amount of sundry creditors is correct or not. All these sundry creditors belong to the current year or not. The company has the obligation against all the sundry creditors, and last comes the presentation requirements in relation to sundry creditors. Now, how will the auditor verify the existence of these sundry creditors? Very simple, by obtaining a confirmation from the sundry creditors. Apart from that, the auditor shall also check the purchase invoices and ensure that all the sundry creditors that are shown in the books of accounts have valid invoices against them. The auditor shall also obtain a confirmation regarding the internal control processes, that is, whether there are effective internal control processes that are being followed against sundry creditor. In case any client is following single entry system, then there would be a credit ledger adjustment account instead of sundry creditors account, and a schedule shall be obtained by the auditor from the client wherein the details of all the creditors are present. To ensure completeness, the schedule should be compared with the books of accounts, and in confirmation should be taken from the management that the schedule is exhaustive. That is, the auditor should ensure that the schedule on which it is relying is of utmost importance, and it serves as a confirmation that there is nothing beyond this. Apart from that, transactions near the year end should be specially verified. So I'll tell you a case usually that happens in case of banks. So because the banks do not like to show a lot of NPA in their books of accounts, what they do is that they take the check from these customers before 31st March and then eventually bounce their checks in the second or third week of April. So as on 31st March, their accounts look clean, but the reality comes to show after the third or fourth week of April. So it could be a possibility that our client has given a check to the sundry creditor before 31st March, but that check bounces on the third or fourth week of April. So transaction near the end should be specially verified. Next comes evaluation, that whether the amount of sundry creditors is correct or not. So firstly, the schedule and the ledger should be tallied and the amount should be compared. Generally, the amount remains the same. In case of any discrepancy, the management should be asked for. Sundry creditors which are due for long or who have not encashed their check indicate a fraudulent practice, so that should be inquired for. Invoices should be matched with the ledger. In case of any purchase return, that should be duly accounted for, and in case any discount is received, that should be inquired for, and in case of any excessive or exclusive discount, the reasonability of the same should be taken. For cutoff, you should verify that the schedule belongs to 31st March and only that is replicated in the financial statements. In case of obligation, the terms and conditions, if any, with the creditor should be checked, and it should be seen whether the company is agreeing to all the terms and conditions and adhering to all the terms and conditions. Now comes an interesting part in the presentation and disclosures. So herein you will have to show how much amount is due to MSME and how much amount is due to non-MSME. Now why the bifurcation of MSME and non-MSME? So as per the MSME Act, if any MSME is unpaid for more than 45 days, then the payer will also have to add an interest as per the RBI current rate of interest, and hence you'll have to disclose as per MSME and non-MSME, so that even your users know that how much amount is still pending to MSME and whether the company needs to pay any interest to the MSME accounts. Next comes bills payable. So bills payable audit procedure is more or less similar to that of sundry creditors. However, there are certain unique procedures that relate specifically to bills payable. So yet again, in the bills payable, the auditor will have to check whether these bills payables as shown in the financial statement exist or not. Next, whether they are complete or not. Third, the amount of bills payable is correct or not. Fourth, whether the company has the obligation on all the bills payable. Fifth, whether these bills payable belong to current year only. And lastly, the presentation and disclosure requirements in relation to bills payable. So as to verify the existence as done in trade payable, the auditor shall obtain a schedule of bills payable wherein all the details of bills payable are contained. Apart from that, the auditor shall also ensure the acceptance, dishonor, and any other discounting or any other adjustment of the bill has been properly accounted for. To ensure completeness, the auditor shall yet again take a confirmation from the management that schedule is exhaustive and compare the schedule with the books of accounts. And the auditor shall ensure that whatever bills are outstanding as on balance sheet date, none of them have expired and all of them are active. To ensure valuation or amount of bills payable, it should be ensured that the total of schedule tallies with that of ledger. Dishonor, renewal, or discounting of bill, if any, should be properly verified with the correspondence and proper communication between management and the creditor. For cutoff, all the bills should be as on 31st March. The rights or basically the obligations of bills payable are to be checked by ensuring that the terms and conditions of bills, if any, should be properly adhered to. And if the company has got any asset mortgage, then the asset should be clearly shown in the register of charges, and the asset should be mortgaged in the name of sundry creditor and not anyone else. For presentation, the presentation requirements are same as on trade payables, due to MSME, due to non-MSME. Apart from that, notes to accounts, and both bills payable and sundry creditors belong to the current liability of financial statement. Now comes the last item for financial statement, that is borrowings, and usually one of the most dangerous items of financial statements, because borrowings prove as a tax haven for many entities. So a lot of times you will see that many loans in the books of accounts are shown as fake, so that the client can show interest expenses on these loans and evade taxes. So borrowings are a must watch for every auditor, and the auditor should be very cautious while examining borrowings. So the first thing that the auditor will see, that whether all the borrowings that are shown in the financial statements exist or not. Next, whether they are complete or not. Third, whether the value of these borrowings are correct or not. Fourth, whether the rights or whether the obligations of the company on these borrowings are correct or not. All these borrowings belong to current year only. And lastly, whether the presentation and disclosure requirements in relation to these borrowings have been adhered or not. So first comes existence, that whether these borrowings exist or not. So as to verify that, the auditor will first take a loan agreement. So even if you give loan or you take loan, there is an agreement that you enter into. So the first thing that the auditor will do is check the loan agreements for all the loans. The auditor shall also obtain a confirmation from the lender and check whether the confirmation amount matches with my books to accounts. Apart from that, the auditor shall also obtain a schedule of loan which contains all the details, so as to help the auditor in assessing the nature of loan and also assessing the risk in that loans. Next, to ensure completeness, the auditor shall compare the schedule with the books of accounts and obtain a confirmation from management that the schedule is exhaustive, so that the schedule serves as the topmost document for the auditor to verify completeness and existence of the loans. Apart from that, all the loans that have been taken currently in the year should be authorized, and there should be proper resolution slips attached to it. To check the valuation or check the amount of borrowings, it should be ensured that the interest is calculated properly. The amount is as per the agreement. In case of amortizing loan, wherein a part of loan becomes due every year, there should be proper bifurcation of current and non-current. Accounting policies in relation to loan should be properly followed. Cutoff, that is all the loans should be as on 31st March and not a year later or year upcoming. Obligations, that is whether all these loans belong to the company only and not someone else. So the first thing that has to be seen, that whether the MOA and OA, that is memorandum and articles of association of the company, permit the company to borrow. Next, whether all these loans are properly authorized. Terms and conditions of loan should be checked, and if any asset is kept on mortgage, then the asset should be entered on the register of charges, and the asset should be mortgaged only in the name of lender and not someone else. For presentation, outstanding amount of loan should be shown. Conditions to the loan should be clearly presented. Current or non-current depends on the tenure of the loan and the due date of the loan. And apart from that, if there is any security that has been mortgaged against the loan, then it should be checked whether the security covers the full amount of the loan or half amount of the loan, depending on which the loan should be tagged as secured and unsecured. So here we come to an end for financial statements. We have taken around 1.5 hours up till now. We will take another 15-20 minutes to complete audit of some special transaction. I hope you are liking the chapter up till now. I have tried to talk as fast as possible, and I've tried to cover this chapter as smoothly as possible. Yet again, if you don't get time before your examination to listen to the entire revision video, please at least go through the revision notes, because there's a lot of time that we know one part of the question, but because we have skipped such chapters, we are unable to attempt that question. So that regret makes you very sad at the exam hall, and I don't want you to suffer that regret. So don't leave any chapter. Even if you're not able to watch the revision video, at least go through the revision notes. Now comes audit of some special transactions. So these are some special transactions which you might encounter when you practically go for audit. So there are around seven special transactions. All the transactions are pretty easy, and you do expect a lot of questions from these, so they are highly important. So one by one we will be reading the transaction, and accordingly we will be knowing the audit procedures for them. First comes alteration of share capital. So here the authorized share capital is being altered. So authorized share capital is basically the maximum amount of share capital that a company can issue. If the company wants to alter that, there are a number of procedures that the company needs to undertake. So if you are an auditor of the client wherein they have altered the authorized share capital in the current year, the first thing that you need to check whether their articles of association permit that. Next, you need to take the minutes of board resolution and ordinary resolution. You need to ensure whether all the changes are reflected properly in memorandum and articles of association. The denomination of the revised capital should be more than ₹1. All the accounting entries should be properly made in the books of accounts. And lastly, in case there has been any change in the voting rights, so it must be seen by you. Next comes issue of bonus shares. So if the company has issued bonus shares during the year, the first thing that you need to check is whether it is authorized by articles of association. Next thing, board and shareholders minutes need to be taken. The bonus shares are to be issued only to the shareholders whose shares are fully paid up. The bonus shares can be issued only when there is no default in interest or in statutory dues. The bonus shares cannot be issued from revaluation reserve. They can be issued only from general reserve or security premium reserve. So that must be taken care of. And lastly, the bonus share should not be issued in lieu of dividend. Next comes splitting of shares. So splitting of shares basically means if a share is of face value ₹10, it is split into 2 or 3 shares of lower denomination. This is generally done to increase the demand of the shares. So it could be a possibility that at ₹10, many shareholders won't be able to buy that share, but when it is at ₹5 or ₹4, that share would attract demand. So splitting of shares is done to increase the buyer demand. So if there has been share split during the year, I'm really sorry, it was a slip of my tongue. So if there has been a share split during the year, the first thing that needs to be checked is articles of association authorization. Next, minutes of board and shareholder need to be taken. Changes, if any, made in OA and MOA, that is articles and association and memorandum of association, are to be checked. Accounting entries needs to be proper. And lastly, register of members need to be checked. Next is reissue of forfeited shares. So forfeited shares are basically shares which are forfeited by the company due to unpaid calls. So it could be a possibility that there was a face value ₹10 share wherein the company had initiated 4 calls. So there might be shareholders who paid the first 2 calls but forgot to pay the last 2 calls. So in that case, the company forfeits the shares. That is, the company does not provide the shares to those shareholders and keeps the share to themselves. So the company might reissue this forfeited shares at a lower amount. So if the company has reissued forfeited shares, then it should be seen that whether it is authorized by articles of association. Board resolution needs to be passed. It is to be taken care that no ordinary resolution is to be passed, only board resolution is to be passed. Amount received should not be less than fair value. If any excess amount is received, if any excess amount is received on these forfeited shares, apart from the face value, instead of crediting security premium reserve, here capital reserve is credited, and the reissue can be at a discounted price. As said earlier, that not all shares are permitted to be issued at discount. Only sweat equity shares and forfeited shares are permitted to be reissued at a discount. Next comes issue of debentures. So debentures are basically loan-like instruments wherein you pay interest to these debenture holders, and after a point of time you need to return back their money. So if the company has issued debenture during the year, the first thing that needs to be checked whether the prospectus has been filed with SEBI. Further, the application amount and the allotment number is to be tallied with. So if there were 10 debentures that were allotted for 100 rupees, so 1000 rupees should be credited in the bank account. That is the amount received, and the debentures issued should be tallied. Apart from that, SEBI guidelines should be adhered to. If the debentures are issued for any purchase consideration, that is the company has purchased something and instead of providing the money to the vendor, they have given them their shares, then that should be separately disclosed, and the contract should also be checked. Apart from that, if there are debentures that are issued for mortgage, it should be ensured and checked whether it is correct or not. And lastly, register for charges should be checked. Next comes redemption of debentures. So as said earlier, that debentures are just like loan and they need to be repaid. So repayment of debentures is basically known as redemption of debentures. Now there are three ways by which the debentures can be redeemed. First, by the way of periodical drawing, that is maybe at an year interval or a 6-month interval. Next, as on a fixed date. Third, as per the will of the company, that is whenever the company wants to. You first need to check that what is the way by which company is repaying the debentures. So out of the three ways, you'll have to see that what is the method that is opted by your client. Next, you'll have to inspect the debenture trust deed, and third, you will have to ensure that proper accounting entries are passed. And we come to the last item of this special transaction, and one of the most items of special transaction, that is payment of dividend. So dividend is nothing but divisible profit. So the profit after tax that is distributed to shareholders is known as dividend. Now dividend can be basically paid out of four sources: out of the current year profit, out of the past year profit, out of free reserves, and out of any money received by central government. However, even if the company incurs any loss or incurs any other hefty loss, they still can pay the dividend, but there are 3 to 4 conditions that needs to be satisfied. In case of loss, if any company wants to make the payment of dividend, it should be ensured that the dividend rate is not more than the average rate of past 3 years. The profit post payment of dividend, the dividend amount should not be more than 1/10 of paid up share capital plus free reserves. The reserves after payment of dividend should still be 15% of paid up share capital plus free reserves. And lastly, the loss set off should be the priority. So the first thing that needs to be done is the current year loss or the previous year losses, if any, are to be set off, and then from the remaining amount the dividend is to be paid if the company incurs any loss during the year and still wants to pay the dividend. Now, as an auditor, what are the things that I need to check? So the first thing that I need to check, whether the dividend is authorized by articles of association. Next, whether the dividend has been paid accurately. Third, the director's book needs to be examined. Fourth, whether the provisions of Companies Act in respect of dividend, that is under section 123, has been followed or not. Further, the dividend has been paid to the right person, that only the shareholder is at the receiving end and not someone else. Two important things about dividend, that as soon as the dividend is declared, it needs to be transferred to a scheduled bank account within 5 days, and the dividend should be paid within 30 days. So as an auditor, I should ensure that the dividend was transferred to a scheduled bank within 5 days and the dividend was paid within 30 days. Now all this procedure was for final dividend, that is once the balance sheet or once the financial statements of the company are made, presented to the shareholders, then the dividend was declared. So that is known as final dividend. But the company has the option to pay interim dividend also. So if the company does not want to wait till the year end, or does not want to wait till the approval of financial statements, or if does not want to wait till the making of financial statements, the company still has the right to pay dividend. So if before the financial year end or before making the financial statements, the company wants to pay the dividend, it is known as interim dividend. That is before the completion of financial year, if the company makes the payment of dividend, it is known as interim dividend. In case of interim dividend, the procedures remain the same as final dividend. However, there is just one addition to the procedure, that is the auditor needs to ask the reasonability of their interim dividend. That is why or what was the reason that the company couldn't wait for the financial year to end. last topic for this chapter is unpaid dividend. So as said earlier that the dividend needs to be transferred to scheduled bank account within 5 days and it should be paid within 30 days. However, there could be a miscommunication or any other reason due to which the dividend couldn't be paid to the shareholder within 30 days. So does the company take back that dividend and enjoy it in the profits or enjoy it for any other purpose? No. The Companies Act says that once the dividend is declared and is credited to the scheduled bank account, it should not be taken back by the company. Instead, the company should wait for the shareholder to come and take the dividend. So if the dividend doesn't get paid within 30 days, or if any shareholder doesn't claim the dividend within 30 days, that dividend becomes unpaid dividend. So in case of unpaid dividend, there are procedures that the company needs to follow. So the company first have to make sure that it pays all the dividend within 30 days. However, if some dividend remains unleft remains left or remains unclaimed, then the company shall transfer this dividend within 7 days to unpaid dividend account. Post transferring to unpaid dividend account, the company shall within 90 days release a statement containing the list of shareholders whose dividend are unclaimed and publish them on the company's website and other corporate websites, so that if the shareholder visits those sites, the shareholder can access that document and claim their dividend. The company will wait for 7 years and put the amount in the unclaimed dividend account. However, if the shareholder does not turn up within 7 years, the company transfers this unclaimed dividend account to Investor Education Protection Fund. Now, Investor Education Protection Fund is basically an initiative by government wherein all the unclaimed shares and unclaimed dividend are kept by the company because it's a very normal thing that for 7 years the company has waited. However, it could be harassing for the company to wait for more years, and suddenly if the shareholder turns up and says that I need the dividend or I need the share, it could be problematic for the company. So post 7 years, these are transferred to the government, and if the shareholder after 7 years comes and says that I have this dividend unclaimed or share unclaimed, they can directly communicate with the IEPF, that is Investor Education Protection Fund. Now, what are the audit procedures in relation to that? So the first thing that the auditor needs to do in relation to unclaimed dividend is obtain the list of unclaimed dividend. Next, check if there is any fault on the part of the company, that is whether the company has manipulated something or the company has fraudulently not paid any person the dividend. So the next step that is to be checked is whether there is any fault on the part of the company. Third, dividend register, warrant, bank statement should be checked. Fourth, the auditor shall see that the money was transferred to unpaid dividend account within 7 days and the money was transferred to IEPF within 7 years. Fraud on the part of the company, if any, should be reported and the company should be charged interest. And apart from that, the auditor shall also verify whether within 90 days the details have been put up on the website or not. So in case of dividend, you will usually see that if you remember the procedure nicely, you can write the audit procedures yourself, because the audit procedures are nothing but the addition of the word check in front of the procedures. Next comes punishment. So since dividend is the right of shareholders, there could be a possibility that the company does any manipulative act, and if the company does so, then the company needs to be punished. So these punishments are in relation to dividend. So if the company does not make the payment of dividend within 30 days, the person in default shall have an imprisonment of up to 2 years and fine of 1,000 rupee per day for default. Apart from that, the company will also have to bear an interest of 18% per annum. If the company defaults in transfer to unpaid dividend account, the company will have to bear an interest of 12% per annum. If the company defaults in transfer to IEPF, that is Investor Education Protection Fund, the company will have to bear a penalty of 1 lakh plus 500 per day of default. The person in default who does that will have to bear a penalty of 25,000 plus 100 rupee per day in case of failure. That can go maximum up to 2 lakhs. However, no offense shall be constituted, that is, nothing shall be considered as faulty or as punishment if these are the 5 situations that the company encounters. What are the 5 situations? First, if there was a legal obligation to not pay the dividend. Next, there was any condition by the shareholder which the company could not comply and the company did communicate it to the shareholder. Third, if there was any dispute regarding the right to receive dividend. Fourth, whether the dividend when the dividend has been lawfully adjusted against any other due of the shareholder. And lastly, if there was anything that was not considered as a default in this section. So this was the revision of the lengthiest chapter of your syllabus. I hope you liked it. We'll take a 1-minute break, post which we will do the Q&A of this chapter. So usually there are not a lot of questions from this chapter, at least from the P&L items. There are almost negligible questions from this chapter. So there are around 7 to 8 questions that I have selected, which we will be solving, which might take us like 20 to 25 minutes from now. But before that, we'll be taking a 1-minute break, and post that we'll be solving the Q&A. Hope you are enjoying up till now, and if you do so, do like, share, comment, and subscribe. So I hope you people are back from the break. Before the break, we completed the revision of subchapter 3 of companies audit, and now we'll be doing the Q&A. That is all the important and probable Q&A of this chapter. Does not have a lot of questions. 8 questions are there that is to be solved. All the questions that I've selected are either 2, 3, 4-star questions. That is, they are highly important as per this chapter. So yet again, even if you're not getting the time to watch the revision videos, at least refer the revision notes and the Q&A for this chapter. So let's start with it. The first question is, write a short note on audit of property, plant and equipment. Again, a 4-star question, that is, it has appeared 4 times in your previous examinations. Now, in case of audit of property, plant and equipment, you will basically have to specify the audit procedures as per the assertions. So what are the assertions that are to be certified in case of property, plant and equipment? So first comes existence. Now how will you check the existence in property, plant and equipment? By conducting PV of the asset, comparing it with books of accounts, and in case of any discrepancy, you can ask the management to rectify it. And if any asset is not in active use, then you shall ask the management to remove that asset from the head of PPE. Now you don't have to write all the procedure in case of every assertion. If the question is of around 8 marks, you will have to write 2 to 3 procedures for each assertion. Now we have done it for existence. Next comes completeness. Now how will the auditor verify the completeness? So the auditor basically needs to take the help of PV report again, and the auditor shall verify the arithmetical accuracy of schedule that is given to the auditor. Next comes valuation. Now how will the auditor verify the valuation? So AS or Ind AS, whatever is applicable to the company, should be followed. The depreciation should be calculated properly as per the installation certificate, and the rate of depreciation and the useful life should be correctly calculated. Apart from that, the cost should be taken as the cost as mentioned in the agreement. In case of any impairment during the year, the auditor shall take the reasonability of the impairment and check whether the calculation is done properly. For rights, the auditor shall check the title deeds and agreements, and also ensure that the internal controls are properly effective and there has been proper authorization, approval and budgeting for each asset. For presentation and disclosure, these PPE usually appear under non-current assets, then tangible assets, and then comes the column for PPE. So you will have to state at least 2 points for each assertion. Usually the marks for each question in case of an audit paper are 7 or 8. So the highest mark in an audit paper for each question is 8 marks. So for 8 marks for each assertion, you will have to state 2 points. Now, next comes as a statutory auditor, how will you verify copyright? Again, a two-star question. So, what are the things that you will check in a copyright? First, you will check agreement, obviously, because copyright is basically an intangible asset. And since these intangible assets do not have any visual evidence, the best way to verify these intangible assets is through documentation. Next, if any revaluation has been made during the year, then you should check the reasonability of the revaluation and check whether that is properly accounted for or not. Approved valuation certificate should also be taken. The opening balance should be verified from the last year audited balance sheet, and apart from that, you should also ensure that the ledger has been properly accounted for. Now, these points might slightly differ from the points that are given in the book, so not to worry. Even if you're not comfortable with these points, you can write the points that you have read in the books, and still you will be able to secure full marks. So not to worry about the answers. If you know the content and the content matches with the book, there is no way that your marks will be cut. You will be given full marks. Now, next comes, how will you vouch the sale of investment? Two-star question. Now, there is no specific topic known as sale of investments in audit of items of financial statement. However, they have still given this topic, and this topic has already appeared 2 times before in the examination. So it could be a probability that you can expect some out of the syllabus questions for this chapter. So yes, the questions relating to this chapter are a must solve, and usually you do not get much out of the syllabus question. Like, you won't get questions that are totally unrelated. The questions that you will get or you can expect would be a bit related to what you have studied, so not to worry about that. And usually this is one unique question that has repeated. Other than that, the unique questions are not of repetitive nature, so not to worry about that. Now, how will you verify sale of investments? So the first thing that you need is documentary evidence. Apart from that, you will have to check from the accounting perspective what all is to be checked, that whether the profit and loss has been correctly calculated and accounted for. Next, the profit and loss should be calculated on the basis of carrying value of investment. Apart from that, interest, rentals, or any dividend relating to that investment should be only to the sale date. Beyond that, there should be no credit in regard to that. Changes in the other investment amount should be duly recorded, and apart from that, the year in investment should be tallied with the physical certificate, and it should be seen that whatever the investments have been sold, the company does not still own the physical certificates of that, because once the investments are sold, and if you have any physical certificate, the authority will also have to take the physical certificate. So as on the year end, the investments which are sold should not have any due documentary evidence, or should not belong to the entity. Next question, write a short note on audit of inventory. 4-star question, hence very, very important. However, there is also a case study based question on that. So we'll read that and I'll explain how do you tackle these case study based questions. So the question is, B Mart is a multi-brand retailer and operates in multiple locations across the nation. It sells products of thousands of categories, from food to consumer durables. Each individual product item has a price tag with barcode. In addition, there is another security tag which is removed only after the billing is done. Inventory records are physically verified on fortnightly basis by auditor of B Mart Limited. Identify the risk associated with audit of inventory in B Mart Limited. So has there been any topic regarding audit of risk in inventory? No. So if these kind of case study based questions are asked, you'll have to see that whether this topic has been taught to you or not, or whether this topic has been in your syllabus or not. So there has been no topic relating to risk associated with audit of inventories, but there has been a topic of audit of inventories. So you'll have to assume and answer according to the audit of inventories rather than risk associated with audit of inventories. Apart from that, this is an important case study question. This is a question from your module. So this question is a must see, but its answer is very simple. You will simply have to write the audit procedures in relation to inventory. So one by one, we'll write upon the assertion and discuss the audit procedure. Yet again, if it is an 8-mark question, all you need to do is write 2 procedures for each assertion. First is existence. So existence of an inventory is to be verified by physical verification. Physical verification is to be tallied with books of accounts. If the inventory is being recorded as per or maintained as per the periodical system, then you'll have to wait for the period to end. If it is on the perpetual basis, then you can have the physical verification of inventory anytime. Next comes completeness. So how will you ensure completeness of inventory? Yet again, through recalculation and through PV certificates. Apart from that, you can also apply analytical procedure and obtain non-financial information about the inventory. If the inventory is lying with a third party or with any branches, you can also obtain a confirmation from them. For valuation, the finished good is to be valued at cost or NRV, whichever is lower. WIP is to be valued at cost of completion. Raw material at cost. Damaged goods at NRV, obsolete goods at zero price. And apart from that, accounting policy in respect of inventory also needs to be seen. For cutoff, it is to be ensured that all the inventory that is being shown is as on 31st March. For rights, obviously, you won't ask the client to put their name on the inventory. Instead of that, you can see whether all the purchase invoices and GRN are in the name of the company. If there is any consignment agreement, check the terms and conditions of the agreement. And in case of any goods lying with third party, obtain a confirmation as to the rights of the company and the quality and quantity of goods. Last comes presentation and disclosure. So herein separate bifurcation is to be given for goods in transit, finished goods, raw material, WIP. Apart from that, method of valuation is also to be given, and inventories are displayed under current assets or financial statement. Next question, again a 3-star question. Audit of bonus shares issued by the company. So what are the audit procedures that are undertaken by the auditor in case of bonus shares issued by the company? The first thing that needs to be checked is whether it is authorized by articles of association. Next, board resolution and ordinary resolution meeting minutes are to be taken. Third is to be seen that only the fully paid up shares are paid, the bonus shares. There should be no default in interest or principal of any deposit and any statutory dues. Apart from that, the bonus can only be paid through general reserve and not revaluation reserve, so that needs to be checked. Partly paid shares are to be made fully paid for issuing a bonus. Otherwise, the partly paid up shareholders cannot get a bonus issue, and the bonus should not be made in lieu of dividend. Next comes question number 6. So as an auditor, how will you verify audit of free issue of forfeited share? Yet again, we have completed this topic in the class for verifying the reissue of forfeited share. First, you need to check whether the articles of association authorize it. Next, board resolution is to be checked and not shareholder resolution. As I specified in the revision also, this is the only topic wherein shareholder resolution is not to be checked, just the board resolution is to be checked. So you need to take care of that. Apart from that, amount collected should be verified. You should ensure that the amount collected before and the amount on reissue is not less than fair value. In case of any surplus arising upon that, it is not to be credited to security premium reserve. Instead, it is to be credited to capital reserve account, and discount provision should be adhered to. That is section 53, which describes the provisions relating to shares issued at a discount. That all provisions should be adhered to. Next, state the auditor's duty in respect of issue of redeemable debentures. So a lot of students might misread this question. So instead of writing about issue of debentures, they will end up writing about redemption of debentures. See this question clearly. They are asking about issue of redeemable debentures. The redeemable word is just to confuse you. They are not asking about redemption of debentures. They are basically asking about issue of debentures. Issue of redeemable, irredeemable, or any other type of debentures remain the same. So whenever you see issue of a particular type of debentures, all you need to write is issue of debentures. Do not fall into the trap and write redemption of debentures. Now, in case of issue of debentures, what all audit procedures are to be followed? First, it is to be ensured whether prospectus has been filed. Next, whether resolution has been passed. Third, SEBI guidelines has been adhered to. Proper entry should be made in the books of accounts. There should be a tally between application amount and allotment made. Debenture trust deed should be examined. In case debentures are covered by a mortgage, then the register of charges should be examined. For debentures issued against the purchase consideration to any vendor, the contract should be examined. And lastly, it should be ensured whether debentures are properly maintained and accounted for in the books of accounts or not. And the last question, again, a 2-star question. Declaration of dividend by a company under section 123. So herein they are not asking about the audit procedure in respect of dividend. They are asking about the procedure to be done by the client in case of declaration of dividend. So first of all, you will have to say out of which kinds of surplus can the dividend be paid. So dividend can be paid from the profits of current year, or from the profits of past year, or from any amount that is received by central and state government. After proposing the dividend should be transferred to a scheduled bank account within 5 days, and the dividend should be paid within 30 days. There should not be any prior default in deposits or statutory dues before payment of dividend, and no dividend shall be declared from any particular reserve or any special reserve. All the dividends are to be declared by free reserves. In case if the company has earned a loss and still wants to pay dividend, there are 3 conditions that needs to be followed. The dividend should not be at a rate more than the average rate of 3 years. Apart from that, the dividend amount should not be more than 1/10 of paid up share capital plus free reserves. And lastly, the reserves after withdrawal of dividend should be minimum 15% of paid up share capital plus free reserves. And not to be forgotten, the losses should be first settled down, because you should first help yourself and then others. So losses, if any, of the company of current year or previous years, if unabsorbed, should be settled down. So this was the question. I feel after revision, the question and answer becomes very easy. So yes, be in continuous revision, and I feel the revision notes are very concise as compared to the long chapters. So you can obviously allocate like 3 to 4 days for audit and just go through the revision notes and the revision videos, and make sure that you're done with the subject audit, because I feel as a theory subject, audit can be a game changer, and audit can help you secure exemption in this paper. Usually in accounts, we have the typical sums, and we might goof up in either accounting entries or certain figures. So audit is a safe option, and plus you will see the papers, the questions in audit are very direct. So if you're very thorough with the revision notes or very thorough with the context of the book, it is very easy to secure marks in audit. So that's it. And then next is company audit subchapter 4, which we will start after a break. So company audit subchapter 4 marks our last chapter for company audit, post which we will be starting audit of different kinds of undertaking. I hope you're liking this video till now. Company audit subchapter 4 is like a short chapter. It would take us 45 minutes to 1 hour, and yet again audit of different kinds of undertaking is also a small chapter, would take us 45 minutes to 1 hour. So let's meet after a break, and you can take a break of 5 to 7 minutes if needed, and post that you can join us in the video. Thank you. Hello everyone. So I hope you people are back from a wonderful break. Prior to the break, we completed company audit subchapter 3, which was one of the lengthiest chapter of our entire syllabus. And now we are left with the last subchapter of Companies Act or Companies Audit, that is subchapter 4. So subchapter 4 basically deals with the main and the final product of audit, that is audit report. As I said in the start of the video, that auditor has 2 duties. First, to check the financial statements, and next to express the opinion on that financial statements through his audit report. So audit report's opinion is basically a parameter for the shareholders to judge the reliability of financial statements. If the auditor's report says that the financial statements are reliable, or if the auditor gives a unqualified opinion or a thumbs up, then the shareholders believe the financial statements. If so, he says that the financial statements are unreliable, then the shareholders do not believe the financial statements. So audit report is very, very important for the auditor. It is ultimately to the audit report that shareholders judge the auditor's work. So audit report is basically a documentary evidence reflecting opinion of auditor regarding the financial statements of the company, whether the FS or the financial statements are giving a true and fair view or not, or whether the financial statements are as per AS and Ind AS or not. Now, always and always remember, an audit report is very, very important for the auditor, because let me tell you, the shareholder does not have the time that he'll check all the audit procedures of the auditor, or he'll see how much hard work the auditor has done. If the audit report of the auditor is wrong, the shareholder would simply defy that auditor and would not believe that auditor and would not hire the auditor for the next year. Whereas if the audit report is correct, shareholder won't be concerned if the auditor slept during the audit procedures or was awake during the audit procedures. Very simple, the shareholders have appointed the auditor because of that only, that the shareholders do not have the time to check the day-to-day functioning of the entity, and they have appointed an independent person to do that. So it is the auditor's ultimate responsibility to give the correct opinion on the financial statements. Now, since the start of this revision, I have been saying that opinion is important, opinion is important. So what kind of an opinion can the auditor give in his audit report? So basically, four kinds of opinion that the auditor can give in his audit report. First is unqualified opinion. So if the auditor thinks that the financial statements are reliable, the financial statements do not contain any mistakes or misstatements, the financial statements comply with all the relevant laws and regulation, comply with AS and Ind AS, whatever financial reporting framework, have disclosed all the accounting principles, followed all the accounting principles. If there has been any change in the accounting principle, the same has been reflected through the financial statements and also has been described in the financial statement. If all the above parameters are satisfied by a company, then the auditor gives them an unqualified opinion. That is, he asks the shareholders to trust upon the financial statement. Now, let me tell you, it is one of the hardest opinions, because if the auditor gives a negative opinion, the auditor has a scope to say that yes, I warned you regarding the financial statement. But when the auditor gives an unqualified opinion, he is blindly asking the shareholders to trust upon the financial statement. So maybe after 2 to 3 years, if any fraud comes up from the company, then the auditor will also be held liable, that what was the checking that the auditor did. Whereas if the auditor would have given a negative opinion, at least he would have a backing that yes, I gave a negative opinion and ask you people not to trust upon the financial statement. So although every company wants an unqualified opinion from the auditor, it is the hardest opinion that the auditor gives. Now, coming to the next kind of opinion, that is qualified opinion. So if the auditor observes any mistakes that are material, that are important, that can affect users of financial statement, but that are not pervasive, that is, they do not affect the whole financial statement, that do not relate to the whole financial statements, then the auditor gives a qualified opinion. Example, so if the auditor is conducting an audit of an entity, and if he has audited the entire financial statement and he observed there was a mistake just in the inventory portion. So now the inventory portion mistake is material, but it is not pervasive. That is, it does not affect the whole financial statement. It does not destroy the whole financial statement. It does not relate to the whole financial statements. It does not have a negative impact upon the whole financial statement. So in such scenario, the auditor gives a qualified opinion. Further, if the auditor is able to obtain evidence for the entire financial statement, but isn't able to obtain evidence for 1 to 2 items of financial statement which are material but not pervasive, that is, do not relate to the whole financial statement, then also the auditor gives qualified opinion. Next comes adverse opinion. So when does the auditor give an adverse opinion? When the auditor comes across any misstatement that is material as well as pervasive, that is important as well as it relates to the entire financial statement, then the auditor gives an adverse opinion. Example, so if you know, in case a company is a going concern, they prepare their accounts on the accrual basis, whereas if it is not going concern, as per the accounting principles, they need to prepare their accounts on realization basis. So if the auditor comes across any entity which is not a going concern and ask them to prepare their accounts on the realization basis, but still they are adamant and prepare the accounts on accrual basis, this makes the whole financial statement wrong, and here the mistake relates pervasively or affects the entire financial statement. In such a case, the auditor gives an adverse opinion. And last scenario is disclaimer of opinion. So when the auditor is unable to express an opinion, when the auditor is not able to get the evidence to express an opinion, then he gives disclaimer of opinion. So let's suppose auditor went to audit a client, and when he asked for the supporting documents or supporting evidences, he was received by none. So if he was checking sales, he asked for sales invoices, but it was not provided to him. If he was checking purchases, he asked for the GRN, it was not provided to them. Similarly, for other items, whatever documentary evidences were required by him was not provided to him. So in such a scenario, he wasn't able to express an opinion because he wasn't able to check the financial statements. He wasn't able to check whether the financial statements are correct or incorrect. So in such a scenario, the auditor gives disclaimer of opinion when the auditor is unable to express an opinion on financial statements. So there are basically 4 kinds of opinion which the auditor has the option to express. First is unqualified opinion, next is qualified opinion, third is adverse opinion, and lastly it's disclaimer of opinion. Qualified, adverse and disclaimer of opinion are types of negative opinion, whereas the positive opinion is unqualified opinion. This opinion para is highly important. You can expect a lot of differences between different kinds of opinion. You can also expect standalone questions on different kinds of opinions. Opinion paragraphs and meaning of the opinion is very important. Now, what do you think? Is the opinion enough, or just the reporting of the opinion enough for an audit report? If in the entire audit report just the auditor gives his opinion, is that enough? No, he'll have to give the supporting of his opinion. Why does he believe that the financial statements are reliable or unreliable? What are the instances that made him believe that financial statements are reliable or unreliable? Which portions of the financial statements are unreliable, or which part of the financial statement he thinks is reliable? What are the statutory requirements that the companies complied with? What are the statutory requirements that the company didn't comply with? Everything has to be given so that the users of my financial statements or the users of the financial statement get a clear understanding of audit, opinion and financial statements. So there are basically 3 areas or 3 statutes which define the content of audit report. First, Companies Act, next SA 700 and third CARO 2020. So as per Companies Act, it states the additional disclosure requirements of an auditor, that is what are additionally to be disclosed in the audit report. Next, as per SA 700, they disclose or they tell you about the content of audit report, that what should come first and what should come next, basically providing a form of audit report. And last comes CARO 2020, which is not applicable to every company or every audit, but to whomsoever it is applicable, it again tells you about the additional disclosure requirements to be made in audit report. So first, we'll come to Companies Act. So what does Companies Act say? So Companies Act basically state about the additional reporting requirements of the auditor, that these all should also be included in the audit report. Now let me tell you, you have already covered this under Company Audit subchapter 1. Under the duties of auditor, when we were reading duty to report, these reporting responsibilities of the auditor are to be reported in the audit report only. So we have already covered this entire portion, but we will still revise it. So what all things the auditor should report in his audit report in addition to opinion? First, whether as per him the financial statements reflect a true and fair view. Next, if any fraud has occurred during the year and whether it has been reported or not. Next, if the company is a government company, whether the company or the auditor has complied with the directions of CNAG and what are the effects of those directions. Apart from that, 10 additional reporting requirements of the auditor, that these 10 things are to be reported by the auditor in the audit report. First is whether he has received all the information and explanation in relation to financial statement. Next, whether branch audit reports have been received by the auditor and whether regular returns are filed by the branches. Third, whether the financial statements is as per the financial reporting framework or AS/IND-AS, whichever is applicable to the company. Fourth, whether the books of accounts are properly maintained as per section 128. Fifth, whether the directors are disqualified or not disqualified. Sixth, whether the books tally with the returns. So whatever books of accounts are made, are they tallying with the returns that are filed? Eighth, whether the auditor has any observation in relation to accounts of the company. So as I said in subchapter 1 also, there ultimately company is run by a human and their will be certain mistakes which be still present in the financial statements. So if the auditor has certain observation about the accounts of the company that is placed before the shareholders or users, then that is to be stated. Anything which the auditor came across that affects the adverse functioning of the company, or that might maybe cause the company to end or cause the going concern assumption to fail, should be stated. And lastly, comments on any of the above. Apart from that, there are 3 additional reporting responsibilities of an auditor: that the auditor should state whether the dividend has been deposited in IEPF on a timely basis and there has been no default on the part of the company, whether provision has been created for all the foreseeable losses as per the prudence concept of accounting, and lastly, whatever pending litigations are there, whether the company has disclosed their impact in the financial statements or not. So these were the additional reporting requirements as per Companies Act. So if you have already covered subchapter 1 of Companies Act or Company Audit, you have already gone through this. This is just a repetition of that. Next comes SA 700, which basically provides the form as per which the audit report should be made. That is, what should come at the start, what should come next, after that what should be given, what are the requirements that are to be provided in the audit report, apart from opinion, what all things to be are to be given, what are the things that should be there to support the opinion. Everything is provided as per SA 700. So if you talk about the form and content of audit report, the main content of audit report or main form of audit report is provided as per SA 700 only. So first that should come in an audit report is the title, which is Independent Auditor's Report. Independent word is given so that the auditor realizes his responsibility to be independent, and he agrees that whatever opinion is provided in the audit report is independent and his opinion is not dependent on someone, or his opinion is not governed by someone else. Next comes addressee. So addressee are basically the ones to whom the report is addressed, who are generally the shareholders. However, it may differ in different situations, and usually the appointing authorities are the addressee of any audit report. Then comes opinion, which is the main paragraph of audit reports. You won't find the shareholders searching for the first 2 title, addressee or other paragraphs. They would first search for the opinion paragraph, because ultimately it is on the basis of opinion paragraph that they can conclude about the financial statement, and they can then further on go to the financial statement. So opinion paragraph is the most important paragraph. Now, what all is to be given under opinion paragraph? First, obviously the opinion of auditor. Next, the client's name, the financial year for which the audit was conducted, reference to any accounting policies or principles if the auditor want to attract attention, and lastly, the statement that financial statements have been audited during the year. Next comes basis for opinion. So as much as opinion is important, basis for opinion is also important, because ultimately shareholders want a proof from the auditor that how did the auditor arrive on such an opinion. So under basis for opinion, auditor will basically state his duties and say that I have been independent during the year. Next, I have followed all the auditing standards and all my work is governed by the auditing standards. Next, he shall also give a reference to the auditor's responsibility. And lastly, he should say that whatever conclusion I have arrived upon is on the basis of evidence that I have obtained. So there is nothing that I have done on my intuition basis. All the results or all the conclusions are a result of my evidence obtained, and the evidence is obtained from the audit procedure, and the audit procedure has been applied by or has been applied according to the standards. Next comes going concern. So going concern paragraph is not to be given under every entity's audit report. Going concern paragraph is to be given only when the auditor feel that there is a lack of going concern assumption in the entity, or there client might not be standing true to the going concern assumption, or there might be a negative effect to the going concern assumption, basically that the client is not going to survive for another year, that is their business is going down. So in case there is a doubt on the going concern assumption, the auditor gives this para so that the shareholders are aware that the going concern of the client does not stand strong and there might be a material uncertainty regarding the going concern assumption. Next comes key audit matter. So key audit matters basically contains matter which the auditor thinks are necessary for the users of financial statement. So any matter which the auditor has come across during the audit of financial statement and he thinks that this is crucial for the user's understanding of financial statements, then he puts that matter under key audit matter. Example, there could be any pending litigation going on. So he might have come across the outcome of the pending litigation during the year, and he must have got to know that if the company loses this case or if the company loses this litigation, then the company will have to suffer losses of 1,000 crores. So this is now crucial matter and requires understanding of users of financial statements. So such matters are usually stated under key audit matters. Next comes management responsibility, which is very, very important because shareholders a lot of times sublime auditors and management's responsibility. So there's a big conception, there's a big misconception that goes around that the financial statements are usually prepared by the auditor. No, it is absolutely wrong. The financial statements are just to be checked by the auditor. The financial statements are prepared by the management. So management's responsibility is very, very important so that the shareholders are aware of the auditor's duty and the management's duty. So what are the management's responsibility? First, the financial statements should be prepared as per the financial reporting framework. Next, to check whether there has been proper design, implementation and maintenance of internal control. And lastly, undertake a going concern assessment. So every year the management should undertake a going concern assessment and check on the basis of assets and liabilities in the entity whether the entity will survive the next year and whether the entity is satisfying the going concern assumption. Then comes the auditor's responsibility para. So the first thing that is to be stated under auditor's responsibility is that auditor should obtain reasonable assurance that financial statements are free from material misstatements, whether due to fraud and error. So this statement is a bit in audit language and the auditor has to give clarificatory remarks on this statement. So the first thing that is to be stated that reasonable assurance is a high level of assurance but is not a guarantee. Next, the meaning of material is to be disclosed or material is to be explained. So material means anything that is important and crucial to users' understanding of financial statement, and materiality at a lot of times can be also calculated on the basis of financial reporting framework. So if you see Schedule 3 disclosures, they require that every shareholder holding more than 5% of the shares should be disclosed separately. Why? Because they consider shareholders holding more than 5% of the shares as material. So financial reporting reference could also be taken up, but it is important for the auditor to explain the users that everything in relation to use of the financial statements have been taken up and everything that is important for the user's decision of financial statements has been considered as material. Apart from that, the auditor shall also disclose the 4 additional responsibility, that is first to identify and assess risk of material misstatement. Next, to recheck going concern assessment, because simply if the management says that we are going concern, the auditor should not believe. The auditor should recheck the going concern assessment, obtain an understanding of internal control, and lastly examine the appropriateness of all the accounting practices and the principles and estimates that the company is following. After that comes other reporting responsibilities para, wherein all the 10 things that are to be reported as per Companies Act are to be reported. So all these 10 things that we revised just now are to be reported under other reporting responsibilities. After that comes the signature of the signing partner, and in case a firm is appointed, so the name of the firm. Then comes the date on which the audit report was signed, and last comes the place, that is where was the audit report signed. So we have completed the content of audit report as per SA 700 and as per Companies Act. Now comes the last kind or the last statute which explains the content of audit report, that is CARO 2020. So as I said in the start, CARO 2020 is not applicable to every company. So first thing that is to be understood, that what is CARO 2020? So CARO 2020 was basically an initiative of government, wherein government said that maybe the notes to accounts are also not sufficient for the transparency to disclosure. I'm sorry. So CARO 2020 was basically bought in by the government, wherein they said that even the notes to accounts are not enough for transparency to the users of financial statement. Example, so if I could see loans during the year, as per the notes to accounts or as per schedule C, I could see to whom the loans were granted. But it could be a possibility that the loans were granted to the same persons who had defaulted in the earlier year. Now, this kind of reporting is not done as per Schedule 3, but this kind of reporting is extremely important for the users of financial statement, so that they get to know that maybe their money is getting wasted and maybe the company is trying to manipulate them and maybe enter into fraudulent practices. So government said that these kinds of reporting should be done by the auditor, and then CARO 2020 was brought in. So CARO's full form is Company Audit Report Order, and 2020 is the year when it was revised. So there are basically 21 clauses, and each clause deals with a different item of financial statement, wherein the auditor has to disclose or has to report about that item. As I read the reportings, or as I explain you the reporting one by one, you will understand that these reportings were very crucial for the user's understanding of financial statement, but were not being done in the notes to accounts, which did show a lack of transparency in the financial statement. So now that we have understood CARO 2020, we need to understand to whom it is applicable. So CARO 2020's applicability is not in the positive manner, it is in the negative manner. So instead of stating to whom CARO 2020 is applicable, it basically states to whom CARO 2020 is not applicable. So to whom CARO is not applicable? So CARO is not applicable to small company, OPC, Section 8 company, banking company, insurance company, and a kind of private company which is not a holding and subsidiary of public company. Further, the turnover of this private company is less than equal to 10 crore, plus the paid up share capital of this private company is less than equal to 1 crore, and the loans and the borrowings of this private company is less than equal to 1 crore. If any private company satisfies all this condition, then CARO 2020 is not applicable to this company. The applicability criteria of CARO 2020 are highly important. You can expect separate questions from them, and you can also expect MCQs from them. So we'll repeat once again, to whom CARO 2020 is not applicable. Yet again, I am saying the applicability criteria of CARO 2020 is on the negative end. Instead of explaining to whom CARO is applicable, they basically explain to whom CARO is not applicable to. So to whom CARO is not applicable: Section 8 company, OPC, small company, banking company, insurance company, private company, which is neither a holding or subsidiary of which is neither a holding and subsidiary of public company, whose turnover is less than 10 crore, paid up share capital is less than equal to 1 crore, and loans and borrowings are less than equal to 1 crore. Now, what are the clauses or what are the reporting items of CARO 2020? So the first item or the first clause is PPE, or popularly known as fixed assets. So what is to be disclosed by the auditor, or what is to be reported by the auditor and for PPE? So the first thing that is to be reported is whether the company conducts regular physical verification of this PPE, and in case of any discrepancy, whether it is properly adjusted for or reported. Next, whether all the title deeds of the properties held by the company are in the name of the company. If not, if it is held in the name of any promoter of any, or if any other person, then that is to be disclosed. Third, whether the company deals in any of the Benami property. So the Benami property basically means that the beneficial and the actual owner of the property are different. Example, so tomorrow suddenly I go and claim that Antilia, Mukesh Ambani's Antilia is mine, and I can show the papers that this property is registered in my name. So would it be correct or wrong? Obviously wrong, because ultimately the actual owner of Antilia is Mukesh Ambani, but I am saying that I am the beneficiary. So these kind of properties are known as Benami property, and they are dealt as per Benami Act. So the auditor has to disclose that whether the company is dealing with any Benami property. Fourth, whether any PPE has been revalued during the year, and if the revaluation amount exceeds 10% of the carrying amount, that is to be disclosed. And lastly, it is to be ensured that all the proper records of PPE are maintained with all the necessary details. Even that is to be reported by the auditor. Next clause is upon the inventory. So for inventory, the auditor has to disclose whether physical verification of inventory is conducted time to time, and in case of discrepancy more than 10% of the carrying value, is it time to time adjusted or is it left? So 10% is the material amount for inventory, so 10% or more of discrepancy should be immediately adjusted. So the auditor has to report that whether if there is any discrepancy found of 10% or more, is that immediately adjusted by the company or not, or is the action taken by the company or not. And the next thing that has to be reported by the auditor, that if the company has taken any working capital loan, the amount of which exceeds 5 crore, and the company is submitting quarterly bank statements, if the company is submitting quarterly statements to the bank, whether the figure of inventory is correct or not. So if you take a working capital loan, that is usually on the basis of the inventory and debtors that you have. Now inventory and debtors are current assets that keep on changing. So to keep a check on the mortgage value, or to keep a check on the asset value, the banks usually ask for a quarterly statement. Now the quarterly statement should have the correct figures of inventory and debtors. So the auditor has to report if the company has entered into a working capital loan that is more than 5 crores, whether the quarterly statement that is submitted by the company to the bank is correct or not, that is the inventory figure is correct or not. Para 3 clause 3 deals with LGSI, that is loan guarantee security investment. So loan guarantee security investment require the disclosures that how much of this, or how many of these loans, or how many of this guarantee security investment has been lent to the related parties, that is joint venture, associate, subsidiary and others. Next, it is to be reported by the auditor that if any amount is overdue for more than 90 days, whether proper action has been taken by the company. Third, terms and conditions should not be prejudicial to the interest of the company. Fourth, the auditor should also report about the stipulation of payment of interest and principal. Apart from that, how much of the advances granted during the year consist of the advances which are extended, renewed, or fresh advance has been granted to the person who has earlier defaulted with the company. And lastly, proportion of the advances that are repayable on demand, or that do not have any terms or conditions, or that are paid to promoter should also be shown, and their percentage to the total advances should also be disclosed. Next comes para 4, which deals with compliance in case of LGSI. So clause 4 basically asks the auditors to report that whether section 185 and 186 of the Companies Act has been complied with or not. Then comes clause 5, which deals with deposits. So if the company has taken any deposits during the year, the auditor has to report whether RBI directives are followed or not. So RBI is basically the apex body of banks, and if you remember the applicability criteria, so CARO is not applicable to banks. Here we are talking about NBFC. So if the client that the auditor is dealing with is an NBFC and it has taken any deposit, then the auditor has to report that whether all the RBI directives are followed or not. Next, whether section 73 to 76 of the Companies Act has been complied or not. That is, these sections basically deal with acceptance of deposits. And lastly, if there has been any default on the part of the company and any order has been passed by the company law tribunal or NCLT, whether the company has complied with those orders or not. Then comes clause 6, which deals with cost records. So herein the auditor has to report whether the cost records is applicable on the company, that is whether the company falls into the criteria of maintaining cost records. If yes, whether the company has maintained proper cost records or not. Then comes clause 7, which deals with statutory dues. So any amount that is payable to government is known as statutory dues. Example of it could be income tax, GST, cess, PF, PTax, ESI, any other kind of tax or any other penalty amount or any other provisional amount that is to be paid to the government is known as statutory dues. So under statutory dues, there are basically two types of dues. First is disputed and the next is undisputed. So in case of disputed dues, the auditor has to state the forum and amount. In case of undisputed dues, the auditor has to state that as on 31st March, how much statutory dues are overdue for more than 6 months. That is how much of the statutory due did already become payable on 30th September and is still outstanding as on 31st March. Basically, if I am auditing a company for financial year 23-24, if I am standing on 31st March 24, I'll have to state how much of these statutory dues became payable or became due on 30th September itself and are still outstanding as on 31st March. A lot of people misinterpret this clause and think that whatever is payable till 31st March has to be stated, but this clause is not asking you to state all the dues up till 31st March. All that it is asking is how much of the statutory dues became due or overdue as on 30th September or 6 months before the financial statement year and are still outstanding as on now. Next comes clause 8, which deals with unrecorded income. So if there is any income that has been recorded in the income tax but that has not been shown under the financial statement, then the financial statement should be adjusted according to that, and the auditor should ensure that the accounts are properly adjusted, and the auditor should also state the amount of that unrecorded income. Next comes clause 9, that is on borrowing. So borrowings are usually the area, or to be said, the gray area, where the clients usually take the manipulative or the fraudulent steps. So in case of clause 9, the auditor has to report first whether the client has been tagged as the willful defaulter by bank. Next, whether the client is regular in repaying the interest and principal. Third, if any loan was used for any other purpose. For suppose if any specific purpose loan was obtained, the auditor has to check whether the specific purpose is achieved or not, or whether the loan is being utilized for that specific purpose or not. If not, the auditor has to state the nature of amount. Fourth, if any short-term loan is used for the long-term purpose, then also the nature and amount is to be stated. Further, if the client has obtained any loan to meet the obligations of JV, that is joint venture, associate, subsidiary, then the nature and amount of loan is to be stated. And lastly, if the client has taken any loan on the pledge of assets of JV, associate and subsidiary, then it is to be checked by the auditor that whether the loan has been repaid or not. Then comes clause 10, which basically deals with utilization of public proceeds, that is money received through IPO, FPO, private placement and public allotment. So in case of IPO and FPO, the auditor has to check whether the purpose as stated in the prospectus is being achieved or not. If not, the delays, the default, and if rectification done in any has to be stated. In case of private placement or preferential allotment, the auditor has to check whether section 42 and section 62 are being complied with. Apart from that, the auditor should also check whether the purpose as stated in the prospectus is being achieved or not. If not, the nature and amount are to be stated. Then comes clause 11, which deals with fraud. So the auditor has to first report about any fraud that he came across, whether the fraud was done by the company or on the company. Whatever kind of fraud was there is to be reported. Apart from that, the auditor has to state whether all the whistleblower complaints that were received by the company are answered or not. And lastly, if the auditor came across any fraud of more than 1 crore, whether ADD 4 was filed with central government or not. Then comes clause 12, which deals with Nidhi company. So first understand the meaning of Nidhi company. So Nidhi company was basically created in old times to promote the habit of saving among the members. So usually what happens is when we have amount of money in our hands, we usually tend to expend that and not save that. However, savings are very important for future contingencies, and this is when similar nature members came upon and created a company wherein they would contribute an amount, invest that and earn through the interest of that. So Nidhi company was basically created for helping people save their money and earn through the interest on this saving. So if the client you are auditing is a Nidhi company, there are three things that are to be reported. First, whether the net own fund to deposits ratio is 1:20. Next, whether 10% of the deposits are kept in unencumbered term deposits form, that is, are kept in liquid assets form. And lastly, whether there has been any default in the payment of interest or principal. So these three requirements are basically as that of Nidhi Company Act and not of the Companies Act. But since we are auditing Nidhi companies, we will have to check whether all the provisions that are applicable on these companies are followed or not. Then comes clause 13, which deals with related party transactions. So all the related party transactions should be duly approved and authorized by audit committee. So the auditor has to report whether authorization and approval under section 177 and 188 of the Companies Act are followed or not. Then comes clause 14, which deals with internal audit system. So the auditor has to state that whether he has considered the internal audit reports, and that is not mandatory, but it is obviously recommendatory. If the auditor reads the internal audit reports, the auditor gets an essence of the internal controls and he or she can design their audit procedures accordingly. So the auditor has to state whether they have consulted the internal audit report, and next, whether there is a proper internal audit system in the entity as per the nature and size of the entity. Then comes clause 15, which deals with non-cash transactions. So non-cash transaction basically mean barter transaction, wherein instead of exchanging cash or exchanging money for a particular product, another product or another service is exchanged with. So in case the company enters into any barter transaction for any asset, then it is to be stated whether section 192 of the Companies Act has been followed or not. Then comes clause 16, which deals with NBFC. So NBFC, or non-banking financial companies, basically means company wherein financial assets of the company are more than 50% of the total assets and financial income of the company is more than 50% of the total income. So if you come across any client who is an NBFC, these are the four things that are to be reported. First, whether any registration is required by the company under 45 IA of the Act, that is, whether it satisfies the financial assets and financial income criteria. Next, if the registration has been obtained, great. If the registration has not been obtained yet, whether the company has engaged into any activities that are not permitted or any activities without a valid registration. Third, whether the NBFC that you are dealing with is in CIC or not. So CIC basically means core investment company. Now, what is a core investment company? Where majority of the assets of the company are governed in investments. Approximately 90% of the assets of the company are directed towards investment. It is known as a core investment company. So as an NBFC, you'll have to check whether your client is a CIC or not. If yes, you'll have to state whether it is an exempt CIC or registered CIC or unregistered CIC, and lastly, you'll have to report that how many CIC are a part of group. Then comes your clause 17, which deals with cash losses. So obviously there can't be actual cash losses ever, because you can't expend more than what you have in case of cash. Here we are talking about the accounting term of cash losses. So if you have a negative operating cash flow, you're said to be incurring cash losses. So if the auditor comes across any such situation of the client, the auditor has to report the amount of cash losses of the current year and the preceding year. Point to be noted, this is the only clause wherein the preceding year requirement is also there. Then comes clause 18, which deals with resignation of statutory auditor. So if any previous statutory auditor has resigned, it is the duty of the new auditor to obtain objection, comments and concerns of the previous auditor. This also helps the auditor in analyzing the entity and also letting him know the problems in previous audit. Then comes clause 19, which deals with going concern. So auditor has to state that on the basis of these 5 things, whether the auditor considers the entity to be a going concern or not. So what are the 5 things that are to be validated by the auditor for judging whether the company is a going concern or not? First thing is financial ratios, whether the financial ratios of the company reflect that the company is a going concern or not. Next, aging schedule of payable. So if there is a lot of payable by the company, it clearly indicates that the company is not a going concern. Third, payment of financial liability. As soon as the financial liabilities being become due, are they being paid or not, or are they outstanding for long or not? This is also an indication whether the company will survive in long run or not. Next, information accompanying financial statements, that is notes to accounts. So whether the notes to accounts state that the company is going to be a going concern or not, or examples like contingent liability state that whether the company is going to be a going concern or not is also to be stated. And lastly, if there is any material uncertainty regarding going concern, even that is to be stated. Clause 20 is about CSR, corporate social responsibility. So corporate social responsibility was an initiative by the government to help the corporates promote a bit towards the society. So you can read the criteria and also the applicability limits and the amount that is to be contributed. That is available on every website. Even if you Google it, that is available, but that is not necessary for the examination point of view. If the auditor is auditing a client which falls into the CSR criteria, auditor has to report upon these two things. First, if the if the company has any unspent amount, that is, I'll just tell you in a brief. So in case of CSR, if anyone falls into the CSR criteria, they have to contribute 2% of their average net profit of 3 years. So if your client falls into this criteria, the auditor should check whether the client has deposited or has expended all this 2%. If the client has any unspent amount that relates to an ongoing project, the auditor should report that whether this unspent amount has been deposited to an escrow account, and if the client has some unspent amount that relates not to an ongoing project, the auditor should check that whether this funds has been deposited in the Schedule 7 funds. Then comes clause 21. So clause 21 is the last clause for PARO. So clause 21 basically states that in case the company that you are auditing falls in the part of consolidated financial statement or has certain holding subsidiary associate, and even they are having a CARO reporting, so the auditor in the standalone report should include a reference to all those paras wherein there is discrepancy, so that the users of financial statement also know that how the consolidated financial statements are doing. So this was CARO. Next comes emphasis of matter and other matter paragraphs. So these are two paragraphs which might be included in the audit report, but that is totally upon the discretion of the auditor. So if the auditor thinks it's necessary to report upon these two matters, then these two matters will be included in the audit report. But if he thinks that these two matters are not required, or these two paragraphs are not required in audit report, then these two paragraphs are not to be included. Now, what is included or what is actually there in these two paragraphs? So emphasis of matter paragraph basically states that if the auditor comes across any item or any disclosure in the financial statements which he thinks is crucial to the understanding of users of financial statement, then that is to be stated in emphasis of matter paragraph. Example, so if he came across any impairment of assets, the impairment of assets is a sign of decline in the value of assets. Now the shareholders or the users of financial statements might have ignored this impairment, but impairment, since it is an indication of decrease in asset value or decrease in business value, as per the auditor, it is important to be noticed by the users of financial statements. So that is stated in emphasis of matter paragraph. Basically, all the important things that the auditor come across in the financial statement and think that the users of financial statement might miss or ignore are stated in emphasis of matter paragraph. Two conditions for EMP paragraph are: first, these matters should not have been already stated in CAM. If these are already stated in CAM, there is no requirement of additional reporting. And next, these matters should include those matters which do not require the auditor to modify this opinion. That is, all the matters that are included in emphasis of matter paragraph should be properly accounted for and disclosed. They should not be a reason for the qualified opinion of auditor. Next comes other matter paragraph. So a lot of time it happens that the users of financial statement either over assume the responsibility of auditor or might not be might not have knowledge of the actual responsibility of auditor. So when the auditor requires to give a clarificatory remark on audit, his report, his responsibility, then he chooses OMP, that is other matter paragraph reporting. So if the auditor wants to give any clarificatory remark regarding audit, auditor's responsibility, audit report, then he chooses OMP paragraph. Yet again, the two conditions are: first, these matters should not have been already stated in CAM. If these matters are already stated in CAM, there is no requirement of additional reporting. And next, the auditor should take care of is that whatever matters he or she is putting in the OMP paragraph should not be prohibited by any law or regulation. Next comes content of audit report. So content of good audit report basically means what all are the features of a good audit report, or what all things an auditor should follow to ensure that his audit report looks clean and is giving a great view and is ensuring transparency to the users of financial statement. So this is basically a poem kind of thing that I have written, but the problem is this is in Hindi, so I'll just spell out this poem in Hindi for you, and then I'll reread this poem and highlight the important points in English. So I'll just spell out the poem. First, simple है सुंदर सा, क्लियर है उसका फंडाना, ब्रीफ और स्पेसिफिक है, एकदम इम्पार्शियल और ऑब्जेक्टिव है, बायसनेस को करता है एलिमिनेट एंड ओपिनियन को करता है फर्मली स्टेट, only relevant information has been presented and timely audit report dena is intended. So basically these are the important features of a good audit report. That is, the audit report should be simple and should not involve any extra fuss. Next, it should be clear, that is, the opinion should be clearly stated. Whatever matters are required for users' understanding of financial statement should be clearly seen. It should be brief and specific, that is, no lengthy paragraphs are required, to the point paragraphs are required, and to the point writings and to the point descriptions are required, to the point reference are required. You don't need to include everything or every story that you came across in financial statement. It should be impartial and objective, that is, whatever opinion should be stated is of auditors only, and the opinion should be stated by an independent auditor, and his opinion should not be governed by someone else. Biasness should be eliminated, that is, the auditor's report should not be such that it is inclined towards a particular person. It should be truth and fair, and it should be unbiased. The opinion should be firmly stated and there should be no objectivity involved. Only relevant information has to be presented. So if the auditor was fed snacks during the audit, or if the auditor was taken on long drives during the audit, or if the auditor was given a chance to fly via flight during audit, all this has to be not to be stated. Only relevant information, relevant understanding of financial statements are to be stated. And lastly, the audit report should be given timely. It should not happen that the next year has also come to an end and the audit report is not given. So the audit report should be presented on a timely basis. Now we are majorly done with the part of audit report. There are just 2 to 3 independent topics that we'll have to cover. So one by one we'll cover this topic. So the first topic is audit report versus certificate. Mark my words, this is very important. I'll show you in the important Q&A list that this has already appeared in your examinations for 8 to 9 times. So you can understand the importance of this difference. So this is very important. But the best part is it is very easy. So if this comes in your exam, this can be a really game changer. So pay important attention to this, pay most attention to this, and try, whenever this question appears in the exam, try to write the maximum points and try to secure maximum points for the maximum marks for this question. Now, what is audit certificate? So as important audit report is as a document, even audit certificate is important. So a lot of times certain statutory authorities offer certain exemptions to the company. Now these exemptions or subsidies are generally criteria based. Example, if I am offering a transport subsidiary to the company, or if I am offering a plantation subsidy to the company, I will have certain conditions or criteria attached to it. Now, how do the statutory authority check that whether the company is complying with the criteria or not? Very simple way, they'll ask the client or they'll ask the company to put in all the details and they'll verify that. But you may know that there are lakhs and crores of companies in India. So how many companies they would be doing this checking thing? So to escape this checking and still ensure that the right person is paid the right subsidy, they came with the option of audit certificate. So they asked the client to get all their figures certified by a CA. They trust the CA and they think that once the chartered accountant or once the auditor has certified these facts and figures, we can easily trust on that document. So audit certificate is basically a document that is required by statutory authorities, and it could be for any exemption or for any explanation or for any kind of subsidy or for any kind of grant. It could be of any reason. Whenever a document is certified by a chartered accountant in practice, it becomes audit certificate. Now, what is the difference between audit report and audit certificate? So the first difference is that audit report contains an opinion on financial statement, whereas audit certificate contains an certification on certain material facts and figures. Next, in case of audit report, the scope is really large because it covers the entire financial statement, whereas in case of audit certificate, the scope is usually limited because it deals with one or two items of financial statement. For audit report, it is based upon assumption and estimation, whereas for audit certificate, hardcore figures and facts are to be certified. Therein no assumptions or estimations are used. Audit report involves expression of opinion, whereas audit certificate involves confirmation of correctness of figures in financial statement. Audit report has a scope for constructive advice, that is whatever advice that the auditor would like to give to the entity can be included in audit report, whereas in case of audit certificate there is no scope for that. In case of audit report, the opinion may be correct or may not be correct, but that might not attract a lot of liability of the auditor because the auditor is only given reasonable assurance. But in case of audit certificate, auditor is liable for each and every figure because as per the statutory authority, the auditor has to check all the figures in the audit certificate and ensure that all the figures appearing in the certificate are correct. Further, when is the audit report to be issued? Once the audit is completed, once the financial statements are approved. Whereas audit certificate does not have a timeline, it can be asked for any time during the financial year. And lastly, audit report has a standard format as prescribed by SA 700, whereas there is no standardized format of audit certificate. So the next independent topic of this chapter is internal control over financial reporting. Now, what is an internal control? So internal control are basically policies and procedures that help in effective functioning or in properly conduct of business of a company. Example, so suppose I made a flow chart wherein the departments of my company could be connected. So the first thing that the department needs to do is this. Then that report would go to the next department who would work on the report. Then they would forward the report to the third department who would work on the report like this, and the chain continues. Now what happens if I haven't established a chain? There would be a lot of confusion, there would be a lot of time wastage, there would be lack of efficiency, my goal won't be achieved, and etc, etc, etc. So this formation of chain or this formation of flow chart is nothing but internal control. So internal control are basically policies and procedures which help in efficient and orderly conduct of business. Apart from efficient and orderly conduct of business, they also help in stamp. Now, what is stamp? It ensures safeguarding of assets. Why? Because if internal controls are properly implemented and properly followed, it will ensure that the assets are protected from unauthorized use and all the assets are safeguarded. From T, it helps in preparation or timely preparation of financial statements. That is, if all the internal controls are followed, all the objectives are achieved, all the accounting records are correct, obviously my financial statements will be prepared on a timely basis. So internal control also helps in timely preparation of financial statement. It also helps in accuracy and completeness of records. That is, it helps to ensure that whatever records are there is complete and whatever is appearing in the accounts is accurate. Further, also it helps in adherence to company policy or management policy. So if the company has the policy of minimum usage of resources, maximum optimization of resources with the help of internal control, even that can be achieved. And lastly, and the most important thing, even fraud and error will be prevented. Now, these are internal controls about the entire organization. What if you are asked to you are asked about just internal controls over financial reporting or financial statements? So what is IC over FR, internal control over financial reporting? So when the internal controls are just restricted toward financial statements, they are known as IC over FR or IC over financial reporting. So in that, what are the things that the auditor needs to check? First, the auditor should ensure that the records are reflecting transactions of the assets. That is, whatever is shown in the accounts is a reflection of what has happened in the company. Next, transactions should be recorded as per GAAP, that is generally accepted accounting principles. Third, transaction should be made only after there is proper authorization and there is proper approval of those transactions. Lastly, it should be such that all the errors and all the frauds are either prevented or timely detected. Now, the statutory auditor usually cries off his duties and says that he ain't able to check the entire financial statement. So how do you think he'll be able to check the entire internal controls? And that is why internal control over financial reporting was brought in, so that the auditor does not have to give in or does not have to report about the entire internal controls, but just restrict to the internal controls over financial reporting. So as an auditor, I will also have to report over internal control over financial reporting and not the internal controls of the entire organization. The internal controls of the entire organization are reported by internal auditor. Just the internal controls over financial reporting are to be reported by statutory auditor. And where is it to be reported? It is to be reported under other reporting responsibilities. And last comes NAFRA. So the last independent topic for this chapter and for the entire company audit, the last topic is NAFRA. So what is NAFRA? So NAFRA's full form is National Financial Reporting Authority. Now, what does NAFRA do, or why was NAFRA formed? So NAFRA was basically formed to oversee the activities of auditors. That is, whether all the auditors are following all the standards, whether all the auditors are efficiently doing their work, whether all the auditors are not compromising on their quality, whether all the auditors are ensuring that the quality of audit is maintained, whether all the auditors are making sure that they live up to the standards. So NAFRA basically oversees all the activities of auditors. Now, who are included in NAFRA, or what is the composition of NAFRA? So NAFRA is basically a combination of three committees: Accounting Standards Committee, Standards and Auditing Committee, and Enforcement Committee. The number of members in NAFRA are 15 and there is one chairman of NAFRA. Now, what are the duties of NAFRA? First, to recommend auditing standards and accounting standards. Next, to ensure compliance of those standards. Third, oversee the quality of service of auditors and suggest improvements. And fourth, in case other duties are necessary, or in case any duty is necessary for checking the above, then complying with the duties or doing that duties. Then comes the functions, or you can say the powers of NAFRA. So what are the powers of NAFRA? So NAFRA recommends auditing and accounting standards to central government. For that, it can also take the help of ICAI, and if it requires, it can also take suggestions and improvements from ICAI, and if there is any additional information required from ICAI, so the NAFRA also has power for that. Then, to ensure and monitor compliance with all the standards on auditing, the NAFRA can review working papers and communications of auditors. Apart from that, NAFRA can also evaluate sufficiency of a quality control system and audit documentation. NAFRA can re-perform testing procedures and see whether all the auditing procedures are correct or not, all the audit procedures are as per standards or not. Apart from that, NAFRA can ask the auditors to report on the governance practice and ask them how have they made sure that the quality of audit is maintained and the quality of audit is not stained. Obviously, all of this work will not be done by chairman. That is, the chairman won't go from one auditor to another and ask them about the working papers. These works are done by the eminent personalities who have experience in audit. Apart from that, NAFRA had understood that just penalty and imprisonment won't be enough for these audit malpractices. So NAFRA also publishes all the non-compliances on their website. If there is any confidential information, they avoid doing that. But if the confidential information is also required in public interest, then NAFRA even reports about that. Apart from that, NAFRA sends the central government reports which require an attention of central government. Further, NAFRA has the power to investigate. So NAFRA, on the request of any other authority or suo motu, can it can investigate any auditor and check their audit papers. And in case of any discrepancy or in case of any fraudulent malpractices that has been found, usually ICA takes the action. But if the person or if the auditor has done any malpractice with reference to working papers, quality control and audit procedures, then the action is taken by NAFRA. So that was it for companies audit. We'll be having a short break, post which we will solve the Q&A of this chapter, and then we will be starting with the next chapter of our syllabus, that is audit of different kinds of undertaking. Now that is not a very big chapter and would require like 45 minutes to 1 hour. And then post that we can start with basics of auditing. So giving you a 1 minute break, post which we can start with the Q&A of this chapter. Now, before the break, we completed the revision of our company audit subchapter 4, and now it's time to do the Q&A of this chapter. So there are not a lot of questions. There are 9 questions which we'll do quickly, but yes, you will see that more stress is upon the questions of opinion and audit report certificate and CARO. So these are usually the important topics of these chapter. So the first question is, what is a qualified audit report? Discuss the circumstances when an auditor shall give this kind of report. So this is a 4-star question. Now the first part of the question, what is a qualified audit report, is known to us and we have studied about this, but there are no answers or no description of this part of the question. So if you open your module also, there won't be any paragraph which describes of the circumstances when the auditor shall give qualified audit report. So all you have to do is think of your own and write under this answer. However, I will state the 5 points that you need to remember in this chapter, but even if you open your module, you won't get any of the points or any of the circumstances wherein the auditor has to give in qualified audit report. And this is a 5-star question. So yes, that is what I'm speaking of. You can expect a bit out of the syllabus questions. You need to be open-minded during the examination and have to ensure that whatever explanation or whatever understanding you have of the topic, according to that, you will have to answer. So now what is a qualified audit report? So whenever the auditor comes across any misstatement that although is material but not pervasive, then the auditor gives qualified audit report. So qualified audit report is submitted by the auditor when the overall impact of reservation or qualification taken together is material but not pervasive enough to vitiate the overall truth and fairness of financial statement. Now, what are the circumstances when the auditor shall give in qualified opinion? Now, Very simple. I told you about the situation where the auditor will give an unqualified opinion. All you have to do is think of the opposite. First, when the financial statements won't comply with laws and regulation. Next, where the books of accounts or books and records are not properly maintained, or are lost, or are not there, or have been destroyed by fire. Then, when the financial statements are not giving a true and fair view. Then, when the financial statements are not as per AS and Ind AS, or as per the accounting principles and accounting estimates, or as per the financial reporting framework that is applicable to the entity. And lastly, when the effect of all the changes in accounting principles, accounting estimates, and accounting assumptions, if any, has not been properly reflected in financial statement. So here all you have to do is think total opposite of situations of unqualified opinion. That is the situations in which you would have given unqualified opinion. Think of the opposite and think of the situations wherein the auditor would be giving an qualified opinion. So these are 5 instances that you should remember, and you will see that all the points or all the extra points revolve around these 5 instances only. So if you remember these 5 things, that is more than enough. Absence of voucher, that is books are not maintained properly. Destruction of books, yet again the books are not maintained properly and the books are destroyed. Non-availability of books and records, so all these 3 points are related to books are not maintained properly. Where proper books of accounts have not been kept, again the 4th point. Where the balance sheet and P&L are not in agreement with books of accounts and return, that is financial statement is not as per AS or Ind AS. When information required by law is not furnished, when the accounts do not disclose a true and fair view. So here the point of true and fair view would come in, and here that the FS does not comply with law or regulation. Next, the accounting practices followed by the company are not considered appropriate. That is AP, AE, and accounting exemption, if any, are not considered appropriate, and changes, if any, made in them are not properly disclosed. Where there has been a change in accounting principle or policies in relation to material items such as valuation of stock, depreciation, treatment of byproduct material items without adequate explanation and disclosure of effect of change. Where difference of opinion with management has arisen with respect to valuation of assets. Where income or expenditure is not properly reflected, that is financial statements are not showing a true and fair view. Where information is not required by the law to be disclosed, but the disclosure of which is considered essential by the auditor in order to show a true and fair view. That is yet again the financial statements are not showing a true and fair view and are not transparent. When there is contravention in provision of Companies Act, that is FS is not complying with laws and regulation. So you see all the points revolve around these 5 points only. So if you learn these 5 points, that is more than enough. You can obviously make or amend certain points according to them. Next question, distinguish between a qualified audit report and an adverse audit report. 3-star question. As I said, opinions are very important, so you must have a thorough understanding of the opinions. Now, what is the difference between a qualified audit report and an adverse audit report? In case of qualified audit report, the auditor says that the misstatement is material but not pervasive. Whereas here, the misstatement is both material and pervasive. So in this situation, in case of a qualified audit report, the financial statements are giving a true and fair view except for that particular item. But in case of adverse audit report, the whole financial statements is giving a negative opinion, is giving a negative reflection, that is the whole financial statements is incorrect. A qualified audit report is the one where an auditor gives an opinion subject to certain reservations. That is, he gives the opinion on the whole of the financial statements except for the particular items where he thinks there exists a misstatement. An adverse report is given when the auditor concludes that based on his examination, he does not agree with the affirmations made in financial statement. The auditor's reservation is generally stated as subject to above. We report that the financial statement shows a true and fair view. That is, except for the points where he has given a qualified opinion, the financial statement show a true and fair view. But in case of adverse audit report, the whole financial statements do not show a true and fair view, do not present a true and fair view. The accounts present true and fair view subject to certain reservations. Here, the accounts do not present a true and fair view. Lastly, here it is said that the mistakes are only material in nature but not pervasive. Here they are both material and pervasive. Next, tabulate the differences between clean audit report and qualified audit report. Again, a 2-star question. So what is the difference between a clean audit report and qualified audit report? In case of clean audit report or unqualified audit report, every item of the financial statement is showing a true and fair view. That is, the financial statement in itself is showing a true and fair view, and there are no corrections to be made, or there are no mistakes in the financial statement. Whereas in case of qualified report, although the financial statements on a large basis is giving a true and fair view, there are certain exceptions, certain reservations, and certain items that contain mistakes. The auditor issues a clean report when he does not have any reservation with regard to matters contained in financial statement. And qualified report is one when the auditor gives an opinion subject to certain reservation. Here, the financial statements give a true and fair view. Here, subject to some reservations, the financial statements give a true and fair view. In case there is obviously a negative report about the company, the management has to take action, whereas in case there's a positive report, there's no foundation of management, so there's no specific duty of management for clean reports. Whereas in case of qualified report, the management is bound to give explanation and full details. Next comes question number 4. Discuss the basic elements of audit report. Whenever this kind of a question is asked, you are required to state the content of audit report as per SA 700. So we'll quickly revise the content of SA 700 or the content of audit report as per 700 in brief. So first comes title, that is independent auditor's report. Then comes addressee, that is the appointing authority or to whom the report is addressed. Then comes auditor's opinion. Herein the auditor has to state the name of the client, the financial year, references to financial statement or references to notes if any, and state that the financial statements are audited. Next, the auditor has to state basis for opinion, wherein he has to state that he has been independent. All the audit procedures are on the basis of standards of auditing. All the audit conclusions are on the basis of audit evidences, which have been gathered by performing audit procedures as per standards on auditing. And lastly, he has to give a reference to auditor's responsibility. Next comes going concern. So in case of going concern, the auditor has to report only when there is an uncertainty with going concern, or there is a doubt, or there is basically a negative report about the going concern. That is, he thinks that for the entity, the going concern does not stand strong. Then comes key audit matters. So whatever matters which the auditor comes across in the audit of financial statement he thinks is material is shown in key audit matters. Management's responsibility for financial statements are to make the financial statements, to make the internal controls, and do going concern assessment. Then comes auditor's responsibility. So the first line that is to be stated under the auditor's responsibility is that to obtain reasonable assurance that financial statements are giving a true and fair view, and the financial statements, and to obtain a reasonable assurance that financial statements are free from material misstatements, whether due to any fraud or error. Now this is an auditing line, so the auditor has to explain about certain terms. First being reasonable assurance, that reasonable assurance is a high level of assurance but not guarantee. Then next, the word material has been used in reference of items that are crucial or important to users' understanding of financial statement. Also, financial reporting framework has been used for calculating materiality. Apart from that, there are 4 additional responsibilities of auditor. First, to identify and assess risk of material misstatement, then to obtain an understanding of internal controls, then to check whether all the accounting principles, accounting estimates, accounting assumptions are correct and appropriate, and lastly to revalidate going concern assessment. Then comes other reporting requirements, wherein the 10 disclosure requirements of company audit are to be stated. Then comes date, place, and signature of audit. The fifth question is Caro is not applicable to private company. Comment 4-star question. As I said in the start, that applicability criteria of Caro is very, very important. So here bluntly they have said that Caro is not applicable to private company. You will have to explain that which kinds of private company are exempted from Caro. So you'll have to say that Caro is applicable to all companies except for Section 8, OPC, small company, and banking and insurance company, and private companies who are neither the holding and subsidiary or public companies, whose turnover is less than equal to 10 crores, whose paid up share capital plus free reserves is less than equal to 1 crore, and whose borrowings is less than equal to 1 crore. Only on these kinds of private companies, Caro is not applicable. Apart from any other company not satisfying these conditions, Caro is applicable. State the reporting requirement of the auditor and the Caro in respect of default and repayment of dues. So there was no particular clause on default and repayment of dues. However, there was a clause on borrowings which talked about default in repayment of dues. So here you'll have to state auditor's duty or auditor's reporting requirements of Caro for borrowings. That is clause 9. So you'll have to state that first the auditor will report that whether the client has been tagged as a willful defaulter, then whether the loans or whether the borrowings are used for the purpose they were obtained. In case any short-term loan is used for a long-term purpose, even that has to be stated. To comply with Caro, how will you report in respect of guarantees for loan? So basically herein you'll have to state about LGSI loan guarantee, security investment requirements. Next comes what is the point that the auditor shall state in his report when he discovers that loan has been given by a limited company during the year. So basically you will have to state yet again LGSI loan guarantee security investment given during the year. So herein you'll have to check whether all the loans are properly secured, details of the party and amount involved, check whether the terms and conditions are not prejudicial. In case the payment is overdue for more than 90 days, what are the recovery steps? Whether the loan has been shown as deposits or not. If the loans are taken from related parties, even that are to be shown. And lastly, documentation in relation to loans has been properly maintained or not has to be checked. Then comes question number 9. So question number 9, you can count the stars 2, 4, 6, 7. And let me tell you, there might be 8 to 10 stars that could be added to this. So this is a highly important question. Usually it comes post each attempt, like for May it might appear for May it might appear, then for December it might not. But again, you can expect the same question in May or June whenever the exams happen. So usually it skips one attempt and appears in the examination. So this question is a must do for you people. Now, what are the differences between auditor's report and certificate? First, and you'll have to give the definition that auditor's report involves expression of opinion, whereas audit certificate involves confirmation of correctness and accuracy of facts and figures. Auditor's report is basically based on assumption and estimation, whereas auditor's certificate is based on actual facts and figures. Auditor's report involves an advice for auditor, whereas there is no scope of advice. Auditor's opinion does not guarantee anything, because herein the auditor gives a reasonable assurance, but that is not the case with audit certificate. In case of audit certificate, he has to certify all the facts and figures. The auditor's report is issued once the audit is completed and financial statements are approved, but there are no particular timeline for certificates. And lastly, in case of auditor's report, the auditor's liability is not very large or very high because he is giving reasonable assurance. But in case of audit certificate, the liability of auditor is very high. So that was it for revision of company audit. Now we will be moving on to the other chapter, that is audit of different kinds of undertaking. Before moving on to that chapter, we will be taking a 2 minutes break. Yet again, the chapter is not very big and would take us around 1 hour maximum to complete. The chapter is also very easy and very interesting. So just after a 2-minute break, we will start the chapter, and post that we will be already done with 2 chapters, and you will have just 1 chapter more to revise, or 1 chapter more to watch the revision video for. I hope you are enjoying the video till now, and if you are doing so, do like, share, comment and subscribe. Giving you a 2-minute break, returning after that. Hello everyone, I hope you people are back from a wonderful break. Prior to the break, we completed the company audit subchapter 4, which also marked the completion of our most important chapter, that is company audit. Now we are just left with 2 chapters, audit of different kinds of undertaking and basics of auditing. So audit of different kinds of undertaking is a really small chapter and would not require as much time. So we would concentrate on that first, and then we would go on to basics of auditing. Basics of auditing would nearly require us around 4 to 5 hours. So first we'll be covering the small portion, the easier portion, and then moving upon basics of auditing. So what does this chapter, audit of different kinds of undertaking, deal with? So audit of different kinds of undertaking basically deals with the different audit procedures that are to be applied in different organizations. But why does an auditor needs to know about the different kinds of procedures that are to be applied in different organizations? Simply because the same audit procedure cannot be applied in every organization. Example, if I'm checking a sales invoice in the company, I can't ask for sales invoice when I go for an audit of school. There I'll have to check the fee register. If I'm checking the fee register in a school, I can't ask for a fee register in a hospital. There I'll have to check the patient register. If I'm checking the patient register in a hospital, I can't ask for the same in case of banks. There I'll have to check the cash and bank transaction. If I'm checking the cash and bank transactions largely in banks, I can't ask for the same in amusement park. There I'll have to check the customer list. So there are different procedures that are to be applied in different organizations, and as an auditor in the practical life, auditor comes across many of such organizations commonly, and it is required by the auditor to know of these audit procedures. So in this chapter, we will be basically learning about the audit procedures of 6 different kinds of undertakings, that is schools, hospitals, hospitality sector, banks, cooperative society and local self-government. Obviously, there are different types of entities apart from this also, which an auditor might face in practical life, but this chapter is restricted to the most common and the most popular 6 entities. So one by one, we'll be covering the organizations, and I hope you will be liking this chapter because I personally like it very much because it is very practical yet very interesting. So let's start. So the first chapter is audit of educational institution, that is audit of school. Now before moving on to the audit procedure, just imagine that if you are an owner of school and are asked to make an P&L of school, what were the major incomes and what were the major expenses that you would account for. Now thinking of the income, the first thing that comes is school fees. It could be in the form of admission fees, tuition fees, recreational fees, hostel fees, or any other form of fees. Apart from that, donations are also a very big source of income for schools. Canteen is also a very big source of income for schools. And coming to the expenses side, the majority expenses are the school's infrastructure. Apart from that, electricity expenses, teachers' salary, and other miscellaneous expenses. Now this is a pro forma PL of an school. But why did I ask you to imagine the PNL of a school or make the PNL of a school? because it is very, very important to know of the financial statement before audit. Even before audit, you should know about the kind of financial statements of that particular entity, because it is ultimately the financial statements that you need to audit, and you should have an idea of what the major income and major expenses of this entity. So this PNL will help us know the audit procedures, because now we can imagine that, yeah, these are the 4 incomes that I need to audit. So your mind will run accordingly and decide the audit procedures for this income. If you were clueless about the income itself, the audit procedures were a far-fetched thing and you won't be able to understand that. But now that you know the income and expenses that are to be audited, you would easily understand the audit procedures. Now, before even applying the audit procedures to check income and expenses, the audit procedures to understand the entity should be undertaken. Entity should be, applied for or undertaken, because schools or any other different kind of entities are different from companies. And before directly moving on to the audit procedures to check the financial statement, you should first understand the entity, the types of controls that are in the entity, the types of risk that are in the entity, what are the laws that are applicable to the entity, so that you can understand better about the financial statements and apply the audit procedures accordingly. So the initial work of understanding the entity involves ensuring that the financial statement is as per the applicable financial reporting framework. Next, checking that the rules and regulations are being complied with. Third, ensure that there is a budget for all the major expenses and the budget is being complied with. Check whether the internal control is effective or not, because that is a really important point. And lastly, ensure that notices and minutes of all the important meetings are taken. So this would help the auditor know of the major decisions taken during the year. Now, coming to income, as said, the major income was school fees. Now, how will you check school fees? Very simple. By ensuring that whatever fees has been recorded in the books of accounts are supported by valid documents. And what could be the valid documents? Counterfoil of receipts could be a document, fee register could be a document, student register could be a document. In case there has been any late fee penalty that has been received by the school, so you should check whether the fees was received after due date. You can check that all the fees are properly adjusted or not. In case any fees is paid in advance, or any fees has been tagged as irrevocable, so you should ensure that that is done with proper authorization and it is properly accounted for. Apart from that, it is to be ensured that all the fees should be deposited in bank accounts. Although the kind of era we are in, everything is directly deposited into bank accounts and there is minimized usage of cash, but still to whatever and whoever parents pay in cash, all the fees to be deposited in bank accounts. Apart from that, if there is any library fee, session fee, development fee, and miscellaneous kinds of fee that the school is receiving, that should also be verified by the count file of receipts. In case of hostel fees, just a second. Yeah. So in case of hostel fees, it is to be ensured that there should be no due of the hostelier. That is, once he leaves the hostel, there should be no due left of that student. In case any caution deposit has been refunded to the student, that the caution deposit should be properly adjusted in the books of accounts. And lastly, hostel fees should be audited with reference to counterfoil of receipts. If the school has received any donation and grant, the same should be supported by authorization, approval, and sanction letter. And lastly comes miscellaneous income. So if the school has had any investments or has rented out any properties, the same should be verified with the rent agreement. And in case of investments, the investment certificate should be physically verified. Now, coming on to the expenses. So the major expenses of school are basically on infrastructure, and infrastructure, if you know, is not a revenue expenditure but a capital expenditure. So infrastructure is tagged as assets. Apart from that, the major expenses that the school incur is teacher's salary. So the teacher's salary should be verified with reference to biometric registers or attendance register. Apart from that, in case of government schools and colleges, usually the teacher's salary is reimbursed by government. So it should be ensured that in case it has been reimbursed by the government, it should be properly accounted for in the books of accounts. Apart from that, all the deductions that were required to be made has been made or not, and has been deposited to the due authority. And lastly, in case of any outstanding salary, the calculation should be made. If there has been any expenditure with reference to any special event, it should be ensured that the expenditure is made within budget, and whatever excess money is left even after spending the budget, it should be reinvested, and there should not be any unnecessary expenditure through that budget. And lastly, if there is any miscellaneous income expenses that the school has incurred, be it for any school staff, or be it for any school function, or handling of some equipments, or keeping some certain kind of staffs, so all these miscellaneous expenses should be properly supported by documents. Now coming to assets, so the biggest asset of the school is its infrastructure, that is the fixed asset. So that should be physically verified. It should be ensured that depreciation and amortization are being charged on it. Apart from that, supporting voucher should be checked. In case of any huge expenditure made during the year, resolution should be verified. For inventory, if any, there should be a physical verification, plus it should be checked with system order inspection, stock register, and it should be ensured that all the bills that are being paid are first authorized and then paid. In case of investments, it should be ensured that TDS is deducted or on the interest received, and yet again for investments there should be a physical verification of investment certificate, and you should also check the calculation or the movement in investment ledger. For liabilities, very simple, all the outstanding liabilities should be validated and checked that all the outstanding liabilities are reasonable or not. Next comes audit of healthcare organization, that is audit of hospital. Yet again, I would request you to imagine a P&L of a hospital. So for hospital, the major income is received through patients by the way of operations, OPD, and pathological tests. Apart from that, donation is also a very big source of income for hospitals. Apart from that, also nowadays the hospitals have started constructing guest house just near the hospital so that the relative of the patient can stay. So even guest house are a major source of income for hospital. Apart from that, medical pharmacies also contribute to the income of hospital. Coming to the expenses, the largest expense that the hospital bears is obviously infrastructure, maintenance of proper hygiene, maintenance of equipments, maintenance of machinery, and whatever surgery equipments or whatever necessary equipments they are required for operating the person. So that is the biggest expenditure of a hospital. The next expenditure that is also big is the doctor's salary. So you might be knowing that doctors are almost one of the highest paid professions in India. So doctor's salary is very high, and that is to be borne by the hospital. Apart from that, electricity expense and other miscellaneous expenses are also contributors to the hospital expenses. Now, the initial work of understanding the hospital must be done first before jumping on to income and expenses. So what are the initial work that will be done to understand the entity? First, to check that whether financial statement is as per financial reporting framework. Next, to check the internal controls. Third, to check the rules and regulation that is applicable to these kind of entities, so that the auditor knows that whether the hospital is complying with the rules or regulations or not. Next, all the notices and minutes of important meetings must be taken so that the auditor is aware of all the important decisions taken during the year. Now coming to income, so the majority income was received via patients through the way of operation, OPD, or radiological tests. So how will you audit the patient's income? So there are three ways by which you can vouch patient's income. First, through the bills. Next, through patient register, or through room register, or through ward register, and lastly through counterfoil of receipts. Donations and grants are also a big contributor to hospitals income, so it should be ensured that they are duly supported by sanction letter, and if they have been received for any specific purpose, then it should be used only for that specific purpose. Guest house income can yet again be verified via check-in check-out register, and if there are any details of patient mentioned there, so it should also be tallied with the patient admission register. if the hospital has invested any excess money for renting out properties or for any other investments, that would account for miscellaneous income, and it should be verified via supporting documents like investment certificates, and in case of rent and stuff, it should be verified via rent agreements. Next comes the expenses. So the major expenses, that is infrastructure, is a capital expenditure, yet again would qualify as an asset. For revenue expenditure, the first expense that comes in is doctor's salary. So doctor's salary should be verified with attendance register or biometric, or name mentioned in the bills or name mentioned in the appointment letter list, and it should be ensured that whatever salary is being paid to the doctor is properly authorized. Apart from that, for small kits or tests or machineries or for maintenance of proper equipments, if any expenditure has been done, it should be duly supported by vouchers, and it should be also ensured that all these expenditures are properly authorized, and first the authorization is done and then only the payment is made. For any miscellaneous expenses, vouchers are the best thing to check or validate the expenses. For assets, yet again, infrastructure is the biggest asset for a hospital. It should be physically verified. It should be ensured that depreciation and amortization are being charged. Capital expenditures, if they are validated or if they're supported by vouchers, are a great thing to check. For inventory, physical verification can be conducted. And for liability, it is to be ensured that all the outstanding liabilities are examined. Next comes audit of organization in hospitality sector. So hospitality sector is basically a instant service, instant payment sector. If you can imagine some entities in that sector, you can guess like movie halls, or maybe amusement park or entertainment type stuff like hotels or restaurants. All these are basically hospitality sector. These are instant service, instant payment sector. So if you go in a restaurant, you eat and you pay the bill. So these kind of sectors usually have their revenue matched with the cash balance or bank balance. That is, as soon as they record the revenue, they receive the cash or bank. So for hospitality sector, there are 4 entities that we'll be going to cover. First is restaurant, next is travel and tourism, third is cinema hall and amusement park, and lastly it is hotels and stay. So there is an initial work that is to be commonly done in whatever entity you go in the hospitality sector. That is, check that financial statements are as per financial reporting framework, ensure that all the rules and regulations are being complied with, internal control is effective or not. And one unique point that is there in the initial work of hospitality sector is that every organization should have a valid license. So if I'm running a restaurant, there should be a food license. If I am running a cinema hall, there should be a particular license that is required. So every organization must have a valid license. Common work that is to be done in every entity of hospitality sector. So whatever entity you go for to audit in hospitality sector, these are the common points present in all the entities of the hospitality sector. So if there is any miscellaneous expenses payment, that should be supported by vouchers. In case of salary, you should vouch it via the help of payroll register, attendance register. In case of inventory, physical verification should be done and valuation of stock should be checked. Yet again, for assets and investments, physical verification to be done, and for liabilities, it should be verified whether these liabilities are reasonable or not. Now coming to specific entities, the first entity is restaurant and food beverage. So this is usually a very easy entity to audit. Imagine you going to a restaurant, the first thing you do is place the order, eat, then pay the bill. Obviously, there is no form of due in case of restaurants or stuff. We are always horrored by the thinking that we'll have to clean the utensils if we do not pay the bill. So this is an instant payment industry. So in this, the auditor needs to check that whether revenue is recorded appropriately, whether revenue is matched with the amount in bank statement. Further, it should be ensured that if there are any miscellaneous expenses that are incurred by the restaurant for any maybe fruits, vegetable, pulses, ingredients, or for any staff, that should be duly supported by vouchers. For assets, depreciation and amortization check is a must, because usually these restaurant kinds business do forget to charge depreciation and amortization. So if there are any assets in the business, depreciation and amortization must be charged. And apart from that, petty cash book should be checked. That is, in case of restaurant business, there are usually a lot of small expenses that are incurred on a day-to-day basis, so that are recorded in a petty cash book. So the petty cash book is a must check. Next comes travel and tourism. So if you are made the auditor of a travel and tourism agent like Go Ibibo or Make My Trip, so what are the audit procedures that you will undertake? First thing, yet again, instant payment, instant service industry. So whatever revenue has been recorded should be tallied with the bank account amount received. If there has been any last minute cancellation, so cancellation fee must be charged by these travel agents, and apart from that, each of the money should be refunded. If the revenue is on the basis of commission, then it should be verified. If any special discount is paid, or if excess discount has been paid to any customer, then it should be inquired upon. And lastly, if any staff based incentive is there, or if there is any incentive being paid to the staff, then the reasonability of it should be known, and it should also be checked whether the incentive is actually driving results to the travel and tourism agent. Then comes hotel and stay. So if you are made the auditor of hotel stay like ITC or JW Marriott or Radisson Blu or any other popular hotel chain, then what are the audit procedures that you might undertake? First, the revenue should yet again be tallied with invoices. So whatever revenue has been recorded should be duly supported by invoices and should also be supported by bank statement. These revenues can be revalidated via check-in check-out register, room occupancy register, and also it should be ensured that the correct rate has been put it. So you can check that via occupancy register. There is basically a register for different kinds of room. That is, for deluxe room there will be other register. For some kind of king or queen room there will be other kind of register. So it should be ensured that the bill is charged with the correct amount, and that can be checked with the occupancy register. In case the hotel has any paid services, so income from those services should be vouched by a counterfoil of receipts and invoices. Apart from that, payment made to the vendor should be duly supported by vouchers. If there has been any particular special event going on in the hotel, then the income from that should be verified via agreement, because obviously rate for special events differ from that of regular customers or regular stays. So income, if any, received through the special event must be verified via agreement. Another special point is that as on 31st March, usually people would stay in the hotel, right? But the hotel has to close their account. So for the people staying before 31st March and would be staying after 31st March, for these kind of rooms, the hotel recognizes unrealized rent. So if I am staying in the hotel from 28th March to, let's say, 2nd April. So the hotel will recognize the revenue that they'll receive from me from 28th to 31st March as unrealized rent as on 31st March, because obviously they can't ask me to get out just because they are closing their financial statement. So these unaccrued kind of income, accrued kind of income but not realized kind of income will be shown as unrealized rent. Next comes cinema hall or amusement park. So first of all, here it is to be seen that if there is any advance booking, that is to be duly adjusted. There should be appropriate control over tickets, because tickets are the only way in these organizations to get in. Collection of tickets should be tallied with cash or bank statement. If any entertainment tax is collected, then it should be deposited, and if it has not been deposited, then it should be shown as a liability. Apart from that, popcorn and cold drink sales should be verified via counterfoil of receipts and invoices. If there has been any advertisement income in their books, so you would usually see before the movie there's an advertisement going on, or if you visit an amusement park, there are billboards of advertisement. So these movie halls and amusement parks usually enter into an agreement with the company wherein they display the advertisement of the company, and in turn they are paid money. So if there is income in the books of cinema hall or amusement park for advertisement, it should be verified via agreements. Further, if you will play anyone's movie in the movie hall, you will have to pay the producer. So payment of hiring of films should be on the basis of agreement. If the movie hall has been booked for any special purpose, yet again, agreement should be checked upon, and whatever small payments are made to the suppliers, that should be duly supported by vouchers. Next comes audit of local self-government. Now, what is local self-government? So, local self-governments are nothing but subdivisions of state government. It is not possible for the state government to look upon to every area, every locality, every municipality. So, instead, they have created local self-government. So, these are subdivided parts that look upon every municipality, municipal corporation, every area, every locality, so that the needs of every citizen of India are catered to. So local self-government are of two types, one of rural type and the other is of urban type. So in case of urban, they are usually divided into three types, municipal corporation, municipality and notified area council. The biggest being municipal municipal corporation, then the municipality, and last being notified area council. For rural, it is Zilla Parishad, Gram Panchayat and Panchayat Samiti. So the biggest here being Zilla Parishad, then being Panchayat Samiti, and then Gram Panchayat. Both of these are extremely important to remember for MCQ. So usually they ask in the MCQs that which of the four aren't a part of local self-government. So they'll give you options such as Panchayat Parishad or Gram Parishad, and that might be very confusing for the students who have not seen this or who are not remembering this. So basically both the kind of local self-government are really, really important. It is a must know to remember all the names of these local self-governments. Now, what is usually the objective of auditor while auditing this local self-government? Firstly, he has to ensure that the financial statements are as per financial reporting framework. Next, he has to ensure that all the frauds and errors are detected. So with the name of government coming in, you can understand the amount of frauds and errors that happen in this organization. So he has to detect all the frauds and errors. Value for money is a very big issue in case of government companies or government entities, because usually it is the public's money that is spent and the value for money is not quantified. So value for money should be checked, and lastly it should be ensured that all the internal controls are correct, effective and are being followed. What are the audit procedures that the auditor will undertake to ensure that all the objectives of audit are fulfilled? Firstly, he'll check that whether his appointment is as per act. Next, he'll have to ensure whether all the rules and regulations are being followed. Next, all the minutes and all the documents of the meetings must be taken so as to know about the important decisions. If there has been any expenditure with regard to any government scheme, that should be duly authorized, approved and supported by documents. If there has been any expenditure made against provision of funds, so provision of funds are basically like piggy banks created for expenditure. So if any expenditure has been made from provision of funds, that should again be within the limits of provision and authorized. And lastly, if there has been any huge financial expenditure that is made against any scheme or for any scheme, so it should be ensured that the scheme is running economically and the objective of the scheme are being achieved. Apart from that, obviously fraud investigation is one of the biggest responsibilities of auditor, because yet again, as the name said, wherever the government comes in, there is a kind of hint of fraud that comes in. So fraud investigation is also the duty of auditor. Next is audit of cooperative society. Now, what is a cooperative society? So cooperative society is basically a society where people of similar interest come in and form a business so that the cost of middlemen is eliminated and they are able to achieve all the objectives of the business efficiently and effectively. Example, for suppose there were 10 persons who wanted to go on to different jobs, and the possibility of all of them being successful was almost negligible. It could be that 4 to 5 of them would be successful and the 5 would be left unsuccessful. So all these 10 people thought, why not run a business together? That would save us the cost of middlemen and our chances of success would also be high. So when these 10 people come together and form a business, it is known as cooperative society. Popular cooperative societies in India are Amul. So Amul is a cooperative society. Lijjat Papad So there are a handful of ladies that roll out certain papads, get them packed, and then distribute them. So Lijjat Papad is also a cooperative society. So yes, cooperative societies do work. Plus, I feel they work more efficiently and more effectively than a company, because herein everyone considers the business to be their business, since they are not a you can say a user of the business or just an medium of the business. They are considered as a part of the business. So before moving on to the audit procedures of a cooperative society, first let's understand about a few features of the cooperative society. So the controller of the cooperative society, or the main head of the cooperative society, is a registrar who looks over all the functions of cooperative society and ensures that all the rules and regulations are complied with, and even ensures that all the important decisions are being taken correctly, and he is the one who appoints the auditor also. So audit in a cooperative society is just like any other entity. It involves examination of asset, liability, income, expenses, debts, everything. That is examination of financial statements. Apart from that, audit shall be conducted once a year, as it is done in the companies. Now, who is eligible to become an auditor in a cooperative society? Now, you'll be thinking, what a rubbish question ma'am is asking. Only a CA in practice is eligible to become the auditor. So, just in case of cooperative society, apart from CA in practice, some other person is also eligible to become a auditor, or some other person is also applicable or qualified to become an auditor. So apart from a CA in practice, any person who has a government diploma in cooperative accounts, or who has served as an auditor of cooperative department of government, is also eligible to become the auditor of a cooperative society. So it is a must know point, because there are very rare instances where apart from a CA in practice, any other person can be an auditor. So in case of a cooperative society, apart from a CA in practice, any person holding government diploma in cooperative accounts, or any person who has served in the audit of cooperative department of government, is also eligible to become a auditor of cooperative society. Now, who appoints the auditor? Yeah. So yes, registrar appoints the auditor, which we have discussed earlier. The fees of auditor is also decided by the registrar. Now, what are the books of accounts that a cooperative society maintains? So just like any other entity, the cooperative society maintains cash book, asset register, stock register, FD register, investment ledger, if any, and if any other necessary documents are to be maintained. One unique register that only a cooperative society maintains is a surety register. Now, why the surety register is maintained? So it is said that if any of the members require loan in a cooperative society, or loan by the cooperative society, they have to give the guarantee of two other members of cooperative society. Now, the person giving guarantee have a limit that they can give guarantee only up to twice of their capital. So hence a surety register is maintained to ensure that no person is giving guarantee above their prescribed limit. Hence, surety register ensures that the right person is given the right loan, and the guarantee is also given by the eligible person and not a non-eligible person. Then comes restriction on shareholding. So as I said from the start, cooperative society is basically a combination of different people coming together and starting a business. Hence, the restriction on shareholding is paid, because if any person is allowed to have a shareholding of 50% or 60%, then instead of the cooperative society coming together, that society would be basically that person dominated society. Hence a restriction on shareholding is placed, wherein every shareholder has a restriction of 20%. That is, no person can hold more than 20% of paid up share capital in a cooperative society, and coming in value terms, that should not be more than 1,000. Now the loan from cooperative society can be taken only by the members, and also after prior or proper approval of registrar. For borrowings, the cooperative society can borrow from anyone and everyone. Like it can borrow from members, non-members, or from other cooperative society, whomsoever cooperative society thinks so. Just in case of loan being provided by the cooperative society, it is restricted to the members. Now comes investment of funds. So where can a cooperative society invest? So since cooperative society is basically a combination of people coming together, it is usually said that the cooperative society should not undertake volatile investments, because that might have the fear, or that might have the loss of people's money. So usually it is advised to have safe investments for a cooperative society. Now, where can a cooperative society invest? So the cooperative society can invest in BICA, cooperative bank, any security as certified by Indian Trust Act, any other cooperative society, any person carrying on business, and lastly, any security prescribed by requisite authority. Then comes appropriation of profits. So how are the profits to be appropriated? So 25% of the profit should go into the general reserve. However, if the registrar feels that it is not possible for a particular financial year to deposit so much profits to general reserve, the registrar can reduce down that money, but that should not be reduced to less than 10%. So the minimum is usually 25%, but in exceptional status, in exceptional stages, this minimum can be reduced to 10%. Apart from that, if the cooperative society wants, the cooperative society can also contribute to charitable purposes, but that should not be more than 10% of the profit, and all the decisions should be taken with the prior approval of members, because it is ultimately the members' money which is getting distributed. Now coming on to the audit procedures. So the first thing is obviously understand the entity. What are the initial work that is to be undertaken to understand the entity? Check that whatever laws are applicable on the society are being followed with. Internal control should be checked. It should be ensured that the financial statements are as per financial reporting framework, and minutes of the meeting should also be read. Apart from that, one unique point that is involved in the initial work of audit of cooperative society is checking the registrar of members. So in other organizations, usually members do not play a pivotal role or important role, plus the number of members are usually too large for the auditor to check. But here in cooperative society, since the essence of society is through its member, the auditor is required to check register of members too. Now coming to the income portion, how will a cooperative society earn income? By selling goods, by investments, by any member paying any part of share capital, by money received through the members, or by interest on any loan provided by the cooperative society. Now, how as an auditor would I vouch these incomes? For sales, I'll have to check sales invoices. For interest and principal received, if any, of any loan, I'll have to check the loan agreement. For share capital received by any member, I'll have to check register of members. And for any income received via member of cooperative society, or any money received via member of cooperative society, I'll have to check the register of members, demands, and money receipts. Now coming on to the expenses. So the majority expenses of a cooperative society are miscellaneous expenses, or expenses required for running of business. Apart from that, there is also capital expenditure that is incurred by a business. Capital expenditure could be expenditure related to infrastructure, or or any machinery, or any particular kind of asset that is required by cooperative society. So for expenses, in case of capital expenditure, it should be vouched via authorization from management. Bills should be vouched, money receipt should be vouched, and bank passbook should also be vouched. For payment of loan, it should be verified via loan agreement. And for establishment expenses, resolution agreement and money receipt should be checked. Now coming to the assets. So usually in other entities, for the assets, we are usually more concerned on the fixed assets, or there are usually audit procedures that we read for fixed assets. However, in case of cooperative society, this portion of asset is concerned over current assets. So herein, we will be covering audit procedures related to current assets. Now, what are the audit procedures that are undertaken by the auditor to check the current assets? So firstly, the auditor should obtain an aging schedule of debtors from 6 months to 5 years. Also, the auditor shall have to check the status of recovery and effect of that in accounts. Apart from that, if there is any interest received by the member So if any loan was given to the member and if there is any interest received from that member after the due date, so instead of just showing it as interest for member, it should be shown as overdue interest reserve account, so that the other members in the cooperative society know that this member has either defaulted or paid late. And lastly, if there has been any bad debts written off during the year, it should be ensured that all the bad debts are properly authorized. And we come to the last entity of this chapter and also to the end of this chapter, that is audit of banks. So with the online usage increasing all over India, banks have been playing a very important role. We have reached a stage, at least in India, wherein even if you don't carry your wallet, you can easily survive through the day by UPI, GPay, Bheem, IMPS, and etc. So for this, the importance, or you can say the increasing work of banks have begun. But with increase in the role of bank, there has also been an increase in the risk. So with increase in the usage of bank accounts, there has been also an increase in the cyber risk or cyber crimes related to banks. So it is very important for the banks to get the audit done, so that the users have the confidence that the bank I'm trusting upon, the bank I'm using upon is correct or not, and the bank has taken all the security measures that ensures that my money is safe. So there are a lot of laws that are applicable on bank, the majority being Banking Regulation Act, RBI Act. Apart from that, there are different kinds of bank which have different rules applicable, just like rural regional bank will have an RRB Act, or a nationalized bank will have a Nationalized Bank Act. So based on the basis of kind of bank, there are different laws applicable to those banks. But in any case, every bank has to follow the Banking Regulation Act and the RBI Act. Apart from that, the act and the laws and the regulations might differ on the basis of the kind of bank. So banks are different from companies, and bank has a different financial reporting framework. Bank does not follow AS and NAS. Instead, banks have a different financial reporting framework. They have a different accounting method. They have different things under accounting to follow, which you will learn in your accounts. So the financial statements of banks are usually presented in two forms. Form A, which is for P&L. Form B is for balance sheet. Who can be an auditor in a bank? Any person who is qualified to become the auditor of a company can be a auditor in the bank. That is, the statutory auditor can become an auditor of bank. Now, how is the auditor appointed? So in subchapter 1, we had a brief discussion on the appointment and the appointment responsibilities and the appointment procedures of auditors. However, here the appointment differs on the type of bank. So in case of a nationalized bank, the BOD will appoint the auditor. In case of SBI, CNAG will appoint the auditor. And in case of regional rural bank, the bank will do with prior approval of CG, that is central government. Now, who will decide the remuneration of the auditor? So unlike companies where the remuneration is decided in AGM, nationalized banks remuneration, or nationalized banks auditors remuneration, is decided by RBI with prior approval of central government. Now, what are the content of audit reports? So as I said, that banks differs from companies. Banks have a different financial reporting framework than the companies. So even the audit report differs from the companies. So the first point remaining the same, that whether the financial statements are giving a true and fair view or not. The next point states that the auditor will have to describe that whether the bank has undertaken any activity that is outside its power. So banks have limited powers and limited rights. So it should ensure that whatever activities it is undertaking is within the powers and not outside the powers. So the auditor has to disclose whether it has come across any situation wherein the bank has surpassed its rights and done any activity. Apart from that, branches are very important in banks. So recently SBI reported a branch count of 22,000. So unlike companies which have like 10 to 20 branches, banks have a lot of branches. So branch reporting is very important. So the auditor or the statutory auditor has to report whether the branch auditor's report has been received or not, and whether the returns are adequately received from the branches. And lastly, the auditor should also tell about any fraud if he has come across, because yes, banking frauds are very, very common. And if there is any fraud which require immediate attention of central government, then that should be reported. Apart from that, RBI may also ask the bank, RBI may also ask the auditors to report upon something. So the RBI, that is the apex body of banks, might ask the auditor for LFAR, that is long form audit report. So long form audit report is basically a questionnaire on the functioning of the entity. So RBI may ask that from the auditor, and apart from that, there can also be any certificates that can be required by RBI. So the auditor has to also report upon that. So apart from just the audit report, in case of banks, the auditor has to also comply with the requirements of RBI. Now comes the initial work, that is the audit procedures. So the first audit procedure that has to be undertaken by the auditor in case of bank is simply understand the entity. Understanding the entity is very, very important. From the start, I'm saying banks differ from companies. Banks function different from companies. So understanding the entity and understanding the functioning of bank is very, very important. So the first thing that the auditor should do is obtain an understanding of the bank, obtain an understanding of accounting processes, obtain the process of bank for risk management, that is how is the bank avoiding risk, understand relevant Basel framework, then make an audit plan, then have an audit materiality, and also check whether the previous auditor's report can be relied with or not. Because if the previous auditor's report can be relied with, so the auditor shall get an idea of the usual risk and stuff that is involved with the bank, and that can help him decide the further audit procedures. Now coming to item specific audit procedures. So the first item is advances. So advances are the biggest asset of any banks, because it is through these advances that the banks earn the most interest. So for advances, the auditor has to verify whether there has been proper authorization, proper approval, whether proper documentation is maintained by the bank, that is whatever necessary documentation are required for taking of advances has been maintained by the bank or not. Accounting should be checked, that is subsidiary ledger and control account should be checked. And lastly, steps for recovery must be checked if any account is overdue. Next comes cash in hand. So wherein other organizations usually have a cash count of 1 lakh to 10 lakh. For banks, usually the cash count ranges for 1 crore or even more. So herein cash plays a very, very important role. So physical verification of cash is a must. For other branches also, physical verification certificate must be obtained. Apart from that, it should be ensured that there are proper internal controls, that is there are proper segregation of duties. The person accessing the cash should not have access to the accounts, or there should be proper records of person accessing the cash. There should be a safe key that should not be available to everyone. So there might be internal controls, and it should be seen whether the internal controls are effective or not. And lastly, if there is any amount of foreign currency that is held by bank, even that should be checked. Then comes balance with RBI, that is balance with Reserve Bank of India. So you might know that if you earn some amount of money, instead of giving it all, your parents take a portion of it and give you the rest. Why? Because they are simply concerned that you will expend it all out and not save. Saving is very, very important for a future contingency. So same is with RBI. What RBI does is that RBI takes a portion of money that is received by banks, so that the banks do not give away all the money to the lenders in the greed of interest, because RBI knows that if all the money is given to the lenders in the greed of interest, there could be high risk, and it could be that there might be a lot of defaults and the bank won't be able to face any future contingency. So RBI asks the banks to maintain a balance with them and keep a balance or keep a portion of their money with RBI. This is also known as cash reserve ratio. So for balances with RBI, a confirmation must be taken to check and to obtain an assurance that whatever is shown as the balance maintained with RBI is actually there or not. And apart from that, a reconciliation statement must also be taken. Then comes balances with other banks. So as the companies usually have the lending between them, similarly even the banks have lending between them, and that is known as balance with other banks. So that should be verified via reconciliation statement. In case of large transaction and balances, that should be inquired for, and if there is any transaction with a foreign bank, then it should be ensured that it is converted at the market rate. Then comes money at call and short notice. So money at call and short notice are basically short-term financing. So if you go to take a loan, usually there are a lot of processes that are to be undertaken, and post the process also it takes time for the money to come in. However, sometimes we are in need of instant money, so you can opt for money at call or short notice. Money at call or short notice are basically instant financing, but the only condition to these are that these are for a really short period. That is, the bank charges high interest, plus the bank can have the money any day repayable at demand. So if there is any money at call and short notice that is given by bank, it should be checked that whether authorization system has been followed with. If there has been any call money that has been taken by the bank from another bank, so it should be ensured that it is not netted off. And lastly, if there has been any money market lending for more than 6 days, it should not be classified as money at call and short notice, but instead it should be classified as deposit. Then comes fixed and other assets. So fixed and other assets are generally not very valuable for bank, because bank does not make investments in these properties. Plus, as per section 9 of the Banking Regulation Act, bank is prohibited to own any assets for more than 7 years unless and until for its own use. So bank does not usually invest in properties. So for fixed and other assets, it is to be ensured that physical verification is conducted, depreciation is correctly charged or not. In case any fixed asset has been sold during the year, it should be verified via sale deed. Accounting method should be appropriate. Section 9 should be complied with, and in case any revaluation had been made during the year, the basis for revaluation should be obtained. Then comes borrowings. So here the borrowings being talked about are borrowings that are taken by the bank, that is money that has been taken by the bank from other banks or another person. So in that case, it should be ensured that they are properly authorized. Rate of interest must not be prejudicial. Rate of interest must be as per the period, and lastly, amount should be properly disclosed. Then comes deposits. So deposits are the biggest liability of an bank, because it is ultimately on these deposits that the bank has to give interest, which is popularly known as FD, or you can say RD, recurring deposit, fixed deposit. These are the kind of deposits that the bank offers and the customer takes. So this is the biggest liability of bank, wherein the bank has to pay the interest. So it should be ensured that there are no window dressing. That is, whatever has been actually given during the period has been shown during the period. And apart from that, as on 31st March, the interest on these deposits accrue but not becomes due. So if there are any interest that have been accrued but have not become due, then it should be shown as other liabilities in the balance sheet. Then comes capital, which is one of the easiest item to audit in any entity. So in case of capital, it should be ensured that the opening balance is correct. It should be tallied with the closing balance. Additions, if any, made during the year should be properly authorized, supported by resolutions. Prospectus should be checked in case any shares are issued during the year, and government notification should also be checked. Then comes reserves and surplus, which yet again is a very easy item to audit in financial statements. So all the additions and deletions in reserves and surplus should be properly authorized, approved, and in case the bank has any foreign branch, it should be ensured that all the rules and regulation of that foreign branch and that foreign country are being complied with. Then comes bills payable. So bills payable, we read in companies audit subchapter 3 that bills payable are generally issued to the sundry creditors. So when you do not pay them directly and when you pay them via bills, it is known as bills payable. So if the bank has taken money or has borrowed money from any other person, and instead of paying them directly, bank pays them via bills, so it is known as bills payable. Generally, the bank takes money from another banks only, so the sundry creditors of a bank are another banks. So for bills payable, it should be ensured that all the internal control procedures are followed. These drafts bills should be in custody of a responsible person. The signature of bills payable should be matched with signature book. Once the payment is initiated against the bills payable, a confirmation should be obtained from the another bank. If it has not been obtained, then this transaction should be stopped. However, continuous stopping of transaction also ignites a manipulative or fraudulent transaction alert. So it should be seen that whether there has been any continuous stoppage of transaction. If not, there is no problem. If once the confirmation is not received, the bank should try and reinitiate the transaction. When the money is transferred from one bank to another bank, there is usually a private code that is shared with only the reliable persons of both the banks. So it must be seen that the private code is made available only to particular persons. Then comes treasury operations. So treasury operation basically means cash and risk management. In our syllabus, we have very little portion of treasury operation, but once you go in the practical audit, you will see that treasury operations take a lot of time. In fact, most and major of the time is taken by treasury operation only. So treasury operation basically means seeing how the cash and the risk is being managed by the company, and in case of bank, then how the risk and the cash is being managed by the banks. So as an auditor, you should obtain a complete overview, check the risk assessment, and design procedures so that you can ensure that whatever risk assessment or whatever cash management techniques are being undertaken by the bank are checked by you, and all of it should be truly and fairly disclosed. Next comes contingent liability. So contingent liability in a bank differs from that of companies, wherein in companies, the contingent liabilities are just limited to certain petitions or certain legal cases going on. Contingent liabilities in banks is a long list because of the non-fund based facilities granted by bank. So the non-fund based facilities could be bank guarantee or letter of credit or letter of comfort. So all these are non-fund based facilities, and in case these fail, so the bank has to pay. So bank accounts for all of these under contingent liabilities. And if you get time, just once visit any bank and see their annual report and see the number of contingent liability and compare that with that of company. So in case of company, when the contingent liability is just limited to 5 or 6, in case of banks, you will see that long list of even 30 to 40. So for contingent liability, the auditor should first check that all these liabilities are identified properly. Non-fund based facility should be granted only to regular constituents, because non-fund based facilities are risky and it should not be given to irregular constituents, because ultimately on non-fund based facility failing, it is the bank who has to pay. Transaction should be authorized, internal control should be followed. If LC, that is letter of credit, is given, so letter of credit is usually given by the importer to the exporter, so that to imbibe trust, that the exporter sends the goods and then the importer sends the payment. So if any LC fails and the bank has to make the payment, that should be only on the basis of shipping bills. Substantive audit tests should be performed. Year-end amounts reasonableness should be checked, and lastly, it should be checked that it should be ensured that whatever comfort letters are issued by the bank, they are disclosed under contingent liability. And the last item for banks, and the last item for this entire chapter, that is bills for collection. So there are usually two types of bills for collection: inward bills for collection and outward bills for collection. Outward bills for collection are bought in by the exporter, wherein the bank is responsible for collecting money against those bills, and inward bills for collection are bought in by the importers, where the bank is responsible for making making payment for them. So in case of outward and inward bills of collection, obviously the inward bills for collection would remain with the bank as they have to make the payment, but the outward bills for collection, as soon as they are received, are sent to another bank for collecting payment. So for outward bills for collection, you can just check the register. For inward bills for collection, you can physically verify all the bills. The better way to verify these bills for collections are subsequent payments and selection. Subsequent payments and realization. I'm sorry. Yeah. So what I was saying that the better way to verify bills for collection is subsequent payment and realization. So as I said earlier also, usually the financial year ends on 31st March, but we continue our audit till May and June. So you'll see all these bills for collection being realized or being paid in April and May. So you can back calculate from the subsequent realizations and check whether the bills for collection that was shown as on 31st March is valid or not. And lastly, the accounting procedure should also be looked upon. That is, what is the process that the bank is following to credit or debit the person, and what are the nature of obligations in respect of these bills. So that is it for audit of different kinds of undertaking, giving you a 1 minute break, post which we will be solving the Q&A for this chapter. There are not a lot of Q&A that you expect from this chapter. Would take us like 20 minutes maximum. So giving you a 1 minute break, quickly go freshen up, and then we can start with the Q&A. Hope you people are back from the break. Before the break, we completed the revision of audit of different kinds of undertakings, and now we'll be solving the Q&A. As said earlier in this video, this chapter does not have a lot of Q&A. We'll be solving like 4 to 5 Q&A, which won't take us much time. But yes, the questions from this chapter are not generally on the part base. So they could ask you a direct question for audit of hospital or audit of school. So therein you will have to write 2 to 3 procedures for each item. So I would suggest you not to do part study in this chapter, because they usually don't ask that what are the procedures for income or what are the procedures for income. What are the procedures for expenses. They would generally ask you the procedures for the entire entity. So I feel the revision notes are more than enough for that. If you get through the revision notes and revise it nicely and are able to write the content inside from your own, you can grab a good share of marks in the questions. So the first question is, demonstrate the audit procedure to be followed by an auditor while conducting the audit of educational institution. And here is a 4-star question, that is, it has appeared 4 times before in the examination. So as I said that there is usually no questions regarding the just the audit of income or audit of expenses. They will directly ask you the question for audit of or the audit procedure of the entire entity. So herein they have asked about educational institution, that is school. So first you will have to say about the initial work. What is the initial work? Check whether the financial statement is as per FRF. Then understand the entity. Then understand the internal control. Check the documents and the minutes of check the documents and the minutes of meeting books. Then check whether every expenses have an allocated budget and whether the expenses are being incurred as per the budget. Now coming to specific procedures for income, for fees, it involves checking of counterfoil of receipts, fee register. In case of late fees, it should be vouched that whether the fee was paid after the due date. Irrevocable and advance fees should be duly adjusted. In case there is any capital fees or admission fees received during the year, that should be credited to capital fund account. All the arrears on account of fees, fines have been taken into consideration at the end of accounting period. If any student has been offered any scholarship or concession, that should also be adjusted. For hostel, it should be ensured that any caution deposit, if refunded, is duly adjusted. And once the student leaves the hostel, there are no dues left from that particular student. So all the hostel dues should be cleared. For grants received by the school, that should be verified on the basis of sanction letter and on the basis of authorization and approval. If the school has invested in certain properties or generates rents from certain properties, then the rent agreement should be verified, the investment should be physically verified, and Where possible, the calculation should be seen, and these miscellaneous income vouchers should be duly seen. Then comes to payment related transaction, that is expenses. The major expense is a teacher's salary. The teacher's salary should be verified via biometric payroll register. Apart from that, in case of a government school or government college, it should be ensured that if the fees is refunded, the fees is duly adjusted in the books of accounts. Apart from that, all the statutory dues should be deducted and deposited in the correct account. And lastly, if there has been any particular kind of deduction for any teacher, or there has been any arrear or outstanding or any prepaid adjustment, then even that should be properly insured. Expenditure associated with special events should be taken care of, and it should be ensured that the expenditure incurred is as per the budget, and any excess of the income over expense should be reinvested. For fixed assets, it should be duly supported by vouchers, duly supported by bills and resolution. Caution deposit, as said earlier, should be adjusted. Physical verification should be conducted for assets. Depreciation and amortization should be checked. In case of investments, it should be ensured that refund of TDS has been obtained. All the outstanding liabilities should be taken care of and should be checked that whether they are reasonable or not. For inventory, system order inspection should be checked. Stock register should be verified with. And apart from that, in case there is any authorization required for purchasing inventory, even that should be ensured. And last comes verification of financial statements. So financial statements should be prepared in the form and manner as specified by the regulatory authority. Next comes question 2. So question 2 is list down the steps taken by the auditor for conducting the audit of hospital. Again, a 4-star question. As said earlier, they don't ask you about specific income or expenses. They will directly ask you to write down the audit procedure of that entire organization. If the marks distribution is 8 marks, you can simply write 2 points under each of item or each of the procedure. So first is the initial work. So initial work involves checking that whether the financial statements are as per financial reporting framework, then whether the minutes of the meetings have been obtained, rules and regulations should be ensured, and it should be seen whether the internal control is effective or not. Then coming to income, so for income received through patients, it is to be verified via bills, copies of bills, counterfile of receipts, and patient register or the ward register. If any miscellaneous income has been received as interest or dividend on investments, they should be duly supported by vouchers. Donations received should be supported by sanction letters, and also donation should be specifically used for the purpose for which it was obtained. Government grants or grants from the local body should be verified with reference to correspondence with local authorities. Clear distinction should be made between items of capital and revenue. Coming to the expenses portion, the doctor's salary and the ward boy salary and any other third person salary should be verified by payroll and attendance register. For doctor's remuneration, you can also check upon the bill. All the miscellaneous expenses should be duly supported by vouchers, and all the huge financial expenditure should have prior approval or authorization of the due committee, and whatever expenses are made, that should be authorized by the department, be it the purchase department, inventory department, or if any higher authority is required. For assets, there should be physical verification of assets. Depreciation and amortization should be charged. Apart from that, it should be seen that all the assets are duly supported by title deeds or vouchers or whatever bank statement verification or bank statement proof that they have. The liabilities should be reasonably tested, that all the outstanding liabilities should be seen that whether they are reasonable or not. Question number 3, mention the steps involved in the audit of cinema hall. 2-star question. So herein you will have to restrict yourself to cinema hall, and you will have to write all the audit procedures related to cinema hall. So first of all, you'll have to see whether the advance booking are adjusted or not. Next, you'll have to see that the tickets are under the proper custody or control of a person. All the sale of tickets and stuff should be authorized. Further, if there is any income received on the basis of advertisement, then it should be verified by the agreement. Sale of popcorn and cold drink should be verified by counterfoil of receipts and invoices. Apart from that, payment also needs to be made for the hiring of films, so that should be made on the basis of agreement. And if the film hall is booked for any particular special purpose or particular event, then payment for that event should be verified with help of agreement. Then comes question number 4. Write a short note on audit of municipalities and panchayats. So first of all, you'll have to write what are the objectives of auditor in audit of municipalities and panchayat, that is audit of local self-government. So the objective of the auditor is to check whether the financial statements are giving a true and fair view, to detect frauds, to ensure value for money, and also to report on the adequacy of internal control. Apart from that, on the audit procedures, the auditor should first check whether his appointment is as per the laws and regulation. Next, he should ensure that all the expenditures are properly authorized and are incurred to conform to relevant provision of law. If any expenditure is to be made after authority or if after sanction from any particular person, then it shall be seen that whether the expenditure is made after being authorized by a particular person or after being sanctioned from that particular person. Provision of funds, usually piggy banks made for the local self-government. So if any expenditure is made from the provision of funds, that should be authorized, and that should be seen that it is within the limits of provision of funds. And in case of any huge financial expenditure for any scheme, it should be seen that whether it is running economically or not, and all the expenditures that are being made are for the particular purpose for which the scheme is being run. And coming to the last question, which is a 5-star question, audit of cooperative society. So herein, in case of audit of cooperative society, first you will have to write about the initial work and then go on to the specific items. So for initial work, in case of a cooperative society, you'll have to check the rules and regulation of the society, then obtain a view about the internal controls of the society. And the unique point in case of cooperative society was to check register of members. So the register of members should also be checked. In case of income, for sales, you should check the sales invoices. For any amount received by the members against share capital, the register of members should be checked. For any interest and repayment of loans agreement must be checked. And lastly, for any income received from the members, the register of members, money receipts and demands must be checked. Then comes audit of expenditure. So usually there are miscellaneous expenditure incurred by the cooperative society in connection with the business, and apart from that, there is capital expenditure that is made. So for capital expenditure, you should ensure that it is properly authorized. Money receipt, bank passbook, counterfoil of check and approvals must be obtained. In case the cooperative society has taken any loan and has repaid any loan or interest during the period, that should be checked with the loan agreement. And lastly, for miscellaneous expenses, resolution agreement and money receipt should be checked. Other aspect points in relation to assets. So herein, in case of cooperative society, we are usually more concerned of the current assets rather than the fixed assets. So for current assets, you need to obtain first an aging schedule from 6 months to 5 years, and then check the status of recoverability, and also notify about the effect of that on the accounts of the society. Apart from that, if any member had taken any loan and pays the interest after the due date, so instead of crediting it in the interest section, it should be credited in overdue interest, so that the other members of the cooperative society know that this member has faulted in the due time of interest. And lastly, if any bad debts have been written down during the year, it should be ensured that they are properly authorized by management committee, or in other scenarios it could also be auditor. So in Maharashtra Cooperative Society, it is the auditor who authorizes bad debt. So whosoever is the person responsible for authorizing should authorize, and the bad debt should be supported by authorization. So that is it for Q&A. Now we are left just with one chapter, that is basics of auditing, which we will be covering after the break. I hope you are liking the session up till now. In case of any queries, you can comment down below, and if not, do like, share and subscribe. Thank you. Hello everyone, I hope you people had a wonderful break. Before the break, we completed the chapter Audit of Different Kinds of Undertaking. Now we are left with our last chapter of the syllabus, that is Basics of Auditing. Now since Basics of Auditing is a lengthy chapter, it has been divided into 4 subchapters, subchapter 1, 2, 3, 4. In an overview, this chapter will basically let us know about audit, the advantages of audit, the limitations of audit, how are the audit procedures conducted, what are the different kinds of audit procedures, what are the risks present in the audit, how does the auditor combat those risks, or what are the solutions to this risk, and how does the auditor actually conduct the whole audit, and then gives the audit report. So basically it is going to teach you about the first level of audit, that is all about the basics of audit. Now in subchapter 1, we are going to learn about the definition of audit, the objectives of audit, the limitations of audit, the advantages of audit, and different types of audit. In subchapter 2, we are going to learn about the first step that is conducted usually in audit and the important terminology of audit. In the third chapter, we'll get to know about the risks of audit, and in the fourth chapter, we'll get to know about the different kinds of audit procedures that the auditor applies in order to complete the audit in a timely manner and in an efficient manner. So let's begin with subchapter 1. So subchapter 1 firstly talks about the evolution of audit. That is, how has audit evolved from older times to now. So in older times, where even accounts was just restricted to P&L, audit was also restricted to just financial information. But now audit has evolved over to both financial and non-financial information. That is, now auditor does not only look to the financial statements but also checks the notes to accounts, internal controls, and whether the business is being conducted lawfully and there are no malpractices in business. Earlier, the accounts were made just to ensure that the business is earning enough profits to feed their homes, but now the financial statements of the business are not just limited to that purpose. They have multiple users and they need to cater to all of them. So the first point in this chapter is evolution of audit, can come as a difference in your examination. So you'll basically have to state that in older times the scope of audit was very limited, whereas now the scope of audit has widened. Apart from that, in older times the scope of audit was just limited to financial information. Now there is both financial and non-financial information catered to by audit. Apart from that, in older times, audit involved checking of books of accounts, and now it involves checking everything related to the financial statements. But since audit has evolved, even the features of auditing has evolved. So what are the features of a good auditing, or what are the key to a good auditing? So that is basically SCARF. So firstly, you need to set standards. To certify anything as correct or incorrect, you need to have a standard to compare to. So first thing that needs to be done is set standards. Next, the auditor should be competent, because it is ultimately the auditor who conducts the audit, and if the auditor is incompetent or not professional, the audit won't be completed on a timely basis and wouldn't be completed nicely. Next, analytical review is a must. The auditor has been appointed to do analytical review only, because if he does not do analysis, there is no point appointing such a high dignitary to do audit. Next, to obtain or to form a view on financial statement, reliable evidence is very much required. So the audit should involve all the evidence that are reliable. Now, if you obtain a reliable evidence, obviously you will be able to comment whether the financial statements are reliable or not. So the next feature is to comment on reliability of financial statement. And if you forgot, we just read above that the scope of audit is not just limited to financial information. So not just financial statement reliability is to be commented upon, but also non-financial information are to be checked. Now, I said that the auditor should be competent, or it ultimately depends on the auditor that how would be the outcome of audit. So how is the competency of an auditor defined? So competency of an auditor is defined by twice caps. First thing, he should maintain proper documentation. Next, if there is anyone in the team who is performing the work, or there is any work performed by other which he is using, so he should supervise that. Next, he should be integral, that is honest. From C, confidentiality should be maintained, because ultimately the client is trusting him with the financial statements and expects confidential behavior from him. Further, evidence is a must. Without valid evidence, it is basically impossible to comment whether the financial statements are actually correct or incorrect. Conclusion and reporting is one of the most important parts of audit. In the previous chapter also I said that audit report is the main and final product of audit. If the auditor isn't able to make the correct audit report, ultimately all his work goes in vain. So conclusion and reporting is very, very important. Accounting books are to be checked properly. Planning is the key to success to any performance. If you don't plan well, you won't be able to perform well. So planning should be very proper. And lastly, obviously the auditor must have skills and competence. Now, what ultimately is the objective of audit then? So the objective of audit, or the objective of auditor, is to obtain reasonable assurance that financial statements are free from material misstatements, whether due to fraud or error. Now, what is meant by reasonable assurance? So reasonable assurance is a high level of assurance but not a guarantee. Financial statements include balance sheet, P&L, notes to account, schedule 3 and cash flow. I said financial statements include balance sheet, P&L, notes to accounts. Schedule 3, it won't be schedule 3, it would be statement of changes in equity, and lastly notes to accounts. Apart from that, misstatements mean mistakes in financial statements. Now mistakes could be intentional or unintentional. So if mistakes are intentional, they are known as fraud, whereas if the mistakes or the misstatements are unintentional or made by mistake, they are known as error. So ultimately the objective of the auditor is to find that the financial statement is reflecting a true and fair view or not, whether the financial statement is as per financial reporting framework or not, or whether the financial statement is actually showing what is happening in the company and does not have a lot of errors which mislead the users of financial statement. Now this was primary objective, but there are other social objectives also that are catered to by audit. First, the shareholders' interests get protected. Second, it helps in tax assessment, because ultimately if your financial statements are certified by an auditor, people believe in that financial statements, and it can be used as a ready reference for tax assessment. It helps in safeguarding from capital erosion, ensures fair return, promises reasonable price to customers, ensures fair compensation to worker, and even helps in CSR policy. Now, to achieve this objective, would the auditor give up on his life? No. So what is included in the scope of audit? That is, to what extent does the auditor need to work? So the auditor basically firstly needs to obtain a reasonable evidence. If he does not obtain a reasonable evidence, obviously he won't be able to comment on the reliability of financial statements. So the first thing that he needs to do is obtain a reasonable evidence. Next, he should have professional judgment and professional skepticism. That is, he should apply his professional knowledge everywhere and he should be alert. Now, obviously, auditor just gets 3 months to audit the entire financial statements of 12 months, and it ain't possible for him to check each and everything. So, to ensure that he is checking all the important things, he calculates materiality. Materiality is the level beneath which the users of financial statements are not affected, or the auditor is not affected by these small mistakes. Whatever comes up above the materiality level affects the users of financial statements, and even the auditor is concerned about those mistakes. Apart from that, the auditor should also ensure that the financial statements is giving true and fair disclosure, and all of the disclosure requirements as certified by Schedule 3 are satisfied. Now, why does the auditor give reasonable assurance and not guarantee? If the auditor is getting 3 months to check a 12 months financial statement, it could be a possibility that auditor could take another month and give guarantee. But why is the auditor restricted to just reasonable assurance? That is because of inherent limitations of audit. Now, what are the inherent limitations of audit? So, first of all, as I said, materiality is the level beneath which the auditors or the users are not affected. But it could be that an individual mistake is beneath an individual mistake is beneath the materiality level. But when hundreds of such individual mistakes are combined, they cross the materiality level. But because the auditor does not check any mistakes beneath materiality level, the auditor might miss out on a lot of errors. So first problem is materiality might be useful in some areas, but it not might be useful in other areas. Next, whatever evidence is obtained by the auditor is to be believed by him. He is not an investigator or not a policeman. So whatever evidence, be it truth or false, is to be believed by him. Next, whatever evidence is obtained by auditor is persuasive and not conclusive. So if the auditor is checking debtors and if he asks for certain evidences, whatever the management gives, the auditor has to be believed by him, and he cannot investigate further and ask for multiple evidences. It could be a possibility that the employees could not like it, and there would be a clash between the auditor and the employees, making it difficult for the auditor to complete the audit efficiently. Now, if an employee does the fraud, it can be caught by the auditor, but if the management itself is involved in the fraud, it is very difficult because it is the management who provides the auditor with all the documents. So if the management is involved in any kind of fraud, the auditor is not able to find it, and this also accounts for an inherent limitation. And lastly, the nature of audit is such that because of less time and less cost, the auditor cannot invest a lot of techniques in audit, which actually concludes him to form just in reasonable assurance and not guarantee. Now, despite these inherent limitations, people want to get their books audited. Why? Because the limitations are just restricted to 5 or 6, but there are multiple advantages of audit. Now, what are the advantages of audit? So, first advantage is from the legal point of view. So, in case you are getting your books audited, it helps you in filing income tax return. In case you receive any notice from income tax or sales tax, it helps you to answer those also. If the business is getting winded up or if the business is getting into insolvency, it helps in proper flow, or it helps in proper distribution to people. Also, the people believe the balance sheet and get an assurance that they will get their fair share of return. Loan taking is very much easy because even the banks want a audited balance sheet. And lastly, if tomorrow your godown gets affected by fire or any natural calamity, audited financial statements also help you in insurance claim. Now, this was from the legal point of view. What about the internal point of view? That is, how does the audit or the auditor help the business to grow better or the business to be better? So first of all, it helps in detection of errors and fraud, which automatically makes the business better. Second, it acts as a moral check on employees. So the employees are scared that if they make any mistake, they can be caught by the auditor. So it acts as a moral check on employee. Third, in case the management is facing any accounting issue or any accounting error, it helps the management solve that. And lastly, it also serves as a comparison with previous year. Next comes external point of view. So audit in general helps in business valuation because audited financial statements are trusted by everybody, so business valuation becomes easier. In case you have a partnership firm, so liquidation, admission, debt of the partner is very easy to account for in the books of account, and the books of accounts are also trusted by other partners. Also, it helps in setting the future trend of the business. Next comes general point of view. So general point of view is nothing but a combination of all of these three, and the best points from all of these three are taken for general advantages of audit. So the general advantages are: it protects shareholder interests, it helps in tax assessment, it helps the business to get loan easily, it acts as a moral check on employee, and it reduces wastages. So all these 5 points were nothing but the combination of best points of all these 3 points of views. Even if you don't learn general points of view, it is okay. Now, the thing is that there is not only statutory audit but other types of audit also that exist. Just because statutory audit is very popular, Common people just know about the statutory audit, but there are around 15 to 16 different types of audit on different bases. So in this chapter, we will get to know about the different types of audit that the auditors do and on which kind of entity are these audit applicable. So there are 5 bases on which audit can be divided. First is organization structure wise, that is on the basis of structure of the organization, the audit is divided. Next, objective wise, that is on the basis of objective of audit. The audit are divided. Next is period wise, that is on the basis of period of financial statements that are under audit, the audit is divided. Fourth is scope wise, that is on the basis of scope of audit or what is to be covered under audit, the audit is divided. And the last is subject matter wise, that is on the basis of different subjects to be audited, the audit is divided. So first comes organization structure wise. So organization structure wise basically has 2 kinds of audit, statutory and non-statutory audit. Statutory audit we have learned in the first class itself. In the first video itself, statutory audit is basically the audit that is required to be conducted as per the law and regulation, whereas non-statutory audit is the opposite of statutory audit. So basically non-statutory audit means the voluntary audit that any business gets conducted voluntarily and it has no linkage with law or regulation. Example of these 2 kinds of audit could be, for statutory audit, company is the best example, and for non-statutory audit it could be partnership firms. So Partnership Act never asks the partnership firms to get their books audited, but if they are doing so, they are a part of non-statutory or voluntary audit. Now the basic differences between statutory and non-statutory audit are that the scope, qualification, powers and duties in case of statutory audit is defined by law or regulation, whereas the scope, qualification, powers and duties in case of non-statutory audit is decided by the appointing authority. And the most important difference is, in case of statutory audit, the audit report is to be submitted to every user of financial statement, that is to public at large, whereas in case of non-statutory audit, the audit report is just submitted to appointing authority. So in case of non-statutory audit, the scope of audit and audit report is very restricted, but in case of statutory audit, the scope is very wide. Next comes objective wise, that is on the basis of objective of audit. So yet again there are 2 kinds of audit based on the objective of audit, that is internal audit and internal financial audit. So internal audit basically checks the internal controls of the company, suggests measures and suggests improvement to the company so that company can implement them and ensure that they are conducting an efficient and orderly conduct of business. So internal audit basically involves checking internal controls, suggesting improvements, strengthening governance, risk management, and internal control. Next is internal financial audit. So internal financial audit just helps the business to know, or just helps the users to know that whether the financial statements are showing a true and fair view. They do not check that whether there are any errors, whether there are any frauds, or whether the financial statements are as per AS, Ind AS, or as per any financial reporting framework, or whether all the disclosures are present. No, their objective is just confined to checking that whether the financial statements are giving a true and fair view, that is whether all the transactions that have actually occurred during the year have been reflected in financial statements. Now in case of statutory audit, the auditor has this point covered in the objective itself. So statutory audits do not get internal financial audit conducted, but in case of non-statutory audit organizations like partnership or other non-statutory audit organizations, they get internal financial audit conducted so that they can know whether the financial statements are giving a true and fair view and all the transactions are covered or. Next comes period wise. So period wise basically means period of financial statements that are to be audited. So here are 4 types of audit that are divided under period of financial statements to be audited. First comes final audit. So when the financial statements of whole year is to be audited, it is known as final audit. So statutory audit is nothing but a form of final audit only when the financial statements of the entire year or the entire financial year gets audited. The biggest advantage of this kind of audit is that they are cost effective, and also they do not indulge in any clash between employee and auditor, because the auditor does his job much later when the financial statements are prepared. But the biggest disadvantage of this kind of audit is the frauds and errors which could have been detected timely or which could have been detected earlier are detected at a later stage. Next comes interim audit. So when the financial statements of any company are audited before the end of financial year, so usually the financial year term is 1st April to 31st March. So anytime before completion of the financial year, if any entity wants to get their financial statements audited, it is known as interim audit. Interim audit is basically conducted for purposes like interim dividend, for any business valuation, to find out any particular fraud, or for any special purpose. The figures during this audit are not finalized because obviously if the year does not end, the client cannot make provisions or certain adjustment as per accounting. So herein just the purpose is being fulfilled and no figures are freezed. Then comes continuous audit. So as the name suggests, continuous audit basically involves that as the accounts are made, even the audit is conducted. So this is the only audit which is conducted 12 months a year. So the biggest disadvantage of this audit is that it is very costly, obviously, because if you are appointing any auditor for 12 months, he would take an hefty fees. But the advantages of this audit is that it acts as a moral check on employees, and it also helps the fraud to be detected at an earlier stage or even prevented. So if the client has a lot of frauds going on or has a lot of errors going on, continuous audit is a must do for him. And last is limited review. So limited review is basically an invention of SEBI. So SEBI said that if the listed companies submit their results once in a year to the stock market, the shares may act very volatile, which might affect stock market. So instead of submitting yearly results, SEBI asked the listed companies to submit their results quarterly. So when the companies are submitting their results quarterly, obviously when they are submitting the results to SEBI, they have to get their financial statements audited. And when the quarterly financial statements of listed companies are audited for the purpose of submitting to SEBI, it is known as limited review. These audited financial statements are to be submitted within 45 days from the end of the quarter, and within 45 days, obviously, an auditor cannot check a lot of things, and hence the name limited review is given because only limited things are checked during this audit. Next comes scope wise. So on the basis of scope of audit, that is what is covered under audit, the types of audit are divided. So here in complete, partial and detailed audit are covered. Complete audit means basically checking and ensuring complete check of financial statements, that every part of financial statements are checked. However, in general practical world, these kind of audit do not exist because these kind of audit would take a lot of time, and no one has so much time. Neither the company has so much time to give to the auditor, and neither the auditor has so much time to give to the company. Next comes partial audit. In case of partial audit, management defines the scope of audit. That is, management restricts the scope of audit and asks the auditor to audit certain items only. So herein the auditor does not have to check a lot of items, but only items that are required by the management. And last comes detailed audit. Detailed audit is also known as audit in depth. It basically backtraces certain transactions and check those transactions in detail. So suppose there's a sales transaction that is passed in. So if the auditor wants to conduct in-depth checking or detailed audit, the auditor would basically backtrace the transaction and check who passed the transaction, when was the transaction passed, who reviewed the transaction, whether the transaction is edited, what are the vouchers to this transaction, when were the goods left during this transaction, what are the internal controls, who take care of the internal controls, what are the software controls, everything. Now, yet again, obviously, it is not possible for the auditor to do that for every transaction. If the auditor does that for every transaction, one financial year audit would take around 5 to 6 years. So in this case, first auditor analyzes internal controls, sees whether internal controls are not strong, picks out those area, applies materiality, and implements these procedure on material items only. These kind of audit are basically done when the business is either getting purchased by someone, or in case there is a big fraud going on in the company. And the last is subject matter wise. That is, on the basis of subject matter, the audit is divided. So there are multiple kinds of audit that occur under subject matter wise. Some of you must have heard about these kinds of audit, and some would be absolutely new. So first is the cost audit, upon which we have had the whole chapter. So cost audit basically means checking the cost records of the company. It helps the company in detecting wastages, detecting errors, and minimizing wastages and ensuring optimal optimum utilization of resources. The next kind of audit is management audit. So management is the backbone of any organization. It is the management who supervises all the activity. So the intent of management and the objective of management should be very clear, because if the intent and objective of management is not clear, it is an likely chance that the auditor, it is a likely chance that the organization won't be able to achieve its objective. So if my management is fraudulent, or if my management has thought that they won't let the company earn, they won't supervise the functions well, they won't direct the functions well, they won't guide the employees well, so how do you think that the organization will achieve its objective? So management audit is very necessary. Management audit basically checks whether the management is taking all its functions seriously, implementing all the functions well. It checks whether the planning, organizing, directing, staffing, coordinating, other functions, if any, are done by the management well, and does the management face any problem in implementing those functions, and what are the extra steps that are taken by management to ensure that the entity achieves its objective. Next is operational audit. So operational audit basically means to check the day-to-day operations. So as much as it is important to check the management's function, it is also important to check the operations. So it could be that the management is supervising and management is guiding the employees well, but the employees do not want to achieve the objective. So as much as management audit is important, even day-to-day operation audit is important. In this case, basically it is checked whether the entity is achieving its objective. If not, what are the reasons and what are the steps taken by management. Operational audit was earlier established as a part of internal audit, but now, since the internal audit has been seen to focus more on the financial statements or the accounting area, operational audit has been divided from it, and operational audit has been separated from him and from it, and operational audit is considered to be other term. Also, operational audit is generally conducted by businesses where the owner and the business are very far. So if I'm sitting in India and I have a business in Dubai, operational audit would help me a lot, because it will help me know about the day-to-day operations of the company. Next comes tax audit. So tax audit is basically defined under section 44AB of the Income Tax Act. So Income Tax Act states that every business which has a turnover of more than 1 crore and every professional who has a gross receipts of more than 50 lakhs need to get their books audited. Now, what is the need to get an tax audit done when there is already a statutory audit being conducted? So in case of tax audit, you come across taxable profit, whereas in case of statutory audit, you come across accounting profits. Now, taxable profit is very much different from the accounting profit, because there are a lot of exemptions, additions, deletions, allowances, disallowances that differ between taxing and accounting. You must have known that there are certain exemptions that are available in tax but that are not available in accounts, or there are certain expenses that are allowed in accounts but not allowed in taxation. So there needs to be a separate evaluation wherein the company can calculate its tax profit well. This will also help the company in ensuring that they are not evading tax, and even the income tax department to ensure that the company is not indulging in any black money practices or in tax evasion. So tax audit is basically done by the companies who fall into the criteria of section 44AB, and it is done to ensure that taxable profit is rightly calculated. Next comes social audit. So social audit is a new age kind of audit. Social audit basically involves checking that whether the company is obliging with its social obligation and whether it is contributing to the society. So these kinds of audit are generally taken up by the startups, because these kinds of audit can be advertised by them, and youngsters nowadays believe in these kinds of audits. So they are very much like the companies which indulge into social practices. So social audit is basically done to increase upon the business and increase upon the fame of the business. Next comes propriety audit. So propriety audit basically checks whether value for money is achieved or not. That is, whatever expenditure is being done by the company is actually achieving the objectives or not. So propriety audit is basically done in government entities, because in other entities, obviously, they are generally owner-owned companies, and the owners would obviously try to save money and invest in areas only where objectives is received. But in case of government entities, entities, the government has public money, and a lot of time they tend to waste that. So in that case, propriety audit is a compulsory for government entities. Next is forensic audit. So forensic audit is nothing short of a fraud investigation. In case of forensic audit, a particular fraud or error is taken up, and everything related to that fraud or error is investigated. Its scope is not like statutory audit wherein the whole financial statements need to be checked. Its scope is limited to that particular fraud or error. Then comes performance audit. So performance audit basically means that to check whether the objectives of the business are achieved or not. So if my objective is to plant 100 trees this year, so propriety audit, performance audit would basically check, am I planting 100 trees those year or not. So yet again, this is done in government entities because other entities would be most happy if they achieve their objectives. But in case of government entities, it is usually found that the schemes implemented by the governments become unachievable and they do not work towards the scheme. So performance audit is yet again an audit mandatory for government entities. Then comes secretarial audit, on which yet again we have had the whole chapter. So secretarial audit basically checks that whether the laws and regulations that are applicable on the business are being complied with or not. Next comes HR audit. So what is an HR audit? So you must have heard about the HR department of the company, human resource department. So human resource or HR department is the one who employs people for the organization. And you must have also heard that if a person is not fit into the organization, the objectives of the organization are less likely to be achieved. So it is the duty of the HR to ensure that a competent employee is placed at the correct position and the right person is into the right job. So HR audit is basically done to check that what are the checks, what are the competencies, what are the other factors that are checked by the HR before employing any person. It fills the gap of how HR currently is or how HR department currently is and where the HR department can land up to or how should be the HR department. Next is information system audit. So information system audit is one of the most important audit in today's world. With increasing use of IT, increasing use of computers, with increasing use of other electronic items, IT audit is a must, be it due to the heavy cost of the computers or the fear of loss of data or the security reasons or over dependence on computers. There are multiple reasons for getting an IT audit done. IT audit basically ensures that whether the data on the computer is safe or not, whether all the security checks have been taken by the company or not, and what are the things that need to be taken care by the company while using the IT system. And last comes environmental audit. So environmental audit is yet again a new kind of audit. Environmental audit basically checks whether the company is bearing the environmental cost or not. So whatever environmental hazardous waste are produced by the company into the environment are to be accounted for as environmental cost in the company's books of accounts. The environmental audit checks whether it is being done or not, and if it is not being done, what are the steps taken by the company to ensure and protect the environment. Environmental cost, decision, estimate, and value in the books of accounts are checked under environmental audit. So we have completed the major part of this chapter. Now there are differences of audit with others. So audit is usually used in combination with accounts, and audit is a lot of times misinterpreted as investigation. So the difference between these two popular terms are given. First is audit versus accounting. So the first step in any financial statements has to be accounting. So accounting involves making the financial statements, whereas audit involves checking those financial statements. Accounting is done by the company, auditing is done by the auditor. Accounting is done for the management, auditing is done for the shareholders. Audit involves giving in or expressing an opinion, whereas account blindly ensures making the financial statements. Auditing is as per standards on auditing, whereas accounting is as per accounting standards. Apart from that, accounting involves maintaining records, auditing involves reviewing those records. accounting communicates business and financial events through financial statements, whereas auditing reviews financial records to form an opinion on financial statements. Whatever 7-8 points that are given here should be memorized by you. Won't take a lot of time if you remember logically, or if you try to strike a balance of logic between this. So these 7 points are a must remember. You can expect different questions in the examination. Next is audit versus investigation. So the scope of investigation is very narrow and restricted to just 1 or 2 items from the financial statement, whereas the scope of audit is very wide, that ensures checking the whole of the financial statement. Audit involves checking of books of accounts, whereas investigation involves checking of accounts for a particular special purpose. Investigations timeline might be more than a year, but for audit the timeline is restricted to 3 to 4 months. Once the financial statements are made, then the audit starts, and once the audit is done and the mistakes are corrected, the financial statements are approved and the audit report is to be submitted. In audit, the auditor gets a persuasive evidence, but for investigation, the person or the investigator needs a conclusive evidence to draw an conclusion. In case of audit, the auditor is skeptical, but in case of investigation, you should be Sherlock Holmes and you should be suspicious. Audit follows generally accepted accounting policies, and investigation is an extended audit procedure. Now, audit follows generally accepted accounting policies does not mean that the auditor needs to follow that, but the auditor checks financial statements as per the generally accepted accounting policies. And the last topic for this chapter is standards on auditing. So just like in case of accounts, you have accounting standards or Ind AS to follow. For auditing, you have standards on auditing to follow. Currently in India, there are 5 kinds of standards that are there. First is S2C, that is a standard on quality control. That is how should the quality be maintained by the auditor in audit. Next is SRE, that is standards on review engagement. So review is even a limited assurance engagement. So in audit, at least the auditor is giving a reasonable assurance. In review, the auditor does have to give a limited assurance. So there's a standard on that. Then it's standard on auditing, which we follow during the audit procedures. Then it is a standard on assurance engagement, and lastly there's a standard on related services. So if the auditor is giving any compilation services or any other book of accounts related services, so these are known as related services, and there's a standard on that needs to be followed by the auditor. Now, who makes the standard in India? So AASB, Auditing and Assurance Standard Boards, makes the standard in India. Apart from making the standards, Auditing and Assurance Board also makes general clarification, guidance notes, and statements to auditing. So what are the objectives of AASB? So basic objectives of AASB are to review these things time to time, to update these things, to issue any practical manuals if required, and to time to time develop new guidance note and general clarification. Now, how does essays help an auditor? So standards basically help the auditor in acting as a ready reference. It provides to the auditor that what are the steps to be followed, how are the steps to be followed, what are the steps to be undertaken. Next, it reduces audit risk because it tells you the audit procedure in the prior basis. It helps you reduce audit risk. Third, it helps the auditor in defending himself. So if tomorrow any authority comes to the auditor and says that the auditor has not worked properly, he can show that all his procedures are guided by standards on auditing. And lastly, standards help in improving quality of audit work. So that was it for this chapter. Didn't take much time. Like I feel half an hour, 40 minutes is the maximum that we would have been taking. And I'll be giving you a 1 minute break, post which we'll be starting with day before examination question. Then comes subchapter 2. So subchapter 2 is yet again a very teeny mini cute chapter. There are 4 broad topics to be done in that, which would again require us maximum half an hour. So giving you a 1 minute break, post which we'll do day before questions, and then we'll move on to subchapter 2. So hello everyone, I hope you people are back from a wonderful break. Before the break, we completed the revision of basics for auditing subchapter 1, which was yet again a short revision. Took us like 35-40 minutes. Now we'll be quickly doing the Q&A related to this chapter. Generally you will find in this chapter the Q&A are a bit out of syllabus, like they do relate to the topics in the syllabus, but their context or the answers are a bit out of the syllabus. So we'll be covering all those questions so that you don't face any difficulty in your examination. And let's quickly begin with the Q&A. So the first question is, the concept of true and fair is a fundamental concept in auditing. Comment. Obviously, concept of true and fair is a fundamental concept in auditing. Firstly, you'll have to state that what is the meaning of true and fair. So true and fair basically means that whatever transactions have occurred during the year are reflected in the financial statements. Then you will have to state that it is the primary responsibility or the primary objective of auditing. How does the auditor ensure that the financial statements are reflecting a true and fair view? By checking whether the financial statements are made as per the accounting principles or the accounting standards are followed. If Ind AS is applicable, then Ind AS is followed and all the accounting estimates are adhered to. Now herein they have given situations by which the auditor gets to know that the financial statements are giving a true and fair view or not. So these situations are not there in your ICMI module, but I'll still request you to learn these situations so that if this kind of a question comes in your exam, you are able to attempt this question. So what are the situations by which the auditor can examine whether the financial statements are giving a true and fair view or not? So the assets should neither be undervalued or overvalued. Same with liability. No material asset should be omitted. No material liability should be omitted. Charge, if any, on assets should be disclosed. So if the assets are given on any mortgage, then it should be disclosed. Whatever disclosure requirements are provided as per Schedule 3 should be there, and all the unusual and non-recurring items should be disclosed. So if these 6-7 situations are adhered to, then auditor can say that the financial statements are giving true and fair view. Next comes a 2-star question. Distinguish between statutory and non-statutory audit. So this is an easy question. Statutory audit is compulsory as per the law, whereas non-statutory audit is done voluntary. The scope, qualification, powers, rights, duties, everything is defined by law and regulation as for statutory audit, and for non-statutory audit it is decided by the appointing authority. The auditor has to be independent in both the situations, but it is mandatory in case of statutory audit, because yet again the audit report for statutory audit is submitted to every user of financial statement, whereas in case of non-statutory audit it is just confined to the members or the appointing authority. Auditor's liability in case of statutory audit is obviously more, because he has a huge responsibility. He has to check the financial statements, and that is to be done as per the statutory obligation. Whereas in case of non-statutory audit, since there is no statutory obligation and it is to be done voluntary, the liability of the auditor is less. Publication of audit reports. In case of statutory audit, the audit report is to be given to users of financial statement and given for public view, whereas in case of non-statutory audit, the audit report is given only to the appointing authority or the members of the organization. Next comes the third question, a 4-star question. Write a short note on statutory audit versus internal audit. Now, you have studied both these topics standalone, but you don't know the differences between both of these. So, we'll be picking up the common points by which you can frame the differences between both of these. So, first of all, you'll write the definition, that what is a statutory audit and what is the internal audit. So, statutory audit basically means any audit that is required by law or regulation, and internal audit basically involves checking the internal controls of the company. Now, you must understand that internal audit is done to ensure that the business runs smoothly, whereas statutory audit is just a reliability measure for the shareholders. So in case of statutory audit, the shareholders are involved both in appointing and removing the auditor, whereas since internal audit is for the business, the board takes the pivotal role, and the appointment and removal both of the auditor is done by the board. Now, in case of statutory audit, the audit report is submitted to public at large, whereas in case of internal audit, the board takes the charge and the report is just submitted to the board, and the board has explained all the weaknesses and inefficiencies. The scope of statutory audit is defined by the law or Companies Act, whereas in case of internal audit, it is the management who defines the scope. And lastly, here he is appointed by board, whereas he is appointed by shareholder. So you have to basically pick out the common points that are between both of these, that is appointment, removal, submission of a report, what is the scope of work. So yes, you have studied both of these topics standalone, and even if you go to your module, you won't find any of such differences there. But here you'll have to use your common sense and frame the differences and think of the common points. Next, state the basic features and necessity of continuous audit. So what is continuous audit? So when the audit is conducted all year round, along with making the accounts, it is known as continuous audit. Now, what are the features of the continuous audit? So it is the only audit that involves 100% checking of transaction, because obviously for 12 months of financial statement, auditor is also getting 12 months. So it involves 100% transactions. Now, to check so much transactions, it is not to be done only at human level. Even technology plays an huge role. Apart from that, it has become an integral part of modern auditing at many levels. It involves examination and verification of firms' financial transaction and their supporting documents continuously throughout the year. It helps to detect the errors and also find the errors in a timely manner, and to ensure that the errors are detected on a timely basis so that the same cannot be repeated. Where is the necessity of continuous audit? So where the internal controls are inadequate, or where there are a large number of transactions where the financial statements cannot be audited in just 3 to 4 months. So in that cases, continuous audit is required. Next, state the scope and advantages of operational audit. So what is meant by operational audit? So operational audit basically means to check day-to-day operations of a company. Operational audit involves examination of all operations and activities of entity under audit. Now, what is the scope of operational audit? So everything that the company does, every operation that the company does comes under the scope of operational audit. As I said, first it was considered a part of internal audit only, but now since it was found that internal audit is just restricted to financial statements, operational audit was separated from it. So the scope of operational audit involves checking the operations of the entire entity and checking the operations of each department of the entity. What are the advantages of operational audit? So operational audit is one of the management tools to get first hand information. So basically, as I said, where the management and the company are really far and the management is not able to operate the company every day or supervise the company every day, operational audit comes handy, and operational audit helps the management know about how the operations are functioning in the entity. Next, management information system has various tools like routine performance report from departmental head, internal audit report, surprise check, and etc, etc, etc. Operational audit helps in that too. So if there is a check in the company wherein all the departmental heads have to report to the management every month, if there's an operational audit going on, the operational auditor can do so and analyze whether the departments are working well or not. And lastly, it can also be used in large or geographically vast entities. So where it is not possible to get the whole financial statements audit conducted at once, operational audit comes handy there also. So operational audit can help in checking the operations of each department. Operational audit, unlike statutory audit, is not just done for 3 to 4 months. It might take up 1 to 2 years. So herein operation of every department is taken care of, and operation of every department is tried to solved or is tried to make better so that the objectives of the entity are achieved. So in case a company has a lot of departments like HUL or maybe any FMCG company, then operational audit can be very advantageous. Next, what is tax audit? 3-star question. Now, what is tax audit? So, tax audit is defined under Section 44AB of the Income Tax Act. Tax audit basically involves calculation of taxable profit. What is the need to get tax audit done? Because the taxable profit and the accounting profit differ from each other due to certain allowances and disallowances as per the Income Tax Act. Next is the system of propriety audit applied in respect of all public limited companies. So what did I say? That propriety audit basically checks whether the value for money is achieved or not, and it is done primarily in government entities and not all public entities. So in case of government entities, usually where the public money is at stake, it is very important to know whether the public's money or the taxes paid by the public are being used efficiently or not, are being used to achieve the objectives, are being used for the welfare of people or not. So propriety audit is not applicable to every public entity but just government entities. Propriety audit is an essential element of government audit because public money and public interest are involved. Otherwise, in case of non-government companies, the auditor has to comment upon propriety aspects in transactions of company, for example, under CARO 2020. Otherwise, non-government company auditors do not conduct propriety audit, unlike in case of government. So it is just the government entities that need to get these audit conducted. Next, what do you understand by information security or information system audit? 4-star questions. First, we'll have to say that IT audit basically involves checking the information technology and the softwares and the hardwares that are present at the entity. It may arise due to various reasons, the reasons of which are giving that consequence of losing the data source, or possibility of misallocating resources, possibility of computer abuse, high value of computer hardware, high value of computer error, and the need to maintain privacy. So as I said in the video, that increasing dependence on computer, security issues, or the possibility of error or the high costs of computer errors can be the contributors towards IT audit. So you'll have to write approximately at least 5 reasons that why is IT audit required in today's era, and what was the cause that gave rise to IT audit. Question number 9. So question number 9 is bring out in a tabular form the relationship between auditing and accounting. As I said during the revision, the differences can come in the examination. You can already say it's a 4-star question. That is, it has already appeared 4 times in the past papers, MTPs or PTPs. So it is a probable question. So whatever differences you come across in auditing, be it audit and accounting, audit and investigation, or statutory non-statutory audit, or internal audit, statutory audit, all of this are a must remember, and you should take care that you are remembering all of these differences and you are stressing upon these differences. Now, what is the difference between accounting and auditing? So accounting is usually done at the start and then the auditing is done. Accounting involves submission of the reports to management, whereas auditing involves submission of the reports to shareholders. Auditor has a liability, and in case of audit, the auditor is also liable to third parties, but in case of accounts, there is no such liability. Auditing is done as per standards on auditing, whereas accounting is done as per AS or Ind AS. Audit could be exempt for some entities, but there is no such case for accounts, because account is to be made for by every business, and it is extremely crucial also for every business, because after the end of the day, they need to know that how much they are earning through the business. Accounting involves recording of transaction at the time of occurrence. Auditing involves checking of transactions after the transactions are posted. It measures the business events in monetary terms and communicates the financial results through financial statements, whereas in case of auditing, the auditor reviews the financial records. Auditor is expected to express an opinion on financial statement, whereas there is no such kind of opinion involved in accounting. And lastly, the accountant's primary responsibility is to maintain the financial record in such a manner that FS can be prepared from these records, whereas in auditing, the primary responsibility of the auditor is to review the financial statements and give opinion on them. Minimum to minimum, at least I'll say that try to remember at least 6 points. If more, then better, but 6 points are the bare minimum that you should remember. Next, state the objectives and functions of AASB. So as I said, the AASB is basically involved into reviewing, updating, and checking the need for new standards, guidance note, general clarification, and statements to be issued by it, if any. Apart from that, AASB is also involved in issuing general clarification. AASB is also involved in issuing technical guides, practical manuals were needed. And the last question for this chapter, discuss the basic principles of governing an audit as per essay 200. So now a lot of you might be confused after reading this question, but let me tell you the answer of it. This we have already covered in the class. It's just that many of the students won't understand the question. So herein they are asking what are the basic necessities that the auditor must have, or the basic features that the auditor must have to remain competent. So if you remember Dwight caps, so herein the full form of Dwight caps and an explanation of Dwight caps is to be given. So this question I have incorporated in day before examination because a lot of students might be confused after reading the question. Even after they know the answer, they won't relate that this question relates to this answer. So herein the basic principles governing an audit as per essay 200 basically means what are the necessary features, or what are the essential features of an auditor for audit. So Dwight caps will be the answer. From D, the documentation should be maintained. From W, if any work is performed by others, the auditor should supervise it. From I, integrity, objectivity, and independence is a must. From C, confidentiality should be maintained. Audit evidence is very, very important. Then conclusion and reporting is a must, because ultimately it is the audit report that reflects the work of an auditor. Then accounting process is the one to be checked. Planning is the seed for any good performance. So planning is to be done very nicely. And lastly, the auditor must have skills and competence. So this question is not very important, but this is one of a kind question wherein the questions and answers are very unrelated, or a lot of students might not understand the answer to this question, and hence I have taken this question under day before examination. So that was it for day before exam questions for subchapter 1. Again, giving you a 1-minute break, post which we'll start subchapter 2. As said, the subchapter 2 won't take much of a time. Like the notes of this chapter are also limited to 7 to 8 pages. Yeah, 7 to 8 pages, so it won't take us much time. We'll complete this chapter and then get forward with the day before examination questions of this chapter. Now this question might be very short, but you can expect a lot of questions from this chapter. So this question, or this chapter, although short, requires attention of you people, because this is like a bonus chapter for you, wherein you'll have to study less, but you can expect a lot of questions both in MCQ and descriptive. So giving you a 1-minute break, post which we'll start this chapter. Thank you. Hello everyone. So I hope you people are back from a wonderful break. Prior to the break, we completed the Q&A and revisions of basics of auditing subchapter 1, and now we are going to begin with basics of auditing subchapter 2. As said prior in this video, basics of subchapter 2 is a really small chapter but a really scoring chapter. So this is a kind of bonus chapter for you, wherein you don't have to study much, but you can secure a lot of marks from this. So it would take us like 30 minutes from now to complete this chapter, and I want all your attention here. So in the first chapter of basics of auditing, we learned what is meant by audit, what are the objectives of audit, what are the limitations, what are the advantages, what are the types of audit, what are the standards, everything that is related basically to the first level of audit. But how does an auditor actually conduct the audit? Does he simply think that next day he has to go to the client and start with the audit, and he starts with the audit? No. There are a series of procedures that needs to be followed for the audit to be conducted efficiently and effectively. So the first step in any audit is giving an audit engagement letter. So audit engagement letter is nothing but a sort of contract wherein all the terms and conditions of audit are written. So if you enter into any service, be it if you are a service provider or a service recipient, a contract is always beneficial, be it oral or written. Example, if you want to get your hall or any room of the house painted, you get a painter, and before starting on the work, you kind of have an oral contract with him wherein you explain the kind of paints you want to get done, the walls on which you want to get the paintings done, and what kind of a work you expect from him, and what would be the payment that would be required by him. Now, why this sort of conversation before starting on the work? So, this conversation or this oral contract helps the painter avoid any confusion in the future, and even you avoid the confusion in the future, so that you both are clear about what is expected from the painting and what is to be done under the painting. Also, it serves as an evidential proof for the painter. So tomorrow, if suppose a third person comes to your house and says the painter that he has not painted this wall, so he can use the oral contract or the conversation with you as an evidence that I had a talk with him or her and I was given the job to paint only these. So basically, a oral or a written contract helps you avoid any sort of confusion in the future, and it also serves as an evidential proof of document. So similarly, audit is nothing but a kind of service that is provided by the auditor to the client. So a contract would help them avoid confusion in the future, and it would also serve as an evidential proof for the auditor. So tomorrow, if any regulatory authority or now for us, SEBI, anyone comes up and says that the auditor has not done his job, or the auditor should have done this also, he can clearly show this engagement letter wherein the terms are written, and he can show that this were the terms that were to be written, and this was only my scope relating to this audit, so I was not expected to do any other thing. Now, who sends the engagement letter? So it is the auditor who writes all the terms and conditions and sends the engagement letter to management. Once the management is satisfied with all the conditions of engagement letter, they sign the letter and give it back to the auditor. Now, a very obvious thing, if the management is not signing the engagement letter or is not accepting the terms and condition of engagement letter, do you think the auditor should continue with the audit? Absolutely not. So tomorrow, if someone questions the auditor regarding audit, he would have no evidential proof of documents. So if there is non-acceptance by management in regard to engagement letter, the auditor should not continue with audit. The auditor should continue with the audit only once the engagement letter is signed by the management and is provided to the auditor. So, what is the advantage of an engagement letter? It can help avoid misunderstanding or ambiguity in the future, and it also serves as an evidential proof of document for the auditor. Now, what are the terms and conditions that are evidential proof of document for the auditor? Now, what are the terms and conditions that are written in this engagement letter? That what are the contents of this engagement letter? So first of all, the objective and scope of engagement is given. That is what is the objective of auditor, and what is the scope of auditor. That is what is covered by the auditor during this audit and what is expected from this audit. Next is management responsibility. So it is very, very important that the management responsibility is given in the engagement letter. Otherwise, the management simply would decline of his responsibility. So management responsibility is a must. Next, existence of inherent limitations. So tomorrow, if suddenly the management comes up and says the auditor to give in guarantee and says that reasonable assurance is not accepted, the auditor should always prior inform the management that there are certain inherent limitations because of which he is unable to give guarantee. So existence of inherent limitation should be informed to the management so that the management does not come up with such weird demands. Next, need for use of internal auditor. So obviously, ultimately, statutory auditor is given only 3 to 4 months, and he is a human, not a machine. So he can't check all the internal controls of the company, for which he will be requiring the work of internal auditor. So even that should be stated, that what are the areas wherein the work of internal auditor would be required. Management confirmation letter. So if you remember company audit subchapter 3, there were certain areas when I said that you should take a confirmation from the management that the schedule is exhaustive. So it should be prior stated that these are the areas wherein the management confirmation letter will be required, so that even the management is prepared, and when you ultimately ask for that letter, management is not surprised or shocked. Restrictions and limitations of auditors' liability, highly important, because a lot of times management or even the users of financial statement consider the auditor to be a superman. So he should state that these are the restrictions and the limitations to my liability, and I cannot check the whole financial statements, or I cannot audit the whole entity. I cannot check each and every aspect of the entity. Next, what is the basis for computation of audit fees? That is, how is the audit fees calculated? What is the billing arrangement? That is, how is the audit fees paid to the auditor? Form of report and other communications of engagement, that is, how would the audit report be? So the audit report would be as per the SA 700, and it should be stated that the audit report is legal and audit report is valid in the court of law, that is validity of report. Because ultimately, when the auditor is signing the audit report, he or she must state that the audit report is legal and the audit report can be challenged in the court of law, so that the client gets to know that everything relating to audit has been followed by the auditor. And lastly, limits on submission of report to other authorities. So yes, obviously audit report is a public document, but there are certain instances where the auditor restricts this submission or this providing of audit report to certain authorities. So it should not be such that if the auditor has prohibited the company from submitting report to SEBI, the company should defy this and straight away submit the report to SEBI. Or for suppose tomorrow RBI comes for any inquiry and the auditor has prohibited submission of audit report to RBI, the company would defy this and submit this report to RBI. So there are certain reasons where because of which the auditors restrict submission of these report to other authorities. So even that should be stated in the engagement letter, so that it is expected from the client to follow it and the confidentiality of audit report is maintained. So these are the matters that are stated in audit engagement letter. Yet again, if the management does not agree, he or she or they will not sign the audit engagement letter, and if they agree, they'll sign the audit engagement letter, and once signed, it can be provided back to the auditor. Apart from this, if anything is explicitly mentioned in law or regulation, that is, for suppose that assets will be valued at cost. Now it is explicitly stated in the law or regulation, so there is not an extra addition or extra requirement for this clause in the engagement letter. So whatever is stated by law or regulation and is clear is not required to be restated in the engagement letter. It is said to be assumed by both the client and the auditor. Now, once the audit engagement letter is made, the next step is audit program. So obviously, if the auditor wants to complete the audit of financial statements of 12 months in this 3 months, proper planning is very, very much required. For suppose if I want to cover like 8 subjects of CMA in just 1 month, obviously I need to plan it properly. I need to chalk down that what subjects I'll do at the start, what subjects I'll do at the end, how will be my day divided, everything. And we are talking about just an exam here, and whole audit of financial statements is being talked about. So planning is very, very important. So the next step that the auditor undertakes is making a detailed plan, or as said, audit program. So audit program is a detailed document containing what is the work to be performed, when is the work to be performed, by whom is the work to be performed, that is everything relating to audit procedures, so that everyone has a clarity of what is to be performed, and everyone also has the clarity when is the work to be performed. Also, everyone is aware of their job, so that it does not lead to misconfusion, or it does not lead to time wastage assuming that the other person would do their job. So this helps in proper planning and efficient completion of audit. Now, audit programs are generally of 2 types. First is general audit program, and next is specific audit program. So general audit program is the one which is made for every client. So if the auditor has 20 clients, so there could be certain audit procedures that will be applicable to each client. So that are the procedures stated in general audit program. Whereas if there are certain procedures that are just specific to that client, it is given under specific audit program. Example, for sales, in any entity, I'll have to take the sales invoice. So that is to be stated under general audit program. But for sales wherein there is GST available, or wherein there is a GST competition, I'll have to take and different GST calculation also. Now that is not applicable to every client. Only those clients to whom GST is applicable, this kind of audit procedure will be applicable. So that is to be stated under specific audit program. So any procedure that is specific to a particular client is to be stated under specific audit program, whereas any audit procedure that is to be applied to every client is stated in the general audit program. Now, what are the advantages of audit program? So, first of all, it serves as a ready checklist for the work to be performed. Next, it helps in accountability of work, because since the name of the person is mentioned, so the person feels accountable, and the person knows that at the end of the day he or she is to be blamed for this work. Third, it helps the manager in supervising the work and knowing the extent of work that has already been done and that are still pending. Further, for upcoming years, it serves as a ready checklist, because all the audit procedures are stated in the audit program, and for the upcoming year, only the changes that are required are to be made. Apart from that, there is no extra effort that is to be given. Further, uniformity of work is attained. Next, it can be used as an evidence by the auditor. So, for suppose any authority comes up and says that the auditor has not executed his work properly, so he can show that he has followed all the procedures in the audit program, and all the procedures in audit program are stated as per the standards on auditing. It is also useful in selection of team members. So, based on the performance of the team on this audit as per the audit program, the auditor partner, or the audit partner, or the audit engagement partner, or the head of the audit team can also select the team members for the upcoming audit. Now, there are certain disadvantages of this audit program which are basically vague. So, obviously, planning would help you any day. Planning would be disadvantages for you, but here they have stated four disadvantages, so we'll have to read that. So, what are the disadvantages of the audit program? First of all, it makes the auditor very mechanical and they can't think out of the box. Next, it is not applicable for every entity. So, rigid programs can't be applicable for seasonal business. For seasonal business, the audit has to be done as per the cyclic business nature of the entity. So for seasonal business or for specific other kinds of business, or a rigid audit program cannot be laid down. Third, for smaller entities, an audit program cannot be made applicable, because they might run out of the cost, and also there are certain other procedures that are to be suddenly added or deleted in case of small entities. So audit program is not applicable for small entities. And lastly, the persons who are already negligent of their work, audit programs add upon to that, because these persons restrict themselves only to the audit program, and do not apply other audit procedures even where required. So audit program also helps in adding to negligency of work. Now, once the audit program is made, what is the next step to apply audit procedures? Now, what are the audit procedures to be applied? We have already learned under company audit subchapter 3. But what is to be obtained from these audit procedures? So audit evidence is to be obtained from this audit procedures. And these are the audit evidences on the basis of which auditor arrives at the conclusion. For suppose I went on to check the sales of the entity. For checking the sales of the entity, I got all the invoices of all the transactions, and I checked that whether the transaction and the invoice is tallying or not. Now, this checking and tallying of transaction and invoice is an audit procedure. But the result of those audit procedure is audit evidence. That is, if I observe that out of 100 transactions that I tallied, 95 transactions tallied, but only 5 transactions were the ones which didn't tally, and the amount of those differences were very negligent, like it was around 50 or 100. So what will be my observation for sales? That I'll say that the sales of the company is rightly accounted for and there are not a lot of mistakes in sales. Now, this opinion is grabbed only after I get an audit evidence. So first of all, you make an audit program, then you perform the audit procedure, that is tallying of invoices and ledger. Then you get the audit evidence that whether the invoices and ledger are tallying or not, and on the basis of audit evidence obtained, you form an opinion that whether the sales of the company is rightly accounted for or not. So audit evidence is very, very important, and it is basically the mid part of any audit, which is obtained from audit procedures and results in audit conclusion. So audit evidence may be defined as information used by the auditor in arriving at conclusion on which auditor's opinion is based. Now, how should be an audit evidence, or what kind of an audit evidence should an auditor find? So an auditor should always look out for sufficient and appropriate audit evidence. Now, what is meant by sufficient and appropriate? Sufficient means that the quantum of audit evidence should be correct, and appropriate means that the audit evidence should be reliable and relevant. Now, what does the quantum of audit evidence mean? So, suppose if I had to check 100 transactions and I asked for 100 invoices from the client provided me with just 3 invoices. Now, is it sufficient for me to form an opinion on sales, or is it sufficient for me to apply the audit procedure, or is it sufficient for me to obtain an audit evidence? No. So here the quantum of evidence is not satisfied, and hence this evidence is not a sufficient evidence. Whereas if I had asked for 100 invoices and my client provided me with 90 invoices, or if I had asked for invoices of 10,000 rupees and my client provided me with invoice of around 9,000 rupees, then it is said that the quantum of audit evidence is satisfied and the audit evidence is sufficient. Next comes appropriateness, that is, the evidence should be reliable and relevant. So to form any opinion on financial statement, you should first ensure that the evidence is reliable. If the evidence itself will be unreliable, how will you form a correct opinion on the financial statements? So if I show you the fake documents, or if I show you the fake evidences and ask you to draw an opinion on financial statements, obviously the opinion on financial statements would be incorrect. So it is to be ensured that the evidence with sufficient is also reliable. Now, what do you think the reliability depends on? So it is always that the external evidence is more reliable than the internal evidence. Internal evidence is to be trusted only when the internal controls are satisfied. Documents that are written are more reliable than oral documents, and evidence obtained by the auditor itself are more reliable than the evidence obtained through the entity. What does external evidence mean? So any evidence that is obtained from the external parties to the organization, like the debtors, creditors, vendors, suppliers, is more reliable than the evidence that is generated by the entity, because when the evidence is itself generated by the entity, there could be a possibility that they could manipulate the evidence. So external evidence is considered to be more reliable than internal evidence. Internal evidence obviously means evidence generated within the entity. So you need to consider and search or hunt for more of the external evidence. Internal evidence are to be trusted only when the internal controls of the company are very well and you have a guarantee that the chances of manipulation are very less. Apart from that, obviously documentary evidences are more reliable than oral evidences. Oral evidences can be defied anytime by any person, whereas if you have the thing written, or if you have that thing contained in a document, you can prove that statement. And lastly, any person, be the auditor or any external party, when the evidence is found by them, it is considered to be more reliable than the evidence found by entity. So evidence found by themselves is considered as more reliable than evidence found by any other person. Next comes relevance. So an relevance of an evidence is defined by the audit procedure that is used. So for suppose there is the sales of an entity, that I need to check. Now, I feel that the sales of the entity are overstated. That is, fake invoices are also contained in the sales ledger. To find whether there is an overstatement, or to find whether the fake invoices exist or not, which ledger I'll have to check? Obviously, the sales ledger. But if I think that the sales of the entity are understated, that is, all the sales invoices are not present in the sales ledger, do you think that sales ledger or checking the sales ledger would be a valid audit procedure? No, because already there are missing invoices in that. So sales ledger is not a valid audit procedure, or checking the sales ledger is not a valid procedure. Instead of that, I'll have to check the stock ledger, or the debtors ledger, or the bank statement. So relevancy of an audit evidence depends on the audit procedure that the auditor applies. So in case if the auditor was to observe overstatement or understatement of sales and the auditor applies same procedure, obviously the auditor won't be able to find a relevant audit evidence or an evidence that supports the conclusion. So relevancy depends purely on the audit procedure that the auditor applies, whereas reliability depends on the source of the evidence, that whether the source of the evidence is reliable or not. Now, what are the factors that the auditor will consider while judging the audit evidence, or what are the factors that the auditor will consider while obtaining the audit evidence? First comes nature of the item. So if the item is risky, obviously you will need more audit evidence, whereas if the item is not risky, you will have, or you will believe in even less evidences. Adequacy of internal controls. If the internal controls of the company are strong, you will need less evidences, whereas if the internal controls of the company are weak, you will need more evidences. Nature and size of the business. The larger the business, the more evidences you will need. The smaller the business, the small evidences you will need. Situations which may exert an unusual influence on the management. So for suppose in the entity, the management's remuneration is calculated as 5% on profit. Now obviously when the management's remuneration is dependent on profit, the management will try that they manipulate the profit so that they can have an increase in the remuneration. So profit is an item where the unusual influence of management is exerted. So in that case, obviously we will require more evidence. So whatever are the areas where an influence of management exists, you will try to find more evidences. Next, financial position of the entity. So if the entity is profit making, obviously the entity won't try to be more manipulative. If the entity is earning a break-even profit or a good share of profit, the entity won't try to be much manipulative. Whereas if the entity is incurring a loss, the entity would try every means so that the loss of the company is converted into profit. So in cases of loss or in cases of negative financial position of the entity, you need to find more evidences because the chances of manipulation are more. Then materiality of the item, that is the more important the item, the more the evidences you will need. The less material or less important the item, the less evidences you will need. Experience gained during previous audits. So for suppose if I was auditing the client HUL and before that I have conducted the audit of ITC. Now from the ITC FMCG business, I had certain experience that purchase is a gray area or expenses are a gray area. So in case of HUL, obviously I'll search for that areas better and I'll try to grab more evidences. So based on the experience of previous audit also, the number of evidences are affected. Results of the audit procedure. So if you had applied 5 audit procedure and up till the results of the audit procedure till now, you have seen that the entity does not have a lot of misstatements or the entity does not indulge in any fraud or error. So you will have a satisfactory approach towards the entity and you will think that there are not a lot of mistakes in the entity, so you will eventually reduce the number of audit evidences required. Whereas if out of 5 audit procedures 4 resulted in fraud or error, or 4 in 4 situations it was found that there is a fraud and error existent, you will try and search for more audit evidences in the upcoming audit procedure. Next type of information available, that is internal or external information available. So in case of internal evidences, you will try and ask for more evidences because internal evidences can be manipulative, whereas in case of external evidence, you won't look out for many evidences. Trend indicated by accounting ratios and analysis. So if the accounting ratio shows that the entity is not much into frauds and errors, you look out for low evidences, whereas if it shows that the entity is more into frauds and errors, you will have to grab more evidences. Now, what are the procedures to obtain audit evidences? So, although we have had a detailed overview of what are the procedures required to obtain audit evidences, broadly there are 2 procedures that the auditor applies. First is the risk assessment procedure, and next is the further audit procedures. So, before applying audit procedures to any entity, the first thing that the auditor needs to assess is the risk. See, when you sit in the exam also, before starting to study, you analyze the risk, that you are weak in this portion, or you're weak in this subject, or you require more effort in that subject, so that you can plan accordingly and you can study accordingly. So similarly for audit, auditor first analyzes the risk so that he can allocate correct audit procedure to correct item. See, if the auditor applies 100 audit procedure to each item, possibility would be either no misstatement is detected, it would result in more time to the auditor, and it wouldn't also result in efficient completion of audit. So the auditor has to have a mix of large and small audit procedures, and this mix of large and small audit procedures is evaluated on the basis of risk. So the first thing that the auditor does is risk assessment procedure and then goes on to the further audit procedure. Now, risk assessment procedures basically involve obtaining an understanding of entity and its environment, obtaining an understanding of internal control, and to identify and assess risk of material misstatements that are present in the entity. Now, once the risk is understood or once the risk is assessed, the next step that the auditor undertakes is further audit procedures, that is applies the audit procedure. So further audit procedures are of two types, TOC and TOD. TOC is test of control and TOD is test of details. So in case of test of controls, the auditor checks the internal control. So whatever internal control he had heard about in case of risk assessment procedure, he checks whether those internal controls are effective or not. So he might have heard that there are 16 controls in sales, and he analyzed that, okay, then there might not be a lot of risk involved in sales, and he can allocate less time to sales. But before trusting upon the words, he first has to analyze that. So then he performs test of control, wherein he checks whether these 16 controls are effective or not. If they turn out to be effective, then the auditor's assumption is correct. But if they don't turn out to be effective, then obviously auditor will have to increase the time to be allocated to sales. The more the controls are effective, the less are the evidence required. It includes an observation of internal control being performed, inspection of evidence that the control procedure was performed on, and inquiry about how and when the control was performed. And next comes TOD or substantive procedures. So substantive procedures are basically testing of every transaction and balance, and these involve audit procedures that we learned under company audit subchapter 3. So it involves testing of every assertion and applying audit procedure to check every transaction and every balance. Now, what are the methods by which the audit evidence can be obtained? So there are primarily 6 methods by which audit evidence can be obtained. First, by inspection. So by examining documents, you can obtain audit evidence. Next, by observation. So by witnessing things, you can obtain audit evidence. Inquiry, that is by questioning or by communicating, you can obtain audit evidence. Confirmation. So for external parties, you can grab a confirmation and check whether their confirmation or whether the amount given by them is tallying with the books of accounts. Computation, that is recalculation. So for example, for depreciation or items that require calculation, you can recompute those items. And lastly, analytical review, that is by calculating ratios or by reasonable test, you can obtain an evidence. What are the types of audit evidence? So there are 2 types of audit evidence, as we studied earlier, internal and external. Internal evidences are those evidences which are collected within the organization, and external evidences are those evidences which are collected from outside sources. Examples of internal evidence are sales invoice, counterfoil of cash memos, goods receipt note, credit notes, and debit notes. Whereas in case of external evidences, example are quotations, confirmation from debtors and creditors. Do you need to learn these examples? Absolutely yes, you need to learn these examples. Internal and external evidence is quite a popular question in case of MCQs, and they would simply give you some examples of evidences and ask you to point out the wrong one or ask you to point out a particular internal or external evidence. So all the examples need to be learned. Now, once the audit evidence is obtained and once the auditor arrives on the conclusion, the next important thing that the auditor needs to do is maintain audit documentation. So tomorrow, if someone comes up and says the auditor that, see, I have seen your audit report and I feel that you have not worked properly, could you show me what were the audit procedures did you apply? So how will the auditor show that? Obviously, if he'll have the documentation, only then he can show or only then he can prove the person that he had applied the audit procedures, obtained audit evidences, and then arrived on the conclusion. So audit documentation is basically a record of everything that is done by the auditor in audit. And one of the popular misconceptions of audit documentation is that the audit documentation belongs to the client. Never ever. The person who does the work, the person who does the audit procedure, audit documentation will belong to them only. So audit documentation is the property of auditor. So audit documentation is nothing but a combination and compilation of all the audit procedures that are performed, all the audit evidences that are obtained, and all the audit conclusions that are reached. That from the start of the audit to the end of the audit, whatever procedures has been initiated by the auditor, whatever evidences has been obtained by the auditor, whatever conclusions have been reached by the auditor, whatever kind of other documentary things that have been taken by the auditor, everything should be contained in audit documentation. Now, what are the purpose of audit working papers? So, first of all, it proves as an evidence of auditor's basis of conclusion. Next, it also helps the auditor to prove that the audit was in accordance with essays. So, tomorrow, if NAFRA comes up and says that the auditor has not worked properly, then the auditor can show his file and say that all the audit procedures that are initiated by me or that have been done by me are as per the standards, and you can check upon that. It helps the engagement team to plan and perform audits. So for suppose an audit term is of 5 years, as we studied in company audit subchapter 1. So for first 2 years, there was a particular team of the auditor that was going to audit. But for the third year, the auditor had to send a new team to audit. So obviously now the new team cannot simply go to the client and restart with the fresh questions. That would be unprofessional. So what to do? So they grab the knowledge from these audit documentation. So audit documentation also helps the upcoming team to plan and perform audit. Further, it also helps the reviewer or the engagement partner to direct, supervise, and discharge review responsibilities. It helps the engagement team to be accountable for their work. So all the audit documentations are signed by the person who has done the procedure. So that also increases the accountability of work of the person who has done the procedure. It helps in retaining records of matters of continuing significance. So an audit term is of 5 years, and a lot of documents will be received by you in the first year that are relevant for the upcoming 5 years. So instead of asking them again and again from the client in every year, you should preserve them and form them a part of audit documentation so that you do not need to ask for them again and again. So it helps in recording matters of continuing significance. It helps in enabling conduct of quality control review, and it also helps in conduct of external inspection. So if any authority wants to check the books of accounts, or if any authority wants to check the audit documentation of any auditor, the regulatory authority or the external person can do so. Now, how should be an audit working paper? So it is said that an audit working paper should be such that any person who is an auditor, who is an experienced auditor, but does not have any connection with this particular audit, if he sees your audit working paper or if he sees your audit file, he must be able to understand these 3 things. What are the 3 things? First, nature, time, and extent of audit procedures performed. That is who, when, what, and how he or she performed the procedures. Next, what are the audit evidences that you obtained, and do the audit evidences support the conclusion that you have arrived upon? And lastly, what are the matters or what are the significant matters that the auditor came across during the audit, and how did he deal with those matters? So the auditor shall prepare audit working papers that is sufficient to enable an experienced auditor having no previous connection with audit to understand first nature, time, and extent of audit procedures performed. That is, who performed the work, what was the work performed, and the date on which such work was performed. Results of those procedures, that is audit evidences, and whether they support the audit conclusion. And lastly, what are the important matters that are encountered by the auditor during audit, and how did he deal with those matters? Apart from that, there are 3 special points of working papers. So as per SA 230, which is the standard on audit documentation, these 3 things need to be documented for sure. First, if the auditor has had any discussion with management and TCWG, then the auditor should document what was the discussion, when was the discussion held, and with whom was the discussion held, and what were the responses of management. Next, if auditor comes across any information that is inconsistent with his final conclusion, so if he had formed a opinion or formed a conclusion that the financial statements of the entity are clean and the financial statements of the entity show a true and fair view. But if he comes across any fraudulent thing about the entity, or if he comes across like a big fraud or big error of the company, so these kind of information are inconsistent with auditor's opinion. So if he has experienced something like this during his audit, he should document that how did the auditor address the inconsistency, or how did the auditor deal with such inconsistency. And lastly, if the auditor departs from any particular standards on auditing, or auditor does not follow any particular standard on auditing, then the auditor should document that what was the reason for departure, why was the uh, what was the reason for departure, why was the SA not followed, and what are the alternative procedures that are followed by the auditor to achieve same kind of presentation. Next, what are the types of what are the types of working paper files? Very, 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 very important. So the types of working paper files is like a question that comes almost every term, be it through MCQ or be it through descriptive. So types of working files is a very, very, very important topic, but a very, very, very easy topic. So what are the kind of working paper files? So there are two files that the auditor maintains. First is permanent file and next is current file. So permanent file contains all the documents which are valid for the entire audit term of 5 years. So as I said that in the first year, the auditor will get a lot of documents that are valid for the whole audit tenure of 5 years. So if the auditor gets any such document, that is to be stored in permanent audit file. And if the auditor gets any document that is just relevant to that current year, it is to be stored under current audit file. Example, audit program is made for every year. It changes every year. So it is a part of current audit file. Whereas the memorandum of association, article of association, or any contract whose term is 5 years, that won't change every year. So that is a part of permanent working file. Examples of permanent working file or permanent audit file are MOA and OA, memorandum of association, article of association, extracts or copies of legal documents relevant to audit, record of study and evaluation of internal controls, analysis of significant ratios trends, copies of previous year audited financial statement, notes regarding significant accounting policy, and significant audit observations. The examples of current audit file are correspondence relating to acceptance of annual reappointment. So this is an engagement letter basically issued every year. So engagement letter is the one that is issued every year and is not valid for it, the whole audit tenure. So engagement letter forms a part of current audit file. Extracts of meetings of that particular year, copies of management letter, analysis of transactions and balances, communication with auditors, experts, and third parties. That is basically external communication or external confirmation. And lastly, audit conclusions reached. So obviously you won't reach upon an audit conclusion in the first year and make it valid for all the 5 years. You will reach upon different conclusions in different years. So that is a part of current audit file. Do I need to remember the examples? Absolutely yes. In case of MCQs, you will be given these options and you'll be asked to pinpoint either a part of permanent audit file or a part of current audit file. So these examples are a must remember. Now, who is the owner of audit working papers? As I said, the one who makes the audit working papers is the owner of audit working papers. So, auditor is the one who owns the working papers. And we come to the last topic of this chapter, that is audit notebook, a very simple, sweet, and short topic. So when you sit in the class, you sit with a copy so that whatever is being taught in the class, whatever important is being marked in the class, you mark it in your book and also copy it in your notebook. Why so? Because these are the things that you would require in the future also, or during your exam time also. So whatever things are important, we usually note it down. Similarly, whatever important thing that the auditor comes across during audit is noted by him in audit notebook. Apart from that, if there are certain queries that are left unanswered during a particular point of time, obviously the management is not free the whole day roaming around and behind the auditor. So there are a lot of queries that are not answered immediately. So auditor also notes all of this in the audit notebook. So audit notebook is nothing but a compilation of all the important points during audit, all the points that will help him draft the audit report better, and a series of unanswered questions. In the course of conducting audit of an organization, the audit staff may come across various misstatements, frauds, or other issues which need further clarification. That is unanswered questions. The audit staff generally records the same in a separate notebook known as audit notebook. Separate notebooks are prepared for each client. Obviously, you won't have a notebook where you will store all the information or all the important things of all the 8 subjects. You will have different copies for different subjects. Similarly, even the auditor has different notebooks for different clients. Now, what are the contents of audit notebook? So the contents, like the first page has the name of business enterprise, the organization structure, important points of MOA and OA, so that they help the auditor develop the audit procedures better. And also, if the auditor gets stuck at any procedure, he can refer to the MOA and OA. Then communication with previous auditor, if any, management's representation, list of books of accounts, accounting methods, key managerial person errors and fraud discovered, because this will help him draft audit report better. So obviously auditor might come across any errors and frauds at the start of audit, but ultimately he has to make the audit report 3 months post the audit. So if he won't note down all the things, he might forget and won't be able to incorporate all of this in the audit notebook won't be able to incorporate all of this in the audit report. So to avoid that, he notes all of this in the audit notebook. Matters requiring explanation and clarification, and special points that need attention in audit report. So this was the revision of subchapter 2. I hope you like the revision, giving you a 1 minute break, post which we'll be doing the questions of this chapter. Yet again, the questions won't require much time, but the questions are important, and you'll see the number of stars behind every question. So it would be like 4 to 5 stars or 2 to 3 stars. So this chapter is short, but this chapter is important from the exam point of view, and you can expect a lot of questions from this particular chapter. Giving you a 1 minute break, post which we start with the Q&A. So let's start with the Q&A of Basics of Auditing subchapter 2. Yet again, I'll say that you will see the number of stars for each question. So would require hardly 1 hour of your day to revise this chapter. So do not leave it unrevised. And it's a dear request. Do learn this chapter, do revise this chapter. This chapter can offer and fetch you great marks during the examination. So this chapter is a must do before the exams. So the first question is, what is an audit engagement letter? What are the points to be covered in every audit engagement letter? Now, this is a 3-star question. So what is an audit engagement letter? So audit engagement letter is basically a contract between management and auditor, wherein the terms and conditions of audit are stated. It serves as a document to avoid confusion in the future, and also serves as a documentary evidence for the auditor. What are the contents of this engagement letter? So first of all, objective and scope of engagement is given. Management responsibilities provided, existence of inherent limitations stated, need for use of internal auditor is provided, management confirmation letter, areas are stated, restriction and limitations on auditors' liabilities is stated, basis of computation of audit fees, billing arrangements are to be stated, form of report, validity of report, and lastly, limits on submission of report is also stated. Next question, again a 5-star question. What do you mean by audit program? Discuss the various advantages of an audit program. So audit program is basically a detailed plan containing what is the work to be performed, by whom is the work to be performed, and when is the work to be performed. What are the advantages of this audit program? So it serves as a ready checklist for the work to be performed. It helps the team head, or it helps the partner know till what extent the work has been done, and what are the works that are still pending. It serves for easy allocation of work. Further, a uniformity of work can be attained. Also, it helps in planning and performing audit for the following years, because once an audit program is made, all we need to do for the next year is do certain changes in the audit program, and a checklist would be ready for the upcoming year. It serves as an evidential proof by the auditor in case any authority questions his work. Also, it helps in selection of team members and delegation of responsibilities. Next question, that is question 3. Distinguish between permanent and current file. 4-star question. As I said during the revision also, permanent and current audit file is a very important topic. You can get a lot of MCQs also from the topic, and even the descriptive questions or the 7 to 8 mark questions can come from that topic. So what is the difference between permanent and current audit file? So permanent audit file contains those documents that are relevant for the entire audit tenure, whereas current audit file contains only those documents that are relevant for that current year. Examples for permanent audit file, it could be articles of association, memorandum of association, all those contracts that have a tenure of 5 years, records of internal control, analysis of significant ratios and trends, copies of audited financial statement, notes regarding significant accounting policies, and audit observations. So these are generally the documents that do not change year on year and are valid for the next 5 years or at least the audit tenure. For current audit file, the examples could be engagement letter, extracts of minutes of the meeting of that particular year, copy of management letter, analysis of transaction balances, copies of communication, audit program, and conclusions reached, that is audit conclusion for each year. Next, what are the essentials of good working paper? State at least 4 points. Again, a kind of out of syllabus question. So this has a 4-star rating, that is, it has appeared 4 times previously in your examinations, PTPs and MTPs. So yes, this question is important. Now, there is no such topic of good working papers in the module. So you will have to use your brain here and think of the points that could be a characteristic of a good working paper. So the first thing is clarity and understanding. So the working papers should exhibit clarity and should exhibit understanding, so that it is very clear to the user of financial statements, and the working paper should not be such that no other person reading the working papers or no other person reading the documentation should be left in doubt. It should be complete and accurate. It should not be such that if there are certain documents filed upon for purchases, then suddenly there are no documents filed upon for purchases. Then suddenly there are documents for debtors. Such a situation should not be there. All the documents should be complete. Logical arrangement, it should not be such that first I am seeing a file for sales, and suddenly then I see files for maybe liabilities, then I suddenly see a file for advances. It should not be in such an arrangement. It should be either in the format of P&L, so that like for the first item in the file could be revenue from operation, next other income, then comes the expenses. So either it should be in that form or any other logical form, so that the person who is reading the file is able to understand that what is the documentation and is able to relate the documentation. Pertinence. The audit working paper should be limited to the objective. It should not be such that if you have a tea or samosa or any other snacks at the client's place, even that you would stick upon and click a photo or stick upon in the working file. Or if you went on some other warehouse trip of the client, you would click a selfie and paste it in the working file. It should not be such. The working file should be limited to important working papers. The working files, if kept in an e or electronic mode, should be safe and retrievable, should be legible and neat. It should not be such that there are ants running in the working file, or no one is able to understand your handwriting. All the things that are written in the working paper or in the audit documentation should be legible. Initial and date should be mentioned, so that the person reviewing the file knows that who has done the audit procedure or who has performed the audit procedure and when the audit procedure has been performed. And lastly, all the conclusions should be supported by the evidences or by whatever documents are there in the working files. It should not be such that the documents are hinting towards an qualified opinion, but the auditor has given an unqualified opinion. So whatever opinion the auditor is arriving upon should be supported by the audit documents or audit evidences available in the working file. Next question, what do you understand by audit evidence? 5-star question. Now, audit evidence is nothing but a result of audit procedure that helps the auditor in arriving at conclusion, which serves as a ready base for arriving upon opinion. So, while auditing, the auditor comes across various assertions of the management, the auditor has to evaluate these assertions so that he would be able to express his opinion on financial statements. This evaluation can be done in light of some facts and reasons. These facts and reasons are known as audit evidence. Even if you don't want to learn this definition and you don't want to write such things, you can simply write that audit evidence are a result of audit procedures, and this helped the auditor in arriving at conclusion, which basically helps the auditor to draw an opinion upon financial statements. Why does an auditor need evidence? A 3-star question. So what is the reason for the auditor to have an evidence? Simply because he wants to arrive on the conclusion. His objective is to state an opinion on financial statements, and for giving an opinion on financial statements, all he needs is an evidence. The auditor obtains sufficient appropriate audit evidence to enable him to draw reasonable conclusions, therefrom on which opinion on financial statement is based. Audit evidence is the information collected by the auditor to ascertain the accuracy and compliance of company's financial statement. Question number 7. Discuss the various methods of obtaining audit evidence. How will you assess the reliability of the evidence obtained? So what are the methods to obtain audit evidence? First, inspection, that is checking the documents. Next, observation, that is witnessing the procedures. External confirmation, that is obtaining confirmation from the external parties, so that the external and internal figures can be matched and it can be checked that whatever is being accounted for in the financial statements is correct or not and is matching with the external confirmations. Recalculation, so calculation of any particular items, just like depreciation or interest, can be done. Reperformance, that is reperformance of certain procedures if required for checking that particular item, can be done. Analytical procedures, that is ratio analysis, reasonable test, are also great procedures to obtain evidence. And inquiry basically means questioning or communicating with people, and that also serves as an audit evidence. Now, how do you assess the reliability of evidence? So the reliability of an audit evidence is assessed on the basis of source of that evidence. External evidence is more reliable. Internal evidence is only reliable when the internal controls are strong, that is the chances of manipulation are less. Evidence obtained directly by the auditor is more reliable than the evidence obtained by the client. Further, evidence is in documentary form is more reliable than the evidence is in oral form. And lastly, original documents are more reliable than the photocopy ones because the photocopies can easily be manipulated. And we come to the last question for this chapter, which is again a 3-star question. What are the contents of a typical audit notebook? So you'll have to write whatever is contained in an audit notebook, which we studied during the revision. Name of the enterprise, organization structure, the important provisions of memorandum and articles of association, communication with previous auditor, management representation, list of books of accounts, accounting method, internal control system, key management personnel, errors and fraud discovered, matters requiring explanation or clarification, and special points that need attention in audit report. So that marks the end of our Q&A of subchapter 2 of basics in auditing, and now we are just left with the other 2 subchapters and our revision will be completed. If you are liking the video till now, do like, share, comment and subscribe. And there goes a 1-minute break, post which we'll be starting with subchapter 3. Then it's Q&A, and then subchapter 4, then it's Q&A, and then we'll be done with revision. I hope this revision will help you a lot and you will feel very confident in audit. So time for a break, and we will meet post break. Hello everyone, I hope you people are back from a wonderful break. Prior to the break, we completed the revision and the Q&A of Basics of Auditing Subchapter 1 and Subchapter 2. Now we'll be going on with the revision of Subchapter 3 and Subchapter 4, and post this revision, our marathon will be ended. I hope you people are liking the marathon up till now, and I hope after this marathon, you really feel confident for the subject audit and you're able to grab a lot of marks for the subject audit. So for subchapter 1 and subchapter 2 of basics of auditing, we learned about the basic definitions of auditing and the audit procedures, or the first steps that the auditor undertakes in case of an audit. Now, up till now, for all the chapters, we have been learning about the good things of audit, that what are the benefits of audit, what are the advantages of audit, what are the types of audit, what are the procedures that are to be undertaken. But is audit risk-free? In a world where everything carries at least 1% risk, do you think that audit can be risk-free? No. Even audit carries the risk, and that is known as audit risk. Now, what is audit risk? So let's take an example that I went on to audit a client, and I was given the responsibility to check cash and bank transactions. Now there were 100 of transactions, and I didn't have enough time to check all the 100 transactions. So I sorted the transaction value wise, and I selected the top 20 transactions and checked them. Now, on the basis of 20 transactions, I got to know that the internal controls are working fine, the authorization, approval, responsibilities are fine, the accounting is fine, and I came to the conclusion that the cash and bank balances that are appearing in balance sheet are absolutely correct, and I gave an unqualified opinion. Later, I got to know that the 80 transactions that I missed, there were a lot of mistakes in those transactions, and the directors were actually paving their or moving their personal expenses through the company's account through these small amounts. Now, this risk is known as audit risk. The risk of giving wrong opinion on any item of financial statement is known as audit risk. Now, these may arise from various factors like materiality or inherent limitations or certain kind of audit procedures or due to time crunch. Anything could be a reason of audit risk. But do you think auditor alone is responsible for this risk? Now, obviously, auditor did apply an audit procedure that helped him save time, and that helped him reduce the procedure or reduce the transactions to a certain level, and that was a mistake on his part also, that he didn't check the entire transaction. But do you think that auditor alone is responsible for this entire risk? No, there are three components to this risk: inherent risk, control risk, and detection risk. Now, it could be a possibility that if the entity had great controls or correct internal controls, these errors wouldn't have even occurred at the first place. Or if they would have been occurred, so they would have been seen, or they would have been identified by these controls. So even entity's part is there in contributing to the audit risk. Now, the three components, as I said, are inherent control and detection risk. Inherent risk and control risk are risks on the part of entity, and detection risk is the risk on the part of auditor. Inherent risk and control risk, when combined, is also known as risk of material misstatement. Now, what is inherent risk? So, risk that some items of the financial statements carry due to its nature is known as inherent risk. Example: any abnormal calculation or any unusual transaction, any related party transaction, any complex calculation, any you say calculation of a provision, anything that involves a lot of judgment. So all these areas or all these items are non-recurring, yet they are significant. So all these non-recurring yet significant transactions carry a risk due to their item, and this is known as inherent risk. Inherent risk is present already in the financial statements even before implementing the control, and these risks is basically due to the nature of the transaction. Next comes control risk. So control risk basically means risk that the internal controls couldn't prevent, detect, or correct the misstatements. That is, either the internal controls were not present in that particular area, or the internal controls weren't working effectively. That is why the risk happened and the error occurred. And last is detection risk. So detection risk means that the audit procedures applied by the auditor couldn't detect the misstatement. That is, like if the auditor has applied materiality principle, or if the auditor has selected a sample of transactions, so the audit procedure that he applied for that particular item wasn't effective, and it couldn't detect all the misstatements, and this is known as detection risk. So these are the three contributors that, when they are combined, contribute to a risk called audit risk. Now, Do you think that the auditor can reduce this risk to zero? Obviously not, but the auditor should always try to reduce this risk to as minimum as possible. Even there are two exceptions to this risk. Now, what are the exceptions to this risk? So, business risks are not counted as audit risk. So, if the business is suffering from any kind of risk due to due to loss of litigation, or due to any other cycle movement of the business, or due to maybe the product distortion of the business, audit risk can't be counted as that. The auditor cannot quote that because business was suffering from certain kind of risk, I encountered an audit risk and I couldn't give the correct opinion. So business risks are not included in audit risk. And next, the risk that if the financial statements are giving a true and fair view and still the auditor gives a qualified opinion, is also not included in audit risk. In fact, it is considered as a professional negligence by the auditor. So if the financial statements are giving a true and fair view, and even then the auditor gives a qualified opinion or a negative opinion, so that is not counted as audit risk. In fact, that is covered as a professional negligence on the part of an auditor. Now, as I said, that the auditor cannot reduce this risk to zero, but the auditor should always try to reduce this risk to as low as possible. Now, how can auditor do that? So, auditor can do that by assessing the risk and applying the audit procedures in accordance to the risk. So, let's say if there are 8 subjects in your syllabus. Now, you examine that my audit subject is weak or my account subject is weak, and therein I need to study more, or I need to revise more, or I need to practice more. Now, this is the intelligent way of appearing the exams. If you had applied the same study technique, same study methods to each subject, you would have seen that there are still certain subjects in which you feel underconfident and you're not able to address that. So smart studying is very much important. Similarly, smart application of audit procedures is important. Auditor cannot blindly put the same amount of audit procedures in each item. Auditor has to assess the risk and according to that has to apply the audit procedures. So this assessment of risk is known as risk assessment procedures. Now, what are the ways that help in risk assessment procedure, or what are the procedures that are undertaken by the auditor to assess risk? So primarily there are 3 kinds of procedures that the auditor can use to assess risk. First is inquiry, that is communication with people. So a lot of time communication with people gives us a lot of information. The auditor can communicate with maybe TCWG or management or sales personnel or accounts personnel and interact with them and let know of the company's policies, the company's rules, the company's internal controls, whether they're functioning well or not, what are the precautions used by the company, what is the behavior of management in case of corrections, does the management want to make all the corrections and make the financial statements error free, or is the management manipulative, what are the precautions undertaken by the employees when making unusual transactions, what are the documents that are checked, everything. So these kind of conversations help the auditor know the kind of risk that is present in financial statement. Next is analytical procedures. So analytical procedures is basically making a plausible relationship between financial and non-financial information. That is establishing a relationship between 2 kinds of data. For example, if I was checking power and fuel. Now, had I checked power and fuel normally, I could have just checked the transactions and tallied it with the electricity bills. But if I would have applied analytical procedures to that, I would have compared power and fuel expenses in production, and then I could have known the production to power and fuel ratio. And in case of any absurd ratio, or in case of any spike in the ratio, I would have got to know about the manipulative tips and manipulative things that are going on in the entity. So analytical procedures basically help you give an indicator of the risk that is present in that particular item of financial statements. If you don't apply analytical procedures to the financial statement, you will miss out on a large portion of misstatements. So analytical procedures is a must do to analyze and to check where are the risks present in the financial statement. And last comes observation and inspection. So observation and inspection is standalone, not a very great procedure, but when combined with inquiry, it can be a great procedure, because inquiry is nothing but an oral conversation. So when it is supported by documents, when it is supported by written supportings, or when it is supported by written evidences, it can serve as a great combination. So observation and inspection basically means witnessing things and checking of documents. Now, what are the things that can be observed and inspected? So entities, premises, invoices, documents, and reports can be inspected. Now, certain important points that help the auditor in assessing the risk better. So first of all, the experience of previous auditor or the reports of previous auditor or the information used from the previous auditor can be of great help, because the previous auditor have had a tenure in the entity and knows about the in and out of the entity. He can guide you about the risks that are present in the entity. On the basis of the report, you can always check that what are the risks that are already present in the entity, what are the explanations or what are the remarks given by the previous auditor, and whether the management is inclined towards making the changes in the entity or not. So for suppose the previous auditor had given the remark in the audit report that the sales have really weak internal control. So now at the time of audit, you can check whether the management has strengthened the internal controls of sales or let it be the weak only. Because if the management's attitude is reluctant towards making changes or making corrections in the financial statements, it clearly shows that the risk present in the entity is high and the management may indulge in the manipulative practices or is very careless and does not care about the errors that are still roaming on in the financial statement. Next, discussion among the engagement team is very, very necessary. If there is no discussion among the engagement team, the juniors won't be guided from the experiences of the seniors, and the juniors may have a hesitation to bring up their problems. So discussion should be a regular part of the team, and there should be time to time communication wherein the juniors can speak about their problems and the senior can speak about their experiences. The experiences would help the engagement team as a whole, and the problems or the queries of juniors can help the other members of the team be alert regarding that particular things. Then comes the most important part, that is understanding of entity and its premises. So this should be actually the first step. Before undertaking any audit, you should first understand that what are the components of the entity, what are the regulatory factors of the entity, what are the laws applicable to the entity, what are the financial statement compliances of the entity, are there anything that the entity needs to comply with, what are the internal controls present in the entity. So every such thing should be examined before starting on with the audit. Yet again, assessing internal controls, very, very important. And the last point is basically a disclaimer point. So however much risk assessment procedures you do and however much you assess the risk of particular items of financial statement, you should not blindly trust it. So if you assess that the risk of purchases is very high and applied audit procedures according to that, but after applying audit procedures or after applying like 5 to 6 audit procedures, you got to know that the internal controls of the purchases are functioning pretty well, and there might not be a lot of risk present in purchases. So yes, even after risk assessment procedures, the further audit procedures may change, and the auditor should keep his eyes and ears open to all the changes. He should not be rigid that once he has assessed the risk, he will go according to that only. There should be time to time changes and updations in audit plan and according to that audit program. So yes, the last point as the disclaimer point, if you are an auditor who has audited and performed the risk assessment procedure, even after that, you should not blindly trust the risk assessment procedures and go as per the further audit procedures results. And in case any changes are needed, do the needful changes. Now, from the above points, one thing is very clear, that internal control is very, very important in the organization. If the internal controls of an organization are working well, the risk in the organization is automatically reduced to almost negligible. Now, what are these internal controls? So, we have studied about internal controls in brief in company audit subchapter 4, but yet again, I'll explain you. Internal controls are basically policies and procedures that help in efficient and orderly conduct of business. So let's suppose I went to a sweet shop and I bought a sweet. The cashier made me a bill and I paid the bill accordingly and got the sweet. While having the sweet, I craved for a snack and I went to the cash counter again and I said that instead of making a bill again, just take the money and give the order to the person serving to give me a snack. So the person or the cashier agreed and took the money and ordered the server to give me a snack. Now I got the snack, I even paid the money and left the sweet shop. Now the cashier, if he wants, he can directly put that money in his pocket because there is no bill made against it, and no one will be able to know about that. But this sweet shop has a control wherein at every day end, the stock and the sales are tallied. Now, when the stock and the sales are tallied, the person or the owner would get to know that one snack is missing because the sales bill for that is not made, but the stock for that particular snack is missing. And this is a control that helps the owner know about all the missing sales or all of some missing frauds that the cashier can. So these kind of controls basically help an entity survive and ensure that there are minimum frauds and the business is conducted nicely. Now, this was an example of one control. There are multiple controls at multiple levels in each organization. Let me tell you, some of the internal controls might be highlighted and some of it may not, but a business cannot function without internal control. Even a small business such as a puchka wala, even they have internal controls, but we never get those controls highlighted. That is why we do not think about those controls. But no business, let me tell you, even the smallest business in the world cannot run without internal controls. So internal controls are a very, very important component of a business. So internal controls are basically controls or policies and procedures that help in orderly and efficient conduct of business along with STAMP. Now, what is the full form of STAMP? It helps in safeguarding of assets. That is, it helps the assets from theft, or it saves the asset from the unauthorized use. Then it helps in timely preparation of financial statements. So once the business is being carried out in the orderly and efficient manner, that is, the business is being carried out as per the policies of the management, and everything is done as per the controls. Every control is being followed upon. So obviously the financial statements would be made in the right time and would be showing a true and fair view. Then from A, accurate and correct records are present. Obviously, because if the accurate and correct records are not present, then there is a lack of internal control, or there is a internal control failure. So for the example that I gave you, even there, at the end of the day, the stock and the sales were being tallied, and once the snack piece was found missing, the accounts were rectified. So internal controls play a very important role in correcting the accounts of the business. It ensures adherence to management policy, that is, company's policy of optimization of resources, fraud minimization, of ensuring minimum wastage. Every such thing is satisfied. And lastly, obviously the most important point, it helps in prevention of fraud and error. Now, internal controls are not just restricted to accounts, but they also move their scope to administrative stuff. So, internal control include both administrative and accounting control. Now, how does a business ensure good internal control? That is, how do they ensure that the internal control in the business remains good and the internal control for the business is apt? So, first of all, a flowchart should be made so that each employee knows that these are a series of things that need to be done. Then the duties should be segregated, and it should be ensured that not one person is overburdened with responsibility, because yet again, if you give one person all the responsibility and there is no separation of maker and checker, he will have the highest authority and the chances of fraud will increase. So segregation of duties must be properly done. Segregation of duties must be such that the person handling the accounts is separate from the person having the custody of assets. So let's suppose in case of a jewelry shop, the one who is a salesperson or the one who is regularly in contact with the stock of jewelry should not have an responsibility or the authority over the accounts also, because it could be a possibility that he steals the stock and he makes the changes in accounts. So the duty should be segregated in such a way that accounts should be separated from custody of assets. Apart from that, there should be proper division of work. All these duties are ultimately to be obliged by the staff, so the staff should be competent. Authorization and approval is a necessary process of any control that is implemented in the organization, and time to time review is necessary so that the control remains updated and whatever changes are required in the controls are being made. Now, what are the types of internal control? So there are broadly two types of internal control: preventive control and detective control. Preventive control basically prevents all the internal controls, and detective control basically detects all the internal controls. So when an error has occurred and the control and then the error has been detected, or when the fraud has occurred and then the fraud is to be detected, then detective control comes to the place. And when there is a control to stop the error from happening or to stop the fraud from happening, then it is known as preventive control. Now, what are the examples of preventive control? So, segregation of duties, approvals, authorization, and access security are example of preventive control. Reconciliation, review of performance, and physical verification are example of detective control. Basically, so if you have your exams due in December 24, so whatever steps you will be undertaking now to ensure that you clear the exam are preventive control. And in case you don't pass in the exam or you fail in the exam, then whatever steps you will be taking to ensure that your next attempt is good, or whatever study plans need to be undertaken for the next attempt are efficient and are according to the examinations, or in order to ensure that you pass the next attempt are detective control. So before the error has occurred, if any control prevents that, it is known as preventive control. But after that, after the error has occurred, if any control detects that, it is known as detective control. Now, what are objectives of internal control? So although I have made a mnemonic of War of USA, if you want, you can learn through this mnemonic. Apart from that, these objectives are very similar to the definition of internal control. So if you remember STAMP, so STAMP is basically an objective of internal control only. From S, it was said that the internal control safeguards the asset. Now, how will the assets be safeguarded? First, when there is time to time physical verification of those assets, and next, when the assets are protected from unauthorized use. Just a second. Now, next was timely preparation of financial statements. Now, when will the financial statements be timely prepared? When true and fair view is reflected in the financial statements. And next, when all the accounting principles, accounting estimates, and accounting standards are followed with. Then it was accurate records. So how will the accurate records be maintained? Accurate records will be maintained only when there is sequentially accounting of all the transaction and no transaction is missed. Then from M, it was adherence to management policies. Management policy means optimum utilization of resources and reducing the wastages to as low as possible. So it ensures optimum utilization of resources. And lastly, from P, that is prevention of fraud and error. That is time to time locating the weak areas. So these were the objectives of internal control. Now, what are the advantages of internal controls? If the internal controls of the entity are working well, here are a few advantages that the entity can encounter. First of all, the frauds and errors are detected and prevented. Now, when the frauds and errors are detected and prevented, even the assets are protected from unauthorized use. Now, when the assets are protected from unauthorized use, even the assets are employed for the purposes they were bought in, or the resources are employed for the purposes they are bought in, thereby reducing wastages and ensuring optimum utilization of resources. And when all the resources are optimally used, even the staff stay happy and the staff stay satisfactory, and it increase the moral boost of employees. Now, these were the advantages, objectives, meaning of internal control. Up till now, we are hearing all the good things about internal control, but do you think all that shines is gold? No. So, there are certain limitations with internal control also. Now, what are these limitations? So, first of all, in case of small entities, the cost of internal control is more than the benefit of internal control. For small entities, internal control is not applicable. Apart from that, if the management itself is involved in some kind of fraud, internal controls can't help them, because internal control itself involves adherence to management policy. So if the management is manipulative, internal controls will fail. For implementation of internal control, it is manual dependent, that if the staff is competent or if the staff is satisfactory, only then the internal controls will be implemented well. So if there is a collusion among the staff, or if the staff is not behaving correctly, or if the staff does not ensure nice or effective implementation of internal control, so the internal control would again fail. Apart from that, internal controls is usually applicable in areas when there is a repetitive kind of task, and in today's era where every business is dynamic, internal control needs to be updated always, which again can lead to a higher cost of internal control than the benefits of internal control. And lastly, management may take certain judgments under pressure, and that may lead to lack of effective internal control. So these were the limitations. Now, how will the auditor evaluate internal control, or how will the auditor judge the internal control of an entity? So there are four ways by which the auditor can detect, or the auditor can evaluate the internal controls of an entity. So the first is narrative records. So narrative records is nothing but a written description of the internal controls of the entity. So a lot of entities have this SOP or RCM or manual wherein all the internal controls are of the items of financial statements are written. So if the auditor goes through those manuals or SOPs or RCMs, the auditor can understand what are the controls that are applicable to different items of the financial statements and what are being followed with by the entity. Next comes flowchart. So flowchart is nothing but a pictorial representation of the internal controls of the entity. So if you have seen any flowchart, that is basically a diagrammatic kind of presentation when one box to another box to third is linked by the arrows, and all the boxes have certain kinds of items and controls. So flowchart is also another great medium by which the auditor can judge the internal controls of the company. Third is checklist. So checklist basically is given to the team members by the audit partner or the team head. So checklist contains all the audit procedures. It ensures that no audit procedure is missed by any audit team member, and all the steps are taken to evaluate the internal controls of the company. And last is internal control questionnaire, which is given to the employees of the company, and on the basis of the answers given by them or on evaluation of answers given by them, internal control is judged. So the kind of questions given in the questionnaire could be that who records the sale transaction, is there a fixed person for recording sales transaction, what are the documentary proofs that are taken before recording the sales transaction, can the sales transaction be altered, if yes, does anyone approval required to do so, or what are the steps to alter the amount of sales, or who is authorized to alter the sales transaction. So these kind of questions and their answers basically help the auditor judge the evaluation or judge the effectiveness of internal control in the entity. Now, since both internal control questionnaire and checklist are forms of questionnaire, here are a few differences that the institute has given. So internal control questionnaire is basically given to the employees of the company, whereas checklist is given to the audit team members. Checklist is given at the start of the audit and is taken back at the end of the audit, because checklist contains all the audit procedures, and the main motive of the checklist is to ensure that no audit procedure is missed. So it is given at the start of the audit and is taken back at the end of the audit to ensure that the auditor performs all the audit procedures, whereas in case of questionnaire, it is given in the mid of the audit and taken back immediately, because the answers need to be evaluated, and on the basis of that the risk needs to be assessed and the further audit procedures needs to be designed. And last comes the motive. So internal control questionnaire motive is to help the auditor in evaluation of internal control, whereas checklist's motive is to ensure that no internal control procedure is missed. Now, one of the most important components of internal control was to detect fraud and error. But how will the internal control ensure that the fraud and error are prevented and detected? So one of the steps to do that is internal check. Internal check basically means framing the procedure in such a way that work of one is automatically checked by another. Example, so we see this kind of example in our daily life in banks. So if you have ever gone to encash a check in a bank, so there will be three persons to do so. So the first person will check your check. The next person will pass a accounting entry in the banking records and again check that check. And the third person will check the accounting records, check the check again, and then give you the money. And ultimately, you being the receiver can obviously check the money. Now, these kind of procedures are nothing but a part of internal check, wherein the work of one is automatically being checked by another. Now, when there are three sets of person doing the same task of checking the check, there are high chances that if there is any error in the check, that will be detected, because it could be missed by the first person or it could be missed by the second person, but coming up to the third person, obviously the chances of not detecting a mistake is very rare. It could be detected by the second person itself, or minimum to minimum it can be detected by the third person. So obviously this process of rechecking ensures that the frauds and errors are minimized. Even you had heard in the school, so in the school our teachers used to say that once you are done with the exam paper, just recheck it. Now why do they advise us to recheck it? Because rechecking helps us to know a lot of mistakes that we could have made in the paper. So rechecking is a very great procedure to ensure that all the errors are timely detected. Now, how will an entity ensure that there is a good internal check system? So first of all, they need to arrange the process in such a way that work of one is automatically checked by another. Next, there should be clear instructions given to each employee regarding their responsibility. There should be clear instructions to each employees regarding the part of checking also, because there should not be situations wherein the employee come up and say that, oh, I didn't know that I had to check this also. So there should be clear instruction to the employees regarding the part of checking also. It should be ensured that wherever the staff is interacting directly with the customer, there is extra supervision, because up till now, up till the chain where a staff was checking another staff work, the part of internal check was coming in, and the work of the previous staff was being checked. But when the staff interacts directly with the consumer, there is no person to check that, and customer is the only checker. So there could be a possibility that the staff and the consumer collude and conduct a fraud. So there should be extra supervision when there is an interaction of staff with the customer. Apart from that, there should be continuous rotation of employees, because a lot of time we kind of overlook, or we tend to overlook certain mistakes. So a rotation of employees help us know about those mistakes. Technology enabled devices must be used, because at a point of time the human can make the mistakes, but the mistakes done by the technology are very rare or almost negligent. So technology enabled devices should be used to the largest. And lastly, there should be supervision and review from time to time. Now, what is the objective of internal check? So I have written a poem for helping the students remember the objectives of internal check. However, this poem is in Hindi, so I'll just spell out the poem and then I'll explain you all the points one by one. फ्रॉड एंड एरर को करना है जीरो, वर्कफोर्स को बना देना है एकदम हीरो। फ्रॉड एंड एरर को आइडेंटिफाई करना है एट एन अर्ली स्टेज, वर्कलोड ऑफ द ऑडिटर्स को करना है ऑलमोस्ट इरेज। ड्यूटीज एंड रिस्पॉन्सिबिलिटीज को एलोकेट करना है सही से, कंफर्मेशन ऑफ फैक्ट्स एंड एंट्रीज लेनी है फिजिकल एंड फाइनेंशियल रिकॉर्ड से। एंड लास्टली करना है एम्प्लॉयज़ पे मॉरल प्रेशर एक्सरसाइज एंड इंश्योर करना है इंटरनल चेक से हमारी कंपनी हो जाए हेल्दी, वेल्दी एंड वाइज। सो इफ यू आर कंफर्टेबल इन हिंदी एंड कैन speak broken kind of Hindi, this poem is a must learn, because this poem is both interesting and easier to learn. So if you can do so, great. If not, I'll explain you one by one all the points in English. So first point is that the fraud and errors are to be detected and prevented, because ultimately internal check is a part of internal control that is made just to ensure that the fraud and errors are prevented and detected. So the first objective needs to be that detection and prevention of fraud and error. It also ensures that the workforce becomes very efficient, because the workforce is doing one task again and again continuously. So it ensures that the workforce is becoming efficient. Again, fraud and error should be minimized to zero. The statutory auditor's workload is also reduced, because if there is internal check in the entity that is functioning well, so obviously you can imagine that there are almost negligent errors and fraud in the entity. So the auditor can focus more on the important areas, and the auditor need not worry about the small risks that could be present in the entity. So the workload of statutory auditors is also reduced. Duties and responsibilities are allocated in the correct manner, because there is a series of function that goes in. Further, this is the only procedure that helps the entity get a confirmation of facts and entry. So even if you apply internal controls, you do not get a double verification or a confirmation of facts and entry. But in case of internal check, every process is double checked, so the entity even gets a confirmation and a double verification of facts and entries. And lastly, it also exercises a moral pressure on employees. So this is basically a peer pressure that the employees suffer. So if one employee is making continuously the same kind of mistake, and the other employee is checking that, so the first employee will always have a kind of fear that if I make a continuous mistake, the second employee will feel low of me and may even gossip about me in the entire organization. So this kind of internal check method also exercises a moral pressure on the employees, which helps them even work better. Now, what are the advantages of internal check? So advantages of internal check are both to the auditor and the client. So for the auditor, it helps him save time and cost, and it also improves the quality of work. But yet again, this benefit comes with a disclaimer. So it could be a possibility that the auditor thinks that the internal check is working pretty well, but in reality, the internal check may not work pretty well, or the internal check may not be functioning nicely. That may lead to audit risk. So the auditor should believe, or the auditor should trust an internal check based on all the procedures, based on all the verifications, based on all the checks. Only after that the auditor should trust upon internal check and design audit procedures according to that. So the auditor should not blindly trust internal check and just go on with the procedures. If the auditor wants to avail the benefits of internal check and save his time and cost and improve the quality of work, the auditor should also check the internal check and apply procedures so as to ensure that the internal check on which the auditor is relying is correct. Now, how does the internal check be advantageous to the client? So it helps in removing the fraud. It acts as a moral pressure on the employee. The work process gets really smooth. And lastly, the financial accounts of the companies are prepared very, very smoothly. Now, we learned about both internal control and internal check. But do you think that once these internal control and internal checks are just established and left alone, would these be effective for the entire lifetime of the entities? For suppose I established an internal control and internal check in maybe 2000, and up till now I have not updated these internal controls, not supervised these internal controls, and I am expecting that these internal controls and checks would continue as I had designed in 2000. Obviously not. Everything need updation, everything need continuous supervision, everything need continuous review. So for this continuous supervision and review of internal control and internal check, internal audit was brought in. So internal audit basically ensures checking of all the internal controls of the entity and suggesting improvement measures to the client, whereby if implemented, it can help in better and efficient conduct of business of the client. Now, internal audit might be a costly affair for certain entities, because in case of small entities where internal control is itself not present, internal audit makes no use. And in other entities also, it could be a possibility that the internal controls are functioning well and there has been time to time supervision by management, so internal audit is not needed. So if internal audit is made mandatory for every entity or every company, it might come as an added burden or added cost to the entity. So hence internal audit is not applicable to every entity. It is applicable to certain kinds of entity which satisfy these three criteria. So internal audit is applicable or mandatorily applicable to all the listed companies. All the unlisted public companies whose paid up share capital is either more than equal to 50 crore, or whose turnover is either more than equal to 200 crore, or whose outstanding loan is more than equal to 100 crore, or outstanding deposits is more than equal to 25 crores. These all the four conditions are or conditions. So if there is an unlisted public company satisfying any of the one conditions, they need to get their internal audit done. Then comes private company. So any private company whose turnover is more than equal to 200 crore or whose outstanding loan is more than equal to 100 crore need to get their internal audit done. Now this applicability criteria is important. You can expect MCQ questions and even descriptive questions on the basis of applicability criteria, wherein it is asked that whether internal audit is applicable to this particular entity or not. Now, what are the basic features, or you can say objectives of internal audit? So, objectives of internal audit are basically journey. First of all, it checks whether the internal controls are helping in accomplishment of objectives. Next, it reviews the efficiency and effectiveness of operations. Third, it reviews the compliance with laws and regulation. That is, whatever laws are applicable to the entity are being complied by the entity or not. Fourth, it reviews internal controls, monitors operation and improvements. Fifth, it reviews the means to identify, measure, and classify and report to FS. That is how it can be ensured that the true and fair view is reflected in the financial statements, and only the current records are given in the financial statement. And lastly, it identifies and evaluates the risk management process and suggests improvements so that the risk can be analyzed better, and accordingly controls can be directed towards those high risk areas. What are the advantages of internal audit? So the advantages of internal audit is very simple. First of all, it helps in improving internal control. Now, if the internal control is improved, the fraud and error will be detected and prevented very easily. Fraud and error, when detected and prevented easily, help in protecting the assets from unauthorized use. When the assets are protected from unauthorized use, the resources are used for the purposes they were bought in for, and there is minimum wastage and maximum efficiency. And where there is minimum wastage and maximum efficiency, even the company's policy are achieved. So if you go in your module, you'll see pointer wise points in case of advantages of internal audit, but I have basically framed a flowchart kind of things on the basis of which you can remember what is the first advantage, what is the next advantage, what comes as a third advantage on the basis of second advantage. So it helps you really remember all the advantages, and all the advantages in a sync in the logical connection rather than just mugging up all the advantages. Now, don't you think it is unfair that the internal auditor is working so much and only the client is taking the benefit of this work? Like, the internal auditor is checking the entire internal controls of the company and only the client is taking benefit of this internal audit. Even the statutory auditor should be able to take the advantage, or should be given to take the advantage of internal audit, because statutory auditor always complains at the time and isn't able to check the entire financial statements itself. So if the statutory auditor is given a chance to know about the internal controls of the company, it can help him assess the risk better and design the audit procedures better. So can the statutory auditor even take the help of an internal auditor? Absolutely yes. The statutory auditor can take the advantage of an internal auditor's work, and that is pretty much legal. In fact, there is a standard on auditing on upon that is SA 610. So SA 610 SA 610 basically describes about using the work of an internal auditor, and the statutory auditor needs to comply with this essay while using the work of an internal auditor. Now, obviously, we won't be reading the entire standard, but there's an extract of those standard in our syllabus which we'll be reading. So first thing, if the statutory auditor is using the work of internal auditor, he needs to know that whether he can use the work of internal auditor or not, or whatever work has been done by internal auditor is of use to him or not. So to check the usefulness of the work of internal auditor, he'll apply POSET. Now what is POSET? So from P, he'll check whether the internal auditor has taken professional care or not. If internal auditor has taken all the professional care, then his work can be reliable. Otherwise, his work won't be very reliable. Next, what is the authority vested upon internal controls? If the what is the authority vested upon internal auditor? So if the internal auditor is very much dependent on the management and favors the management, then the internal auditor's work may not be very reliable. But if this situation is not the case, then the internal auditor works can be held reliable. Then from U, whether the internal audit is undertaken by outside agency or whereas it is an in-house department. So a lot of organizations have an internal audit department themselves in their organization. So in those cases, this department is not very much independent of the organization and is kind of dependent on the management. So if there is an internal audit department in the organization itself and the internal audit is not undertaken by an outside agency, then it could be a possibility that the work of an internal audit couldn't be trusted much. Then from S, what is the scope of internal audit? That is, what are the works that are undertaken by internal auditor, or what are the controls that are checked by the internal auditor? Then from E, what is the experience and qualification of internal auditor? Now this could be a very stereotypical thing to check, but till date also there are people who judge you on the basis of experience. So if the experience of internal auditor is really high, it could be said that the internal auditor's work is reliable, whereas if the experience is low, then it could be said that the internal auditor's work is not reliable. And the last comes from T, that is technical compliance. So if the internal auditor has undertaken all the technical compliance, it is said that the work is reliable. If not, his work is held to be as unreliable. Now, post the POSET decision, if the statutory auditor feels that he can use the work of an internal auditor, he shall inform the internal auditor about the same, discuss plans with him that how does he plan to use the work of internal auditor. Then the statutory auditor shall also recheck the work of internal auditor and get a resatisfaction that he can use the work of an internal auditor. Then he shall inform the management about this, because ultimately internal auditor is appointed by the management, so he has to inform the appointing authority. He shall inform the management about this and let him know that these are the areas where he'll be using the work of internal auditor, and he will ask the management not to intervene in such areas, and he shall also obtain a written agreement upon this from the management. Post that, he shall also obtain a written agreement from the internal auditors that whatever will be the work wherein the internal auditor's work will be used by the statutory auditor, those matters will be kept confidential and he shall not disclose it to anybody else. And lastly, the external auditor or the statutory auditor should document all of this by himself also, so that if someone studies his audit documentation, they know that these are the areas where the internal auditor's help is taken upon. But every benefit comes with the disclaimer, so here is also a disclaimer. However much the statutory auditor uses the work of internal auditor, in case if anything gets wrong or if anything goes wrong, it is the statutory auditor who will be held liable and not the internal auditor. If if there is anything that is not in compliance with laws and regulation and it goes wrong, then it is the statutory auditor who will be held punishable and not the internal auditor. And despite using all the work of internal auditor, or despite having an excessive dependence on internal auditor, whatever opinion is to be given by the statutory auditor should be of his own and not of the internal auditor. That is, the statutory auditor will shall still be expected to give an independent opinion on the audit report. Now that we have studied all the three important internal related terms of audit, there's a difference between internal audit, internal control, and internal check. First of all comes the definition. So internal audit basically means to check the internal controls of the company. Internal control basically means to ensure policies and procedures that help in orderly and efficient conduct of business along with stamp. And internal check means framing a procedure in such a way that work of one is checked by another. Now coming to cost, so internal audit is a costly affair. Internal control can be a costly affair only for the small entities. For big entities, it is kind of more advantages than the cost, and in case of internal check, there is no additional cost because it is just about framing a procedure. Now what is the timing of checking? So in case of internal audit, once the internal controls have been established, once the financial statements have been made, then the internal audit gets conducted. For internal control, checking is done simultaneously with work, and in case of internal check, checking is done once the work is performed by the previous one. In case of internal audit, each component of internal control is checked. In case of internal control, checking is in the routine process, and in case of internal check, work of one is automatically checked by another. Apart from that, there are more 2 to 3 differences given in the institute book that you can check, but they are not very important, and usually this topic is not a very much asked topic in the examination, so you can just read through, and if I feel if you read the above 3 topics very well, you can yourself frame all the differences and give the answer. Now, however good the internal audit was, there was a problem in that it checked the internal controls of the entire organization. Now, there could be certain areas that required immediate attention of internal auditor, or there could be certain areas that required more attention of internal auditor. Now, what about those? Internal audit was basically ensuring checking of all the internal controls of the company and giving time to all the internal controls of the company, which either lead to which can either lead to basic checking of all the internal controls and not a detailed checking of any internal control, or which may lead to missing out on maybe certain types of control which could have been important. So there was one issue with internal audit that it focused on checking everything relating to organization, and when you check everything relating to organization, you either miss out on the important ones, or you are not able to check everything as in detail, and you are just able to conduct basic verification of everything. So to combat this, risk-based internal audit was brought in. Risk-based internal audit basically focuses on high risk and significant risk areas that require immediate attention. So if there's a company that is suffering from particularly significant risk and requires immediate attention, instead of getting an internal audit done, they can get a risk-based internal audit done. So risk-based internal audit basically ensures that whether the management has assessed, identified, and responded to all the risk, then whether the management has implemented controls on this risk, and the controls that have been implemented are effective and not excessive. So you might see at our homes also, when there's a risk coming up or when there's a problem in our home, we try to put all the solutions at the end, and we do not see that whether the solutions are effective or not. Let's say that suppose there's a corner in your house that is attacked by ants. Now everyone gets worried and everyone tries to give their kind of solution. Someone tries to throw water, someone tries to do anything else, someone tries to feed them something, someone tries to clear off that areas, and different things. Now what we don't realize that we are putting all kinds of control, and the controls are just becoming excessive and not effective, because none of us are looking at the source of these ants and are busy trying to just push off that particular area of ants. So it should always be ensured that the controls that are being implemented to waive off the risks are effective and not excessive. Then whatever residual risks are remaining, that is whatever risks are remaining even after implementation of control, that should be within the risk appetite of the entity, that is it should be within the risk taking capacity of the entity. Further, it should be ensured that all the risks are properly classified and reported. And lastly, the risk management process is being monitored continuously. So the objective of risk-based internal audit is basically to provide an assurance about risk management process, management of key risk areas, and ensure complete and accurate reporting of such risk. Now, what are the advantages of risk-based internal audit? So first of all, it focuses on high-risk areas and helps the management put the controls where these risks are present, and helps the management direct the resources at the right place. Further, since risks are detected and corrected, and all the significant risks are removed from the organization, if the organization needs to change anything, it can easily adapt to the changes, because now it is risk free and can focus on new things. Further, it helps the management to put their funds in the right area. So earlier what the management used to do was put the funds in the entire internal controls. Now there could be certain areas which didn't even require funds, and there could be certain areas which required excessive funds. Now since the fund was allocated equally to all the controls, that these two high-end areas, that is the areas which didn't require any fund and the areas which require more fund were not addressed. So risk-based internal audit tends to solve that problem and help the management know about the right areas where the fund needs to be allocated. And lastly, a lot of compliance framework provides for these risk management process, but nothing is as effective as in risk-based internal audit. So risk-based internal audit is a must-do for any client if they are suffering from significant risk areas. Now, what are the differences between a traditional internal audit and a risk-based internal audit? So, traditional internal audit focuses on the internal controls of the entire organization, whereas risk-based internal audit focuses only on high risk or significant risk areas, where traditional internal audit does not focus primarily on business risk. Internal or risk-based internal audit focuses on those risks and all the other risk that the company is suffering from. In case of traditional internal audit, resources are spread all over the business, whereas in case of risk-based internal audit, resources are given only to the high-risk areas. Traditional internal audit focuses on non-compliance and deficiency of control, whereas risk-based internal audit focuses on risks that are not controlled and are over-controlled. And lastly, the most important point. So, in case the internal auditor suggests certain measures to the management, they are kind of reluctant or they may kind of delay the implementation because they do not see an immediate advantage of that. But in case of risk-based internal internal audit, where the auditor highlights all the important significant risks and helps the management know that if these risks are combated, what are the advantages that the company will feel or what are the advantages that company will get, the management is usually inclined to make all the changes and fund these controls. So in case of traditional internal audit, there is usually a delay in the responses, whereas that is not in the case of risk-based internal audit. Now, what is the process of risk-based internal audit? So I have written the process in a brief, but this is not important. Once you read through this or once you understand it, that is more than enough. It is not a very important topic for the examination also, so not to worry about that. Just go through and read through this, and I feel after reading once, everyone will be able to write it on their own also. So there is nothing to be worried about this particular topic. So first of all, the entity's business and the internal controls needs to be understood. Then the risk needs to be assessed. Once all the risks are assessed, the risks are categorized on the basis of their maybe the risks that are contained or maybe the problems that they are making or maybe the errors that they are making. Then the control assessment is checked, that what are the controls that are implemented on these risks and what are the residual risks that are left now, that after post application of control, what are the residual risks still remaining. Then yet again, that risk is categorized on the basis of the errors that it is taking or on the basis of hierarchy. Then the resources are allocated. Post allocation of resources, the risk is again reassessed, and once the risks are reassessed, then the risk based internal audit plan is updated, and this cycle continues until all the risks are combated and all the controls are properly implemented. So in brief, it basically first does the risk assessment, then the risk categorization, then the control assessment, then the residual risk assessment, then the residual risk categorization, then it allocates resources, then it reassesses the risk and checks whether the controls that have been implemented by the auditor are working well or not, and after that he or she or the auditor updates the risk-based internal audit plan, and the cycle continues again and again. And we come to the last topic of this chapter, that is internal financial control. So we have already read about this internal financial control in company audit subchapter 4. So when the internal controls are directed mainly towards financial statements, they are known as internal financial control. I have even given an example in the class relating to McDonald's. So when McDonald's specifies that the burger patties need to be fried at this temperature, the Coke needs to be filled at this level, or the burger buns need to be heated at this level, these all are internal controls. These all are controls basically that the management of McDonald's is undertaking so as to ensure that the consumer is fed with the same taste all across the nation. So if you have visited any McDonald's of the nation, you will generally feel that the burger tastes the same. Now, why is that? Because they have laid down SOP, that is standard operating procedure, and they function only according to that. So this kind of procedures are known as internal controls. Now, in the management of McDonald's specifies that the burger patties needs to be taken from this particular vendor only because the quality is maintained and the purchase rate is not fluctuated, or the purchase rate here is reasonable. These kind of controls are internal financial controls, that is controls related to financial aspects of the business. And when the management of the McDonald's ensures that all the entries that are given in the books of McDonald's are going correctly in the financial statements, the financial statements are giving a true and fair view, they are known as internal control over financial reporting. So when operational and anti-fraud controls are added to internal control over financial reporting, they make internal financial control. And when entity level controls are added to internal financial controls, they make internal control. Now, in company audit subchapter 4 also we read that the auditor or the statutory auditor of the company is not responsible for commenting about the internal controls of the entire company, because that is the job of internal auditor, but the statutory auditor of the company is responsible for commenting or giving remarks about internal control over financial reporting. Now, where is this obligation stated? So this obligation is stated under section 143 subsection 3(1). Apart from the auditor, even the directors have to comment about internal control over financial reporting. In case of listed entities, the directors need to report in director responsibility statement. In case of other companies where independent directors are present, the remarks need to be stated under section 149 subsection 7 and schedule 5, and even the audit committee is obliged to give remarks on internal control over financial reporting as stated under section 177. Now, what will happen if the company implements internal control over financial reporting, or what are the benefits that the entity will avail by implementing internal control over financial reporting? So it helps in senior management accountability, it helps in improved control over financial reporting, it improves investor confidence, promotes transparency of accounts, helps in accountability of management, because even the management will feel obliged, because there are different kinds of persons commenting upon internal control over financial reporting, so it even makes the management feel responsible. It helps in more an accurate and reliable financial statement, and lastly, it helps the auditor in making the audit comprehensive. So that was it for this chapter. Now we'll be moving on to the Q&A of this chapter after a 1 minute short break, and then we'll be moving to the last chapter of our marathon, and our marathon will be finally completed. So giving you a 1 minute break, post which we'll be doing the Q&A of this chapter. So we are back from the break. Prior to the break, we completed the revision of basics of auditing subchapter 3, and now we'll be doing the important Q&A of this chapter. There are not a lot of questions to be done, like there are 6 to 7 questions that are to be done, so it won't take us much time. So straight away, let's move on to the Q&A. So the first question is, discuss the various types of audit risk, which is a 4-star question. Now this is a very easy question and a very scoring question. So what are the kinds of audit risk? So there are basically 3 components to audit risk: inherent risk, control risk, and detection risk. Inherent risk means the risk that some items carry because of its nature. Control risk means that either the internal controls are not present or the internal controls are not functioning well. Detection risk means that the auditor's procedure or the audit procedures that the auditor implemented in the organization couldn't detect misstatement. Next question is, an auditor applies various techniques to evaluate internal control system of the organization. Discuss. Now this is a 3-star question. Now what are the techniques that the auditor can apply to evaluate the internal control system of an organization? So there are 4 techniques that the auditor applies. First is narrative records, that is obtaining a written description of the internal controls of the organization and forming an opinion based on that. Next is flowchart, that is basically a diagrammatic representation of the internal controls of the company and understanding the internal controls based on that and evaluating the internal controls. Then is checklist, which is basically provided to the audit team by the audit team head or the audit partner, so that it ensures that no team member is missing any internal control procedure or any internal control audit procedure, and all the audit procedures that are required to check internal control are being implemented. Then is internal control questionnaire. That means that in questionnaire is given to the employees of the organization, and on the basis of their answers it is evaluated whether the internal control is functioning effectively or not. Then comes question number 3. Discuss the importance of internal control system in an organization, basically asking about the advantages of internal control system in an organization. So first of all, it helps in detecting fraud and errors. Now, when the frauds and errors are detected, obviously the assets are protected from unauthorized use. When the assets are protected from unauthorized use, there is efficiency and effectiveness in the operations, and all the resources are being optimally used. When the resources are being optimally used, then the management's policy or the company's policy is being adhered to, and all the laws and regulations are being complied with. Also, it helps in attainment of goal and objective. Further, it also helps in employee satisfaction. And lastly, it helps in producing a reliable financial information. Now, this answer differs from the advantages given in the module. So if you're not comfortable with the answer, you can still write the advantages of internal control as given in the module, and you will still get all the marks. So not to worry about that. These questions are basically previous terms question, and previously the syllabus 2016 would go on, so the answers are given according to that. But if you're comfortable with the answer as given in the module currently, you can write those answers and you can still get all the marks, so not to worry about that. Next, internal audit is an important tool for management. Discuss 3-star questions. So here again they are asking about the advantages of internal audit. So first of all, internal audit helps in improving internal control of a company. Now, when the internal control of the company is improved, the fraud and error are detected. When the frauds and errors are detected, the asset is protected from unauthorized use. When the asset is protected from unauthorized use, then all the objectives of the company are adhered to and the wastages are reduced. And lastly, when the wastages are reduced and all the resources are being optimally used, then the management's policy or the company's policy is adhered to. Then comes question number 5. It is an accepted fact that internal auditing function to be effective must be independent of the activities to be audited. Comment. Now, this is a 3-star question. Now, first I'll explain you the question. So, the question is basically stating that if the internal audit function needs to be effective, it should be independent. Now, as I said during the revision, there are 2 forms of internal auditor that an organization can opt for. So firstly, it can have an internal audit department in the organization, or it can hire an external person or external firm to do that. Now, if the firm is external, obviously it's independent, and obviously they won't be influenced by the decisions of management, or they won't be influenced by the wordings of management. So therein the reliability of that firm becomes more, and it is said that their functioning is better. But wherein the company has an in-house internal department, there is some kind of dependence of those departments on the management, and it is usually considered that these dependency makes these departments unreliable, and hence it is concluded that internal audit function is not very reliable when it is an in-house department functioning. So yes, there is a kind of question on reliability based on the dependence of auditors, but apart from that, there is nothing to question about. An internal auditor may or may not be the employee of a company. That is, an organization might have an internal audit department itself in the organization, or might hire an external agency. A proper organizational status for internal audit department ensures its relative independence so that it can carry out its work freely and objectively and render impartial and unbiased service. The given statement is correct, but it cannot be a fully independent department for obviously various reasons. If there's a department in the organization, obviously they'll have certain kind of dependence on the management. Question number 6. Question number 6. Distinguish between internal audit and internal check. So basically the differences between internal audit and internal check is asked. So first of all, you should state about the objective of internal audit. So the objective of internal audit is to check the internal controls, whereas the objective of the internal check is to detect fraud and errors and ensure that no single person is handed over all the work. In internal audit, each component of control is checked, whereas in case of internal check, work of one is automatically checked by another. Internal audit bears additional cost, whereas internal check bears no additional cost because it is just lining up the procedures in a way that work of one is checked by another. Internal audit is done once the internal controls are established, that is once the work are done. In case of internal check, when the work of the prior person gets completed, then it is checked by the next person. In case of internal audit, it is said, or the thrust of the system or the objective of the system is to detect fraud and errors, whereas in case of internal check, it is ensured that all the frauds and errors are prevented and no single person is given all the work. That is, there is proper division of responsibility and authority. Lastly, internal auditor submits its report to management, whereas internal checks help in day-to-day reporting. Last question is, internal audit cannot be avoided in certain companies. Comment. So herein basically they are asking about the applicability criteria of internal audit. So you'll have to say that internal audit are only applicable to certain companies who satisfy the criteria. And what are the criteria? Any listed company, unlisted public company whose paid up share capital is 50 crores or more, turnover is 200 crore or more, outstanding loans and borrowings are 100 crore or more, and outstanding deposits are 25 crore or more. Further, every private company whose turnover is 200 crore or more and loans and borrowings from the banks is 100 crore or more. So yes, the given statement is correct. Internal audit cannot be avoided in certain companies. So those companies who satisfy the above criteria need to get an internal audit done, and no avoidance can be made by these certain companies. So that was it for its Q&A. Again, giving you a 1-minute break, post which we'll start with the revision of our last chapter for this marathon, Basics of Auditing, subchapter 4. That is not a very lengthy chapter, and it is a very interesting chapter also because it relates more to the practical side of audit. So it would take us like half an hour or 40 minutes to complete this complete that chapter. And from that chapter also you can expect the least number of questions. So in the past also only 2 to 3 questions have come up till now. So that chapter doesn't have a lot of Q&A also. So we'll be completing the revision very quickly and then doing the Q&A, and then we'll be ending this marathon. Again and again, if you're liking this marathon, do like, share, comment and subscribe. And if you have any problem, you can comment down below. Meeting you after a short break. Hello everyone, and finally we are at the last chapter of our syllabus, that is Basics of Auditing, subchapter 4. So in this chapter we'll be getting to know about the different audit procedures that the auditor uses in order to ensure efficient and effective conduct of audit. So as I've said earlier also, the auditor has got just 3 months to conduct audit, and wherein he has to check the entire 12 months financial statement. So humanly it is not possible that he can check each and every component of financial statement, because if the maker required 12 months to make that financial statements, obviously if the checker goes on to check each and every item, he would require more than 12 months. But here is a time crunch and he has got just 3 months. So there are different audit procedures that are used by the auditor in order to ensure that he does not fall into the trap of audit risk. He is able to cover maximum items, he is able to cover high risk items, and it is ensured that audit gives maximum coverage of financial statements to the users of financial statement. So herein in this chapter, we'll be learning about such audit procedures. Apart from that, there are 2 to 3 independent topics that we'll be also covering in this chapter. So first method is audit sampling. Now audit sampling is a popularly used method by all the auditors across globe. So what is audit sampling? So audit sampling basically means application of audit procedure to certain items in the ledger and forming an opinion upon the ledger based on such transactions. So suppose there's a ledger of miscellaneous expenses. Now this ledger contains 100 transactions. Now, as an auditor, I do not have the time to devote all these 100 transactions attention, and I cannot check all these 100 transactions. So I pick out some 20 transactions and check these transactions. Now, whatever opinion I have formed from these 20 transactions, that will be considered as an opinion for the entire ledger. That is, I pick out certain transactions from a ledger, apply audit procedure, obtain audit evidence, form an opinion, and that opinion is considered as an opinion for the entire ledger. So audit sampling basically means application of audit procedure to less than 100% of items of a population, that is 100% of you can say the ledger or 100% of the item of financial statement, such that each sample has a chance of selection in order to provide auditor with a reasonable basis to draw conclusion of the population. Herein population refer to the particular item of financial statement that is being checked or the ledger that is being checked. So basically herein you do not check each and everything but draw a sample, check that and form an opinion and consider that opinion to be the opinion about the entire population or the entire ledger or the entire item of the financial statement. Now, do you think that auditor thought that he'll do random sampling or he'll be using audit sampling, and the next day he went, randomly drew three samples, formed an opinion, and got that item done and dusted? Is it so easy? No. So there's a calculative sampling that goes around in audit sampling, and that has a series of procedures to be followed. So the first procedure that needs to be followed in audit sampling is selecting the sampling method. Next, the sample size is selected, that is how many samples does the auditor need to draw. Third, the samples are drawn. Fourth, the audit procedure is applied, and then the audit evidence is obtained and audit conclusion is formed. So we will be understanding about all these procedures one by one in detail. So the first step comes as selection of sampling method. Now there are two types of sampling methods that the auditor can choose from. So the two methods are statistical and non-statistical sampling. Now, as the name suggests, statistical sampling uses statistical tools such as mathematical tools, probability, or certain theorems or algorithms, and non-statistical sampling does not use any such statistical tools. But the question is, if non-statistical sampling does not use such statistical tools, then what does it use? So it uses the experience of auditor. So whosoever is the audit partner or whosoever is the head of the audit team has undergone a lot of audits in their career journey and have a share of experience from those dealing of different clients, and now they can assess the kind of samples that needs to be drawn from the ledger. So usually in this cases, the year-end entries or the high value entries or the entries of peculiar nature or the entries of similar kinds of amounts are drawn, or any other experience if the auditor has relating to the particular expense, income, asset or liability. Now the biggest disadvantage of this kind of non-statistical sampling is, first, not every sample gets a chance of selection. That is, not every item in the population gets a chance of selection as sample. Not every transaction can get selected. And next, not every time the experience of auditor might work. So he might have dealt with like 20 companies with different nature, and this company is of different nature. So experience might have worked in those 20 companies, but it might not work here. So there's a problem that experience of an auditor might fail and non-statistical sampling might fail in that case. Now the next type of sampling is statistical sampling, which basically uses statistical tools. We all were taught probability in class 9 or 10 if you remember, and one of the most common examples that we had were if there is a bag with 10 balls, 5 of which are red and 5 of which are black, what is the probability of drawing a red ball or a black ball, which could be 50%. So if you remember this kind of examples that were taught in school. So similarly here, even the auditor uses probability and statistical tools to draw samples. Now this statistical tool gives you 5 types of sampling to choose from. First is simple random sampling, wherein the auditor uses a random number generator and a random sample or a random transaction is drawn from the sample. So if there are 1,000 transactions, the auditor would simply ask the Excel to generate certain random numbers from 1 to 1,000. On the basis of the random numbers, the transactions are selected, samples are drawn, and the audit procedure is applied. Now the biggest advantage in these kinds of sampling is that every transaction has got a chance of selection, but the biggest disadvantage in this kinds of sampling is that it could be a possibility that transactions with no misstatements might come to the auditor, or transactions with very high misstatements might come to the auditor. Now both of these extreme cases can be disadvantages for the auditor. Next comes stratified sampling. So stratified sampling is basically an intelligent way of random sampling. Stratified sampling basically divides the transaction based on their nature, and then a random sample is drawn. So suppose there's a ledger of miscellaneous expenses. So stratified sampling would first bifurcate the transaction on the basis of their nature, and then a sample would be drawn from each nature wise item or each nature wise transaction. Herein the biggest advantage is that items of each nature are caught in the sample, but the biggest disadvantage is that the auditor might not bifurcate the transaction on the basis of their nature correctly, and the auditor might goof up on dividing the transactions on the basis of their nature, so that might be a problem. Next comes systematic or interval sampling. So in case of interval sampling, basically the transactions are selected at a particular interval. So it is decided either every third transaction would be picked up, or every transaction after rupee 5,000 would be picked up, or every transaction after rupee 500 would be picked up. So a lot of times even the management has this sequence sort of things for making mistakes. So it is really beneficial in that kinds of areas, but nowadays even the management has become smarter. So interval sampling is kind of not used a lot in the practical life. Next comes monetary unit sampling, the most used kind of method of sampling in practical life. Herein the transactions are sorted on the basis value, and all the high value transactions are covered. Now why is it the most used method in practical life? So usually in sampling you cannot test a lot of transactions, but through monetary unit sampling at least you can cover a good chunk of amount of the transaction. So if the total amount of expenses is 10,000, and if you sort the transactions according to their value, it could be a possibility that you are auditing just 5 to 6 transactions, but you're covering around 7 to 8,000 of amount. So at least if you're not able to cover a lot of transaction, you're covering a good chunk of amount of the ledger. And the last is multi-stage sampling. So a lot of times the ledgers are such that they are subdivided into other ledgers. Then these subdivided ledgers are further subdivided into other ledgers. So basically different stages are made. So in that case, multi-stage sampling is used. Example, so there could be a head as a miscellaneous expenses. Under those head could be printing stationery, cartridge, or maybe some security expenses. Now this printing and cartridge expenses further bifurcate as printing and cartridge. So this multi-stage presentation or the multi-stage accounting of transactions is usually audited through multi-stage sampling. So where the transactions are subdivided into different types of transactions or ledgers, in that cases multi-stage sampling is used. Now once the sampling method is selected and the auditor has decided that which sampling method he needs to select, the next step is selection of sample size, that is determining what is the number of samples that are required by the auditor. Now what is the number of sample that is required by the auditor depends on different factors. First is objective. So if the auditor is inquisitive to find any particular fraud or any particular misstatement, In that case, the sample size needs to be increased, because the auditor thinks that there is certain something fishy here, and to detect something fishy or to detect some fraud, obviously you will need to increase sample size, otherwise the sample size can be reduced. Next comes nature of population. So if there are very similar items in the transaction, so let's say, suppose you are auditing rent expenses. Now in case of rent expenses, what other would go apart from rent expenses? So there would be the rent transaction entry, so that are homogeneous nature transactions. So if the nature of population of the nature of the ledger is homogeneous in nature, so you can pick out some less samples, because ultimately the nature remains the same. But if there are different nature transaction or heterogeneous transaction, in that case the sample size needs to be increased. Then internal control system. So if the internal control of the companies are strong or entity are strong, then uh, if the internal controls of the entity, or if the internal controls of the company are strong, then the sample size needs to be reduced because the risk is less. But if the internal control is weak, then the sample size needs to be increased. Next comes materiality of the item. So if the item is material, yet again sample size is to be increased. If not, sample size is to be decreased. Then comes sampling risk. So you will know about sampling risk like from 2 to 5 minutes from now. But for now, consider it just as a normal risk. So if there is a high sampling or non-sampling risk, or if there is a high risk, obviously the sample size needs to be increased, and if there is low risk, the sample size can be decreased. And last comes tolerable error, that is the error taking capacity of the auditor. So if the auditor is able to accept a larger amount of errors, the sample size needs to be reduced. If the auditor is not very inclined to accept errors, then the sample size needs to be increased. So now the sampling method is selected. Now the number of samples that the auditor requires, or the sampling size is selected. Further after that, then the sample is drawn from the ledger, the audit procedure is applied, audit evidence is obtained, and audit opinion is based. Now, what are the benefits of audit sampling? So first of all, obviously it reduces the time and cost of auditor. It also improves quality of audit work, since it allows the auditor to focus on areas which require attention of auditor, or certain important areas or certain judgmental areas which the auditor might not be able to focus otherwise. Workload of the auditor is reduced. Now, since the sample size involves checking of internal control system, so effectiveness of internal control system is also determined. And lastly, usually in practical life, people don't tend to opt for non-statistical methods. People only tend to opt for statistical sampling methods. So audit sampling is very effective, since mathematical or statistical tools are used. So the chances of error are very less. But as we know, every good thing comes with a risk, or every pro has a con. So there are certain risks in sampling also. So there are two kinds of risk involved in sampling. First is sampling risk, and then is non-sampling risk. Non-sampling risk is the risk which you would get in any other audit procedure. So the risk of incompetent staff, the risk of loss of data, the risk of improper processing of data, the risk of analysis, lack of vouchers, lack of evidences. So these kind of risk remain in any audit procedure application. So non-sampling risk is basically the risk present in application of any other audit procedure. Whereas sampling risk means the risk that arises due to audit sampling. Now, what is the risk? So it could be a possibility that whatever samples are drawn by the auditor contain a lot of misstatements, while in actual, the financial statements do not contain such misstatements. Now, on the basis of sample, the auditor would be shocked, and the auditor would try to apply as much procedures as possible, which would lead to extra effort and extra time on the part of auditor when it is actually not required. So the first kind of sampling risk is it can lead the auditor to work more than required. And the next kind of sampling risk is it could be a possibility that whatever samples that the auditor has drawn do not contain misstatements, while in actual, the financial statement is materially misstated. So on the basis of samples, the auditor would think that the internal control is working well and wouldn't apply audit procedures. But in actual, there are a lot of mistakes which remain undetected. Hence, the next risk of sampling is that the auditor might fall in trap of the audit risk and may not be able to detect all the misstatements. So both of the extreme situations are possible, that the auditor encounters a sample with no misstatements and encounters a sample with a lot of misstatements. Now both of these extreme situations can cause problem to the auditor. So sampling can be used, but it should be used with a very careful mind, and it should not be used in unusual areas or where the business has a seasonal fluctuation, or where there is a lot of provision or judgment involved. In those kind of areas, the auditor should stick to 100% of checking. Whereas if there are any repetitive transactions going on, in that case, the auditor can adhere to audit sampling. So this was audit sampling. Let's go and understand the other tricks also. So the first other trick, or the first audit technique which the auditor uses in audit procedure, is routine checking. So routine checking is basically the basic checking of financial statement. It basically involves to check that whatever transactions are recorded in the business, have they actually been converted into financial statements or not. Now, this might be a very basic level checking, but it is a very important checking. At least you should know that the financial statements on which you are relying upon is correct or not. The financial statements on which you are applying audit procedure is correct or not. So the base financial statement should always be correct, and that can be ensured only with routine checking. Routine checking involves the basic or the most basic level of checking in audit, and just ensures that whatever transactions have actually occurred during the year have been converted into financial statements. Now these kinds of checking are usually done by the first year auditors or the first year articles or the junior level employees, because this is a very easy peasy kinds of checking, but yet again very important checking. Next comes test checking, that is audit sampling, that is application of audit procedures to less than 100% of population, such that each item has a chance of selection, and it enables the auditor to draw an opinion on the entire population. So upon test checking or upon audit sampling, we have had a whole lot of conversation, so I don't think I need to explain it again. Then comes audit in depth, which basically means detailed auditing, about which we read in basics of auditing subchapter 1. So detailed auditing basically involves back tracing of certain transactions. So I might pick out certain transaction of sales or purchase and check who passed the entry, when was the entry passed, what are the documents, what are the internal controls, whether a GRN or whether an SRN was received or not, what is the PO, who made the requisition, is the vendor a regular vendor, is the rate correct, is the quantity correct, was this quantity needed or not, everything related to that transaction. Now yet again, it is not possible for the auditor to conduct detailed checking of all transactions in practical life. So the auditor basically checks the internal control of the entire organization, then checks where are the risks present or where are the risks high. In those areas, the auditor applies materiality checking, and whatever are the material transaction or whatever the high value transaction or whatever are the transactions that are important, upon those transactions, the auditor applies in-depth checking, or involves back tracing the transaction. Next is cut-off examination, about which we have also read in company audit subchapter 3 under audit of items of financial statements. So cut-off checking basically involves that whatever transactions are recorded in a financial statements of a particular period, they should relate to only that period. So if I am making the financial statements for financial year 23-24, they should only have the transaction that relate to 23-24 and not 24-25 or 21-22 or 22-23 or any other year. They usually tend to be tempered in the start of the year or end of the year. So the auditor should pay attention on transactions from 25th to 31st March and from 1st to 10th April, and should ensure that only transactions relating to that particular year have been recorded and no previous and post-year transactions have been recorded. Then comes surprise checking. So surprise checking basically involves doing dhappa to the client. So if you remember in our childhood when we used to play I Spice or hide and seek, apart from the dinner, all the players would hide, and whenever the dinner would come and the players would catch him, or the players wanted the dinner to get out, so they would do dhappa to the dinner. So similarly, in case of surprise checking, the auditor does not inform the client, and the auditor suddenly appears in the organization of client to check whether all the claims, whether all the validations made by the client is correct or not. So the client makes a lot of fake promises and builds a lot of stories about the organization, that my organization is this good or that good, my employees are this good, that good, we all have this kind of internal control, that kind of internal control. So surprise checking basically ensures checking all of those claims, that whether all the things that the management claimed or management promised is correct or not. Surprise checking is usually done in sensitive areas like cash or in case of any particular fraud. And usually in the traditional audit era, this kind of methods were not used. But in modern auditing era, surprise checking has become a part of the audit procedures. And the last one is walkthrough testing. So walkthrough testing is basically the performance of transaction to check the internal control. So herein certain transactions are picked up and they are re-performed from the start to end to check whether all the internal controls that were stated for these particular transactions are effective or not. They are combating the risks or now, these were other audit techniques that the auditor uses in case of auditing a client, or these were audit procedures that help the auditor complete the audit efficiently and effectively. And we come to the last procedure that the auditor very popularly uses in audit, and this is very much required for the auditor to analyze the misstatements or risk better. So this procedure is known as analytical procedure, about which we have read recently in Basics of Auditing subchapter 3 under risk assessment process. So analytical procedure basically involves making a plausible relationship between two kinds of data, which may be financial or non-financial. So its essence lies in establishing a relationship between other items of financial statement or non-financial information and thereby arriving at a conclusion. So there I gave you the example that if you compare production with power and fuel, you'll be able to know that if there is any manipulative technique that is used by the auditor. Apart from that, there can be countless situations where the auditor can use analytical procedures. Still, I'll give you one more example. So let's suppose there is traveling expenses. Just a second. So let's suppose there are traveling expenses in the books of accounts of clients, and the traveling expenses are for 4 employees A, B, C, D. Let's suppose for A it is 2K, for B it is 3K, for C it's 4K, and for D it's 5K. Now these traveling expenses were incurred on these particular employees because they went to different areas in India and created new customers and generated new sales. So basically it was a sales promotional kind of expense, and herein the employees were sent to gather more customers and to gather more sales. Accordingly, when you analyze, so A bought in a sales of 20,000, B bought in a sales of 30,000, C bought in a sale of 40,000, but D bought in a sale of only 10,000. Now, when you see the ratio of traveling expenses to sales, you see that for A, B, C, there has been a 10 times conversion. But what happened with D? Now, had you just examined sales separately or traveling expenses separately, you wouldn't have been known about this, that there's a kind of relationship between both of these. You would have simply audited traveling expenses separately and sales separately and wouldn't have even known of such kind of manipulation. But once you applied analytical procedures, you got to know about this. And when you inquired more about this, you got to know that the employer doesn't even exist, and all these expenses and sales are fake. So these are the situations where analytical procedures help. Analytical procedures give a very broad indication that the risk is present in the area. They wouldn't directly make you aware about the risk. They wouldn't provide you that here is the risk present, but they would provide you a broad indication that there is certain risk present in this area. So analytical procedures are a must use for every auditor. Analytical procedures, yet again, help you know a lot of misstatements which you might have missed or which you might miss, and they may remain in the financial statements. So analytical procedure is a must use for every auditor. Now, where are the places where the analytical procedures can be used. So analytical procedures can be used from the start to the end by the auditor. They can be used in the planning phase for understanding the entity, obtaining an assessment about the risk of the entity. They can be used in the substantive testing phase as explained for sales and traveling expenses. That is, they can be used for testing items of financial statement, and they can also be used in the review phase to help the auditor know that whether the opinion whatever has been drawn by or whatever conclusion has been drawn by him is correct or not. Now, what are the techniques of analytical procedure? That is, what are the ways by which the auditor can apply analytical procedure? So, ratio analysis is one of the best ways. So, you can establish a kind of ratio between two kinds of data, and on the basis of ratio, you can understand that whether there is any misstatement under this or not. Apart from that, you can apply reasonableness testing. So the example of power and fuel to production is basically an example of reasonable testing only. You are finding out whether the power and fuel expenses that are shown in the financial statements are reasonable or not. That is, whatever power and fuels have been expenses have been shown in the financial statement or have been shown in the P&L are actually belong to the entity, and the entity has actually availed the benefit of this kind of power and fuel expenses or not. Trend analysis is also a great way. So herein the trend or the graph of a particular item is set up, and the auditor can examine the peaks and the low of the trend, that is the unusual spikes and the downs in the trend. And herein also it helps you get to know about the manipulations or misstatements, if any, in the financial statement. And lastly, sources of information such as budget or maybe non-financial information or maybe other entities information also help you get to know about the misstatements or the fraud indications. So these are the popularly used techniques of analytical procedure. Apart from these also, if the auditor wants, the auditor can obviously indulge in other kinds of analysis. Now, what are the areas that can be compared with, or what are the kinds of data that can be compared with financial information? So non-financial information can be compared with financial information. The financial statements of the entity can be compared with other entity of the same industry, and the previous and the forecasted information can be also used. So the previous year financial statements or some budgets or forecast can be also used to compare the financial information or financial statements, and analytical procedures can be established also among them. So this was analytical procedure, and these were the audit procedures as given in this chapter. Apart from these, there are multiple audit procedures that the auditor uses in practical life. But since since it is a marathon, we will stick to what it is written in the syllabus, and we wouldn't indulge in practical insights of auditor. In the regular class, we usually discuss about all the practical procedures that the auditor undertakes in practical life, but here in to marathon we restrict it only to what's contained in the syllabus. But yes, apart from these also, there are multiple audit procedures that are used by the auditor to ensure that the audit goes smooth and the auditor does not fall in the trap of audit risk. Now, apart from these, as I said, there are 2 to 3 independent topics that we need to cover. So the first topic is trial balance and grouping schedule checking. So if you know the financial statements, that is the P&L and balance sheet, are made from trial balance, so it is extremely important to ensure that the trial balance, which is the source of financial statement, is correct or not. So trial balance should be extensively checked. It should be ensured that it is giving a true and fair view. If there has been any alteration in the ledger, then the alteration should also be reflected in trial balance. Whatever codification logic or whatever accounting standard is to be followed has been followed. And lastly, the trial balance should be prepared after a particular cutoff date. That is, it should contain all the adjustments that are made by the entity. Then comes grouping schedule. Now, what is a grouping schedule? So let's suppose a client has 4 buildings, 5 plants, and 2 lands. Now, when you see in the balance sheet, does it show 4 buildings, 5 plants, and 2 lands? No, it straight away shows as fixed asset. Now, why is that done? Because it ensures that the balance sheet gives a comprehensive view of whatever assets is being held by an entity, and the balance sheet is not showing an unnecessary lengthy description of the assets. Now, this cumulative this cumulative addition of all these lands and grouping of these cumulative addition under a particular head is known as grouping schedule. That is, if you remember PPE. So PPE fell under tangible assets. And under this PPE fell land, building, plant, and other fixed assets. Now, this grouping of these fixed assets under PP and this grouping of PP under tangible assets is known as grouping schedule. So, basically ensuring that whatever items of the financial statement are there, they are presented in the balance sheet as per Schedule 3 and they are presented in the correct group is known as grouping schedule. Now, what should be checked in the grouping schedule, or how should the grouping schedule be checked? So it should be ensured that all the groupings are done as per Schedule 3. The groupings are to be done only by the authorized personnel. The grouping is changed only when it ensures better transparency and better disclosure to the users of financial statement. And lastly, nowadays when everything has moved into the software, so the software itself does the grouping schedule. So it should be ensured that the correct data is fed or the correct command is fed in the software. Trial balance checking and grouping schedule checking both are kind of irrelevant topics and they do not usually happen in practical life, plus they are not also important from exam point of view. So if you want, you can skip this particular topic or just read through this topic, it will be fine. And then comes audit in automated environment. So with increasing use of computers in both auditing and accounting, it is extremely important to know that how does the auditor conduct audit in an automated environment. So usually all the clients nowadays maintain their accounts through softwares. They do not have that pen paper system. So it should be known to the auditor that what are to be checked in an automated environment, what are to be checked in the software, how it is to be ensured that whatever data is being fed in the software is correct or not, whatever data is being produced in the software is correct or not, the client is not making any mistakes through or manipulations through the software, and it should be ensured by the auditor that the software is producing the correct data and the client is not undertaking any manipulative practices through the software. So first we'll understand from the client point of view. Now, if a client has a software, what are the basic things that he'll need? So he'll need a database, operating system, hardware, software, storage, network devices, network, and physical and environmental landscape, that is Wi-Fi, CCTV, or other automated devices if any are needed. Now, what are the advantages that are provided to the client if he uses software or if he uses tools of automated environment? So it helps in accurate data processing, it makes business faster, it minimizes human error, it involves better integration, control efficacy and security are increased, and it is able to process large volume of transactions. Basically, the crux of the point is if you use software, your work is also reduced, your work is more efficient, and obviously it is done in much less time than it would have been done manually. So all these are the advantages, but what about the risks that the softwares get with themselves? So there are a lot of IT and cyber risks involved with software. Now, how does the client combat that? So client combats that with controls. So there are generally 5 kind of controls in any software. First is application control, the control that relates to every application, basically the head control of the software. Then input control basically involves that the input is fed correctly. Example, so if you visit certain websites wherein they ask your phone number, now in case you correctly enter the alphabet, they'll give a signal or they'll send a message that you are inputting the correct you are inputting the wrong data. So these kind of controls are basically input controls which ensure that the input is fed correctly. Input controls could be range check, compatibility check, validity check, or exception check. Then comes processing control, that is ensuring that the data is processed correctly. Then comes output controls, that is to ensure that the output is handed over to the correct person only and the output is accessed only by the correct person. So a lot of times there's a lot of misuse of computer data. So it should be ensured that the correct person is given the correct data and there is no misuse of such data. And last comes master file control. So master files are basically files changing which can lead to changing a lot of ledgers of the organization. So the master file control should be given only to the eminent persons of the organization or the responsible persons of the organization, and it should be ensured that the password of such controls are not leaked. Now, this was from the part of entity, that whatever components are needed, whatever advantages the entity has, and whatever controls the entity implements in order to make the most use of software. But what about the auditor? So if the auditor goes to such a client which uses software, so what are the procedures that the auditor should use? So first of all, he should obtain an understanding of such environment. Then he should ensure and check that how a transaction is being recorded by the user. He can either go for walkthrough testing and check that what are the inputs that are to be given, who passes the transaction, what are the authorizations given, what are the approvals given, so he can understand the whole functioning of the software. And lastly, he should check application controls, that whether they are working well or not, because application controls are the head of controls. So if application controls are working well, or automatically all the controls will be working well. But if the application control is not working well, all the other controls won't be working well. So the auditor should basically undertake these three procedures. First of all, understanding of environment, then knowing how the transaction is being processed by user, and lastly, to ensure and configure application control. Apart from this, even the auditor uses a lot of tools of automated environment, or a lot of tools that help him in making audit program, audit planning, or in analytical procedures. So what are the tools that are generally used by the auditor? So auditor uses tools such as MS Excel, MS PowerPoint, MS Word. There's a software called CAT, Computer Audit Assisted Techniques, that helps the auditor in analyzing a lot of stuff. Apart from that, Power BI, Tableau, other analysis softwares, data analysis softwares, these all come handy into the auditor, because largely the use of software or the use of tools or the use of automated tools are done by the auditor for analysis purpose only. Apart from that, the areas of use of an auditor for automated environment are audit program, audit planning, audit schedule, and audit assignment. So the auditor can use or take the help of MS Word to draft audit program and audit plans. It helps in reviewing the internal control, yet again the part of analysis. It helps in checking the validity and consistency of transaction. So the validity and consistency of transactions can be checked through tools like MS Excel, wherein the ledger is exported and checked that whether the transactions are valid or not. Arithmetical calculations become very easy through MS Excel. Analytical review, as said earlier. Flowchart can be made from PowerPoint presentation, and lastly, audit report, documentation, and working paper all are made through MS Word generally, and MS Excel also for the recomputation of for the working parts. Apart from that, generally the drafts are prepared by the auditor in MS Word. So these are the areas of use of auditor, and these are the areas where the auditor uses automated tools. And we come to the last topic of our marathon, that is audit trail. The audit trail is a recently emerging topic. It has been mandated by 1st April 22 for every company to maintain audit trail. Now, what is an audit trail? So the government said that with increasing use of softwares by every client, nowadays almost every client uses a software to record the transaction. It is highly important for the auditor to know about the in and out of the transaction. That is, whatever transactions are being passed in the software should have the name of the person passing the transaction, should help the auditor know about the know-how of the transaction, should have a description of the transaction, and whatever data is being fed in the software by the client should have a transparency with the auditor itself. So audit trail was implemented. Audit trail basically requires the client to switch on the audit logs or the audit log feature, wherein whosoever is passing the transaction, the software would show that who has passed this transaction, who has altered this transaction, who has reviewed the transaction, when was the transaction passed, what was the narration of the transaction, what was the supporting documents through the transaction, and if there are any complementary entries to that particular transaction, even that would be displayed. So it basically helps the auditor check even the transactions that are in the software, and it improves transparency, and it also increases accountability of the employees, because they know that now they are in surveillance. So if they'll pass an entry which goes wrong, so their name can be easily displayed in the audit log or through the audit trail feature. So here is basically an example of audit trail that goes in the practical life, but we won't be indulging into that. However, if you want, you can get or however, if you want, you can just check out this diagram. The revision notes would be made available to you, so if you want, you can check this diagram in detail. But apart from that, there is no necessity of doing so for examination. Now, where is the requirement stated in the Companies Act? So Rule 3 Sub-Rule 1 states that every company is mandated to make the audit log feature switch on from 1st of April 22. The benefits of audit trail are that it increases users accountability, it promotes organization data security, it allows reconstruction of events, and it also involves detection of system inference and errors. So hello everyone, I hope you people are back from a wonderful break. Before the break, we completed the revision of basics for auditing subchapter 4, and now we'll be doing the Q&A of this chapter. It doesn't contain a lot of questions, just 2 to 3 questions. So we'll quickly wrap up these questions and then the marathon. So the first question is, what are analytical procedures, and discuss the tools and techniques of analytical procedure. So what is analytical procedure? So analytical procedure basically means evaluation of financial information through analysis of plausible relationship between financial and non-financial data. Now, what kind of the data can be compared with financial information? So non-financial information can be compared with financial information. Apart from that, budgeted and forecasted financial statements or budgeted or forecasted records can be compared with financial information, and the financial statements of the entity can also be compared with other entities of the same industry. What are the tools of applying analytical procedures? So trend analysis, reasonableness testing, ratio analysis, and sources of information are great tools to apply analytical procedures. Next question is a 4-star question. Explain computer auditing. So now you might find the answer a bit weird. So herein they have given the answer from the control point of view. They have basically written that how computer auditing helps the auditor in testing of controls and substantive testing, and helping the auditor know about the items of financial statements. So basically herein they are talking how evaluation of internal control and substantive testing, that is testing of each item of financial statement, has been made easier with computer auditing. The acceptable view is to evaluate the controls in computer information system, and then decide the nature, time, and extent of substantive procedure to be followed, and make use of computer conducting compliance tests as well as substantive tests. And the auditor must have a sufficient knowledge of the compiler system, even in certain case specialized skills in operation of computer system. That is, to do every testing, the auditor himself should have all the knowledge that is required in relation to the computer system. Now, this kind of answers are a bit weird answers, and they do not usually appear in the new syllabus. Like, I have not seen this kind of question in syllabus 2016 or syllabus 2022 a lot. Like for 2016, I have seen it come in like 1 to 2 terms, and in the prior syllabus, that is even the previous syllabus and syllabus 2016, this question used to come a lot. But yet again, important question, it's a 4-star question, so you must know and you must memorize at least the answer of this question. So if this question comes in your examination, you will be able to answer it. Next, state the purpose of audit trail, which is a part of computer information, 4-star. So this is an easy question. How does the audit trail help an organization? So audit trail helps to protect the entries from unauthorized access. It increases accountability of your employees and accountability of staff. It serves as an indication for upcoming system inferences, failures, errors, if any. Data retrieval is very easy. It helps to record every transaction of every user. It helps to avoid viruses by protecting the system from unauthorized alteration and unauthorized user. Also, it helps to obtain an understanding of operation of customers of the entity. So audit trail is not just limited to the users or employees of the entity. It can also track the behavior of customer of the entity. So if the customers are trying to do any cyber attack or any other crime, even that can be detected from audit trail. So there are two inferences to these kind of trails, wherein one inference deals with the backend kind of data, wherein it records the transaction and it records the name of all the employees. It also does it for the consumers, and if the consumers are trying to inject certain viruses or doing any cyber crime, it makes the entity alert about that. So that is it for this chapter, and that is it for the marathon. I hope you enjoyed this marathon. There will be a link given in the description box which will contain all the questions and all the revision notes that we covered in this marathon, and I hope you really feel confident in audit after this. And I can guarantee it for sure, if you have read audit once, then this marathon is all you need to do. So once you revise through this marathon, you are done with most of the questions, and you are done with 100% coverage of institute module. So there is no other revision that you need to do. Just one requirement, that cover the syllabus at once by yourself and then watch this marathon, because we all know that revision videos do not help if we have not even studied the subject once. So study the subject once, and for revision video you can very much use it, and this can prove to be a great revision video just before your examination. So that was it for this video. If you like this marathon, do like, share, comment and subscribe. And if you want any such more videos from us, you can comment down below. Thank you.